it will watch for the incoming data and assess the impact of recent global developments before changing course.
And ITC reports first quarter results that were weaker than expectations. The cigarette volumes dropped 5 to 6%, but that was less than the feared 8 to 10% drop. The FMCG and paper division performed well, while for Maruti it was a mixed quarter as volumes remained strong, but margins saw a sharp contraction of over 300 basis points. And contrary to what the oil prices are reflecting and the US futures are showing on your screens as well, the Asian markets have started off on a mixed note. After the kind of frenzied moves that we saw on Friday, the Japanese markets and the South Korean markets both are taking a bit of a break, although the Taiwanese index and the Hang Seng are trading with gains of around 0.5 to 1%. But the Kospi is down close to 5% this morning, and that is after it moved up 18% earlier in the day, on Friday that is. And well, the Nikkei is down close to 2% as well. So the Nikkei and Kospi, of course, in a world of their own, taking some profit booking after Friday's moves, while the rest of Asia is doing fairly well. But the bigger headline from Asia this morning is from the currency markets, and that is after the Japan and United States have conducted a rare coordinated intervention to prop up the yen. Now, this joint effort is the first in the last 15 years where the two nations have acted together in the forex markets. Now, the yen last week had fallen to levels of 163.73, and that was the lowest level since 1986. That was driven by widening interest rate differentials between the Fed and the Bank of Japan. Now, the weakness in the yen has pushed up import costs, fueling unwelcome inflation. Now, this move, this intervention has calmed some fluctuations in the Japanese bond yields as well, and tempered demand in the safe haven US dollar. Now, the two countries have also signaled that it is prepared to act yet again if need be, saying that it will not hesitate to conduct further coordinated interventions in the future. And as a result of that, you can see that the yen is now down to 156.5 as we speak, compared to 164 levels that it had surged to as early as last Thursday. So at least the big news from Asia this morning is from the yen intervention, Vinny. But the bigger development, of course, can't not say anything more than Donald Trump.
Absolutely, eating a lot of tacos over the weekend, every weekend, that's the story. But let's keep it going, and now getting you the updates from West Asia. US President Donald Trump says that an agreement with Iran is imminent, and with the negotiations set to begin today. In a post on Truth Social, he said that he had agreed to call off a planned military strike on Iran after Tehran and other regional governments requested a pause. Now, saying that the parameters of a deal had been agreed upon. Later, he spoke to reporters about the Air Force One on the matter. Let's listen in to his comments.
I was asked to by Saudi Arabia, by UAE, by Qatar, and by Iran. We were all set to go just about at this time right now, and it would have been a massive attack. We're all set to go, but when the allies ask to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. There's a deal on Hormuz, and then there will be a deal on the nuclear, or you might call it the denuclearization of Iran. Well, now what we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that, save a lot of lives, save a lot of unnecessary power, to be honest with you. It would take many, many years to ever build it back. If it could, I don't think it would be even buildable back. So we had an attack that would be the biggest attack since World War II, and it would have been disastrous for them, and they didn't want us to do it. And frankly, Saudi Arabia didn't want it either. They thought that a deal is imminent. And the deal is imminent, having to do with the Hormuz Strait and also ultimately the denuclearization of Iran.
Meanwhile, Iran's president urges the U.S. to remain committed to the MOU signed between the two countries in June, says the interim deal will be the center of gravity of Tehran's foreign relations in the future. Additionally, Iran's foreign minister says that negotiations between Tehran and Oman on the future management of the Strait of Hormuz are in their final stages of the talk. Elsewhere, Israel says that there is no change in the policy towards Gaza despite Trump's announcement of a roadmap to implement the second phase of peace deal, including Hamas disarming and Israeli troops withdrawing as well.
And let's set you up now for today's trading session. Our research team is here with the trade setup, the stocks that should be on your radar, and of course the setup on the F&O side of things as well. Firstly, Sonal is here to tell us all the market cues that we need to watch out for. Sonal, good morning.
Good morning, Hormiz. Well, a lot happened over the weekend yet again, and we are seeing the impact on GIFT Nifty Asian markets. However, let's talk about what happened with the US markets first up. All the key indices, they closed in the green. It was majorly driven by earnings as well. So we did have Dow, S&P, NASDAQ all up anywhere between 0.4% to 1.2%. Amazon stock surged after better than expected earnings, so it was up anywhere between 10 to 11%. We did have Apple stock that declined due to shortfall in services revenue. It was a good set otherwise, but the street did not like that small disappointment. If we talk about the bond markets, a lot is happening there as well, because the 30-year Treasury yield jumped to the highest level that we've seen since 2007, and 10-year Treasury yield jumped to the highest level since Jan 2025. You guys have been talking about it, where Donald Trump has cancelled the planned attack on Iran, says he has reached an agreement over the perimeters of the deal as well. Crude oil prices are below that $84 per barrel mark as we speak, after surging beyond that $90 per barrel mark over the last couple of weeks. Asia, quite mixed. We are getting mixed cues where the Japanese markets or the Korean markets, they are in the red. The others are seeing some green, but the GIFT Nifty is indicating a higher start for our own markets. The last time I checked, it was up around 190 points. For our own markets, last week was the biggest weekly gain that we saw in almost 4 months. There is some positive momentum which is coming back. Now the Nifty has a resistance at 24,500 to 24,550, while the support stays at 24,000. Cash market buying continues from FPIs. We did see FIs net by 278 crores in cash. DIs also bought around 20 to 50 crore rupees in cash. FIs net bought both in index futures and index options as well, between 450 to 2150 crore rupees. Other than that, we do have some positive macro news. For instance, RBI indicated that from the FCNR deposits, they've been able to garner more than $40 billion of flows. July GST collections were up 15.5%. However, Bloomberg has deferred inclusion of Indian bonds in global index. So that is a bit of a dampener. But other than that, the macro setup looks strong.
Okay, macro setup looks strong as of now. Those are the cues that we're keeping an eye out on in terms of the markets. But let's take you all through the important stocks to watch out for in the trading session. We have Maruti that first up reported in terms of volumes that remain strong at 29%. Numbers were quite muted this time, but volumes, that's where the growth, the good volume number is something that is positive. Margins that came in at 8.2% versus expectation of 12%. All in all, muted numbers, watch out for that one. IOC, when you look at it in terms of numbers, revenue has seen a growth of 26%. EBITDA has seen a growth of around 91% as well. And in terms of overall performance of the company, the numbers were better than what the street was expecting. So it'll be interesting to see where that's going to be headed. Overall, the core GRMs also came in at $19.19 per barrel in Q1 FY27 versus a USD of 2.2 billion barrels per USD in Q1 FY26. ITC overall results were weaker than expected. Cigarette volumes came in at a decline of 8 to 10% decline is what we saw. And estimate was a decline of 5 to 6%. So it's a bit worse than that. So we could see a bit of a red opening that comes in for ITC. On the finance front, we have Muthoot Finance that reported its Q1 FY27 numbers. Margin normalization is something that led to a sequential profitability, lower sequential profitability. Net interest margins, NIMs of the company, that have seen a decline of around 220 basis points. A bit of a concern on that front. 10.4% is what the NIMs came in at. Let's talk about Persistent Systems. The Persistent Systems overall numbers, constant currency revenue, that's come in at around 3.2% to 3.5% in that range. EBIT margins have come in at 16.5% as well. So not a bad number that's coming from Persistent System. Blockbuster numbers coming in from DV's Lab. Q1 FY27, strong performance in terms of EBITDA margins, revenue growth, overall good performance, green expected here as well. ABB India, a bit of a mixed quarter, bit of a pressure that we're expecting to see in terms of margins going forward as well due to inflation and forex. So that could be some bit of a pressure there. Urban Company revenues have seen a good growth of around 44%. Net transaction value has seen a growth of 42%, so watch out for that one. Nalco, good growth in terms of Q1. Highest ever bauxite excavation is what the company has seen as well. And Z Entertainment, that gets a nod for preferential issue of warrants, so that will be also something that we'll be keeping an eye out on. Though To not forget that Puneet Goenka as well as Subhash Chandra are barred for 1 year from the securities market. So we'll be watching out for Z Entertainment. Maybe a bit of a mixed move is what we could watch there.
Oh, plenty of stocks, lots of them to keep on your radar. And while Vinny has a glass of water, we'll have Sudarshan joining in with cues from the FNO space. Sudarshan, good morning. Is today finally the day that we cross 24,500 and sustain above it?
Good morning, Ramas. Do you know, till the month of June, there were 37 times when Trump has said deal with Iran is done or we are closer to the deal being done. Now that number has increased to almost 50 times. But coming besides that, just talking about our market, over the last few days, we have seen a good rally. Now the big question is, can Nifty hit the swing high of 24,600? If you go by the indicators, all the indicators are suggesting that in all probability today, Nifty will open near 24,500, and from that level, we might move higher because crude, you can take a look, it's now below $85 per barrel on the commentary related to the West Asia tensions between US and Iran, and both of them are closer to the deal. Next positive part is the rupees appreciation against US dollar. Now rupees at almost 1 month high. We are trading around 95.40. Two sectors that will remain in the focus today as well. One is IT. Over the last few days, we have seen a good move. And today, after looking at all the chip names, we might see another up move today as well. Second sector that will be in the focus is the financials. Most of the companies that have reported earnings so far, with few exceptions, most of them have reported a very good set of numbers. Now, GIFT Nifty, it's suggesting an uptick of almost 160 to 170 points. Now, talking about FI's flow, both in the index futures and in the stock futures, they were buyers on Friday. Even they have added long position. Addition was just minus 320, but good part was the reduction in the short position. And there, it was more than 13,000 contracts. Now, longs exposure has increased to 11%. Come to the options data. On the put side, 24,400 and 24,450. And on the call side, 24,400. So 24,400 was the biggest active or most active option on both the sides, put as well as call. So it tells you that on the downside, 24,300 to 24,000 might be protected, and on the upside, 24,400. So first support around 24,300. Next support comes around 24,130. That's your 20 DMA. Resistance will be 24,600. Some of the stocks that I'll keep around first and Muthoot, very weak set of earnings. And let's see how the stock moves. CG Power on Friday has seen fresh addition on the long side. And last one, capital market names BSE over the last few days has started seeing addition on the long side.
Okay, Sudarshan, thank you so much for that. Important will be those support and resistant levels for our market. So thanks so much for that. But on that note, we're going to spend a very short break. After the break, we'll come back with cues from Wall Street. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now let's shift focus and talk about the US markets. Wall Street indices ended higher on Friday. The Dow Jones posting a marginal gain, even as the Nasdaq and S&P 500 closed out this month in the red. Though Thursday's post-bell earnings, what we saw coming in, sent mega caps in opposite direction as well. So it'll be key to watch out for. And to give us those highlights coming in, we have CNBC's Georgia Bell, who's going to take us through a wrap on what happened on Wall Street.
U.S. markets were up across major indexes in Friday trading as the Nasdaq and S&P finished down for the month, while the Dow posted marginal gains. Massive moves in opposite directions for two mega-cap stocks on Friday. After Apple and Amazon reported earnings after the bell Thursday, Friday's session saw Amazon shares soar 15% on massive cloud sales growth in its cloud business, reinforcing investor confidence in its AI spending. On the flip side, Apple fell 9% despite beating the street's expectations on earnings and revenue. The company, which briefly hit $5 trillion in market value earlier this week, issued cautious guidance because of surging memory costs and supply constraints. And FIFA President Gianni Infantino's plan to sell part of the World Cup's commercial rights to private equity investors continuing to collapse amid backlash. Carlos Cordero, a former Goldman Sachs banker and key advisor to Infantino, resigned in protest Friday, saying he opposes the plan unequivocally. That resignation came after several soccer federations around the world blasted the idea, and Europe's governing body threatened a complete boycott of FIFA events. FIFA issued a statement Friday acknowledging the global backlash and pledging a, quote, commitment to an open and democratic consultation.
Georgia Bell, thank you for that update there. Staying with Wall Street, listening to some market experts and economists on the road ahead.
Much borrowing going on, and that the economy is running hot, and so bond yields need to be higher, and so therefore I think bond yields are moving north, and 5% could be a very critical mark on the 10-year. But I think if we get above 5%, then this whole AI bubble would even burst. If you end up getting the 10-year above 5%, if you look at every single bubble in history, it requires higher interest rates for those to burst. So if you end up getting the 10-year above 5%, I think it's a pretty good chance that the AI bubble unwinds.
We already have a pretty hawkish call. We had the Fed hiking September, October, and December of this year prior to the Fed meeting. So we think we're very happy to stay there for now. I kind of agree with the idea that the market could force the Fed's hand. The data could force the Fed's hand. The market question, though, is really interesting, right? Warsh was very, very dovish. Bunch of comments he made kind of got the markets thinking, okay, are we muddying the waters around inflation credibility? And that's what led to the move in the long end, right? And we know that the other 18, we don't know what Warsh thinks, he doesn't like to tell us, but we know that the other 18 put a lot of weight on inflation expectations, on credibility. If they start to see risks that expectations are getting unanchored, then I think the bar for them to hike in terms of the next 2 months of jobs data and inflation data comes down meaningfully.
Okay, now on that note, we're going to slip into a very short break. After the break, we'll tell you how the auto sales numbers were looking like this time for the month of July. Stay tuned in for that.
Welcome back. Now, auto sales data for the month of July has come in stronger as expected. Let's go across to Sudarshan for all of those highlights. Sudarshan, back to you.
Like non-stop rains in the city of Mumbai, we are seeing non-stop selling of everything you name in the auto segment, whether it's car, bike, tractor, or even commercial vehicle. All the segments in the month of July have seen double-digit growth, and this month, July 2026, has been the biggest ever July that auto sector has seen. And on the back of that, let's take a look at all the numbers. So first one about Maruti Suzuki, strong set of number, highest ever monthly sales, highest ever production that company has seen, and total sales have seen an increase of 34%. Domestic continues to see an uptick, and this month also has seen an increase of 42%. SUV sales 50% increase. Entry-level segment for the second straight month has seen an increase of almost 90%. Exports though saw a minor fall of 5%. Next one is Hyundai. After a strong set of Q1 numbers, company has reported highest ever monthly sales. Total sales have increased by 25%. Domestic sales have seen an increase of 23%, and export sales were highest ever in last 100 months, and here sales have increased by 31%. Mahindra & Mahindra, both auto and tractor segments have seen a growth of more than 20%. Auto sales were up 26%, SUV sales have increased by 20%, and LCV between 2 to 3.5 ton sales for this have increased by 21%. Tractor April to July sales have increased by 18% versus FY27 industry growth estimate of mid-single digit. And just if we talk about July domestic sales, that was up 21%. Hero Motors sales were largely in line. Sales have increased by 19%. Eicher Motors too reported sales largely in line. Both segments up to 350cc and more than 350cc have posted healthy growth. So far, whichever companies have reported numbers, they have seen a very healthy growth.
A very healthy growth. Sudarshan, I'm assuming you were also a contributor to that, for all the auto sales growth in that. But thank you for that update. Keep auto stocks on your radar as well. Now, the currency also is going to be in focus after the RBI on Saturday announced that it has received over $40 billion via the FCNR deposits, the OFCBS and the ECBs as of the 31st of July. Lata is joining in with more on this. Lata, good morning.
It was a surprise announcement from the Reserve Bank on a Saturday, saying that 40 billion has come in all, and the breakup is as follows. 36.7 billion came in via the FCNRB deposit route. 2.5 billion came via what they call OFCBs, that is overseas foreign currency bonds taken by banks, and 1.5 billion via ECBs, which we all know, external commercial borrowings. Now, the news is positive because if you remember, it was 20 billion as of July 20th, when the first announcement came. So that was 5.5 weeks, you got 20 billion. In the next 10 days, you've got another 20 billion. Now the market is expecting an accelerated flow in the remaining 2 months because you can bring in money all the way up to September 30th. And even in the previous time, in 2013, when such a scheme was announced, a better part of the flows came towards the end. So now 80 billion is seen as a given. And then the OFCB and ECBs are open till December. So, you know, it can go well over even $80 billion. Again, the dealers pointed out to me that it is surprising RBI said it on Saturday when normally the central bank is closed. It looks like there is an intent on the part of Reserve Bank to talk up the rupee, also to, walk the talk, because for the last 6 days, dealers have been telling me that the Reserve Bank's dollar sale has been fairly aggressive. So there is an intent on the central bank to push up. Plus the other, this morning we are waking up to crude prices lower by about 3%, and dollar index, mind you, has gone below the 100 mark. It is about a 1.5% fall in dollar index as well. And the dollar rupee in the NDF market is giving us an indication that it may open at a 3-week high of 95.20 per dollar.
Okay, thank you so much for that, Lata. But with that, we're absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me my colleagues Rima and Nigel. Guys, good morning.
Hi, good morning. So GIFT Nifty up more than 150 points.
Yeah.
This is over and above the 600-point rally that we had last week. And the domestic cues are positive. Crude is down to $84 and below. Auto sales numbers double-digit across various segments. GST collections have inched up 15% in the prior month, year on year. So it's looking good. Good start to the week.
Well, that's right. Good start to the week. It's hopefully a good start to the month, and it's going to be a big month, Rima, because I believe somewhere during the course of this month, we get a big party coming in for Prashant.
Yes.
So the birthday month, Prashant.
And it coincides with Shireen, so which is why expectations
Absolutely.
are very,
Because
very
there
high.
was so
Delhi
much,
to Bombay.
Rima put in so much about crude, GST, things looking up. I said, let's lighten the mood. Prashant's birthday, we're getting ready.
Keep it light because it tends to get heavy through the week.
Gonna get party.
I think. Okay, well, let's take it from the top, right? In terms of where we are at. Oil's down 7%, and it's a sharp drop. 83, 84 on oil after 90 on Friday. And, you know, I was saying this on Friday, you don't know how you're going to come out the other side of the weekend. It could be up, it could be down. There were threats of big strikes, the biggest ever since World War II. And well, guess what? It's fizzled out, nothing, pulled off. So, you know, that's the kind of place oil markets and then, I mean, consequently equities, etc., risk sentiment is flippant. Now, Trump essentially said that he's called off the biggest military attack since World War I on the request of allies. So that essentially was the justification given. And he essentially said that US would re-engage or engage in talks with Iran starting Monday afternoon. That is today afternoon. Talks perhaps are back on the table. Talks will start again. There's also initial signs of diplomatic moves which came through yesterday. So Iran's foreign minister said that talks with Oman, which is essentially the other country on the other side of the Strait of Hormuz, talks with Oman about a mechanism for the Strait of Hormuz was nearing completion and in their final stages. You know, what this leaves out is whether Iran is still determined to collect a toll for all ships which pass through the Strait of Hormuz. By the way, there is also a reportage over the last 3-4 hours that, you know, oil tanker, you know, basically a ship or two has been fired upon, but maybe not on target. These are ships which were not passing through the route which has been prescribed for ships through the Strait of Hormuz by Iran, and they were trying to pass through with, you know, through other routes. So it's a fluid situation right now, but the market seeming to believe that you know, the escalation will come from from the US, from President Trump, and that escalation so far has been held off. It doesn't mean he can't change his mind, as we've seen so many times in the past, that this is not working, and you know, we're gonna hit them very hard. I mean, his words that we've heard over and over the last 5 days or so. Now, I'll just leave you with the US market session on Friday. Nasdaq was up 1%. The 30-year. If you look at the 30-year yield, that jumped 6 basis points to 5.28%. That's a new 19-year high. So, you know, you may wonder what's happened. Is there something afoot? I mean, I think the big talking point was that Fed meeting, and more importantly, the commentary from Fed Chair Kevin Warsh, the new Fed Chair Kevin Warsh, you know, lots of doubts, lots of write-ups, lots of commentary around whether Kevin Warsh is trying to move the goalpost here with regards to not accepting what is being commonly used as the preferred gauge by the Fed to measure inflation in the US, which is PCE, whether he's going to change all that up. And there is a committee, by the way, which is appointed by Kevin Warsh, which is looking at all of this, whether that is just an excuse to get what he wants. So bond markets are not having none of it. We had, for example, Ed Yardeni last week, right after the Fed decision, who also said that, you know, bond markets are in a way at some level revolting, and I mean they're marking to market some of what is happening as far as the Fed is concerned. So basically, Warsh acknowledging inflation, but absolutely nothing on the table in terms of what he's ready to do if he's willing to do something. Now, July auto sales were strong here in India, and Sud will talk more about that a little bit. So, Hyundai, from Hyundai to Maruti to Mahindra and Mahindra. But, I mean, numbers were expected to be strong. And just one more data point. This came out 2 days back, but loan growth data, this is the, June non-food credit, which has grown 18.3%. In the month of May, that number was 17.4. Guess what? The number was June last year. It was some 9%. So, and this has been the thesis for a lot of people for auto sales to be looking very good, which is that credit demand has picked up and inflected in a meaningful way. And I think this shows up not just in auto sales, but many other areas as well. One more piece of information, which I think was good, which is $40 billion, almost $41 billion has been taken in through all these swap schemes by the RBI. So far, this is data as of the 21st of July. So this number also is going to, in terms of the full estimate, because the schemes end on the 30th of September, so there's still time, a lot of time. So the total number could be much larger compared to what initially markets thought it will be. So this is money in. This is, I mean, I just want to say one thing, right? I mean, the number is positive and all of that, but this has to be repaid. Depending on what tenure this is coming in. Most of the money, I think, is coming in a 3-year window, not the 5-year window, but this has also got to go out. So, but anyway, I mean, for now, this is positive, and it'll perhaps show up on the currency as well. I'll just leave you with levels. Nifty resistance is 24,500 and 24,800. These are the two numbers which you need to watch on the upside. There's a channel support for the Nifty at 24,375. And below that, I mean, a break below that would mean that 24,220 and then 24,170 perhaps come into play once again. We left off at the channel support of 24,375. The close was 24,383. So, I mean, supports are basically, so I don't think we get to it. The GIFT Nifty is indicating it'll come up on your screen, a pretty healthy start. We'll just see if you're able to build on it. 164 points higher is the indicative higher start on the GIFT Nifty. Nigel has walked across to the wall with the F&O cues, positioning and more. Nigel, take it away.
Well, the GIFT would be suggesting a nice positive start. And the big question is, are the pieces coming together for the Indian markets? Well, the bulls will really hope so. Let's run you through a few factors. As you said, Brent crude prices have cooled off. And it's good to see that Brent is now closer to around 80 rather than close to around $100 per barrel. Next up, the RBI says that the dollar swap facility has already received close to around $41 billion so far, with the FCNR-B deposits accounting for a lion's share. So now the total foreign inflows could approximately be around $80 billion, which is much higher than earlier thought about that $50-60 billion odd. Now that's good, and that's particularly good for the Indian rupee. So after showing some strength in the last few days, the Indian rupee could continue to show some strength even in today's trading session. The dollar index as well I saw is a little bit softish, and Brent crude prices have cooled off. The FI flows, well, that's heartening to see. After months of selling, the FI flows have finally turned positive. 20,000 crores of inflows. Well, the bulls will be very, very happy. After close to around 4 months of aggressive selling, we finally have a buy flow. Well, we'll be hoping that this is not a flash in the pan, and hopefully this trend will continue into the month of August as well. And finally, with regard to earnings, I was looking at a Motilal Oswal note. They have analyzed the earnings of 39 Nifty companies that have already reported, and they're saying that the earnings growth actually has been close to 11% in comparison to around 7%. Not just that, they say there are more upgrades than downgrades. So on the whole, Q1 FY27 earnings have been better than expected. Getting to the year end now, then in terms of flows, the FI flows, well, they turned a little bit positive. It was close to around 277 crores, and the institutional number on the whole was positive. That's good to see. What about the F&O market? Well, the FIs, they went ahead and they covered shorts, both on index futures as well as on stock futures. So the short squeeze does continue. Keep in mind the short positioning continues at around 89%, but in absolute terms, that number has come down, which the bulls will be quite happy to see. So there has been some bit of a short covering bounce that's taken place, but yet the short positioning continues at around 89%. Well, we'll move to the options data then. The FI is not just covering shorts. They're going ahead and they're writing puts, which is giving hope that in the near term, maybe in fact those lower levels at around the 23,600 may not be revisited. And because of this kind of action we have seen on the put side, the PCR has moved up to around 1.4. Remember, the upper end of the range is around 1.6. So that's going to be important to track. For the time being, it still has some distance to go, but gradually we have moved up from around that 1 all the way to around 1.39 or thereabouts. So looking at the options data, looking at the technical levels as well, I'm going to tell you the levels that we're looking at just in the near term. The 20 DMA, that becomes the first reference point on the downside. So that's going to be important. The bulls will not want this to breach on the downside. The 200 DMA, they'll be hoping that, in fact, this move towards the 200 DMA is well and truly on once we get past that 24,500, 24,550, which is the first level of resistance. And finally, as I said, the Nifty Bank has been looking pretty okay. The IT index as well has been coming into its own. But Reliance Industries, that could be the stock that could lead the bulls from here on, because it showed signs of coming back into its own. It crossed the 20 DMA as well, and the bulls will want it to maintain the momentum. So GIFT Nifty suggests a positive start. Let's see whether or not you can drive home the advantage.
Thank you very much for that. And it's a big week coming up. Nearly 550 Indian companies report numbers with 4 Nifty heavyweights. It's SBI on Friday. You've got Bharti Airtel, Titan and ONGC also reporting numbers this week. And then the big RBI MPC minutes. But let's get you the latest from the updates from West Asia. US President Donald Trump says an agreement with Iran is imminent, with negotiations set to begin today. In a post on Truth Social, he said he had agreed to call off a planned military strike on Iran after Tehran and other regional governments requested a pause, saying the parameters of a deal had been agreed upon. Later, he spoke to reporters aboard the Air Force One on the matter. Listen in to his comments.
I was asked to by Saudi Arabia, by UAE, by Qatar, and by Iran. We were all set to go just about at this time right now, and it would have been a massive attack. We're all set to go, but when the allies ask to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. There's a deal on Hormuz, and then there will be a deal on the nuclear, or you might call it the denuclearization of Iran. Well, now what we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that, save a lot of lives. Save a lot of unnecessary power, to be honest with you. It will take many, many years to ever build it back. If it could, I don't think it would be even buildable back. So we had an attack that would be the biggest attack since World War II, and it would have been disastrous for them. And they didn't want us to do it. And frankly, Saudi Arabia didn't want it either. They thought that a deal is imminent. And the deal is imminent, having to do with the Hormuz Strait and also ultimately the denuclearization of Iran.
Okay, for now, it's a pause on the escalation in Middle East, and there is cheer on, at least in the crude markets, but there is a surge in the bond yields. In fact, let's get in our next guest on the show to talk about the way forward for global markets, Stephen Englander, Managing Director, Global Head of G10 FX Research and North American Macro Strategy at Standard Chartered Bank. Thank you very much, Stephen, for joining in. The US 10-year yield, 4.7%, the 30-year yield hitting its highest level since 2007. Does this set us up for a September rate hike? Is it a big macro worry? Because higher yields also complicates the AI rally because it's increasingly getting funded by the debt markets.
Well, those are a lot of questions. I think it may not be needed to have a hike in September if the PCE numbers are friendly. We have 2 more before we get to the September meeting. And, I think that one of the things that has the market worried is that war is
I think we lost the line there. Steve, can you hear us? Steve, can you hear us? I think we lost the line there. So maybe, we'll try and have him back in just a bit, connect him back in. Just a quick look at what's happening with Taiwan and Korea, because those were markets which rebounded towards the end of last week. Friday was pretty consequential, 18% I think on KOSPI, 18% that is. We should actually have Taiwan and KOSPI together on one plate. KOSPI is down about 3.75%, and I think Taiwan is the other one, which is up about 1.5% or so as well. So, today, singing and dancing to their own tune in that sense. Despite this massive move, it was a pretty bad month for KOSPI and Taiwan as well. So far it's quite incredible. The average move per month in 2026 on the KOSPI, the average is about 21%. So I mean, it's just unbelievable what we've seen. I think Steve is back with us. He was talking about the US 30-year sort of spiking. I think we lost you there, Steve. Take it away. Go on.
Yeah, my bad. Thank you. Look, I think that the 30 years being pushed up because of Warsh's reluctance to talk about anything that would make him raise rates. And I think there's a case that he won't have to raise rates, a legitimate case, but he's not making it. What he's trying to do is avoid the subject entirely. And that's worrying the market. In addition, keep in mind that this week we get the from the Treasury and from the Treasury Borrowing Committee, their assessment of U.S. government borrowing needs. And that could be the most important data point of the week, because there is some fear in the market that between defense spending and non-defense spending and demand from AI, that credit demand is just going to keep on going up. And we're sort of in that school. We don't think that they necessarily will be hiking at the short end because inflation might turn out to be okay. But we think that the credit demands at the long end mean that, even 470 is going to be pretty low, that the risks are that the 10-year goes close, higher and approaches 5.
Got that. Steve, the Treasury intervention in the yen market, just explain that for our viewers and us. I mean, what does it mean and how unprecedented is this?
Well, it's a funny sort of intervention, right? Because, you go to a dance, you dance. You don't, announce in advance what partners you're going to have and what you're going to be doing. This was very choreographed. And, the intervention on the part of the U.S. wasn't that big. It was, 5, maybe 10 billion. Our understanding is Japan has been doing much bigger clips than that. But I think the market is intimidated. This is the first time that the U.S. has done a directional intervention, for kind of macroeconomic currency adjustment purposes in a long time. So I think that Besant has a lot of respect. On the other hand, the question always is, what do you do next? Does the market really believe that anything is changing in Japan? Is the Bank of Japan going to raise rates to support these moves? I think that over time, the demonstration effects from interventions, particularly if the U.S. interventions are kind of small, when you look at it, they'll wear off. But for now, those are very powerful impact on the market. And you're seeing even that some of it spilling over into other Asian currencies. Like after the first intervention on Thursday, nothing much happened. Even on Friday, nothing much happened. But today you're beginning to see some catch up from some of the other currencies. And it's possible that that's actually Besant's hope. That the JPY isn't like the US's trade problem and currency problem. The US's problem is Korea and Taiwan and other currencies. And it wants to get JPY stronger because that will enable these other currencies to get stronger along with it.
You're saying they've spent a total of $6 billion or so far, from what you understand. The US, that is.
Yeah, they said 5 to 10 on the US side, but the Japanese have done a lot more, multiples of that.
Of course. But I mean, and the strategy seems to be more talk, less bite at this point, but it's working so far. As you said, markets perhaps are a little intimidated for now.
Yeah, but you intervene at literally 4:15 on a Friday afternoon. That's a very illiquid part of the market. So you have to see if that sticks. I mean, because it often that's not seen as a sign of strength if you're intervening when half the people are on the way to the beach. So today it looks pretty good. Let's see what happens as the week progresses. I suspect that they'll have to keep coming in if they want to keep the the impact.
Any view, Stephen, on what the RBI might do this week?
We think they're going to hold. We don't think that they're going to move. The economy, the data are mixed, but there's nothing there that screams for them to deviate from their path, I think.
All right, Stephen, we'll leave the conversation here. Thank you very much for joining in. There's also that interesting article in New York Times about where Kevin Walsh perhaps is considering a proposal to reduce the number of FOMC meets. Currently, the FOMC meets 8 times in a year. The bare minimum requirement is 4 times. So this is what New York Times has reported. Will it add to the volatility? Stephen was talking about the reason bond yields went up is because Kevin Walsh's reluctance to perhaps give a forward guidance. So if you reduce the frequency of the FOMC meet, what this means. Well, that's on the global setup. Let's tell you the interactions lined up on the show today. Coming up 8:35. We have MC Cube's V. Shanmugam to discuss the new market closing rules effective starting today. At 9 a.m., Jinesh Joshi's of Prabhudas Leeladhar will talk about the Z preferential issue and the SEBI order on the stock and more. 9:20, Pankaj Tibrewal of Ikigai Asset Manager will be a market master for the day. 9:30, the management of Muthoot Finance will break down the Q1 numbers, the margin miss, the profit decline. Following that, the management of Shree Cement will chat with us at 9:40. 9:50, we will speak with the management of Dixon Technologies. And again here, there has been a sharp margin contraction. Towards the end of the show, Lata discusses the future direction of the rupee and rates with Mithil Kotecha of Barclays and Abhishek Upadhyay of ICICI Securities.
Time to slip in a short break, but we've got a lot of stock-specific action they're going to be tracking for you in a top 10 segment. Let's run you through the list. Indian Oil, Divi's, Urban, Company as well as Nalco, they'll all four react to positive news flow. Flip side, Maruti could be under some pressure. Added to the list, ITC, Muthoot, ABB India and Z Entertainment as well. While Persistent Systems could see a mixed reaction. Take that break, come back, get into further detail on all of these names.
Welcome back. Our research team is standing by with CNBC TV 18's list of top stocks for the day. So many earnings to go over. And Sudarshan has auto sales as well. But Sudarshan, Maruti numbers?
So Maruti's numbers for Q1 FY27 can be divided in two parts. Positive volume has remained strong in Q1 FY27. Total volumes have seen an increase of almost 29%. And the second part is company continues to gain market share in the domestic market. In Q1 also, it has gained by more than 200 basis points. And the last one, entry-level segment demand remains very strong. But the negative part is that company has changed the settlement cycle from quarterly lagged settlement cycle to monthly settlement cycle. And that had an impact on margin. And also because of sharp increase in commodity cost also, we have seen an impact on the margin, and total impact on the margin was around 300 basis points. And because of certain measures that company has taken, it has managed to offset that impact by only 60 basis points. That's the reason there is a sharp fall in the margin. Talking about the headline numbers, revenue has increased by 36% on the back of very strong volumes. EBITDA was down 7%, while our expectation that it might see an increase, and margin has fallen to 8.2%. Our expectation was around 9.8%. So due to sharp reduction or sharp fall in the margin, and also because they are also only saying gradual coming back to the quarterly cycle, we are going with red. But as far as the outlook is concerned and the July sales are concerned, they remain very strong.
Got it. All right. Thanks a lot for that, sir. Well, let's hop across to Sonal. She's here to tell us about IOC's numbers. Hey, Sonal, morning.
Good morning, Nigel. Well, much better than what the street was working with. Yes, it was a loss, but lower than the estimates. So revenues are up 26% sequentially, EBITDA down 91%, margins declined 900 basis points, and it was a net loss of around 2,600 crore rupees. But in the next plate, you will see it and compare it with the poll and see the numbers were much better. EBITDA was at 1947 crore rupees. The loss was just at 2,600 crore rupees. The poll was above 18,000 crore rupees. It was the refining segment that led to this strong beat. Their core GRMs came in at $19 per barrel, which compares with just $2.2 per barrel. They've also maintained their capex guidance for FY27 at 32,700 crore rupees. Additionally, they are looking at refining capacity additions, and that is why their throughput is guided to increase every year from 77 million metric tons to 85 in FY28 to 90 in FY29, which they say will give better margins as well. The marketing loss, of course, on petrol was high at 12.9, at diesel at 15.1 per litre. Going with green here also because crude prices are lower, so there could be some green on these OMCs today.
Well, thanks very much, Sonal, for that. Well, Mangalam is now with us. The volume growth on cigarettes is much better than what the market expected, a fear in that sense. Mangalam, take it away.
Well, for ITC, the reported results were weaker than expectations, but I expect the stock to see a big recovery in today's trading session, and that's largely because of a couple of positives. One, the cigarette volumes dropped lesser than feared. Secondly, we did see good performance coming in from the FMCG and paper business, and that brings us to the question, is the worst behind? And that's what brokerages are expecting as well. They've upgraded the stock. The revenue at shy of 17,000 crores. The street was working with a number of 17,350 crores. The EBITDA 4,500 crores. Again, the number was expected was about 5,000 crores, and the net profit at 3,600 crores. The expected number here was 4,000 crores. So across those parameters, these numbers go down as a miss. But the internals, the cigarette volumes declined by 5 to 6% versus expected 8 to 10% drop. The net revenue declined by 25%. The EBIT declined by about 35%. Here the expectations were a 25 to 35% decline. The FMCG revenue, that grew 12% versus expectations of 12 to 15% growth, and the margins improved by about 55 basis points as well. And then there was strong performance coming in from the paper business, where revenues grew by 9%, expected range was 3 to 5%, and the EBIT grew by 38% as well. Amidst all of this, remember the stock has fallen about 30% from the start of this year, and there were a lot of people expecting weaker set coming in from ITC, especially after VST and Godfrey's numbers. So perhaps there are a bunch of shorts in the system as well. At 17 times, most analysts say that all the weakness is priced in. So maybe opens in mild red because of the weakened number, but expect a sharp short covering rally on the stock.
Okay, thank you very much for putting the positioning also in context when it comes to ITC. Ananya now joins in to tell us Muthoot Finance. Ananya, here margins are a miss, lower than expectations?
Well, yes, there's a 300 bips compression this quarter, and which led to a sharp fall in profitability. It was the bigger disappointment here. PAT declined 17% quarter on quarter, while NIM fell sharply around 10.4% from 13.7%. Now, this was because as gold yields normalized to 18% and borrowing costs remained sticky here. If you look at the business growth, it was broadly in line rather than any major positive because of the sharp correction in gold prices and increased dependence on the physical gold tonnage here. And standalone AUM grew only 43% year on year, but only around 6% sequentially. Now, management said that FY26 had benefited from usually high recoveries, rollovers and top-ups, which are unlikely to repeat here. Asset quality was largely, stable. Management retained its FY27 AUM growth guidance of around 15% with a possible revision after the first half. Expects yields to stabilize around 18 to 18.5% and sees funding costs remain broadly stable here. But overall, the margins will be the key monitorable going forward, and also the gold prices.
Thank you very much for that. I'm looking at Persistent, and here it's a mixed quarter. The company's top-line growth has come in ahead of expectations, but margins have missed the mark. Top-line growth at 4.1% is ahead of consensus expectations of about 3.2, 3.3%. But margins have come in at 16%, a drop of 30 basis points sequentially and lower than street estimates. This is on account of an increase in direct costs and higher sales and marketing expenses. Lower margins coupled with a higher forex loss of nearly 100 crore have resulted in profits also declining for the company by 8.7% on a quarter-on-quarter basis. That said, growth is higher and deal wins for the company are strong. In the quarter gone by, the company had won a large 650 million new deal from a global tech giant. So the overall deal wins are in excess of $1.1 billion. So mixed quarter, strong on revenue, miss on margins. But I think one number which is unequivocally strong this time has been Divi's Laboratory. Ekta, give us your analysis.
Well, yes, absolutely. Surprisingly, very good set of numbers which have come in for Divi's. The revenue came in at a little over 3,000 odd crores, so that was better than expectations. But what really surprised the street was the margins, which came in at 40.7%. It's a multi-quarter high, best levels that we've seen since FY22. So that was basically the biggest surprise. The profit also came in at around 902 odd crores. Now, the street is estimating that maybe there's a possibility of a one-off payment during this quarter. However, the management going forward has maintained its double-digit growth guidance for revenue when it comes to FY27. And EBITDA margin, they're expecting it to be broadly similar to last year, which would be around anywhere between 30
Ekta, sorry to interrupt you. We'll come back to you. There seems to be some audio issue. Let me go across to Vinny for more on ABB India, and then we'll go back to Ekta.
Hi, so for ABB, it was a mixed quarter that came in from the company. When you look at it, revenue was above expectations, while margins and PAT was a miss that came in here. Order inflows, we've seen a 50% growth coming in here. What's interesting is that they still have a strong order backlog as well of around 11,900 crores approximately is their backlog. Now, con call highlights. Key highlights that came in, margin pressure obviously this time was there because of Forex, as well as in terms of commodity cost, inflation that came in, that was a big impact that came in here. Management is not given anything in terms of a timeline of when could one expect that mid-teens margins again coming back. So that's a bit of a worry there. Order book this time, mainly it was more base orders versus large chunky orders. So that will be interesting to watch out for. And overall, in terms of segment-wise also, where they saw strength coming in this time was mainly in the data center side of the business, where they saw good growth coming in. Renewable side of the business, that has seen a good growth as well. Weakness came in on the West Asia side of those businesses of theirs. That is the refining side, crude-linked products or developments that they're making on that front. That saw a sluggishness. Apart from that, there was they've taken two price hikes, but the challenge is coming in that customer acceptance of this price hike is not as much as one was expecting it to be. So we will have to watch out for that. We could see the stock opening in the red and maybe then some bit of a recovery, but at least a red opening is what we're watching out for.
Okay, all right, Vinny, thanks very much for that. Urban company is the next one we want to focus on. Mangalam is back. Mangalam, take it away.
Well, if you had to equate urban company to another new age company, InstaHelp would be similar to what quick commerce is, and then the food delivery business, which is the Indian services business, which is doing extremely strong. And that's exactly how it's playing out right now. Solid growth in their core business, whereas InstaHelp investment has dented their margin. So the EBITDA loss actually widened from about 5 crores all the way up to 93 crores, and as a result of which they made a net loss of 92 crores as well. But overall, the revenue growth was 44%. If you look at the internals, their core business, which is the services and products business in India, 31% revenue growth out there. The EBIT nearly doubled from year on year ago. Native as well, 60% revenue growth, sharp reduction in losses. The international business did extremely well as well. That turned it around to the positive side. And InstaHelp, that's where the revenue of the company has been around 11 crores and the EBIT loss has been 131 crores. But despite that, the internals are strong out there. The orders actually grew over 43% quarter on quarter. The EBITDA loss per order reduced. And the company said that here they are prioritizing market leadership over everything else. So maybe losses will remain elevated out there. The mood of the market is good. The core business is strong, so expect the stocks to see some green.
All right. Thanks a lot for that, Mangalam. Well, let's focus on Nalco. The results were strong, but as strong as expected, so mostly in line with what the street was working with. The company continues to focus on efficiency, value creation, as well as sustainable growth, as they mentioned in their release. And the results are supported by favorable aluminium price as well as sales volumes. That's what's led the revenue to grow by close to 39%. The EBITDA margins have come in around 51%, which is much better sequentially, as well as on a year-on-year basis. And besides having a good top-line growth, the other expenditure has come down sharply as well by close to around 12%. What's led these numbers is the aluminium business, because the EBITDA has come in around 2,300 crores. That's rocking. Alumina business remains a little bit softish, but hope is that alumina prices have actually bottomed out and they look up from year on. So put everything together, these numbers are good, they're strong. However, part of the street will believe that this is backdated. We're going with green on this particular name since aluminium prices have stabilized around $3,150 to around $3,200 per ton. But let's wind this down with Divyani, who's here to tell us about Zee Entertainment. Divyani?
Well, in the case of Zee Entertainment, on the one hand, shareholders have approved the 3,144 crore preferential warrant issue to its promoters to increase their stake to roughly around 24%. Now, that said, SEBI, on the other hand, has come out with an order against both Zee Entertainment as well as its promoters Puneet Goenka and Subhash Chandra, barring Puneet Goenka and Subhash Chandra from participating directly or indirectly in the securities market for a period of 12 months and Zee Entertainment itself for a period of 2 months. Now, this is regarding Zee's Hyderabad property, which was used to secure borrowings worth 726 crores for 4 SL Group entities, and SEBI says that the board and audit committee did not get the requisite approvals to go ahead with this particular pledge against Zee's property. And now the big question that stands is whether this shareholder approval of warrant issue can go ahead at this point in time and whether this board resolution will hold. Now, Zee Entertainment states that it is currently seeking legal advice and maintains that the recent SEBI market restraint order has no direct bearing on its ongoing fundraising exercise. Now, what lawyers say, especially with advocate HP Ranina telling CNBC TV 18 that currently, as per the current SEBI order, Zee Entertainment cannot proceed with the warrant issue at this particular point in time. And while the company can appeal in the SAT, a stay order being granted cannot be assumed at this point in time. So based on all of these developments, going with a red on Zee Entertainment and trade today.
Right, thanks very much. We'll take it up with some of the some experts and some market participants as we go along. Devani, thanks very much. We'll just quickly run you through stocks we've highlighted. Now, on the green side, Indian Oil, Divi's, Urban Company, and Nalco. Stocks with negative news flow, Maruti, ITC, Muthoot, ABB, and Zee. It's a mixed view on Persistent Systems. So that's the stack of stocks we'll discuss. Well, Sunny Agarwal of SBI Securities comes up on the other side, and we throw some of these names to him for his views.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's get in our funder guest this morning. We have Sunny Agarwal, Head of Fundamental Research, Retail Desk at SBI Securities, who joins us. Hi, Sunny. Good morning. Good to see you in. Thanks a lot for joining in. Well, we've got a lot of earnings reactions that we're going to be looking forward to. So let's start off with the better looking numbers. Divi's Laboratory looks blockbuster, actually. What's your view on that particular name? The stock has seen a bit of a rally in the last few months, anticipating good numbers. but I understand the numbers are even better than those expectations. How do you approach the stock?
Yeah, good morning, Nigel. Sorry, I missed the stock name. Yeah.
Divi's.
Divi's again, again, a very strong set of numbers by Divi's, no doubt. And anyway, the kind of guidance which the company has given that they would like to grow on a full consolidated basis, integrated basis, rather than focusing only on CRAMS as an one-of-an division. So I think continue to remain constructive, but one has to keep in mind, as you rightly pointed out, that stock has rallied significantly during the last few weeks. So better to adopt a buy on dip strategy as far as Divi's is concerned.
Okay. All right. Got that, Sunny. Sunny, the other big debate is on ITC. What's the view on that particular name? It's been an underperformer. The numbers are a little bit softish. But I was looking at a Nomura note as well this morning, and they're saying that risk reward is now favorable. Most of the bad news is in the price. They're expecting profitability to come about, and they're looking at price hikes as well. Smoking is injurious to health. But what's the view on the stock?
Yeah. Nigel, as you rightly pointed out, most of the negative is in the price. So we have seen the volume degrowth across all the three players, whether it is Godfrey, aviation industry, and ITC. And ITC, in fact, the volume degrowth has been slightly lesser as compared to the street expectation. And again, trading at 17 times price to earning multiple, I think the company has initiated many actions, corrective action to ensure that the volume is back on track. So I think if somebody is a long-term investor, definitely we continue to remain constructive. We believe the fair value of the business is 350 rupees. FMCG, which is a consumer staple business that continues to do well. There we have seen a healthy double-digit growth. Paper business, as we have seen across all the entire industry, the paper segment has been doing well. So I think overall on net basis, if somebody wants to invest from a long-term perspective, 350 is the price target which we believe one can invest.
Sunny, hi. Morning, Rima here. At the SBI Securities desk, what's going to be the stock of the day today in terms of an earnings reaction?
Coming to earnings reaction, I think Maruti will react negatively to the earnings. But what we feel is that the July sales volume has been very robust. And we all know that they have taken one-time price action wherein the quarterly price reset for their vendors has been revised to monthly price reset. And that has impacted margin by 200 basis points during the quarter. And that is giving an optically weaker set of number. We believe the fair value of the business is 16,000 rupees. And again, if somebody want to ride on a very strong auto sales number, we believe that auto ancillary pack, which are focusing on two-wheeler, companies like Sandhar Technologies should be on radar, wherein during the last 3-4 years, they have invested 100 crore rupees. And over the period of next 2 years, the asset should be utilized better way. And we believe the profit number should be doubling over the period of next 2 years. So FY26, 150 crore profit number. FY28, we believe 300 crore profit number the company should deliver, trading at 10 to 12 times price to earning multiple. 60-65% of the revenue comes from two-wheeler pack.
Right. Sunny, hi, morning. Quick view on Z.
Again, would like to avoid this stock. I mean, there has been a lot of negative news flow pertaining to the company. And anyway, the entertainment industry, especially broadcasting industry, has been struggling in terms of top line growth and profit growth. So would like to avoid the stock at current juncture.
Okay, got it. So stay on. There's some change as far as market structure is concerned. The NSE will introduce a closing auction session for F&O eligible stocks starting today. So, I mean, it all happens from from 3 o'clock, 3:15 or so, and lots of changes. But we have Venkatachalam Shanmugam, partner at M-Cube, who is with us. Mr. Shanmugam, good morning. Good to have you with us here. Thanks very much for joining us. So, for viewers who are watching, for retail, etc., what are the 2 or 3 things to watch out for starting today? So, all the stocks with F&O contracts on them, right? They will have a closing auction session from 3:15. Like in the morning, we have a pre-open session from 9 o'clock to 9:07. 9:07 to 9:08, prices are matched, right? In a similar way, from 3:20 to 3:28 is when you have a closing auction session, correct?
Yes.
And then
Between 320 and 25 is the time where both the market orders and limit orders would be accepted. And randomly, the market would stop anyway between 325 and 330. Actually, I'll tell you the history behind why it was random. It was chosen by the regulators to be random at a later point in time. Anyway, good morning, Nigel.
Prashant here, Mr. Venkatachalam. So what is the so just tell us the different index values are going to be derived at 330 for the Sensex, Nifty, etc.
Yes, as soon as the closing prices are announced, actually, so 330 is the time where the computation of the closing price would start happening and would be announced around 330, 335, between 330 and 335. And that's the time in which index values would be calculated and announced, actually.
And then for index futures, index options, stock futures, stock options, they continue to trade till 340, correct?
Yes, that they will continue to trade till 340, and that's the beauty of it, right? So now that you don't need to chase the market, actually, so the market, you will be setting the price, actually. So there will be a perfect convergence between the spot markets and the futures market. So that will make the FNO settlement mechanism further more robust.
I see. And why are we doing? Why are we sort of extending trading on sort of FNO trading till 340? Is it because what is the logic behind that?
It's actually because the closing time would be announced at 3:30, and so there should be some time which should be given for the market to align itself to the closing price that would be announced. So that's why
Correct.
the market
But how is it different from now? I mean, right now we have the volume weighted price for the last 30 minutes, right?
Yeah.
So if you
that's
are
the difference. That's the beauty of the market structure, actually.
no,
right?
my question is why another 10 minutes on the FNO segment? Because I mean, if you're especially on option side, it's based off the underlying, which is how index values are settled, right? And if they want to make changes, so that's the reason why you said, you've been given the chance for them to be able to execute anything if they want between 330 and 340. So how does it work now? I mean, right now also we get closing values at 330, right? In the continuous session.
Yeah. So the point is actually to arrive at the convergence of the spot market and the futures market, actually. So for the futures and spot market to converge, we need to make sure that there is a little bit of a window that is available for people who are on the FNO on the settlement day, that the market, the FNO expiry is actually converging with that day's closing price of the spot market, actually. So that's the reason.
I see.
And we can't have it for one day, which is the expiry day. So it's a standard one extended across all the expiry days.
I see. So for all practical purposes, Mr. Venkatachalam, markets now are going to run till 340 every day.
Yes.
Yeah.
FNO markets are going to run up to 340 every day.
I see. What happens if there is some big news flow? President Trump says something between 330 and 340?
This would not much impact, actually. So here is the beauty of the market is actually there is a lesson that has been learned from Hong Kong, actually. So if you look at Hong Kong introduced a closing auction system way back in May 2008, actually. But what happened in March 2009, the HSBC stock went down by almost as low as 12.5%, actually, because they didn't have a price band, and there was a closing which is known to everyone, and there is no random closing, actually. And so Hong Kong had been toying up or closed the close auction system between 2009 and 2016. And in 16, they restarted it. When they restarted it, they started with a price band of 5%, plus or minus 5%, and then a random closing, actually. So if you look at the regulatory announcement and the way that NSE has been implementing it, so there is a plus or minus 3% over the reference price. And the reference price will still be the volume weighted average price that had happened between 3 to 315, actually. So that's the beauty. So the reference price remains, there is a price band that remains, and there is a random stop that, that happens in the market, actually. So that will, introduce a little bit of stability in the market.
So for non-FNO stocks, right? Trading ends at 3:15, is it?
No, they will end at 3:30 as usual. They'll
Okay,
happen.
yeah, sure. Sorry. Just kidding. And that's how the index values are going to be. The F&O stocks trading ends at 3:15. There's a 5-minute break, and 3:20 to 3:28 you get this auction system, which fair enough. Got that. Anything?
Slowly, they will shift this price discovery mechanism to other non-F&O stocks as well, actually. So,
And this is happening for all 219 odd stocks from today?
Yes.
Sure. And you're saying that slowly in phases they will extend it to outside of this list as well. Yeah. Got that, Mr. Venkatachalam. So it'll be interesting, and I hope. Actually, why don't you come if you're going to be watching this anyway? Do it with us in the afternoon today
definitely
at 3:15.
We'll be happy to do that.
And you can guide us through what we'll be seeing on the screen. It'll be interesting.
I'll tell you the advantage of this is a fair and transparent way of this one, actually. So why this is being introduced, actually, this should have been introduced a little long ago, actually, but it has been introduced because our international exposure and international indices have been, have been increasing over time, actually. And this is particularly, I'm talking about the passive investors, actually. So we have typically about 1 to 2% in the global indices, and we have 10 to 15% or up to 20% in some of the emerging market indices. That's the passive exposure that we have to that, actually. To all the passive investors, actually, what they need is a price which is much more transparent. And so this closing auction system will actually have one strong liquidity pool, which will determine what is the equilibrium price that has been arrived at. And that equilibrium price is not a continuous trading system, CTS mechanism that we call it, as it is in today's equity market, actually. So the orders will be accumulated between 320 to 325, and between 325 to 330, there is a random stop where only limit orders would be accepted, actually. So let's say, for example, randomly the market starts.
Mr. Sorry, Venkatachalam, apologies. We're running up to market open. As I said, why don't you join us at 3:15 and we'll talk more. And you can sort of give us a live ball by ball commentary and explanation of what we see on the screen. Then thank you very much for joining us this morning.
Thank you.
We take a break. We're back with some volume buzzers. We'll also connect with Sudarshan Sukhani and Mitesh Thakkar for some technical trading ideas. Stay tuned. Coming up.
Welcome back. You're watching Bazaar Morning Call. It's time now to get to, just to tell you some of the big movers on Friday where we saw heavy volumes, a lot of momentum in the stock price, just to get a sense on how they'll perform today. Harmis now joins in with the big movers.
Morning, Rima. And of course, there were plenty of result reactions that took place during the course of the day on Friday. Bajaj Finance, of course, was the standout. Is the biggest single day gain that the stock saw since July of 2022. It was up around 8.5% during Friday's trading session. There's a top gainer, of course, on the Nifty and the Nifty 500. The premiums on the 1140 call option were up close to 300%. Volumes were the highest in over 2 months. Over 4 crore shares were traded. The 20-day average was 80 lakh shares, so around 5x its 20-day average. And even after this elevated volumes, more than 60 or close to 60% of the shares that were traded were marked for delivery. So 2.5 crore shares for delivery. This too was 5x its 20-day average. And the stock, now at record high levels, was down at its 52-week lows at the end of March, is up around 45% from those levels. The other positive result reaction on Friday was Hyundai. It was the biggest single day gain since August of last year. This one too has gained in 4 out of the last 5 trading sessions. The premiums on the 2180 and the 2360 call option were up 300% each during Friday's trading session. The volumes again were the highest in over 2 months. 55 lakh shares were traded on Hyundai. It's almost 8x the 20-day average, which is close to 7 lakh shares, and 22% of those were marked for delivery. So 12 lakh shares for delivery, 20-day average of 3 lakh shares. But the stock is still down around 5% for this year and down around 25% from its post-listing peak, which is around about 2,800 rupees. And lastly, Ashok Leyland was one stock that continued to move higher. There's a 6th straight day of gains on Friday for the stock. It's up around 11% during this period. The premiums on the 185 call option went up over 90%. For volumes were the highest in over a month. Close to 5 crore shares were traded. The 20-day average is around 1.5 crore. Around about 45% of the shares traded were marked for delivery. The 2 crore shares for delivery, the 20-day average of around 65 lakh shares, is still down around 10% for the year and around about 25% again from its 52-week highs.
Thank you very much for that. And strong numbers reported by Ashok Leyland for the month of July. Auto sales are up 30%, coming in ahead of expectations, with MHCV truck sales surging nearly 47%. Sunny Agarwal is back with us. Sunny, in terms of, you were telling us about Maruti. Reported numbers optically look weak, but you think it could be a buying opportunity, and you're like Maruti Suzuki. Any particular thoughts on Ashok Leyland?
Again, if you look at the entire commercial vehicle the space, there was an overhang of higher crude oil prices, and there was a belief that because of higher crude oil prices, the profitability dynamics of a logistic player may get impacted, and to that extent, the sales volume is likely to get impacted. But however, we have seen a very robust set of numbers from all the commercial vehicle players, including Ashok Leyland. So again, continue to remain constructive. The only concern which we have seen across all the automobile players is on margin front. But anyway, I mean, I think corrective action has been taken by most of the players, and seeing that second half of FY27 again should be a better year, at least for commercial vehicle players going forward. So continue to remain constructive on Ashok Leyland and both Tata Motors commercial vehicles.
Bruce, by the way, did very well. The auto index last week was up 5.5%. I mean, just behind the IT services index, which went up 7%. So actually, it was last week. It was in Friday to Friday, IT 7%, autos 5.5%, and pharma, which was up about 4% or so as well. I mean, and if you just look at the Nifty stocks, right, Bajaj Finance with that 13% pop, bulk of it, of course, coming in on Friday, was the big gainer. And of course, I mean, there was Eternal, which went up 7%. All that thing around Zepto, helping both Swiggy and Eternal, but Eternal more, which is past 300. And of course, Mahindra, we had the Mahindra management with us on Friday, talking to us about numbers and more outlook and, some of the other group companies, etc. Bajaj Finance or NBFCs in general, anything you like, Sunny?
So among NBFCs, we like Aditya Birla Capital have reported a very strong set of numbers, and we have seen that both NBFC, core NBFC as well as housing finance vertical AUM is growing at 20-25% CAGR and has the share of unsecured book, which is closer to 18-19%, currently goes up to 25%. There is a scope of 20 bips improvement in net interest margin. We believe the SOTP fair value of the business is 450 rupees, wherein majority of the value is ascribed to NBFCs and housing finance business. So Aditya Birla Capital should be added in the portfolio.
Okay, all right. Sunny, we'll leave it there. Thank you very much for joining us. Good speaking with you and good chat. We'll take a break. We're back with the pre-open rates in about 2 minutes' time. We also have Jinesh Joshi of PL, Prabhudas Liradhar on the Z issue. I mean, shareholders have voted yes. Promoters can put in money. SEBI, of course, has also come out with an order on Friday late evening. Will that have an impact on the success on the shareholder? What is the question many are asking without really a clarity there? But Jinesh joins us on that and more in a bit.
Welcome back. This is Open Exchange, and we are coming to you live from the Motilal Oswal studio. Well, let's welcome our technical experts as promised. We have Sudarshan Sukhani, who joins us, as well as Mitesh Thakkar. Good morning, gentlemen. Good to see you in. Well, the mood is a little bit upbeat. Do you think the Nifty has enough to get closer to around the 200 DMA? The 20 DMA has got taken out. And now the all-exclusive 24,750, 24,800 is what the bulls will have on their radar. Sudarshan, you go first.
Yeah, good morning. Well, I'm very pleased. All of last week, I have been saying, let's be long. The market is giving us signs that it is willing to go higher. Remember, it has already crossed the number of thresholds, the Nifty. First, 24,200, then 24,350. So 24,500 or 24,700 is not an unsurmountable threshold. It's just there. That's all. The market is already telling us that it's willing to break resistance and go higher. So the trade is, if you are long last week, be long. There's no rush to get out. If you are not long still, then wait patiently for minor dips to be long. This is a good run-up we should expect.
Okay, so Sudarshan very bullish in the markets from here on. He has been bullish and maintaining that. Mitesh, we already have about 616 points in the bag from last week's gain, and another 150, 160 points as we begin trade. From there on, where do you think the Nifty goes?
Good morning. So I think, the best thing which happened was that we kind of managed to close this around the 24,400 mark, which is what I've been saying will be a level to watch. And today we opened with that gap up. So I think the near-term target is obviously 24,600, but more logical target would be close to about 25,050 to about 25,100. So I think about 24,600, some profit booking. Probably this head towards 25,050, 100 zones.
Basically 25,000, 25,050, around those. Sudarshan and Mitesh, morning. Sudarshan, what do you do with stocks?
Well, since we are long and should be long in the Nifty, we are looking at mid-cap stocks primarily. Ambuja Cement is a buy with a stop bid of 425. Bharti Airtel, although it's a large cap, not a mid cap, but still it's a buying opportunity to stop under 1930. NAM India is a buy from the financials, stop under 1140. I have one short just to keep our minds cool. That's Dabur, sell with a stop above 430.
Mitesh, what about you?
Yeah. I'll go with 3 buys and a sell 2. On the buying side is Chola Finance. Keep a stop at 1824.5. Look for targets of 1900. Gas Authority had a breakout on Friday. That's a buy with a stop at 177 for a target of 190. And Geo Finance also, that's a buy with a stop at 251. Look for target of 268 here. And LIC Housing Finance is the sole solitary sell call. Keep a stop at about 536.5. Look for targets of around 500.
Okay. All right. Mitesh and Sudarshan, thank you very much for that. Appreciate your time here on CNBC TV. We didn't speak again soon. Let's just put up the Z in the pre-open. The pre-open is kicked off. I think Z is starting 10% lower. We should have the first look in on that particular name, 102 odd on Z. I mean, what was supposed to be a pretty happy occasion for Z shareholders this morning, because of the shareholders saying yes to promoters infusing money, has become a bit of a sticky point with the SEBI order, which came in at, I think, about 10 or 11 on Friday night, basically, essentially asking promoters to stay away from capital markets for a year. Suddenly has soured the mood and soured the situation out there. Jinesh Joshi is with us, research analyst at Prabhudas Leader. Jinesh, good morning. Good to have you with us here. It's this and that, and that is overwhelming this. I just want to ask you, how do you look at it?
Good morning, Prashant. I knew this will be the first question from your side, and honestly speaking, I also knew that I may not have a very clear-cut answer to it. Honestly speaking, the shareholder approval coming through was a big positive, and then suddenly we saw the SEBI order come through, right? And given I'm no legal expert, I'm not in a position to comment whether the fundraise will go through or not. But to give you a layman perspective, going through the order obviously indicates that the promoters are barred for about 1 year, and the company for about 2 months from accessing the capital markets. So there are a lot of ambiguous views that are floating around currently with respect to whether the preferential allotment can go ahead or not, and it's a tricky situation to comment at this point in time. And as I mentioned, that someone with a legal background will be in a better position to kind of give a very sound opinion on this one.
But in case it doesn't go through, the fundraise doesn't happen, how much of an impact will it have on Z Entertainment?
Right. So, Rima, see, if the fundraise doesn't go through, what happens is that the growth capital will not come into the company, right? This was a pref allotment of about 3,100 crores. 1,000 crores was about to be deployed in sports and about 940 crores for M&A. So, growth capital will not be there. But see, the company already has about 2,700 crores of cash on the balance sheet. So, when it comes to the routine business, I don't think that is going to have that much of an impact. But having growth capital come in via the preferential allotment, things could have looked very different.
So what's the call that you have on Z Entertainment now, and does it change because of this legal overhang?
Yeah, so our paper TP is about 117. We have an accumulate on the stock. But as I mentioned, given where we are in terms of the preferential allotment situation, if it goes through, obviously that will not hold because the option value can definitely unlock. But if it does not, then I think definitely with no growth capital at work, you'll have to kind of basically rely on the broadcasting business to recover. And especially if I talk about 1Q, given how the ad environment is, we are not expecting much to come through in 1Q.
All right. Hi, Jinesh. Good to see you in. Do you think, but now, if this promoter infusion doesn't happen, Z could maybe reach out to other investors and say, guys, we were ready to put some money. We have a technical problem out here, but we were ready to put down a lot of money. Will you all come in? Do you think that could be another strategy that they adopt?
Uh, I doubt, because see, over here the strategy was to increase their skin in the game. The promoter holding currently is at about 4%, while the preferential allotment, the holding would have increased to about 24%. And see, honestly speaking, if you ask me, the company was not in dire need of money. As I mentioned, it had about 2,700 crores of cash on the balance sheet. So reaching out to investors for fresh capital, and I think could be slightly tricky and challenging.
You know, there's again, this is all legalese, but there's one view that they may go to SAT. I mean, obviously they'll go to SAT, they get a stay, and then they proceed with this. That's have you heard that, and anything you make of it?
So yeah, I think that could be the legal recourse for them if they go to SAT, and if they are able to achieve a stay, and if the preferential allotment goes ahead. As I mentioned, things could look very different, because what will happen is that the option value will then get unlocked. They have that music business, right? The tendency, or rather the incentive to disclose more, will be there if the fundraise goes through. So yeah, things could look different if it happens.
Okay. All right. Final question before we let you go, Jinesh. Have you watched Spider-Man? Are you taking the kids? I mean, I'm planning that because I believe it's a blockbuster. The collections in the last 4 days, I think, are around 200 crores. So Avatar's record of close to 400 crores could be in for a bit of a challenge. You know, what are you factoring in out there? Because the base year for PVR as it is very high, because quarter 2 of last year was good. How do you see things pan out for PVR from here on?
Right, Nigel. Yeah, I've seen the movie. Spider-Man's collections are indeed very good. I mean, 200 crores in about opening weekend is definitely very good. And if the momentum continues, given the fact that over the next 12 to 14 days we do not have any major movie lined up, our sense is that the lifetime collections can settle anywhere between 400 to 500 crores. And if that happens, Spider-Man will be the highest grossing Hollywood movie in India. And given the fact that in 2Q so far we have seen certain movies doing well, say for example, Dhamal, you have Odyssey that has done extremely well. And also if I talk about the pipeline, you have Toxic come up, you have Batwara come up. So I think overall 2Q for PVR looks good, while the base quarter was high, given the fact that you had Sayyara over there. But overall, given how the pipeline is trending, I think 2Q for PVR again will be very good, and we continue to maintain our positive stance on the company.
Okay. All right, we'll leave it there. Jinesh, thank you very much for joining us. Good speaking with you, and you know, we'll speak again. But the pre-open has come to an end, and just quickly to take a look at the Nifty. 190 odd points higher on the Nifty, 24,572. Sudarshan and Mitesh are back with us with their calls. Sudarshan, what do you have?
It's Bharti Airtel. Buy Bharti with a stop under 1930.
Okay, and Mitesh?
I'll go with the buy on Shriram Finance for a target of around 268 to about 270.
Okay, you know, why not take the gentlemen, thank you very much, both of you. Why not take the opportunity to look at how stocks are starting up this morning and in terms of results reactions. So Divi's is up 4%, and Urban Company, I think, has got an upgrade as well, 5%. Post numbers, IOC is up 1.6. Z, of course, we already highlighted. Muthoot is the other one we should look at. And there are some, you know, cuts on earnings and all of that. Nalco, Maruti, ITC is up about 1.25. So ITC, I mean, big improvement compared to what the market was expecting for the volume degrowth to be. But ITC is still up about 1.25. Muthoot is down 8%, 28.76. You'll hear from the management in short order. ABB India is down about 0.5% or so. And, you know, essentially some of what we are seeing. Persistent is down about 0.25. And, of course, Z is down 10-11% as well. So that's the picture at this stage. Well, Vinny's here. Divi's with that 4% pop, just to put the spotlight on the numbers once again. Vinny, take it away.
Hi, so obviously a strong set of numbers that's coming from the company, right? Exceptional growth in Q1 FY27. Overall, the growth for this year on a year-on-year basis is a 28% growth. EBITDA margins, a sharp improvement there of 72%, as well as in terms of margins also, we are seeing a very, very strong improvement. 40.7% versus just a 30.2%, so around 1,000 basis point expansion in terms of margins, improvement in profit as well. Obviously, the EBITDA margins are at a multi-quarter high. The street was, is maybe penciling a possibility of a one-off milestone type of a payment that is coming during the quarter. So that will be interesting to watch out for. The management has maintained the double-digit growth guidance, and despite the lumpiness, they're expecting this growth to continue. The company also reiterated to assess the performance of a full year rather than on a quarterly basis for the company. But all in all, good set of numbers coming in here, and we're seeing a sharp green as of on the screens.
Thank you very much for that. 4% up on Divi's Laboratory in pre-open rates. But let's talk about the auto sales, because I can see M&M right on top in the Nifty names. How did the numbers look, Sudarshan? What stood out?
It's been a strong set of numbers each and every company has seen in the month of July, and in resultant, July 2026 has turned out with the best ever July for the entire auto sector. So speaking about Maruti Suzuki, highest ever sales, highest ever production, total sales have increased by 34%. Domestic sales continue to do well, and their sales were up 42%, and SUV sales have increased by 50%, and entry-level segment for the second straight month has seen a growth of almost 90%. For Hyundai, again, it was highest ever monthly sales, increased by 25%, and exports were highest in last 10 years almost, and sales have increased by 31%. For Tata Motors vehicle, continues to see a very strong growth on a low base, reports 59% increase in sales. PV domestic sales have seen an increase of 58%, and EV sales have almost doubled, 114% up. Mahindra & Mahindra, both auto and tractor segments have seen a growth of more than 20%. For auto, total sales have increased by 26%, SUV sales increased by 20%, and LCV of 2 to 3.5 ton sales have increased by 21%. Even tractor April to July sales have increased by 18% versus FY27 growth estimate of mid-single digit. For two-wheelers, Hero Motors sales were largely in line, increased by 19%, and growth was led by domestic segment, while exports have seen a decline. For Eicher Motors, again, sales were largely in line. Both segments up to 350cc and more than 350cc segments have seen a very strong growth. Now, today, three other companies have reported numbers. Bajaj Auto, total sales were largely in line. It has come at 4.74 lakh units. TVS Motor has become the highest selling vehicle company in the two-wheeler space, have sold more than 6.3 lakh units. And for Ashok Leyland, it has reported more than 19,000 units against our expectation of 18,000. So it's been a strong showing for all the companies.
All right. Thanks very much for that. And stocks are reacting. Mahindra has started to move up. I mean, you know, during the depths of the first round of the strikes between Iran and US, I mean, you know, it had fallen to, and still, I think, would be around 20, 21, 22 times F5, 28 earnings, which is not expensive in the current context. But, you know, it stayed there, didn't move very much around the 3,000, 29, 3,000 rupee levels, but has started to now perform, post the quarter numbers. And of course, now the July sales numbers also will is starting to look up. Strong numbers. We have the first rates coming up, 24,572. It's a 0.75% pop. The Nifty Bank is up 0.5%. You've got the mid and small cap indices also starting in the green. 0.6 in the small cap index. The mid cap index should also come up on your screen. I think it's higher for now. 138, 140. So cooling off a little bit, but you know, you've got the Bank Nifty also should come up on your screens. 0.5%. That's about, uniform 0.5% kind of gains are coming through for the market right now. Let's just look at the Nifty heat map straight up, and then we will take it forward from there. What do we have? We've got Bajaj Finance, which is the top gainer. Friday, it was the top Nifty gainer. And of course, for the week, it was the top gainer. 13% Friday to Friday last week, as I said. And I think it's coming up once again with gains. Indigo is at number 2 position with the oil cool-off. Mahindra is at number 3. Tata Steel, Dr. Reddy's, Tata Motors, Passenger, Infosys, Hindalco, ITC, Geofinance. I mean, you've got 45 names in the green and a few in the red. ONGC is one of them, which is down as oils come off. But otherwise, overwhelmingly green screen. Rima.
Well, looking at some of the large cap movers, it's InterGlobe Aviation right on top, 3.5%. We've seen the dollar index cool off to sub 100. And that's providing a leg up to metal names this morning. So you've got Tata Steel, JSW Steel, higher in trade. Hindalco will also come up for you on your screen. The Nifty Metal Index has also opened up in the green, and that is one of the big movers sectorally. Keep your eye out on auto names. So, Sudarshan was telling us about the auto sales numbers. You've got M&M and Eicher Motors. Bajaj Auto numbers were largely in line, but Hero MotoCorp numbers were also fairly strong. ITC is now gaining strength. ITC numbers look disappointing, but Mangalam was telling us about the shorts in the system, and those seem to be playing out. So it's a positive start now for ITC. TCS Infosys continue with the gains from last week. L&T is a big mover. Asian Paints higher on the back of declining crude prices. Just 4 Nifty stocks in the red right now. You've got Sun Pharma lower by more than %. Cipla, ONGC and Titan, but the losses there are very, very minimal. But lots of big movers in the broader markets. I can see an urban company 12% up. A Blue Dart is rallying 6% there. 19.
Well, that's right. The Shadowfax as well is continuing its good form. I think in Friday's trading session, it had a big move If I got that right, Shadowfax for this month is up close to 12%. We're just starting off a couple of days out there. So big move out there on Shadowfax, continues to gain. Nalco as well, I saw the initial pop-up. That had opened up in the green, so good going out there. The numbers look good, as strong as expected, holding with the gain of around 1.5%. Part of the street believes that these aluminium companies are reporting peak earnings. Smaller companies actually are also in focus. Aarti Surfactants, volumes not very, very large, but the revenue there has come in at around 270 crores. That's up by 26% year on year. But the positive is that margins have come in at around 7.5%. So the stock has now gone to upper circuit. It opened up 12-13% higher. Just pulled out those numbers, and that one is flying away. Clean Sciences, well, out there, no big surprise actually on the numbers. Top line, the growth was close to around 10%. EBITDA numbers actually was a little lower. Margins at around 36%. That compares with around 41%. But I think the reason the stock is up is because Clean Science and Technologies, they have signed a 5-year long-term supply agreement with Kemin Industries to supply key ingredients for food as well as feed industry. So that explains why that one as well is running away. Shalimar Paints, that one's up close to around 5%. I think it's a good start to today's trading session. The big casualty this morning, though, is Muthoot. So we'll get the management in just a bit. The problem is that yields have come out. How is competitive intensity going from here on? But after that correction from 4,000 to 3,000, yet it's down. So the street clearly a little bit concerned.
Yeah, absolutely. Well, I think let's just take a quick look at what the Nifty is, where it's picked up from the 0.5%, 24,550. The Nifty Bank is up that much, and so it's a good looking start at this point. Muthoot has done phenomenally well, one-way rally for the last many quarters, several quarters. So there is that more than anything else, I guess. And I think we'll hear that from the management as well in a bit. Pankaj Tibrewal is with us. He's founder and CIO at Ikigai Asset Managers. Pankaj, good morning. Welcome back on the channel. It's been a while. Thanks very much for joining us. So, bang in the middle, not middle, but maybe the fag end of the earnings season now. And earnings have been very, very good. You've had a phenomenal run, Pankaj, picking off some of those names off the bottom of the first phase of the Iran conflict when the market really sold off. And those stocks did very, very well. How are you placed? What are you doing? Are you adding exposure, reducing, calibrating? Just give us some specifics to kick this off, Pankaj.
Good morning, Prashant. We are in halfway through the earnings season. It's very important to take a note because we started the season expecting that earnings won't be great. So 207 companies out of the Nifty 500 companies have reported till now. And if you look at the top line growth, it's about 19.5%, which is one of the highest over the last 12 quarters, what we look at. The adjusted PAT growth is about 9%. But if you adjust for OMCs, the earnings growth in this quarter, which was expected to be the worst quarter, is 21%. Mind you, it's halfway. But the most important part, Prashant, is the resilience of the earnings. In the last 12 quarters, this is the first time that 60% of the companies which have reported earnings have reported more than 15% growth in earnings. Normally, the ratio is about 45 to 55% in the last 12 quarters. But this time, 60% of the companies reported have more than 15% earnings growth. And when we bifurcated between large caps, mid caps, small caps, and adjusted for OMCs, because OMCs had a huge loss this quarter, and they kind of, deviate the entire earnings season. If you look at the three large cap, mid cap, small cap, large cap is about 20%, mid cap about 23%. And small caps about 30%. I'm not talking about micro caps because micro caps is more than the small caps. So I think the earnings resilience is the real story going into the quarter, and more companies will report in the next 15 days. But I think the start has been extremely good. So from an earnings perspective, I think we are very well positioned. We have seen earnings upgrade across almost 50 to 60% of our universe, which is a very healthy number. The second part is when you look at the macro, Prashant, I think the concerns incrementally have started to fade away. Look at what was there a month back, monsoons. July, 3% above rainfall, and cumulative rainfall is now just 13% deficit, which was in June about 40%. The second was rupee. And I think I must give credit to RBI and Finance Ministry for the FCNR. And since the 6th of June, when the FCNR announcement happened, we have seen about $36 billion of FCNR deposits flowing into the system, what it has done two things. It has stabilized rupee and it has stabilized the FPI outflows which were happening. In fact, in the month of July, FPI actually turned out to be buyers. And the third part is that the bankers are expecting about $80 billion of cumulative inflows through FCNR, ECBs, and the other schemes which have been introduced by the government and RBI. So I think full marks to them for stabilizing and the currency, and hence the equity markets per se and the sentiment. The third part is the frequent indicators numbers. If you look at auto sales, GST, everybody is talking this month they will come down, this month they will come down. But cumulative numbers till June post the GST cut was about 25 to 30% across two-wheelers and four-wheelers. July continued the momentum again. So these are not fluke numbers. These are something which has happened at the ground, which we have been talking about. And Prashant, one thing, if you remember, last 3-4 months, we have been saying inflation is a friend of corporate India. And the value growth, which has been subdued for last 3 years, will start to surprise. Even if there is a gross margin dilution, at the operating leverage, you will see operating leverage kicking in because fixed cost won't move at the same pace. And exactly the same script is playing out for corporate India. Though the market is surprised by the earnings resilience, we are not that much surprised because that was built into our expectation, and that's what we wrote in our latest newsletter as well.
Pankaj, hi, morning. Rima here. I remember a conversation a couple of months back, and you had said specialty chemicals could emerge as the dark horse. Do you have any other dark horses? Which sector, which theme do you think will do increasingly well from here?
So, Rima, absolutely. If you look at the results of most of these specialty companies declared now, they have reported very strong results. Market is saying there is inventory gains, and hence we will watch out. Our sense is that the second quarter has also begun on a very strong note as far as spreads are concerned. Though there could be some dilution as far as quarter on quarter is concerned, but year on year it should be good. And don't forget that for the entire corporate India, the second quarter base also of last year is weak. So optically, second quarter will also look out to be very strong for corporate India as you move into the September quarter. The third part is that private sector banks have not participated yet. We believe that the next run up in the market, especially in the Nifty or the front indices, would happen from the private sector bank financials. And if FI starts to slow down, in fact, if they turn buyers, I think banking sector is very well poised, private sector lenders, as far market is concerned. In terms of another dark horses, home improvement space, I think tiles, plywood, pipes all have shown very, very strong numbers. And we see an indication where unorganized to organized movement is happening in all these sectors which are happening right now. So whether it be tiles, whether it be plywood, PVC, everywhere we are seeing market share improvement. And that's one sector, I think, which has been forgotten by the street, which looks good. Even in consumption, the early trends have been very encouraging. Volume growth across many of the categories have started to pick up. And the ground level feedback is that things have started to improve, which was not the case for the last few years. So apart from the known sectors, the banking, the NBFCs, the autos, we believe that incrementally home improvement, consumption, discretionary, along with specialty chemicals could be the sectors to watch out.
All right. Hi, Pankaj. Good morning. Always good to see you. And Pankaj, you're taking the bold move, gone and set up Ikagai at a time when things were looking pretty good. And from then on, you're being faced with one after the other. Bad news, FI selling, the war, I don't know what, all sorts of news. But I believe that in the last 3-4 months, your fund portfolio, I believe, is up close to around 15 to 20%, if I'm not mistaken. So your investors will be quite happy to see the kind of bounce back you've seen in portfolios. Now, you've given us some themes. Share some names as well with due disclosures. As you said, the building theme is something that you like, tiles, etc. The move from unorganized to organized. What's the stock you're betting on? I think even the kitchen appliances maker out there, I think Hawkins is a stock that y'all have owned for a bit as well. And I think in comparison to the historic valuations, it's much below that. So give us some names with due disclosures, Pankaj. Be a little liberal today.
See, I always believe that finally, we should not misguide any of your viewers. So we will have a view on few stocks and themes, but that can change with the other news. But I can give you broader thoughts what we are thinking about. I think from a home building improvement perspective, I think what is happening, for example, let's take an example of tiles. I think in Morbi, there was a lot of under-invoicing going on, and there was a wide gap between the organized and the unorganized. With the gas price increase, which is a major cost for all the tile manufacturers, I think that under-invoicing is behind us. And what it is leading is that the price gap between unorganized to organized has come to a very small level now, which means if as a consumer you are given a choice between 5 to 10% differential, you will always go for a brand. And hence that's what we are seeing in the volume pickup across the street, whether it be tile, whether it be plywood, even in Yamunanagar. With the cost price increase on raw materials, smaller players are finding it difficult to put a check for raw material in advance. And hence the market share is started to shift to the larger guys. And that's happening across the industry. If you go into the last 20 years, whenever inflation has come back, the organized, strong players in every sector has taken away market share from the unorganized guys, because the unorganized guys don't have balance sheet, they don't have money in white for buying of the raw materials, and hence you see that their production levels comes down. So that's one theme I think which is very, very clear, and inflation is going to stay. I think that's a mega theme which we are chasing, that the world is surrounded by geopolitical events. Some of the other events will keep on the resources and the metal and mineral prices elevated, and that will make sure inflation is there to stay for some more years to come. And hence, bet on the leaders of the sector. You will see incrementally significant market share gains from here on also. That's the broader thought which we are chasing in the home improvement and other sectors as we. Right.
Yeah, absolutely. And I think, I mean, I'm. You can correct me, but I think Kajaria is something you've talked about in the past, and maybe Sarah as well. I'm not sure, but Kajaria we have discussed in the past. Financials, the credit growth numbers are strong, and there are various ways to play that. Autos is one. I mean, it shows up everywhere, right? I mean, 18-19% credit growth. Same time last year, it was running at about some 9%. So it's really turned the corner. But directly through financial institutions, Pankaj, any would you want to do that? Lots of people are talking about housing finance companies, which have not done very well. There are some private companies which used to trade at 5-6 times. They're all corrected, right? Aptors and Home First, and there is Aadhar Housing and so on and so forth. Or other segments, Bajaj Finance, for example, which does pretty much everything, has also sounded very confident and bullish. So financial specifically, ex-banks, what do you like?
So ex-banks, we like the vehicle financing entities, a couple of the NBFCs which are part of our portfolio. Also, your observation is absolutely right in terms of housing finance. They have been well-positioned, very strong in terms of growth. But the only thing where we are not sure, that if you look at the last 20-25 years, except SDFC, which has scaled up significantly over a period of time, most of the housing finance companies see a barrier of growth around 20 to 25,000 crore a year. I don't know what's the reason, but historically now what we have looked at is that at 25,000 crore, there is some accident, there is some problem on asset quality, the growth slows down, some other problem happens, and whichever company has crossed that 25,000 crore mark on the AUM starts to see strong growth again. So I think most of the names which you mentioned in the housing finance companies are in that range of 15 to 25,000 crore AUM. We continue to remain positive in a couple of names and part of our portfolio. But that's one thing we have to watch out very closely, that which of these names now see a breakout in terms of AUM growth beyond that range. Otherwise, history suggests that something happens in that range and they kind of falter out. But we are positive. I think credit quality, ground level feedback continues to be strong. AUM growth continues to be good. And so housing finance, vehicle finances, and a couple of other diversified NBFCs are part of our portfolio. And results this time around, Prashant, has been very strong. They have shown NIM expansion. They have shown better asset quality, better AUM growth. So I think stars are getting aligned for the market as a whole, in my view, that economy, macro, micro are not doing as bad as people feared out to be a month back. And most of them expected that June quarter will be a disaster as you move ahead, but that's not been the case.
That's absolutely not been the case. I had more questions, but we're on, as you said, we're only in the middle of the earnings season, Pankaj, so it's, lots of corporate conversations. So I thank you here. You're welcome to stay on and listen into the next conversation with the management of Muthoot Finance. It's been an outstanding performer. A bit of a hiccup, I say, today. Stock's down about 11%. Let's get straight with the management. George Alexander Muthoot is Managing Director at Muthoot Finance. He's with us. Mr. Muthoot, good morning. Great to have you with us here. Prashant, this side.
Thank you. Good morning, Prashant. How are you?
All well, sir. All well. And I hope you're well too. Your team's doing well. Just a quick, I just want to start with margins, sir, which is yields basically, loan yields, which seem to have come off sharply. I wanted you to give us some perspective on what happened in the quarter.
Okay. Nothing happened in this quarter. What happened was last year, quarter 2, quarter 3, quarter 4 was quite good. And probably because of the elevated gold price, etc., a lot of old loans got closed. We got a lot of interest on that. There were a lot of ARC money coming in. And of course, the old loans, etc., contributed to a good lead of income. So the 20% of yield which we saw in Q2, Q3, and Q4, actually it is not sustainable. Actually, we had been saying that steady state or yield should be in the range of 18 to 18.5. I think we'll stabilize at that. Today it is about 18 something. It should stabilize at 18.5. Steady state, that is the yield. And even with that, we have a good ROA and ROE, etc., and also good growth. So I think steady state, the yield should be in the range of 18 to 18.5. What we saw in the last 3 quarters was just an aberration, or maybe some old loans and interest coming in, ARCs coming in, etc.
Right. So last 3 quarters, very high yields, not sustainable. And same time last year, 20% was kind of... So that comparison is what is wrong, Mr. Muthoot, right? That's what you're saying.
I can understand.
Yeah.
I can understand.
Yeah. And you said 18.5% is the more is the range which...
Yeah.
Okay. Now that directly takes me to the other to the next question, which we've discussed quite a bit, which is the impact of competition, further normalization of yields, Mr. Muthoot. And you've always said there's leadership position. I mean, you're far ahead, and all those things are true. But, company after company, financial institution after financial institution, when we speak with them, they all kind of are focused on this segment, gold loan. We just, at the last conversation off the top of my head, the management of Capri Global came up. And I was looking through their presentation, special focus on gold, right? And that is not just them. It's pretty much everyone wants in. So what will it do to yields? Will we see further normalization, Mr. Muthoot?
No, I think there is nothing. Normalization. Normalization happened in our case just because of the extra income which we got last quarter. Otherwise, steady state, there is nothing to be normalized, or normalized income and yield would be in the same range. I'm sure we should be able to continue with that, because even with all these competitions, we still have our customer base. We still have our customers who still think of Muthoot as the first priority for gold loans. So as long as that is there and Muthoot goodwill is there, I'm sure we should be able to do business.
I remember, Mr. Muthoot, I remember you used to say that gold loan intensity has come off. This is a few quarters away back, right? But it has it. How intense is the competition? Because I mean, even if there are smaller players, much smaller in size, not with your decades and decades of history and brand, etc. But price is price at the end of the day, right? If somebody is offering, a far more attractive rate of interest, I mean that does pressure yields for Muthoot as well, or it does not?
So I think it's only time that will play out on this, and I'm sure we should be able to continue with our yield and our customers, etc. So new players will come. They have to offer a lower interest or something to get new customers. New customers, probably they have to get new customers. But having said that, always I'm saying the industry is also growing, Prashant. The industry is growing everywhere. So it is not that somebody is taking away my business or I am taking away somebody else's business. It's not the same customer going from one company to other company. It is a new customers coming in. See, you have seen our new customer acquisition has also been quite good. So that means new customers are coming. So the market is expanding and we should see good growth of AUM. I think more than the yield, we are more concerned with the AUM. I think the AUM will play out well in the next few quarters.
So 43% AUM growth, sir, in Q1. You've always spoken about a 15% guidance. Why not raise it now? What do you think FY27 realistically, not conservatively?
So I think next quarter we should be able to revise that guidance from 15%. Definitely, we should be able to positively up that in the next quarter. So
closer to 30% plus. So do you think you can raise it to 30% plus? That leaves enough buffer.
We'll put numbers there. We should definitely increase it. No. Definitely. I think what we saw April, May was the time when the new regulations kicked in, and the customers also needed to understand the new regulations. Where earlier most of it was bullet loans. Now Reserve Bank new regulations insist on shorter term loans and monthly interest payment, etc. So there is a bit of education which needs to be done to our staff as well as the customers.
Okay.
So but now that is behind us, and we have seen good growth in June and July also very good growth. I think we should see good AUM this year.
Okay. Sir, and this 43% AUM growth, can you disaggregate it in terms of the tonnage growth, customer growth and price appreciation?
Yeah, I think the tonnage growth, I think I'm getting redeemed now. See, the tonnage growth will go up when the price of gold comes down. When the price of gold goes up, the tonnage will come down. So it's inversely proportional. So when the price of gold comes down, to borrow the same 1 lakh rupee, customers have to bring more gold. That is why you see the tonnage increase. I think I've been telling that for the last several quarters. So if the price comes down, gold price comes down again, tonnage will definitely go up. So it has to. So tonnage is not of much relevance today, because even today, our average LTV is only about 68%. So people have borrowed only 68% of today's price. There's still a lot of headroom for people to borrow if they want to.
Okay. But sir, gold prices have come down, right? Are you seeing any kind of traction with regard to tonnage growth till now? You know, I'll tell you what the fear is, that competitive intensity is high. The yields have come down a little bit. So they're fearing that, you know, maybe in fact there is some market share loss as well that's taking place. How do you respond to that?
Market share loss, we have not lost any market share. Our market has already come up only.
Okay. So you believe, sir, that market share is actually maintained or it's gone up? Take that point as well. And yields.
I wouldn't say.
Yeah.
Market share means you have to see the market is improving, sir.
Correct.
So number of customers, the pie is increasing. So more and more people are coming forward. Market, there is space for everybody. New players, old players, everybody, there is space. And those who are in the field will be able to continue. I think that's what is happening today.
Okay.
So as a result as far as our result is concerned, compared to last quarter on quarter, our yields, our profits were higher. Our growth was quite good. It's only the last 3 quarters where the yields were very high. Now we have come to the normalized yield of 18 to 18.5%. I think that will continue.
And you don't see a risk to this 18 to 18.5%, right?
Yeah, I think so. Surely.
Okay, so now, you know, you're clarifying a couple of good points. You're saying that the market is growing itself, so you're not losing market share. In fact, you're seeing good growth. Got that? And in terms of yields, you're expecting it to hold at these levels. But the point is on NIM, sir.
Over the last several years, our yields have been in 18.5.
Right.
It is only last 3 quarters it came up to 20% because of what I said. Some ARCs and old loans getting closed and old NPAs getting closed. All those added to the yield. I think that we clarified that in Q4 results and Q3 results, why the yields have gone up.
Okay, sir.
Now it is normalized yield.
Okay, and what about NIM, sir? NIMs, they come down to 10.4%. Yields are going to hold out. Do you expect some relief on the cost of funds, which in turn would take your NIMs back up to, say, that 11.5%?
I think we will maintain our yield, etc., and NIMs will continue to be in the same range. NIMs will continue. If the cost of funds goes up, we will increase our rates. If the cost of funds comes down, we will reduce our rates. We will maintain our NIMs.
Okay, got it. NIMs will be maintained. That 68%, Mr. Muthoot, that you said LTV, that is on the existing book, or are new customers taking loans, and on those new loans LTV is at 68?
New loans are not 68. New loans may be 70, 75. Even some people even take 85. But overall, the book, the old loans were taken at 40%, 75%. Right. The price has gone up. So their yield is, their LTV is only 60. What I wanted to say was, it is not that everybody is borrowing the maximum because of the price. They borrow only what they want and what they feel they can repay.
Right.
That's the point I was trying to say.
Right. Got it. Mr. Muthoot, but new loans are coming at 75, could be 80% as well.
Yeah, 75. Some loans are at 80 and 85 also.
Just one last question from my side. Okay, my question is slightly off track, but why don't you go on? Arriva,
right.
why don't you
So
take this
have you taken calibrated pricing action to defend your AUM growth? I'm reading a Motilal Oswal note verbatim. The competitive intensity in the gold loan industry has increased meaningfully, with Muthoot Finance management acknowledging that it has taken calibrated pricing action to defend AUM growth. Yes or no, sir?
I didn't understand what they were trying to say.
Well, they're trying to say that the competitive intensity compared to some time back has gone up, and therefore you are being aggressive with your yields to make sure that you continue to have that AUM growth. So you are looking to defend your AUM growth at the expense of pricing or margins, in a way paraphrasing them.
Yeah, I think we have the depth in the market, depth in the AUM, depth in our profits, depth in our funding to do such things if necessary. So that, yes, as you said, if we need to reduce our prices to get more customers, we can do it. But whether we need to do it or not is a call which we should be taking. So it is possible that we can always reduce our rates also. But I don't think today it is necessary.
Yeah. Got it. And you've given us that guidance on yields. So whatever you do, it'll, the yields will be 18.5% as you said.
Yeah. NIM is definitely going to be steady.
And NIM guidance, 11 to 12?
Same, yeah.
Holds?
Yes. I think 10.5 to 11 is what we have always been saying. It can't be more than that.
Muthoot, all micro questions, one macro question. Gold prices, sir. I know you don't take a view, but gold prices have come off the highs. What do you think? Do you have a view? I mean, it's a personal question. It doesn't have to do anything to do with Muthoot or what's your sense?
I think because of all this international uncertainty, political uncertainty, gold price will remain elevated. It is just that some bips, etc. is happening. What has actually fallen is the gold price has gone down by about 15-20% max. There was one bip, 2 months period where it went up phenomenally high, but at that time no loans were priced at that rate. So to say that the steady state, the gold price would have come down by about 15% in the max. So, but then to answer your question, the gold price will remain elevated because sort of uncertainty internationally, it cannot go down very low.
Well, it is one of the oldest forms of exchange that we know of. Thank you very much, Mr. Muthoot. Appreciate you joining us. And good speaking with you as always here on CNBC TV 18. Good conversation.
Thank you. Good day.
Well, elevated expectations after those 20% kind of yields last few quarters and markets. I mean, as I said, I began the conversation by saying stocks done so well, just pulling back a little bit. 11% though, it's a large one today. We take a break. Shriram Finance management with us on the other side. Stay tuned.
Well, let's focus on the next management from the old economy. That Shree Cement, they reported actually a mixed quarter. The sales volumes came in high by close to around 17%, but the margins did see some kind of compression. What's the way ahead? What's the strategy going ahead? We have with us Mr. H.M. Bangur, the chairman of Shree Cement, who joins in. Hi, Mr. Bangur. Good morning. Always good, sir, to have you on the show. First of all, congratulations on that strategy of going ahead and grabbing the market share, because your volume growth at around 17% is the highest I think I've seen in the last 12 quarters or thereabouts. So good on you. Now you're guiding for a 10% volume growth for this year. Are you being a little conservative after this sort of a start that you've seen? And also help us out with the trade and non-trade mix, because traditionally trade used to be 70-75%. But since the non-trade market is gaining traction, last quarter you went ahead and you grew that segment more. So how did the mix evolve from here on? Please go ahead, sir.
So first of all, still we maintain 40 million ton, that is the 10% overall growth. One quarter high growth doesn't mean that it will grow always at that rate. So that 17% is that because of the low base. Other 3 quarters our base was already good. So we still want to grow at the same rate. The secondly, non-trade is the market where the margins are low but the volumes are high. This time we went for non-trade. In future, the non-trade market also is increasing. RMC is increasing. And RMC means non-trade. We have also entered the RMC segment. And within 1 year, it is doing better than expected. So non-trade market is going to last and will increase. We will also increase in trade market, but trade market overall is diminishing.
So your mix should be what now going ahead? I think last quarter it was 62%, 38%. For the year, what should it be? 65, 35 or 70, 30 in favor of trade?
In favor of trade, it will be 60 to 62 only. It will not be increasing because, as I said, I expect the growth of non-trade segment to be more and the market is shifting there. Even in the small cities, people want to go for ready-mix concrete.
Okay, all right. Let's focus then on the demand trends, sir. How are the trends shaping up? As we always know, north is the bulk of your market. Then you look at east and then south. How are you seeing demand trends on ground? Are they as strong as expected? Are you optimistic that things improve from here on?
Yes, demand will be as expected. 7 to 8% growth will be there in demand. And it is pretty almost sure that minimum 7%, maximum 8%, this is the growth of cement industry.
Okay. So in that case, you're going to be outgrowing the industry. And that's been the strategy that you have laid out as well. When you spoke to me last, you said you're going to go and grab some market share since the pricing has got corrected. Tell us about costs then. Cost per ton went up in Q1 in comparison to Q4. But you're believing that the peak cost is behind now. I was looking at some measures that you have taken. Pet coke consumption came down drastically. You went more for coal. So you've made some changes at your side as well. Could you tell us how will the cost per ton look like in Q2 in comparison to Q1? If you expect it to remain flattish, or if in fact you expect the cost per ton to actually decline?
Cost per ton depends a lot on fuel cost. Fuel cost is right now dependent also on Iran situation, Hormuz situation. But overall, the things will not be worse than first quarter. First quarter, high uncertainty was there. And we were caught unaware. Lot of fuel cost has increased. That was the basic reason for cost increase. And now the coal we have to go because pet coke was coming from that area and that was all closed.
All right. So you're saying that basically the peak cost is behind you, but you want to give us a number. Will cost decline in Q2?
Yes, cost will decline in Q2, but how much we don't know. Okay. Because some coal will be there, some pet coke is there, which is to come, which is little cheaper, but the rest of the cost also should go down.
Okay, got it. Let's talk about it.
I will not like to give any number for cost decrease.
And I don't think you'll give us a number even on pricing outlook. So let's get straight to the point then. What about EBITDA per ton, sir? It's come down, but you're optimistic that things improve from here on. So for the second half of the year, what kind of a EBITDA per ton band you should look at? I think the past quarter was around 1,050.
It will be for the whole year. One quarter here or there may go, but whole year it will be about 1,050 plus minus 30 rupees.
1,050 plus. So you're talking about around 1,020 to 1,080?
Yes, that is the range.
Okay, got it. Tell us a little bit about your UAE operations. You know, I think the profitability is improving gradually. If I take a look at the console minus standalone, the contribution is going up a little bit, and you're adding capacity. So the UAE expansion comes on stream by September, October. Could you confirm that? And also, could you tell us how do you see profitability move up over there?
Profitability there should be good. By first week of September or second week of September, depending on the Hormuz opening up, some of the machines, all are ready. Some of the machines are stuck up. The ship has arrived there. And within a week or two, the machine parts should come to us. Another 2 weeks, we should be able to put them on the ground. So there the grinding capacity will be doubling. And we have enough clinker, or the clinker is available in the market also. So I think the profitability there will definitely increase.
Is there any kind of value unlocking plans there? Because UAE, I think for the year, on an annualized basis, could do 800-900 crores or maybe 1,000 crores as well, say in FY28. You could correct me on that number. If that's the case, would you consider separating this unit, maybe listing it somewhere, the UAE business? Well, I'll tell you what, sir, Mr. Bangur, you have created a lot of wealth over the years. But now the street is saying they want something more, dil mange more. Either you go ahead, do some inorganic growth, either you unlock some value in the UAE operations. They want some spice, sir. Are you going to give it to them?
Of course, everybody wants more. The more will come only once. So if it is today, it will be little less. If it is in future, it will be more. And the trunk of the tree is continuously increasing. You can cut it only one day. So we will actually delay it.
Okay, so what do you think, Bud? What is in all probability Mr. Bangur going to do? List the UAE operations, do some inorganic growth, or maybe do a big buyback as well, since you're sitting on close to around $1 billion of cash?
Buyback is not really required because commodity will always need cash. This year we have increased our dividend payout and we will like to keep it at higher level.
Okay.
A lot of the time we had increased the shareholders' value by conserving it. Now we will have enough, we will be distributing it.
Okay, so dividend payout you're going to look at. Listing of
Yes.
the UAE business at some point of time, is that an option? And is
No,
Mr.
it is
Bangur...
not.
No listing.
No listing. In fact, UAE market, stock market is not as developed as we think.
Okay. Inorganic growth, then Mr. Bangur not only going to the party, actually participating and putting in a more aggressive bid.
Inorganic growth, I don't think we can take it. We will look at it if the value is correct, and value is definitely not correct in India. It is very high.
Yeah.
So, but some good fix and match may be there. We are not totally away from it. We can look at it.
Okay, Mr. Bangur, as you said, spicy things take time to come about, and you're constantly looking to reinvent the business and scale up the business as well. Thanks a lot for joining in. We'll hold you these numbers. I think that volume growth of 10% is a little bit conservative, while the EBITDA per ton, we'll hold you this number, 1,020 to around 1,080 rupees. All the best and wishing you well for the coming quarter.
Thank you.
Okay, thank you very much, sir. Let's move on. We've got the management of Dixon Technologies reporting their numbers. Stock is down 2%. The miss here again came in on the margin front. The company's EBITDA margins came in at 3% below consensus expectations, and the company says smartphone volumes will remain flat in FY27. I think this is ex of Vivo. We have with us Saurabh Gupta, Director and Group CFO of Dixon Technologies, now joining in. Saurabh, margins at 3%. You've given us the explanation on why margins have contracted. In the comparable quarter of last year, you had PLI benefits. This is absent this time. Volumes have come off. But the question is, 3% margins, is that the bottom in Q1? Or do you expect FY27 margins to stay compressed around this level?
Yeah, good morning, Reena. Good morning, Nigel, Prashant. Yes, margins, of course, there are three major factors. One, of course, the PLI 1.0 has come to an end in March 31st, 2026. And now mobile PLI 2 has come in, but of course the guidelines need to come out. So we don't know how much will be the financial impact coming forward in the coming quarters. Secondly, there has been a consistent inflationary pressures across the commodities and supply chain. And in most part of the businesses, those elevated costs are passed on to the consumers. So optically, our margins look lower. And the third major factor, because of crude being on the higher side, the polymer prices and related costs have been higher, which has impacted the margins in our ODM business, which is a relatively higher margin business, both in washing machine and refrigerators. And but there's a pass-through mechanism. And but yeah, hopefully the crude, if it continues to come on the lower side. So these three were predominantly the factors. Now the margin drivers for us is going forward. One will be higher share of ODM business coming from lighting, from refrigerator, washing machine business as we expand the portfolio. Second is the impact of PLI 2.0, as and when the guidelines come out. We think we'll have increase in volume, especially on account of exports. And third, we feel that as and when our backward integration play starts to stabilize, both on the camera side and both on the display side, which should largely play out from next financial year, the margin should continue to see an uptrend.
So what you're saying is margins recover only in FY28? So for FY27, as things stand right now, what is your expectation on margins?
So Rima, broadly, we feel it should be in the similar range of 3 to 3.1. As of now, I am not able to foresee the impact of mobile PLI 2. Definitely, there should be some positive impact of that as and when it comes out. But one has to wait and watch for the guidelines, which should be hopefully announced in the next couple of weeks. And then you sit along with the customers on how much margin we can, as an EMS players, how much we can retain. But apart from that, yeah, broadly, it should be in the similar 3 to 3.1% kind of range.
Okay. All right. We'll come back to some of the nuances of the business, the input costs, and memory, for example, is also a big cost increase, cost inflation. Someone called it memflation. Saurabh, good morning.
Yeah, good morning. Good morning.
I just want to start by asking you about and congratulations, the Vivo JV finally approval came through, Press Note 3 approval came through. We have that 32 to 33 million number in terms of volumes, which you've, I think, put out in the guide, in the call as well. But you mentioned that earlier as well. But that is ex-Vivo, right, Saurabh?
That's ex-Vivo. So overall, Prashant, the market this year, because of this increase in memory prices, should contract by at least 10-15%. And if we are able to maintain our similar numbers as same as last year, I think so we have done well. So clearly, we are taking some incremental share from other competitors.
So you're saying overall smartphone segment should fall 10-15, market should contract 10-15%. And if you're able to do your volumes of 32 to 33, it will be close to last year's, which should be good.
That's right. That's right.
Okay. And anything you can, I don't want to push you, but on the Vivo front, anything you can tell us in terms of what your expectation is? It'll start, I think, to contribute to numbers in the third quarter. Just broadly, directionally, what is the guidance?
Yeah, so Vivo should be fructified in the next couple of months. We are just closing all the other formalities of Vivo. And on an annualized basis, Prashant, it should contribute almost 35-40,000 crore revenues to us, which should hopefully happen from next financial year. And our target for H2 of this financial year is to at least get 40% of that. So that should significantly add both to the volumes as well as the revenue numbers in the next half, in the H2 of this fiscal.
Half of the 35 to 40,000 crores in H2 27 and the full impact in?
35 to 40,000 will be for next financial year, and 40% of that we will definitely target to get in this fiscal.
Okay, got it.
All right. Hi, Saurabh. Good to see you again. Saurabh, just to get back to the volume front, I think you're guiding for around 9 million ex of Vivo in quarter 2.
Yeah, that's right. That's right. Slightly, nine, between 9 to 9.5 million. Yeah.
You can correct me on this point, but that will take the first half volumes to around 16.5 million, right? Pieces.
That's right.
Normally, first half of the year is better than second half of the year, right? So, I mean, traditionally that's been the case. But are you still optimistic that ex of Vivo, you can still do that 32.5 million that you're talking about?
Yeah, no, so not Nigel. Actually, mobile is something that people buy throughout the year, except for maybe one month immediately post Diwali, because you already have inventory in the channel. So quarter 3 is generally slower, but quarter 4, then again it normalizes. So mobile is one product I think so which people buy throughout the year. There's less seasonality as compared to other products.
You don't think that that's a challenge, because a couple of notes were mentioning that first half is normally better than second half, but you have cleared that point. Let's talk about the competitive intensity in the export market then. How do you see yourself going ahead and penetrating? Because the industry itself is not growing by a very great margin. In fact, there are signs of degrowth as well. And competitive intensity is moving up. So give us some color on that front.
So this new mobile scheme is focused on incremental volumes. So they will define FY 25-26 as the base year. And of course, everybody knows that India has done very good as far as the mobile phones are concerned. So we feel that once this mobile scheme gets announced, the incremental volumes from our customers, especially two of our anchor customers, will come from exports, and they will look at making India a large hub for their servicing the global market. So we're already in deep discussions with them. And we feel that two out of that, all the customers that we have, largely we feel that a lot of export volume will shift to India.
On exports, I think you flagged off an opportunity of 18 to 20,000 crore.
Yeah. We feel in next couple of years, we can take this export numbers to 15 to 20 million. And revenue-wise, it can be almost 25,000 crores. And this PLI timing is absolutely come at the right time for us and for the industry, actually.
Okay. And on PLI, it currently offers, I think, 2.5 to 5% on incremental production, plus a 1.5% on localization. Where would you stand at currently in this entire band? And suppose if it comes through by, in this quarter, in Q3, because it's retrospective from 1st of April, will you account for it one lump sum in Q3? Would Q3 see that bump up?
Definitely somewhere around Q2 and Q3, it should start reflecting, a guideline should be out hopefully next couple of weeks. Already we have established infrastructure. We already have working with all the large marquee brands in the Android ecosystem. It should be up and reflecting in next couple of quarters. Of course, the new models would take some time, but my sense is, it should definitely start reflecting in Q3 as far as exports are concerned.
Just out of curiosity, the memory inflation, what was it as a percentage of a cost of a smartphone on an average, and what is it now? And what's been the increase last 2 years or last 1 year?
The last 1 year, Prashant, it has gone up from 12% contribution in an overall smartphone to almost 30-35%, which means the memory prices have gone up by 5 to 6 times. And the average selling price of a smartphone has gone up by anywhere between 30 to 40%. And that is the reason why the demand is getting impacted.
Wow. That is... at some level, this should feed through into consumer inflation as well, right? I mean, generalized consumer inflation. I mean, I don't know, but that's maybe a topic for another time. But this is quite significant. We'll leave it there for now, Saurabh. Thank you very much for joining us. Good speaking with you. Appreciate your time here, and good luck.
Thank you, Prashant. Thank you.
But it's showing up in the volumes, right? So if you look at Dixon's volumes, smartphone volumes in Q1 are down 23% on a year-on-year basis. In Q2, when they guide for 9 million of units, it's still down about 14% on a year-on-year basis. So that higher price is sort of feeding into higher realizations, higher ASPs, but lower volumes.
Yeah, but they're saying that the overall FY27, they'll end up with $32 to $33 million, which is essentially...
Same as last year.
Same as last year, which means that, if the industry is shrinking 10-15%, they're actually taking share from somewhere else, from some other players. And I think that's the important point. Well, Nagaraj Sethi is with us of HDFC Securities with some technical... Okay, I think we'll take a break. Nagaraj with us on the other side. Welcome back. Nagaraj Sethi is with us of HDFC Securities with trades to take right now. Nagaraj, good morning. Good to have you with us here. Index and stocks, what's on your mind?
Hi, good morning, Prashant. Thank you for having me. Market is placed very well on the charts after having consolidated over the last couple of months. The Nifty is now placed at the edge of breaking decisively above around 24,500, 600 levels. The overall chart pattern is looking positive. Once Nifty sustains above 24,600 levels, I'm expecting another 500 points upside in a quick period of time. And I have two stocks from my side. First is one from a financial front, Chola Finance. Chartically, Chola Finance has been in a tremendous up move. Higher tops and bottoms on the charts indicates the sustainable upside in the stock price. Currently broken above after forming a higher bottom and now trading around 1895, 1900 levels. One can look to buy at current market. The immediate target would be around 2000. One can place a stop loss at 1850. Second one is from an energy front, Chennai Petro. The Chennai Petro has been moving up constructively around high tops and bottoms over the last few months, and currently placed at the edge of moving above the crucial hurdle somewhere around 1320 levels. Overall chart pattern, volume and RSI indicating more upside in the near term. One can look to buy at current market, which is around 1315 levels. The immediate target would be 1375, and one can place a stop loss at 1270.
Okay. Thank you very much for that. Let's talk about Divi's Laboratory. Ekta in the morning was telling us blockbuster numbers. Ekta, what else have you learned?
Well, yes, all of the details did come out over the weekend because they did have their conference call over the weekend as well. So overall, it was a very good set of numbers. The revenue came in a little above 3,000 odd crores. The street was anticipating around 2,900 odd crores this quarter. The margins were the real kicker this time. So the margins came in at 40.7% this time versus 33% on a sequential basis and versus 30% on a year-on-year basis. These are the best margins that you've seen for the company report since FY22 at least. Now the profit came in at around 902 odd crores and the street was anticipating around 657 odd crores. Now the street is estimating that maybe there could be a one-off type of payment during the quarter, but nonetheless the management is very confident about the rest of the year. So they have reiterated their peptide capabilities to investors on the conference call. Separately, they've maintained their double-digit growth guidance as well, and they expect the EBITDA margin to be broadly similar to last year, which stood at anywhere between 32 to 33 odd %. Overall, they're targeting a healthy, balanced product mix with no over-dependence on any single product, customer or supply chain. So well diversified is what they have communicated to the investor community. Remember, expensive stock, it's already run up around 27% on a year-to-date basis. It's already trading at around over 50 times on a FY28 PE. So expensive, but still the street seems to see some upside today.
Thank you very much for that. We will get into a break. On the other side, Lata will discuss the future direction of the rupee and rates with Midul Kotecha of Barclays and Abhishek Upadhyay of ICICI Securities. Stay tuned.
Welcome to It's the Economy. A bunch of short and long-term changes are buffeting India's rupee and rates markets. Short-term factors include the flow of $40 billion so far via FCNR deposits and the others like ECBs and overseas foreign currency in just 7 weeks. FPIs are turning positive on Indian equities in July. It was our first time after February, and Bloomberg did not include India in its bond index, has deferred the decision for now. The longer-term factors include some new thinking on the part of Kevin Walsh, like not giving guidance, and he's even questioning the PCE inflation as the right measure of inflation. This has kept US bond yields at 2-year highs of 4.7%, despite crude prices falling. Finally, of course, we have an RBI policy day after tomorrow. To parse all these factors, I have with me two experts, Mitul Kotecha, the head of FX and EM Macro Strategy Asia at Barclays, and Abhishek Upadhyay, the co-head research at ICICI Securities Primary Leadership. Abhishek and Mitul, thank you very much indeed for your time. Abhishek, to start with you, Bloomberg index inclusion not coming in, is that a major disappointment for the market? And of course, from the policy itself, do you see anything positives emerging for bond yields?
Well, to the extent government had rushed an ordinance to make the big tax changes, it was expected that, and it was considered highly probable by markets that Indian bonds will be included. To that extent, clearly, in terms of sentiment impact, clearly it's a negative surprise. That said, our base case was that the phased inclusion process for inclusion of IGBs could have likely started around the start of next fiscal year only, even if announcements were to come now. And if there were any front-running flows which were to accrue in run-up to the inclusion process, those could have likely come at the fag end of this year or early next calendar year only. So I would treat this more as a sentiment impact rather than a big negative from immediate flow picture. Based on the commentary given by the index provider, it still appears that the inclusion process should be considered as a baseline sometime, next fiscal year. So perhaps June or September next year, we could still see the start of the inclusion process. So don't think it is a long-term negative in that context. Still quite optimistic it should happen. In terms of monetary policy from RBI, this should be a status quo policy from RBI, and markets will really focus on any soft signals RBI provides about subsequent meetings, about their reaction function, and whether they are leaning towards a rate hike in next couple of meetings or not. Again, don't expect any sharp communication from RBI or a stance change that boxes them into a corner. But ideally, the language should turn progressively more hawkish to indicate such a bias in subsequent meetings.
Okay. Abhishek, the other thing that may impact us is this persistent US yields at 4.7%. It's now no longer moving as much as it used to with crude. Today we saw a 5% fall in crude. We are not seeing the fall in yields. And that appears to be because of several doubts sown by Kevin Walsh about whether PCE inflation is the right measure, about the number of FOMC meetings, and, of course, removing guidance altogether. First of all, is this expected to continue, US yields at elevated levels, and what does that mean for India?
Well, US long end of the curve was already under pressure last few months, and what we saw after the last FOMC meeting was that the 30-year bond yields actually went sharply higher on the day, which is a development which should unnerve any policymaker. As you know, and in US, long end of the curve is quite important from macroeconomic standpoint because mortgage rates, etc., are linked or pegged to that part of the curve. So that part of the curve behaving the way it did on the margins increases the possibility that Fed will need to tighten policy maybe in the September meeting or if not a little later. And that is the part which RBI should take into account as well. Of course, we have seen, I mean, in earlier periods that RBI has been able to ease monetary policy while Fed has hiked. I'm referring to the 2016-2019 period when that happened. But the difference is that interest rate differentials are very narrow this time around. And our real policy rates, while those went up in the 2016-2019 period because rates were cut at a slower pace compared to the fall in inflation, what we are seeing this year is that real policy rates are going down as inflation picks up. So it's a tricky setup from Indian standpoint as well, and one which RBI should take into account when considering the monetary policy reaction function, maybe as soon as the October MPC meeting.
Okay. Yeah, actually, after the August meeting, this rush of dollars will also be something which will be on the RBI's plate. It's $40 billion already. We still have 2 months. So what is now the market's expectation? It was very common on the market for everyone to guess 50 billion. Now that looks like it will be, end of this week or, in a few days. So what are you all working with as overall dollar flows, and what will that mean in terms of liquidity? Should you expect some liquidity advanced steps to be, hinted by the RBI in the policy itself? And anyway, when and what kind of steps are you expecting to absorb the liquidity?
So, Lata, in terms of FCNR flows, we were thinking roughly 60 to 70 billion of flows all put all together earlier. But based on the numbers which are put out lately, it appears we are clocking a 10 billion kind of run rate every fortnight, and it is possible that back half of the period, next couple of months, could attract more flows. So yeah, I mean, I agree that the street estimates will be drifting higher, perhaps to 80 to 100 billion kind of range for overall flows put together. And that will have impact on the bond market sentiment, on the FX market sentiment as well. In terms of what this means for liquidity, yes, I mean, liquidity surplus will build up. But still, what we are looking at, I mean, for the full year, we will be likely be looking at somewhere between 40 to 50 billion BOP surplus, which is comfortable but not high enough to mean core liquidity surplus continues to build up over the course of the year. What will happen is that core liquidity surplus will build up over the next 2-3 months, but then come down over the latter part of the fiscal year, which will mean RBI does not need to take any durable or resort to any durable liquidity withdrawal or to resort to instruments to CRR or OMO sales. Maybe a long-term VRR kind of a tool will suffice from RBI standpoint. One point I will make here, though, is that RBI should be proactive in ensuring that overnight rates don't dip below the repo rate. Given risk, RBI may need to tighten in the back half of the year. And I mean, taking into account that monetary conditions actually compared to the June meeting are now easier. As you would be aware, the short end of the bond curve has drifted lower after RBI announced the FCNR scheme. So to that extent, RBI needs to be extra vigilant. Given global interest rates are going higher, our inflation risks are building up, and potential need for rate hikes, RBI should be proactive in ensuring overnight rates don't drift below repo rate in this environment.
And so they would have a VRRR or something?
Yes, I mean, long-term VRRR with some optionality to reverse could be a good tool to begin with.
Okay, but will they hint it in day after tomorrow itself?
So don't expect RBI to say all tools are on disposal. Okay. I mean, if governor indicates OMO sales or CRR hikes are on table, then that would be negative. What market thinks right now is a more temporary, a tool which is more temporary in nature. May not flash it out, I mean, in full detail.
Okay. And Abhishek, finally, just give us an idea of anything that you will watch out for. Will there be a bringing down of the inflation forecast or bringing up of the GDP forecast? Because April, May, June appears to be very strong. And look at the July auto sales as well. Growth looks stronger than what RBI prepared the markets. Anything that you will watch out for forecast changes or tone? Just guide us.
In the last meeting, RBI revised up the inflation forecast sharply, while growth forecasts were lowered. In this meeting, don't expect big changes. It is possible that maybe growth forecast could be pegged up 20 basis points, whereas inflation forecast could be pegged down similarly, given inflation has surprised a little lower over the last quarter. But I mean, forecasts are important not just in terms of looking at the arithmetic, but also markets will interpret any tweaks to forecasts as signaling from RBI. So to that extent, I would believe that if RBI does want to indicate that maybe rate hikes are on the anvil in subsequent meetings, it will be wise to maybe largely retain the inflation forecast for rest of the year, while growth forecasts could be pegged higher. Also, other factors, I mean, what I would look for particularly is a governor's emphasis on headline inflation versus core inflation. I think it will be ideal for governor or broadly RBI, I mean, policy statement to emphasize headline inflation more. Given back half of the year, we could see headline inflation averaging closer to 5.5.
Yeah.
While a lot of it will be because of food inflation, it will not be because of just one-off factors like vegetables. Expect a broad-based rise in food inflation, which RBI should not ignore, given the strong growth that we are seeing and given the current level of policy rates, which are very, very accommodative in our understanding.
Okay, so you want the RBI to indicate some hawkishness in some fashion. Very quickly, I mean, Abhishek, I know this is not your core area of interest, but looking at the FCNR flows, the change in the sentiment of FPIs, where do you see dollar rupee? We have seen 95.14, but this Bloomberg thing is a negative today. We are underperforming other markets, though we are up 0.25%, the rupee. What's the rupee trajectory now?
Well, the rupee price action was quite weak over the last couple of months. I mean, after the scheme was announced, we would have thought rupee could appreciate more strongly. Of course, that didn't happen, partly because dollars strengthened in the interim. Also, what we saw was that weak price action begets weak price action. So because rupee didn't appreciate strongly, and that was partly also because RBI was unwinding some of its short positions, short dollar positions in its forward book. Lately, what we have seen is RBI has acted more strongly, and which is suitable. I think it will be suitable for RBI to keep intervening strongly in this environment, because if a stable rupee could mean that the hedging behavior of importers and exporters, which was a key headwind for rupee over the last few months, as importers hedged very aggressively, whereas exporters were not doing that, maybe that behavior could change and could be a tailwind. So, broadly, assuming dollar stays on a strong footing but doesn't appreciate too strongly, in an environment of good flows, and now that RBI is intervening more strongly as well, expect rupee to trade with a positive bias.
Okay.
So maybe a 94.5 level over 3-month period, but don't expect any big appreciation as well, because flows in the back of the year could be weaker.
Oh, right. Okay. We'll leave it at that. Thank you very much, Abhishek, for giving us a 360-degree perspective of the economy. At the moment, markets in a fine fettle. And when I say markets, I mean equity markets, almost racing to 1% gain, the mid-cap index that is, and Bank Nifty as well, not terribly worried about the fact that bond yields have not done very well. In fact, bond market is the only one that has not gained too much today. It is the Bloomberg impact. But other markets, both currency and stocks, in a fine fettle, in a fine mood this morning. Wrap up on Bazaar Chartbusters. Take the action forward after the break.
OPEC Plus completes the rollback of its voluntary output cuts, raising production by over 188,000 barrels per day. Brent crude tumbles over 5%, lifting sentiment on D Street. Stocks gap up, with pharma being the lone laggard.
Cigarettes and hotels conglomerates ITC delivers a weaker than expected June quarter, but they get a boost from less than expected fall in cigarette volumes at around 5 to around 6% in comparison to around 8 to 10% expectation. FMCG and paper business whole firm Kotak, CLSA and Nomura, they remain upbeat on the counter. Hence, the stock is up 3.5%.
Margin pressures weigh on Muthoot Finance June quarter as margins shrink 250 basis points, dragging profits lower sequentially. MD George Alexander Muthoot guides for 10.5 to 11% margins. Tells CNBC TV18 that AUM guidance may be revised post the second quarter, stock down 10%.
SEBI action batters Z Entertainment. The stock tumbles 10%, marking its sharpest decline in nearly 2 years. Regulator bars the company, Subhash Chandra as well as Puneet Goenka from securities market for a year. The order casts a shadow over the company's 3,100 crore warrant issue.
Divi's Laboratories delivers a standout June quarter with EBITDA margins hitting a multi-quarter high of nearly 41%. Management reiterates its double-digit growth guidance for the year. Meanwhile, core business powers urban companies' June quarter performance. Both stocks steady in early trade. Divi's up 5%, urban company up 13.5%.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, Mangalam, things looking quite good. The bulls will feel pretty good waking up on this Monday morning. They're driving home the advantages as well as we speak. The 20 DMA has got taken out. All eyes are on the 200 DMA, which is approximately close to 200 points from current levels.
Take that point, Nigel, on the frontline index. And the interesting part is that, all the sectors which weren't doing particularly well have now come back in style as well. Case in point, look at the IT index as well as the pharmaceutical index. The IT index took a bit of a backseat on Friday, recovered towards the end of trade, and right now as we speak at the high point of the gain of almost 1.3%. And the pharmaceutical pack as well started off fairly in the red, and from there we've seen recovery. That index too has moved higher. Across the board there are gains. There are 5 stocks advancing for every stock which is declining. The only fly in the ointment is the put call ratio, which has moved to 1.5 versus 1.4. So higher in the range. Let's see where that goes.
Well, that's right, Mangalam. And a few stocks actually that were under pressure cutting their losses. Latent View, I recall the stock was down more than 5%. That's cutting its losses. In fact, we've seen a bit of a recovery from the day's low. I think we should pull that up. And Aarti Drugs, that's the other stock that I'm looking at. That as well has pulled back a little bit from the day's low. We'll also keep an eye out on the kitchen appliance maker, Stovecraft, that comes out with its set of numbers. The stock actually has corrected close to 8-9% from the recent peak. There is some profit taking that's creeping in. But in the last few minutes, there is a bit of a pop-up. Results today. So let's see what that has to offer. Stock moving to the day's high. Well, let's turn our attention, though, to our special segment where we get you a few ideas for profit from Money Control Pro. Madhu Chandra Dey of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu?
Hi, we are talking about InterGlobe Bank that recently came out with its earnings report. Going by the Q1 FY27 earnings release, what is evident is that the turnaround in the bank has already started. The bank reported a sequential growth in its advances as well as deposits. While the growth in advances was supported largely by wholesale lending, the growth in deposit was also mostly due to the growth in term deposits. However, the bank improved the share of retail deposits in total deposits. Thanks to the adverse loan mix, there was a compression in lending yield, and hence, despite repricing of deposits, the bank saw 4 basis point sequential decline in its net interest margin. However, asset quality improved, fees growth remained supportive, and added management of cost also provided a kicker for earnings. With multiple levers for ROA improvement, including credit cost, the bank is gunning for 1% ROA by the exit quarter of FY27. We see InterGlobe Bank as a good long-term turnaround story.
All right, we take that point. Thanks a lot, Madhu, for that. Before we take that short break, just pull up Godfrey Phillips as well. A short covering rally in ITC has pulled that one higher as well. Maybe the street believes that this quarter, the quarter that just went by, was obviously the bottoming out quarter for this space itself. And now over the next few quarters, we'll probably see some repair from all these companies when it comes to volumes and overall performance. Godfrey up 5%, pull up ITC, that's the one which is up 5% as well. Take a short break, come back, get you more on earnings. We have the management of Kirloskar Brothers joining in to detail their first quarter numbers.
Welcome back. Well, let's focus on another management, that of Kirloskar Brothers. They reported actually a steady revenue growth in Q1. Margins and profitability remained under some bit of pressure. The order book, however, continues to strengthen. Joining us now is a rare voice, Mr. Alok Kirloskar of Kirloskar Brothers. Hi, Alok. Good morning. Thanks a lot for speaking to us here on CNBC TV 18. Well, let's break it down first in terms of your numbers, the standalone business as well as the international business. Now, in the standalone business, the growth is close to around 8.5%. However, the margins have seen some kind of compression if I look at it on a quarterly basis at least. How do you see things pan out from here on the standalone business and your international business as well? Growth has been good out there, but on the margin front, there has been some compression. So guidance on both these two.
Sure. So, domestic business has a component of an industrial side and a retail side. I would say that both have been relatively strong in terms of opportunities. Conversions have been a little bit slower. As you might be knowing, on our industrial side, we have good opportunities on the steel stake segment where almost projects of over 50 to 60 MTPA have been announced. And that's something that's interesting for us and continues to be a driver of growth. We also see opportunities in oil and gas as well as in water especially. There are a lot of new projects in JJM, Amrut 2 that have been announced, and that's an area that we believe will continue to give us growth. It has given us, as I see on the screen, a little bit of muted growth in the last quarter, but we are optimistic about where that's going. At the same time, like our international business, we do see data centers coming up, not quite at the same pace as our international business because international business covers America, which is quite large in data centers. But we do see them coming up in India, which is a big opportunity. Margins have been tight, and that's also because input costs have been going up. I think the various issues across the world, which we are all aware of, have contributed to these trends of costs going up across the areas. Another point that I think is interesting on the domestic side is both defense, where we have a large number of opportunities, many of them covered under an NDA, so I can't mention each of them.
Okay.
But definitely connected to Atmanirbhar Bharat. And as you know, we are approved with the Indian Navy, the Indian Army, and also have UA approvals on the domestic side.
I'll give us some numbers, right? Standalone business, what kind of revenue outlook are you looking at on that front? Where do margins stabilize at? And international business as well, since it's growing at a faster clip, how do you see that evolve?
Domestic, I think we've always said on all our calls that we are looking at double-digit growth. That's really what we are focusing on. There are opportunities for us in double-digit growth and margins. As we get the input costs back in, and we, as many of us as manufacturers do push on some cost to consumers. We should expect to get back in line to previous quarters in terms of percentage margins. International side you have mentioned has been very strong. We have a good momentum on data centers in the US, which has picked up from probably 4 years ago or 5 years ago from 0% of our business to 25% of our US business. And similarly, we have a strong movement in oil and gas, especially in the Middle East. We made a disclosure a little while ago of a single job of over 125 odd crores. And that was the third job in sequence that we've got on the Qatar projects, and there are many more coming up in that space. So we do see a good amount of momentum. We also see the AMP cycle, AMP 8, which is Asset Management Program 8 coming up in the UK. That's a 88 billion pound program over 5 years. Of course, a large portion of it this year has been around resilience, which is clear water. It's an area that we're strong in. So that's another area that we see huge potential in. We anyway have mentioned that you have seen double-digit growth there. Our, of course, issue has been on the international side that our mix has changed, and that is really what is impacting our margins significantly. With the price of energy so high in Europe and the UK, a lot of energy-intensive plants where we have multi-year framework service contracts are idling. These are chemical plants, steel plants, plants like this that require power. And because they're idling, we're not able to get the same amount of regular service business that we get from them. Today, we manage almost 160 sites outside of India, framework contracts, multi-year framework contracts.
All right, take that point. So, short point, double-digit revenue growth for this year happens both across domestic and international. And you said margins will progressively move towards what you had done earlier. In the peak, you've also done roughly 15%, but normalize about 12 to 13%, or maybe 13 to 14%. That's a fair estimate, right?
Yes, definitely. And that's something we're seeing on the international side, as we build back the service order book.
That's good. If you could give us a sense a little on order wins as well, because through the conversation you've been speaking about, a fair amount of opportunities in water, oil and gas business in domestic, international as well, India data center opportunities, you have domestic opportunities in defense, the nuclear power reactors as well. So across all of these, could you give us a sense on what's the kind of order win that you're targeting at least this year, and then the opportunity over the next 1 or 2 years? If you could give us a sense on the bid pipeline, the ordering activity that is taking place, and your execution, winning of these orders, say, over the next 12 to 18 months, both international and domestic, if you could break that down category-wise too.
Sure. So I would say that, if we start in, let's say, domestic as an example, we do have good traction in the steel industry. That's somewhere that we've been historically strong. And we do expect the projects that I have mentioned to you, which are covered under various big manufacturers, but mainly under Tata, JSW and others, where we expect to get good traction. At the same side, there are projects in the ethanol space that we see that there is movement there. Historically, we have been very strong in sugar plants, distilleries, along with the key OEM supplying products in that segment. And that's something that we see continuing to give us momentum. On the international side, and hence connected also to domestic side, is data centers. A majority of the big players, whether I'm just giving you names as examples, whether it's Brookfield or whether on the private equity side, or it is Amazon or Google on the international operator side. We have installed products in all these installations that are managed by them outside of India. And now that they're coming in India, we are already approved on an approved vendor list. So, from that point of view, we see in India to get good traction. We already have great traction outside India in that segment. But just to put it in context, as you probably know, the US has 4,200 active data centers, and 2,000 data centers have got planning permission, which includes water and power supply. So to put that in context, the opportunity is far larger than the rest of the world.
Could you quantify that opportunity in India? Say for every 1,000 rupees that is spent on a data center, what part of the value chain is actually accrued to you?
So usually, I think I mentioned this on an analyst call, usually on a hyperscale data center, most hyperscale data centers, because we don't supply just pumps. Normally, in any project, 1 to 1.5% is what we expect to get, regardless of what the project is. But for pumps. But because we supply modular systems, and this is something that we took from our offshore experience in the oil and gas industry, which is plug and play systems, into the data center industry, it is not the same. And so usually in a data center package, pumps account in a hyperscale data center package, pumps account for, or pump systems account for around, excluding intake water systems, which is important to note because intake water systems could be seawater or river water, which is very different. But excluding intake water systems could be anywhere from $10 to $12 million for the pump package. So that's really what we are, we are sort of targeting in all these industries, and we see opportunities. Like I said, India, the US. The Middle East was quite a hub because they have water and power, both quite cheap. But unfortunately, in the current scenario, that's taken a back seat for all the Middle East players. But there continues to be growth in Southeast Asia. So I would say that's an opportunity that is there, both in international and in domestic. Oil and gas obviously is an opportunity that is there, international and domestic, with, as you probably are aware, upgrades in Qatar, but also new exploration that has happened in Guyana and now coming into Suriname.
Absolutely.
Number of projects coming up there, and we've already installed recently a project in Guyana.
Okay, all right. Alok, just going by all that you're saying, it seems the opportunity is tremendous, and you and your team are looking at capturing majority of what you all can garner. All the best. We look forward to having a longer chat with you as the course of this quarter does pan out, and then catch up again for the results. Wishing you all the best, and we'll get further details as things progress. For the time being, we slip into a short break. On the other side, we have another management that's waiting for us, that of Intellect Design Arena. Stay with us.
Welcome back. It's a 200-point up move that we're seeing on the Nifty. As you can see at the top of your screen, the Sensex closing in on that 79,000 mark as well. We have the management of Intellect Design Arena joining in to discuss the company's first quarter results. And joining us today is, the company saw strong license-linked revenue and robust deal wins across. Arun Jain, who's the chairman and managing director. You can see him on the screen. Thanks a lot, Arun, for joining in. You're smiling widely. I see, you're happy with the performance that has happened so far. 20% plus revenue growth. The margins holding on around that 20% mark as well, just shy by a bit. But that's also led by, higher investments in employee costs and higher R&D. So if you could give us a sense on, what's the outlook when it comes to growth from here on? Annually, will you continue this 20% plus sort of growth? And margins, where do they settle given your increased spends in both R&D as well as employee expenditure? while saving some costs coming in from artificial intelligence as well. So how should we look at your numbers for the full year now that the first quarter is behind us with over 20% revenue growth and margins near 20%? I think you're on mute, Arun. Yes, go ahead.
Thank you for this beautiful question. That it's a breakthrough quarter for us. This quarter, maintaining this 20% growth rate achieved because of our two technology stacks, eMAX stack and a Purple Fabric stack, where AI first banking becomes important, and it's got attention span that we need accuracy over there on the technology. So now the important point is, what is the outlook forward? We have a fundamental, our research team investments, which is done in AI over the last 5 years, or I would say 10 years, but 5 years after generative AI. Our technology team have cracked something very unique on the top of Claude, which Claude is not able to do it, is we crack AI native engineering for financial services enterprise applications end to end. And this end to end is so unique to us in an industry where Anthropic and Claude, which is designed for individual productivity or coder productivity, we expanded that to the application lifecycle management. Our research team has come out with two technologies where we filed 28 patents in last 3 months in Indian right now and in US. And these patents are on around two areas. One is called spatial 21 dimension spatial graph technology. And second is precision blast radius. When any financial change happen, how you calculate a very precise blast radius of the change, which most of the time delays the.
Mr. Jain, I can make out the kind of passion you have and excitement you have for the business, and that's someone who's heading a company and looking at growing it. Clearly, you're very, very involved. But I'll tell you what, the audience as well as your shareholders will want to know two big numbers. One, if you could tell us what kind of revenue growth can you guide for the year, and since you're spending a lot on R&D, what could the margin trajectory look like? So I'll request you for both those two numbers. And just one more number, Purple Fabric, what kind of contribution can it, is it at, and where is it headed? 3 numbers, revenue for the company, margins, and Purple Fabric. Go ahead.
And that I cover, but I think investor has to look at the lead indicator today, because AI is the lead indicator market, not only the lag indicator market. When you are the lag indicator, which is, we have demonstrated 15 to 20% growth in last 6 quarters consistently. We crossed 845 crores. So all these numbers are in line, 20%, 15 to 20%. Our design on EMAC is in line. We can be, we are confident about 15 to 20% growth in a year. So that's one number. Margin will improve quarter on quarter because our cost of AI has been applied internally. So margin will improve quarter on quarter. This both the question has been answered. The third question is sustainable. Yes, it's sustainable, and AI will have impact on at least sustaining the same cost. So new growth will come with almost 80% of it will go to the bottom line. So bottom line margins will go up. So this is what the simple answer is for that question. But lead indicator was important for me to highlight to my investors.
Absolutely.
No, we understand that entirely. And it's interesting that you're giving us both the lead, lag, and the present right now as well. So since you're giving us as many data points, one thing that we'd like to know is Purple Fabric. Specifically, how much does it contribute to your revenue and the pace at which it's growing? What's your aspiration here?
Yeah, so Purple Fabric is where the major breakthrough happened. The cloud as a technology growing phenomenally well, but it's doing the justice to the individual productivity. Our research team has applied in financial sector where the precision is most important. And our experience of last 40 years in this field has helped us to apply the technology into the context of reducing the cycle time of the change and reducing the effort required to make a change. And that these two technology which I was describing was we have built up a complete AI native engineering.
Right. No, we are excited about the technology and, the way you are explaining that as well. The streets listening into everything that you're saying, the stocks actually move to the high point of trade. We just wanted to know financial contribution currently coming in from Purple Fabric, and given that it's a breakthrough technology, one would expect exponential growth happen out here as well. So how much does it contribute in your revenue right now? And what is it likely to be, say, 12 to 18 months from here on?
The revenue number we have disclosed last quarter is close to 200 crore. The revenue comes from Purple Fabric, 170 crore was the last quarter. So that's a number which is there. And Purple Fabric as a overall unit, which is a secondary unit investments, which is getting a revenue because of banking sector products are getting sold better. You can contribute another 10% of revenue coming because AI has been applied in all the products of Intellect.
All right. So you see this business scale up considerably. Finally, you're sitting good amount of cash. How do you use it, sir? Is there some inorganic growth you're planning?
We are looking for some opportunities to see some inorganic growth can be possible in some countries where legacy applications are there. Can we migrate to emac.ai application? So those are the areas which we are looking at it to apply for.
And what could the possible size and timeline of potential deals be?
As of now, we are too busy in scaling up our initiative on the cloud. I think this is a very, very large initiative. So it's only partially which is working on. The acquisition team is not getting that much attention. But important is scaling up of this technology, what we have built up, AI native technology. I think India is not taking stock of the Indian. I think we have a handicap that all of us are so focused on yesterday and today that we not investing and making a noise about our technology disruption at a larger scale. So that there's a less of listening in our channels on what is the power of the AI is needs to be listened to. That Indian research labs can also produce superlative job that compared to anybody else in America. And
Mr. Jain, talking about listening and channels, people are listening to you here on CNBC TV 18. As we speak, your stock has moved to the high point of the day. So clearly the street has taken note of what you're saying, the kind of guidance you're giving, and the kind of passion that you're talking with as well about scaling up this business.
More than anything else, the patriotism. He said that we can look about, technology driven in the US and all of that and stuff, but our Indian labs are no less. And that's exactly where you will be putting in a lot of your R&D as well, the R&D capabilities. A big up move is what we've seen. But with that, unfortunately, we're out of time, not out of questions, but we'll invite you to have a longer chat with us and then you explain each of your products in detail to us and the shareholders along with our viewers as well. Thanks a lot, Mr. Jain, for joining in. With that, we take a short break, wrap up on this edition of Chartbusters with the news that the market continues its march forward, 24,600, closer to that number on the Nifty. From Nigel, me, thank you for watching. The team of Trading Hour comes up next. Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangala Malu. With me as always, Hormas Fatakia, Ritu Singh. We kickstart a new week, a new month here on CNBC TV 18 with the bulls going all guns blazing. Everything's looking good. We have Brent crude prices much lower, around that $83 per barrel mark. The Nifty hitting a double century straight off the bat, closing in on that 24,600 mark. The Sensex doing well. The IT index, the banking index, and the pharmaceutical index, which was underperforming earlier, has now moved higher as well. What does all of this mean for the way your portfolios are looking today? Well, 5 stocks in the green for every stock which is declining right now. So across the board, great gains coming in. The only worry, is it too much of a good thing? Because the put-call ratio has now moved towards 1.6. But the bulls will take it as it comes. A good day is what we'll take. Hi, Ritu. Good morning.
Well, good morning. No such thing as too much of a good thing in markets. I mean, good to see the markets looking stronger today. 24,500 has been that psychological barrier. We're trading well above that at 24,595 as we speak. It's looking good across the broader markets. All the heavyweights pulling their weights. Bank Nifty trading with gains of almost 500 points. The IT pack also doing its thing. But, individually what's, holding up pretty well as well is names like HDFC Bank, ITC, Infosys, ICICI Bank. All of these are helping the Nifty along. But on the flip side, Airtel, Sun Pharma, Bharti are some of the names that are a bit of a drag. The media pack as a whole, on account of what's happening with Z primarily, that's in the red. But apart from that, it's a sea of green. But let's do one thing. We'll focus on individual stocks to focus, in the market session today. And Hormas, as always, has walked over to the wall with that list. Good morning, Hormas.
It's a very good morning indeed. And it's taken 3.5 months, but we are finally back at 24,600. The intraday high just a few minutes ago punched in 24,601.1. That is the swing high that we saw on the 21st of April, and we haven't seen those levels until today. So that's the level that we need to see, need to cross and need to sustain for a further move back towards that 24,800, 24,850 levels on the index. And today, after that entire last week of sluggish moves, the Nifty Bank is contributing to the gains on the index today. And after facing that 57,500 level as a barrier all through last week, the index has finally managed to sustain above those levels near the 57,800 mark now, 500 points higher on the index as well. Now look at the result reactions that have come in today. Unlike last week, the result reactions are more positive than the negative ones. Look at Urban Company, 15% higher on that. Divi's Laboratories, after a very strong quarter, more price targets coming in excess of 10,000 rupees now for the stock, 4.5% here as well. Aditya Birla Capital is a consensus buy. The stock is at a record high. They're still trading 6% higher, and ITC, after some upgrades that have come in for the stock today, cigarette volume growth being better than feared, 3% higher on that one as well. But look at the negative ones as well. Muthoot Finance is the one that dominates that list, 9% higher. There's still some recovery that you're seeing from the lows. At one point was down 11%, even 12 at one point. Latent View is down 5%. Persistent Systems too seeing losses of close to 3% after its results that were reported on a Sunday. The newsmakers list, well, Z Entertainment leads that chart here, 10% higher, 10% lower in fact on the stock, the top loser on the Nifty 500. Thangamayil Jewelers, another 5% lower circuit. The price band has now been revised to 5%, so continues to trade in a lower circuit. And Shalimar Paints, after of course the fall in crude oil prices, paint stocks doing well. Now look at 17.5% higher on that stock. Well, look at the FMCG names as well in today's session. ITC's results has had a positive rub-off on Godfrey Phillips, that's 5% higher. Jubilant Foods has moved to the highs of the day, 6% higher here as well. Emami and Godrej Consumers reporting results this week, trading with gains of close to 2.5%. And lastly, look at record highs. We spoke of Aditya Birla Capital earlier, but look at Craftsman Automation. That has crossed 10,000 rupees as well, 4% higher on that one. Minda Corp is at a record high. Deep Industries too at record high levels, 6% higher. All of them having a great day at the office.
A great day at the office. Thanks a lot for that, Hormaz. A bunch of stocks which are buzzing around. Let's talk about Raymond Lifestyle now. Reported their numbers. The top line growth in the quarter came mostly from its garmenting business on a low base, up almost 50%, even as the bottom line stayed in the red on account of higher costs, taxes and margin compression. We do have the management who joins us now. Satyaki Ghosh, who joins in to detail the numbers and break down the outlook for the company. Thanks a lot, Satyaki, for joining in. The street's looking ahead. The stock's up in trade today, and that's largely because of the green shoots that the street is expecting, specifically from your garmenting business. 50% growth is what you've done in this quarter, closer to 300 crores on the top line. EBITDA turned positive as well. So if you could start with the outlook on this particular division for this year, given the sort of free trade agreements that we've had, what's the run rate likely to be here quarterly and EBITDA? And the weakness in your branded textile business on account of a high base, what's that likely to do over the next 9 months? So your FY27 guidance led by both branded textile and the garmenting division.
So garmenting, I'll start with. Garmenting is the star business right now. Obviously, Indian government is also helping in that. But the Trump tariffs, which have equated out for the rest of the world, has helped because some of our US customers have come back to us. But the UK free trade, which came into being actually on 15th July, our orders started flowing in from Q1. The execution will largely come in Q2 and Q3 of UK orders because it takes time from when you get order to when you execute. But the Europe FTA is also getting traction. Europe FTA maybe actually 6 to 9 months away, but the announcement has come and the interest from Europe is quite high. People are looking at China +1, and now India is becoming a feasible option given the taxes will get equated. So we had started prospecting Europe and UK long back when US started being a bit more unreliable, let's say, from a long-term perspective. But right now it is that period where US orders are also back and UK and Europe orders are also coming in. We have done plus 50% quarter. We aim to keep the momentum. The big piece is that the profitability is changing. We have changed profitability by 1100 BPS over last year's same quarter. And this growth will continue. It will not remain 1100 BPS all through, but the start is good, and we think that garmenting business will have a grand year this year. Coming to the textile business, actually textile business has done quite well. We had a large base in Q1 of last year because Q4 of the year before we had some cyber attack issues. So the invoicing went to first quarter, and that is what we are we struggled with. But individually, if you look at suiting business, our top-end products have sold more. Premiumization is clearly working. We have launched a range called Kalakrit, which is more for the celebration moments of suiting in a fabric format in the suiting business, fabric business, and that has done well, which means casualization even in a suiting business is working. In shirting business, I think linen is the story of the quarter. Has done well for our apparels in Color Plus Parks also in Park Avenue, but on the shirting business, linen has really done well. So the premiumization piece in fabrics is working. It is just the base effect. When you look at the margins are down, it is because when you do some lesser turnover, the extra turnover gross margin actually straight flows to EBITDA. So we are looking at a good year. We are ahead of our budget projections for Q1 in both top line and EBITDA level, and we're good for the year numbers.
Right. Satyaki, I wanted to get back to the garmenting business. Compared to last year, now with the FTAs and everything in place, are you seeing a change in the kind of orders that you're receiving compared to what you received last year in terms of the quantum of the orders / the durability of the orders? Is it a longer term? Is it more longer term contracts that you are signing compared to what you did same time last year?
Totally. The quality of the orders are good. The quantities are obviously good. Otherwise, these kind of results do not come through. But the quality of orders are also good. And we are getting expansion in product categories. For example, we were really good at suits. Now we have started getting shirt orders. One, we have improved our shirt making business. Two, which was quite cheap from our neighboring countries, making shirt. It was more commodity-like and less niche. Now we are price competitive on those also. And we're getting higher quality orders. Our order book is filled till December. From 1st August, I have started booking January. So 31st July, we have closed December. Our capacities are full. And the orders are much more longer term. As you can understand, if I book on 1st August for 1st January, I think we are looking very, very good for export business.
Satyaki, out of time, just a quick word on, with what's happening with cotton prices, wool prices, etc. What kind of a price increase do you think you can pass on to customers before you see any resistance? Just a one-line answer.
So we are trying to renegotiate most of our contract, but price increase is still a reality. 5 to 7% price increase will go through. In some categories, double-digit price increase will also go through.
All right, Satyaki, thanks very much. That's all the time we had, but pleasure having you on the show.
Thank you, ma'am.
We'll take a short break on that note, but up next, we're going to be joined by the management of Rajan Venkatesan of Latent View Analytics on their first quarter numbers. Welcome back. Latent View Analytics has reported a muted set of first quarter numbers with margins slipping to their lowest level since the second quarter of FY24. Joining us now to decode the quarter and outline the road ahead is the CFO, Rajan Venkatesan. Rajan, thanks very much for your time here on CNBC TV 18. Quick word before we get to the numbers, since you've had the CEO change come in the month of July, what that means in terms of a strategic direction for the company. And secondly, a quick word on your margins, whether the slip that we saw was a one-off on account of the wage hikes, etc., that you undertook, and how quickly do you see it getting back to the 22% kind of levels?
So thanks for having us on the show. To respond to your first question on the leadership change, right? Our current CEO, or CEO who is in charge before Sonal joined us, Mr. Rajan Sethuraman, took over as the CEO in 2019. Of course, he's had a fantastic run in taking the company public, and from the year in which we took the company public, the company's roughly grown about threefolds, right? We were close to about $44 million in revenue the year before we went public. The last year, we ended the year with close to about $120 million in revenue. So, of course, Rajan's had a fantastic run. But we also felt that this was the right time for us to bring in fresh leadership to take the company forward to the sort of next goal that we have, to get to about $200 million of revenue, right, which is an immediate goal. So we felt Sonal, given her leadership position in the Tata organization, so she's worked in TCS and Tata Technologies in the past, and more recently, she was heading the engineering practice for Wipro in North America, right? So given her background, we felt she'd be the right person to help the company move forward and hit that revenue mark of $200 million.
Yes, please continue.
Sorry, your second question was specifically on the slippages that we saw on the margin front. So You will note that Q1 typically is impacted. I mean, even if you go back historically, is always impacted by wage hikes that we generally do. So in this particular quarter, for close to about 70% of our entire workforce, we did wage hikes averaging close to about 8%. So you did have that one-time impact of close to about 2.7% on the overall EBITDA margins, right? Of course, the revenue also, there was some bit of softness specifically in the CPG vertical, which also had an impact of another 1.5% on the overall margins, which we expect, by the way, will get reversed in the following quarter. But as we continue to build the growth momentum for the rest of the year, you will see the EBITDA maybe slowly inching closer to the 21% mark as opposed to the 20.4 that we reported in the current quarter.
Is bringing margins back to normal levels also an agenda for the new leadership? Because the margins took a big hit this time around. What led to that, A? And of course, what are the steps that you would be taking to bring them back to the levels where they were? Do you see that happening this year itself?
So this year, our focus, by the way, like I said, right, I think the focus will be to make investments both on the AI side as well as on the partnership side. So those are, fairly large strategic initiatives that we've outlined as part of our leadership strategy as well. So the focus this year will be to continue to make investments on both these fronts, plus the fact that we've also had a leadership change, right? So the guidance that we have for this year is that we will maintain the EBITDA in the range of 20 to 21% on a full year basis. But the focus will be to deliver the $200 million revenue goal that we have, right? So you will see that through a combination of organic as well as inorganic. So those will be the immediate priority.
$200 million revenue growth is something that the street would like, Rajan, because my question was pertaining to that itself. I look at some of your segments. There was a quarter-on-quarter growth in financial services. I reckon this was more seasonal in nature. Retail and CPG, however, fell about 32%. And then you had this 18 to 20% growth guidance for consumer sector as well. So given all of this and the pace at which you've been, the growth has been declining year on year. Same time last quarter, you grew at 32% year on year. That came down to 23%, 24% of the next subsequent quarters. And now you're at 21%. So what's the year-on-year growth run rate that is likely to play out over the next few quarters with this 19 to 20% margin growth that you're giving? And if you could break that up into sectors as well.
Yeah. So specifically, I think financial services will continue to maintain the strong growth momentum. I think the last year we closed the financial services practice. We delivered a total revenue of about 17.7 million. The expectation for this year is that the financial services should be anywhere between $25 to $26 million of revenue, right? So you will see that that's almost like a 70 to 80% jump in relation to what we delivered last year. So financial services, the momentum will continue. In fact, 4 out of the 6 new client wins that we had in this particular quarter were all driven by financial services. We do see very, very strong growth momentum over there. Specifically on the softness that we witnessed in the CPG and retail practice. So maybe if I were to just bifurcate the CPGR, right, between CPG and retail, by the way, is very, very strong. In fact, there also we see fairly strong momentum. What we've been particularly impacted by is actually the CPG sector, right? There are 2 reasons for it. One, of course, there was an acquisition that we did, the Decision Point acquisition, and we just closed the entire sort of leadership transition where the erstwhile founders of Decision Point moved out, and we've actually we're running that company now. But more importantly, there were a few one-time projects. We've outlined that in our press release as well. There were a few one-time projects that we'd executed in the CPG segment, specifically in Q4, where we didn't have the follow-on revenues to show for in the current quarter. That is what has led to the decline in the CPGR practice. But on a year-on-year basis, now, the visibility that we have on a full year basis is to deliver close to about 12% of revenue growth over the previous year. Now, of course, this is lower than our historical growth rates. That is primarily because of one large technology account. In fact, our CEO would have probably spoken about this in the last quarter earnings call, where there was insourcing that happened in one large technology account of ours. where, beginning of the year, we were almost like $8 million behind the run rate that we were tracking for in the previous year. That has impacted the overall growth rate. But our focus is to balance that shortfall through growth in financial services as well as our retail practice.
Got that, Rajan, and therefore you'll get to that 12% growth in revenues for the year. Thanks very much, Rajan, for joining us here to help us decode the numbers that you've posted. Take a short break on that note, but up next, we're going to be joined by Shriram Subramanian of InGovern and Akshay Bansali of Mindsprite Legal on SEBI's regulatory order against Zee Entertainment. Stay tuned.
Welcome back. Still at that 24,600 level on the index, but the one stock that's in the eye of a regulatory storm right now is Zee Entertainment, and the stock is down almost 10% after SEBI barred the company, its promoter Subhash Chandra and Managing Director Puneet Goenka from the securities market for a period of 2 to 12 months. And the fallout doesn't stop there. Now, the order has put a serious question mark over Zee's freshly approved 3,100 crore warrant issue. Devyani is joining in with more details on this first, and then we go across to our guests.
Well, on the one hand, Zee's shareholders have approved the 3,143 crore preferential warrant issue, which allowed the promoters to hike their stake from the current levels of 4% to roughly around 24%, which would also bring in roughly around 3,100 crores into the company. That said, on the other hand, SEBI's final order against promoters Puneet Goenka and Subhash Chandra, barring them from participating directly or indirectly in the securities market for a period of 12 months, and Zee Entertainment itself for a period of 2 months, is weighing on sentiment today. Now, this is on the back of Zee's Hyderabad property being used to secure borrowings worth roughly around 726 crores for 4 SL Group entities, and SEBI says that the board and audit committee failed to get the requisite approvals for this particular encumbrance, and at the same time has held the promoters under certain violations against the law. Now, the big question that stands is whether the shareholder approved warrants can now be implemented and whether this board resolution will hold.
In this matter, Zee Entertainment has stated that it is currently seeking legal advice in this matter, but maintains that the recent SEBI market restraint order has no direct bearing on its ongoing fundraising exercise. On the other hand, though, lawyers say that at this current juncture, Zee cannot proceed with the warrant issue based on the SEBI directions, and we cannot assume that the SAT will grant a stay order on this particular order if the company or its promoters appeal in the SAT. So based on all of these developments, Zee's stock is currently trading lower than its last closing.
Divyani, thank you for putting that up for us. Let's go across now to our guests, Shriram Subramanian, the founder and MD at InGovern, and Akshaya Bhansali, the managing partner at Mindsprite Legal. Shriram and Akshaya, thank you for taking out time and joining us on the show today. Shriram, to you first. With this, so earlier when Zee Entertainment had planned a fundraise, it fell through because the shareholders didn't approve it. Now that the shareholders have approved it, we have another speed breaker in terms of the SEBI order. Does that have a bearing on the overall fundraising exercise? Because if the promoters are not asked to participate in the securities market, what does that do to the overall fundraising exercise?
Good morning. Firstly, we have to see that usually a company seeks shareholder approval, and within a day or two, it issues securities, right? So if you see the timing of the SEBI order, it came half an hour after Zee put out the stock exchange notification that shareholders have approved the resolutions. So from that perspective, while Zee has got shareholder approval, it cannot issue new securities because the SEBI order is effective immediately. That means that the SEBI order is effective 31st July itself. And so Zee cannot issue new securities for 2 months. So after 2 months, what will happen? We don't know yet. But at least for 2 months, Zee cannot issue new securities. So that fundraising exercise, in that sense, the warrant issue cannot happen. Two is Mr. Puneet Goenka and Mr. Subhash Chandra anyway cannot subscribe to the shares for about a year, okay, to the warrants. But the issue of warrants was to a Mauritian entity called Sun Pharma, Mauritius Investments. So it is now unclear as to whether SEBI usually any such order will encompass promoter entities also. Most of promoters, shareholders in Indian corporate is held through promoter entities. So to that extent, SEBI should extend this order to promoter entities also, including Sunbright Mauritius. Otherwise, that order is sort of invalid in its spirit. So I would think that SEBI will extend the order to include promoter entities also.
All right, you speak about the SEBI order being valid in spirit and letter. Let's go across to Akshaya Bhansali, who's the managing partner, Mindsprite Legal as well. Akshaya, what do you make of the timing of these two events? And shareholders' approval was for basically primary issue. It's not necessarily actively participating in the secondary markets. So is there any slip out there where maybe the challenge could be, okay, we're not doing this through the securities markets. Instead, we're raising funds primarily by infusing it directly into the company as promoter entities. How does that go about?
So it's not the promoters who are being debarred, who are debarred from raising the funds. The warrants have been issued by the company, and within the period of 2 months, I think after that, the company will be able to do this fundraising exercise. It will be able to sail through to this exercise. Also, which I think is once although this resolution has been passed, but the in-principle approval might be an issue for getting these warrants to be listed.
Akshay, just to clarify, you're saying Zee can simply wait for 2 months and then issue the warrants, and unless, of course, the SEBI order is extended to the promoter entity, they can go ahead with the fundraise? Is that the deduction, Akshay?
Yes. So right now, the warrant resolution has already been passed by the company. So only the in-principle will be affected by this order. And after 2 months, I think they will be able to sail through with go ahead with the warrants issue.
Okay, Shriram, would you want to come in on that? I mean, typically, how often do you even see SEBI coming out with these kind of clarifications, extending the order beyond, the two promoters to the entities owned by them? How likely is something like this, even, if it were to happen?
You have to differentiate it. It's not a regular fundraising. It's a preferential issue. And
The question was to Shriram, actually. Yeah.
Yeah, Ritu, obviously, this is a unique situation where the SEBI order was not very clear. It should extend to promoter. As of now, as it stands today, definitely that warrant issue can happen after 2 months to Sunbright, which is a Mauritian entity owned by the promoter. But to give effect to the spirit of the order, SEBI will have to modify that order or come out with a clarification. I would think so. SEBI will do it. I am sure that minority shareholders who were aggrieved by this warrant issue will raise it with SEBI, or SEBI by itself will realize that this order does not include the promoter entities. Historically, obviously, if you look at SEBI orders, usually it bars the individuals as well as promoter entities from access to securities markets.
Akshaya, in that case, if SEBI does come out with an order clarifying what they are supposed to do, extends it to the promoter entities as well, does he have a legal recourse? They can go to SAT, yes, but if SEBI appeals against that, and then this goes into a long-drawn legal process, and then so therefore the fundraising, the warrant issue, then it puts a pause on all the entire process, right?
No, that doesn't happen in that way. See, you have to differentiate a preferential issue as compared to the right issue or the IPO fund. In the LODR, it's very clear that ICDR, it is very clear that any issuer which is going through the preferential issue, the promoters, the distinction is only that the promoter cannot be a fugitive economic offender. It is not that they are if he is debarred from the securities market, he cannot raise. So there's a distinction between a preferential issue and the IPO or the right issue or any kind of fundraising activities.
I take that point.
I think this was a conscious decision of SEBI, because if you see the timing of both the order and the resolution, it happened on the same day.
Yeah, we take that point. Thank you so much for that. As a series of conversations we'll probably have at a later date. Thank you for joining in with your initial takes. We take a short break, come back on the other side. We get you more on the markets and a lot of stock-specific action. Stay with us. Welcome back. Let's look at the FNO setup at the middle of trade right now. We have 200 points on the Nifty bank leading gains. Alongside that, we're seeing some traction coming in on all the other indices as well, the mid caps as well. Not too bad. In fact, the Nifty bank is the start of the show today, above the 20 and the 200-day moving average, the marks which it hadn't crossed over the last 2.5 weeks. And this is a congestion zone which the Nifty bank has crossed. So that's important to track as support going forward. And as that has happened, the Nifty put writers are fairly active at 24,500, 24,550, some of them even at 24,600. Remember, these are options that expire tomorrow. So 24,500 put tells you that there is support at 24,470 thereabouts, 24,550 and 24,600. Both of those puts come up for you on the screen, telling you that support starts building for the Nifty all the way up from 24,450 and to about 24,530 thereabouts. So this is an important zone for the market to protect. But on the way up, there is resistance because we're seeing writing at the 24,600 call. After crossing that today once, we're still not above that convincingly. So between 24,650 and 24,700 is where we're likely to face some sort of resistance. And there's reason for that. One, the Nifty's 200-day moving average comes up around that 24,778. The Nifty IT index, which has been outperforming, that too runs the risk of running into the 200-day moving average as a resistance. And amidst all of this, despite the market moving higher, there are two indicators which are suggesting overheatedness. One, the India VIX, which has spiked about 2% on a day like this, where it could have been easily down 5%. And secondly, the put-call ratio too is at the higher end of the range at around 1.6. A lot of individual stocks on our radar. We have Jubilant Foodworks, which is seeing some short covering. But what we'll do is take a short break, come back, get you more. Vijay Nakra, who's the president farm equipment sector of M&M, joins in on their auto sales numbers.
Welcome back. Let's focus on Mahindra & Mahindra, which has reported a 20% rise in total tractor sales for the month of July. My colleague Sudarshan Kumar caught up with Vijay Nakra, the president of farm equipment sector at M&M, on what's driving their growth. Take a look.
The start to this first season has been very strong. Monsoons were delayed. There have been a lot of conversations and news around El Nino and its impact. But we can see that the monsoons have been delayed, but they've come back pretty well. The data shows that if you compare it for the long period average, the deficit in rainfall is now reduced to about 14%. Because of the delay in the monsoon, the sowing season has been slightly delayed, but the recovery again there has been very strong. It's only 4% lower than last year in terms of acreage of land in the Kharif season. Paddy is only down 2%, and in fact, sugarcane is up compared to last year. Government spends in rural have been strong, 16% up compared to last year. Strong cash flow in the hands of the farmer coming from last year's Rabi season. So I think all of this has augured and played well to keep the demand strong in the first season of the year. And the numbers, as you see, is a result of that.
So as you have said, there has been a very good recovery in the rainfall, and that has led to a strong set of numbers in the tractor segment. And also there are some of the other factors too. How confident you are in sustaining these numbers going forward? Because FY27 outlook, industry outlook is mid-single digit. And we were talking to Anisha and he said there is a potential of upside. So just on the back of everything, I want to know how confident you are in sustaining these numbers going into H2 FY27.
Well, we remain cautiously optimistic, if I can say. Yes, there is an upside. You may have read that on Friday afternoon, the World Meteorological Organization put out some data which said that while there is the impact of El Nino, there is also the positive side of a positive IOD over the Bay of Bengal, which can offset some of the risk of El Nino going forward. So we believe that some of this could play the role of offsetting some of the risk. But yes, I think the situation is dynamic. We are going to have to see it month by month. But for now, we remain cautiously optimistic and we hold on to our outlook of mid-single digit 5% for the year.
Potential upside, sir, can we hit double-digit growth by any chance?
I wouldn't want to comment on that. We are going to have to wait and see. But I think a double-digit growth coming on the back of 2 very strong years of continuous growth in tractor industry with last year at 24%. I think expecting a double-digit growth this year is got very, very low chances or probabilities. But some recovery from mid-single digit, I think we'll have to wait and see how the year plays out.
Take that point, sir. So last time when we were talking, you had talked about some of these several launches along with Swaraj. So just if you can talk about what all launches have already been done. And second, what are the launches that you will be undertaking over the next few months?
So we had spoken about 20 launches during the year, which had a mix of, or rather 19, where we had a mix of 7 new launches and 12 refreshes. So the 7 new launches are the significant ones, and 4 out of the 7 we've already done in the first season. Typically in the tractor industry, you launch it across the country in a phased manner, and that is exactly what we are doing. So the full potential of an all-India launch of these models will happen over the next couple of months. And most of these launches, or rather all the 4 launches between the 2 brands of Mahindra and Swaraj, have been in the 40 to 50 horsepower segment, which today account for almost 70% of the industry because of higher adoption of mechanization. So these are new products with much higher level of comfort, convenience, and productivity features that we bring for our customers to the market. And we believe it will help us to further consolidate our position in the industry.
Just I have 2 more questions, sir. First one about the market share. So in Q1, you had the tractor market share of around 45%. Is this range of market share between 43 to 46 you'll be holding on to? Or is there any target that you have said that by the end of FY27 or say in the next 1 or 2 years, this has to be the market share range that Mahindra would be looking at?
Well, I think we're already at a very, very healthy market share. And for us, the priority is to be able to consolidate the market share with a very strong balance even on the profitability and financials of the business. So we don't believe in buying market share. And it is important for us that we deliver scale, get strong market share as a market leader, and deliver good financials. So that is always the balance that we will focus on, and we are already at a very, very healthy market share. And as you can see in this industry, even a 0.1, 0.2 market share gain or loss is something that gets monitored between the competitors. So we've done well. We intend to continue to consolidate our position as we go forward and deliver strong financials too.
Just last one question, sir, related to, because it's been the talk of the town, that's the commodities. And over the last few months, I'll say just in the last 1 month, there has been some downtrend. So how do you see the commodity cost trend going into H2, or like already we are in Q2? So how do you see the trend panning out over the next few months?
I think the situation is still pretty volatile. And when you talk about tractors, more than 60% of tractor cost comes from steel, castings, and rubber. And while you've been talking about certain change in trends of commodity costs, for these three, we've not yet seen the change in trends. In fact, if anything, they have been increasing. And these commodities are non-hedgeable. So you can't even hedge these commodities to protect your material cost going forward. So I think that headwind still continues to loom going forward. We are going to have to be mindful and watchful as we go forward. But I think margins would be range bound in tractors. And we've always, in the core tractor business, delivered margins between 17 and 19%. And we are mindful that, we need to keep a close watch as far as the commodity prices go up. And in fact, to mitigate some of that risk, we have taken 2 price increases. We took a price increase of 10,000 in the month of April, and we've taken another price increase of 15,000 effective 1st of August. So we are doing a lot to mitigate the impact and risk of the commodity costs.
Right, positive commentary coming in from the management of M&M, the stock doing well ever since its numbers came by, and now we had obviously the July sales data come by over the weekend as well. Strong growth out there. Let's talk about Urban Company. That's the stock which is doing extremely well in trade right now, up in teens, and that's because their core business is growing extremely strongly. We have, the overall revenue, if you look at it, showed a 44% growth from 367 crores all the way up to 528 crores. Now, the EBITDA loss increased from 5 crores to 93 crores, and the net loss increased from 7 crores to about 92 crores. So you would say, what is so great about these numbers? Because the stock is moving higher. Let's look at it like how you look at, say, something like an Eternal or a Swiggy. The mainstay of the business is food delivery, and then the growth driver is quick commerce. And that's exactly what's happening here. The mainstay of the business is India business, the core segments. Out there, it's doing extremely well, 31% revenue growth. The EBIT has jumped over 100% from 40 crores all the way up to 82 crores. Margins increased from 15% to 23% as well. The other parts of their business, Native, which is the consumer discretionary products business, here as well, there's been a 60% revenue growth. Losses have come down from about 10 crores to about 7.5 crores. International business, 82% revenue growth, broken even, and turned positive on the bottom line as well. Now, all of this is now being redirected towards growing in InstaHelp. So if you look at InstaHelp, the growth has been 50 times year on year. The revenue has grown from about 20 lakhs all the way up to 11 crores. The EBITDA loss is about 131 crores. This business is growing very fast. Quarter on quarter, 43% jump in the orders. EBITDA per loss has come down as well from 450 rupees all the way up to 346 rupees. Yes, the average order value declined because there is a lot of competitive activity out there, and the company said losses will remain elevated. Why is that? Because prioritizing market leadership over everything else remains their goal right now. So their core business doing extremely strong, supporting the cash that will be later used to invest in the InstaHelp business, where they will become market leaders, and there is a strong total addressable market out there as well. So despite a big loss widening, their core is strong and they are investing going forward, which is what the street really likes, and it's up 14% of the back of that. Remember, the company is trading at a market cap of almost 20,000 crores. And if your belief is that the total addressable market is not very different from what you see in all the other companies, Swiggy's market cap close to 70,000 crores. You have Eternal, which is close to about 3 lakh crores as well. And even if you look at the reduced valuation buzz that was going around Zepto, it's still about 26,000 crores. So from a market cap standpoint to a total addressable market standpoint, Urban Company is something that a lot of people are looking at. We saw sporadic jumps on account of funds buying this stock as well earlier, and that continues after these numbers.
And clarity is also something that the street likes, right? This is what they plan to do for the future, and rewarding the stock accordingly. Of course, still below its post-issue high of 201, but continuing to remain well above its recent post-listing low, which was around 100 rupees, which was also its IPO price. Take a short break, get an interesting insight on the banking heavyweight HDFC Bank, which is seen to enjoy street confidence, but with a caveat. Ritu helps us put that into perspective on the other side. Stay tuned. Welcome back. We're above the swing high now of 24,601, but the one stock that has been in the headlines all through this year has been HDFC Bank. Once the easiest stock in the banking sector to own, it's now down nearly 25% this year, even as the Nifty has continued to move higher. Now the margins are shrinking, profit growth has slowed, and ICICI Bank is pulling ahead on almost every other metric. Ritu is breaking down what's gone wrong and why analysts are still not giving up on that. Ritu.
Well, HDFC Bank was once the easiest stock to own in banking. Now, down nearly 25% this year, even as the Nifty rallies. Margins have been shrinking, profit growth has slowed down, and ICICI Bank, of course, is pulling ahead. Let's look at what's really gone wrong here. Because, earlier, you had the market that was happy to pay a premium for this stock. And now what's really happening is that it's down 25% this year. Like I said, more than 9% in the last 3 years, while the markets are performing better. Start with the profits. They're still growing, but the pace has slowed sharply, just 5% in the June quarter and 11% for FY26 versus the near 20% growth engine that HDFC Bank used to be. Bad loans are not really the problem at all here. Asset quality remains among the best in class. So let's look at what's happening to margins. Now, when HDFC Bank merged with its parent, it suddenly had far more loans on its books than deposits to fund them. So it spent the time since bringing that CD ratio back in line, which has come down from a peak of 110% to about 96%, still high, but at least coming down. But let's look at the funding mix, that is CASA, the current and savings account, which has fallen from 44% of the book to 32%. And that means a smaller share of deposits is now coming from the bank's cheaper funding sources. And you can see the impact in the margins down to a record low of 3.26% versus more than 4% the bank would consistently deliver before the merger took place. Let's look at the return ratios, because ultimately when you're buying a stock, you're looking at how efficiently it is generating returns on its assets and on shareholders' capital, and both have come down. Now, those are important numbers because superior returns were one of the big reasons that HDFC Bank commanded that premium valuation. Then, of course, there's governance, which adds a cloud. The chairman's abrupt exit, the CEO reappointment delay, the regulatory matters around AT1, the Dubai issue, the MSRDC issue, these US law firms announcing investigations. Now, independently, none of that is existential, but together, it is one more reason that investors have found it easier to stay away. And that matters right now because investors have somewhere else to put that money. ICICI Bank is out-earning HDFC Bank almost across the board. Profit growth of nearly 16% against HDFC's 5% in the last quarter. Margins of 4.36% against 3.26%. Return on assets is higher, and that performance gap is also showing up in the valuation. So HDFC Bank, that trades at roughly 2 times the book value. ICICI Bank closer to 2.8 times, and this is a complete reversal from just 2 years ago when HDFC Bank commanded that premium. But here's the most interesting part. Of the 47 analysts that cover the stock, 46 still have a buy rating on HDFC Bank, and the average target price even today implies an almost 38% upside from the current levels. So essentially, analysts are saying the franchise is strong, it's good, but the stock has become too cheap. The market, though, is waiting for evidence that that old growth engine gets roaring again, and that's essentially the debate around HDFC Bank right now.
And the street's still not ready to give up on HDFC Bank. They're still hovering around those 52-week low levels, but the analyst community continues to remain bullish as ever. The index, well, still around that 24,600 mark. A couple of stocks that have moved to the day's high. SBI is one of them, 2% higher, reporting results on Friday. So that is contributing to the gains. The other one is L&T. That too has now moved to the highs of the day, also contributing to the Nifty upside now amongst the stocks with the bigger weights on the index. Take your leave on this edition of Trading Hour from Ritu Manglam and me. Thank you for watching. Halftime report on the other side.
Stock surge after Trump says an Iran deal is in the works, driving down the oil prices. Strong forex inflows and recent FPI buying also buoys the sentiment, and FMCG, IT, NBFCs lead the gains while media is the drag.
ITC's Q1 margin takes a hit from the tax hike on tobacco, but resilient volumes and likely price recalibration suggest better days ahead. The management says multiple measures have fortified the portfolio and its market standing.
Zee Entertainment's preferential issue of warrants approved at its AGM is now in question after SEBI bars the company and promoters Subhash Chandra and Puneet Goenka from the securities market for specified periods. The stock slumps.
Sales of automobiles across segments sees double-digit growth in July. Maruti and Hyundai clock their highest monthly sales, while tractor sales grow far ahead of its estimates. Two-wheeler sales too stay on the growth path.
The rupee gains after RBI reports an inflow of over $40 billion under the special swap facility with FCNRB deposits, alone seeing an inflow of $36.7 billion. A drop in oil prices after Trump stopped strikes in hope of a deal also aids sentiment. Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala and Ekta Batra. Girls, good afternoon. Well, it's a good start to the week. It's a fresh new week. It's a fresh new month as well. And the Nifty is at the day's high as we speak. PSU Banking Index doing well. IT is contributing yet again. Even the broader markets are not far behind. Small cap index, mid cap index, all of them higher. Rupee is appreciating. Crude is declining. So the macro setup looks strong for India. We'll have to see which way things go. For now, the market's at a 5-month high.
Hi girls, yes, absolutely. So there's no debating that it's been a very strong start in terms of trade, and we're managing to scale past that 24,600 mark very quite decisively. So let's see whether we manage to do that or not as the day goes on. But separately, remember that the markets have risen above that swing high of around 24,601, which we had hit on the 21st of April. So that's an important point to note. Separately, remember that NBFCs also continue to gain in today's trading session. So that's another pack to watch out for. Obviously, rate sensitive such as autos also gain on the monthly sales. So a lot to watch out for. It's a heavy day in terms of earnings, heavy day in terms of news.
Absolutely heavy day in terms of earnings as well as news. And do not forget, IT again has started on the strong footing today as well. And PSU Banks also leading the charts there. So that's also what is supporting the up move in terms of today's market. But what's on the show for you all today? We'll connect with the management of Sun Pharma, Park MediWorld to discuss their Q1 earnings. We'll also be speaking with the top management of ABB India to discuss their June quarter performance as well as the way ahead for the company. Sonal is going to be decoding for us the Q1 FY27 earnings of the OMCs and the key highlights, takeaways from management conference calls as well. So that's what is lined up for you all on the show. But first up, and starting with the first segment for today, we have Vivek, who's here to take us through the stocks that are moving around this afternoon. Good afternoon, Vivek.
Good afternoon. Thank you so much for that. Well, we started off this particular week on a very strong footing. Advance decline ratio very much in favor of the advances. In terms of individual stocks and sectors, first stock on the radar has to be Urban Company. Losses have narrowed in the core business segment, and Morgan Stanley has gone ahead and double upgraded this particular name. Stock high by almost 14% today. Both of the cigarette companies, ITC as well as Godfrey Phillips, ITC volume degrowth not as bad as feared. That led to a bit of short covering. Godfrey Phillips also rallying along with ITC today. Divi's Labs, clearly, one of the best results seen as far as the pharma pack is concerned. That particular stock high by 5% despite the strong rally seen into Q1. Allevius Life Sciences, another name from the broader markets, an upgrade coming in terms of revenue as far as the management is concerned. So that particular stock high by almost 5% today on good volumes. And Balrampur Chini, the top mid-cap gainer in this session today. On the other hand, quite a few laggards as well. Can't look beyond Muthoot Finance. Clear pressure coming in as far as profitability is concerned from declining NIMs. That is something that the street hasn't liked, down over 8% today. Latent View, one of the top laggards as far as the NSE 500 is concerned, has recovered a little bit from the day's lowest point, but still this particular stock down almost 5%. Zee Entertainment, one of the other drags.
Okay, all right, Vivek. Thanks very much for taking us through all of the stocks which are buzzing in today's trading session. But let's get to the first management on the show. We have with us Jayashree Satagopan, who's the Chief Financial Officer at Sun Pharma, joining in. She's going to take us through the Q1 performance. Jayashree, thank you very much for taking the time out. Well, you know, before we talk about numbers, my first question is in fact what's taking place in the US. The US is now debating tariffs on generic drugs and onshoring of pharmaceutical manufacturing. How exactly do you assess this as a risk to Sun Pharma?
Look, the announcement had come just about a week back in terms of the additional tariffs that could be there for generics, probably in a couple of years from now. So I think we all have to assess what could be the likely impact. There's still a long time between now and 2 years. So Sun would be engaging with the administration on its own and also along with some of our partners in the pharma industry. So in my view, it's a little too early to comment on it, Ekta. At the same time, we do have manufacturing facilities in the US, both technical and formulation. So we'll look at it appropriately at the right time.
Okay. How exactly does the Organon portfolio fit into the US strategy of the company? Does its manufacturing presence, for example, help offset concerns of offshoring?
Organon's manufacturing is mostly in Europe and in countries like Brazil, Mexico, not in US. So therefore, with this particular circular that has come in, I don't think it's going to be helpful. Having said that, in US, primarily they are into innovative medicines, which is in the women's healthcare segment. That's not in generic space. And they are also into biosimilars. So these are different categories. The products and the segments are very complementary to what Sun has.
Okay, and what about Organon's portfolio being impacted itself by Trump's policies, say on branded drugs, as well as maybe the most favored nation?
Organon is still a separate listed company, so I don't think we will be in a position to comment on it at this point in time.
Okay, fair enough. We'll wait by for that acquisition to close. But Jayashree, you know, the company is sticking to its FY27 guidance on revenue of high single-digit revenue growth of around 6 to 9%. This is despite a 10% growth this quarter.
Yeah, that's true, Ekta. Over the full year, we expect it to be around 6 to 9% high single digit. One should also factor in some impact that could come in on account of Forex fluctuations. We have seen the rupee depreciation from last year to this year. So we need to keep that in mind while we're looking at a full year performance numbers.
Okay, but if you can give us directionally any guidance on what you are looking at in terms of margins?
Directionally too, we don't give any specific guidance on the margins, but philosophically, our endeavor is always to see that we get the margins to our fullest potential.
Okay, and you know, what is the status in terms of the acquisition as well? Shareholders of Organon have approved it. The timeline, is it close? Will it close by early 2027? Does that still stand? What is the outlook there?
Absolutely. So the shareholders have approved it in their meeting on July 23rd. All the regulatory filings that are required in several countries have all been filed. So I think we are on track to get these approvals in a timely manner. So last quarter of this financial year is a good time for us to look at for the transaction closing.
Okay. What was the performance of the base business in the US, Jayashree, given factors such as, say, price pressure and the lack of Revlimid generic? And what exactly is your guidance on the base business going forward now?
Yeah, I think one of the reasons for the generics business in the US declining this quarter, as you said, is lack of Revlimid. We have launched 5 new products in the generic segment in US, and we'll continue to focus on getting few more products in that market. Having said that, the pricing pressures are real and is likely to continue in generics business. We have seen this over the past few years, and we don't see any change in the coming quarters. Therefore, our focus on generics is to see if we can get newer products, but at the same time, continue to grow our innovative medicines business in the US.
Let's talk about your global innovative medicines portfolio as well. How did the key drugs there, such as Unloxit and Lexelvi, perform? What was the performance this time?
The overall business, as you see, has grown around 12.8%. This growth has been both in US and the global markets. We had launched Lexelvi and Unloxit in the US. I think both of them are tracking pretty well in terms of formulary prescriptions, the prescribers finding the drug good. The patient's response has been pretty encouraging, especially on Lexelvi. We have seen that we have crossed 1,000 prescriptions as of June 2026. Unloxit is also tracking pretty well. So I think this is the first year of launch, and therefore we should see these products coming out pretty well in the coming months and quarters.
Or that, but Jayashree, Levulan saw an impact during this quarter. What was the update there?
Yeah, Levulan is a seasonal impact. This was quarter to quarter and not on a year-on-year basis. So compared to the March ending quarter to June ending quarter, we've seen a little bit of a decline, but that's very natural. We see this trend every year.
Okay, so net, based on what you are guiding on key drugs, what is your estimate on the global innovative sales in FY27, considering that in FY26 it was around $1.4 billion and up around 16%? Do you expect a similar growth in FY27?
So while I may not be able to give you an exact percentage, the intent is to always see how we could grow our innovative business portfolio well. Obviously, each of the markets might have its own dynamics. We have 2 new products that have got introduced late last year, so those should also sort of kick in. I will leave it at that broad level, Ekta.
Okay. Well, you know, there's a lot happening on the GLP-1 space when it comes to Sun Pharma. So, Jayashree, just break it up for us. How much of an opportunity is semaglutide for the company in Brazil? Something that you are looking at just in the past couple of days. How is India doing in terms of a launch? And are you now looking at the Canadian market? Are you waiting for approvals? What's the status there?
So let me first talk about the India launch. We launched the product in April 2026. In the injectable generics, we are currently number 2 player. The auto injectables that we have has been received extremely well by both the prescribers and the patients. The APIs and the formulations are all done in-house. And we also have our tie-ups with the manufacturers and suppliers of the devices. Therefore, this should help us in ensuring continuity and product availability for the patients. That's as far as India is concerned. It's just about 4 months since the product launch has happened, and therefore we expect the growth to continue. We've also received regulatory approvals for both South Africa and Brazil. Brazil is a much larger market. Here we have out-licensed this to one of our partner, and we expect the opportunity to be good. And being one of the early entrants in the market, we think our out-licensing partners should be able to capture a reasonably good size of the market in the generics. This again is on the injectables. So we'll have to wait and see how the out-license partner is able to work through on the market. From our end, we are all set to ensure that supplies are made on time and there is no shortage in terms of product being available in the market.
Okay, take that point, but we have to ask you about Halol, right? What is the status of the facility which has import alert? Is there a re-inspection by US FDA which is planned?
Yeah, it continues to be there. So our teams have been working on improving the quality management system, the compliance system, so on and so forth. We would be waiting for the FDA to come for an inspection. So until that happens, the status remains the same.
Okay, all right. Jayashree, just circling back to the Organon acquisition, Sun Pharma is going to assume around $9.25, $9.7 billion of Organon's debt. Just give us a sense in terms of, you've had some time to take us to go through the planning on the debt reduction, since there's some time which has passed on the acquisition. Any timeline, any thoughts on the timeline of reduction? What can you share with investors on the debt plan?
So the transaction, as you know, is yet to close, right? We are looking at Q4 of FY27 for the transaction to get consummated. At this point in time, the plan is to see how we refinance the current debt of Organon. We have our own internal projections in terms of how Sun's revenues, cash flows would come in, how Organon's cash flows would come in. So on a pro forma basis, we do have an idea. But the initial step is obviously to see if we could take a consent and roll over some of the bonds or finance it from Sun on its own through taking fresh loans or bonds from the bankers. I think that's going to be the year one. And then post which, in the next few years, obviously with the cash generation that's likely to come from both Sun and Organon together, endeavor is to look at deleveraging. But I think even before the transaction gets closed, it's going to be too early for me to comment in terms of the timing when the debt will be totally repaid. But endeavor is obviously to see we rapidly deleverage.
Okay, all right, Ms. Jayashree, we're going to leave it on that note. Thanks, as always, for joining in and talking to CNBC TV 18 with regards to Sun Pharma's guidance for FY27 and the latest on the Organon acquisition as well as policies and Q1. We're going to take a short break on that note, but up next, we'll continue focusing on pharmaceuticals and healthcare. The management of Park MediWorld will be joining in to decode their Q1 numbers. Stay tuned for that. Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Well, let's get to another earnings conversation. Park Medi reported what was a steady set of numbers. Profit and margins came in healthy, but there is an occupancy decline which took place. To discuss this, we have with us Sanjay Sharma, who's the Group CEO and the whole-time director at the company, joining in. Mr. Sanjay, thank you very much for taking the time out. There's been a dip in terms of the occupancies which has taken place on a year-on-year as well as on a sequential basis. Just guide us through the reason behind that.
Thank you so much for the invite, Ekta, Sonal and Vinny. Thank you so much. See, I just would like to inform you and your viewers with a great pleasure that we started the Q1 on a very strong note. There has been 19% surge in the revenue at 476 crores from quarter-on-quarter basis from 399. And our EBITDA has also been at 126%, which is 26.5%, which has shown a growth of 20% from 105 last year. And our PAT has been at 89 crores, which is 18.6%, which is 35% growth from last year, which was 66 crores. Yes, there has been a dip in the occupancy at about 56% from 68% on Q-on-Q basis. That is largely because on quarter one, we had 3,000 beds, and we have added nearly 1,000 beds. To be precise, 960 beds from Q1 to now. And largely the Agra facility and the Panchkula facility was just started. Agra was launched in February, and Panchkula was launched on 10th of April. So that is yet to contribute. And this is the reason why occupancy is lower.
Okay, take that point. Occupancies are lower because of the new facilities that came on board in the last 2 quarters. Mr. Sharma, give us a sense of your margins, considering that you're commissioning new bed capacity as well. And what is the margin from the complex cases? They are around 57%, the last known number. What was it currently? What are you guiding for in terms of margins here?
Yeah. Our margins were coming from higher super specialty and tertiary and quaternary products was about 57% last quarter. But the product mix has changed, and now our margins from higher super specialty are at 62%. So there has been a growth of about 5% in the margins from the high-end products.
Okay, 5% growth in terms of margins for the high-end products and complex side of things, right? So, I just wanted to understand one more thing. Your ARPOB, what is the growth this time, this quarter? I think last time you had mentioned about 28,000 was where the ARPOB was, over 28,000. You've guided for 7% growth for FY27. What does it currently stand at?
Currently, the growth quarter on quarter has been about 12%. And our ARPOB stands is roughly about 30,450 per bed. And this has largely been because of 2 major things. One has been the product mix, high-end tertiary and quaternary product mix has increased from 57% to 62%. Also, we have got a shade benefit. The effectivity of the CGHS rate revision, which was in October 2025, has started showing the results now. And that is also one of the reasons why the ARPOB has increased.
Okay. So, Mr. Sharma, in that case, what are you guiding in terms of ARPOBs going into FY27? Do you think that the best of the CGHS revision is already factored in and, that might just be a cap now?
The factoring in will continue to grow till Q3, Q4 results also, because entire factoring has yet to come in. But we see 10 to 12% growth. ARPOB would be coming up in the next year also.
Okay, all right. The other factor which I wanted to speak about is your latest acquisition which you've made in Punjab. It's a 150-bed facility. It's just about doing, I think, around 17 crores in terms of revenue. Tell us whether it's EBITDA and profit positive at this point in time. How is it going to add into your entire blended margins going forward?
Ekta, if you permit me, then I would like to start with our launch, which happened yesterday with regard to Rudrapur in Uttarakhand, which is the largest facility in Uttarakhand. It's an NABH. It's a 330-bedded hospital that we have launched. as of yesterday on 2nd of August, the Medicity Rudrapur. And the second one, which we are acquiring, which we have done on is Meher Hospital in Zirakpur. It's a 150 plus bed capacity. Yes, it's under functioning because the occupancy is low. The other super specialities have not been there, and it's largely running on mother specialities like medicine, surgery, and others. So we intend providing for all the major super specialities out there. And we see a growth in FY28 of about revenue of about 70 to 75 crores. And we feel that the EBITDA would be in line with the profile of what we have been submitting and continuing with.
Okay, all right. So that's on this particular facility. Mr. Sharma, last question before we let you go. What are the other plans for inorganic expansion? You do have that in place. What is the kitty that you've set aside? Is there something that we'll hear about more in this fiscal? Will it be in FY28?
Yeah. So we ended the last financial year at 3,610 beds. We'll be adding about 1,130 beds, which we've already partly done this thing. Rudrapur has been launched. So we'll be adding 1130, which will take our tally to 4,740 by the end of this financial year. And next financial year, we are adding 1,000 beds more, so which will take our tally to about 5,740. One special thing which I would like to mention is this, that in the calendar year 26, we would be adding, we have 1,490 beds, which is nearly a 46% surge in our bed capacity. So it's a milestone in our, you could say, move on. And that is one of the greatest achievements which we'll be doing.
Okay, Mr. Sharma, thank you so much for joining us this afternoon and giving us an understanding in terms of what to expect from the company going forward. Complex cases now account for around 57% of the total new facilities are coming in as well. So that'll be interesting to watch out for in terms of the outlook going forward as well. Thanks so much for that. On that note, we're going to sip into a very short break. After the break, we'll have Jay Thakkar of ICICI Securities will join in with some trading strategies. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Nifty continues to trade near the 24,600 mark, just around that level as of now as well. 0.9% of gain for the Nifty 50. Broader end of the market continuing to do well in the trading session as well. And obviously advance decline ratio in the favor of advances versus declines. But let's keep it going then and bring on board Jay Tucker of ICICI Securities, joining us on the show now to talk to us about his trading strategies. Jay, good afternoon. Thank you so much for joining us on the show. For the August month, at least itself, we're starting on a good footing, strong footing, 24,600 as of now. What are the levels we're keeping an eye out on for the month as well? And in terms of the trading session, what are we keeping an eye out on?
Good afternoon to you, Vinny. I would say that, Vinny, see, overall, the markets definitely has been trending higher. There was a consolidation, but then within that consolidation as well, Vinny, if we see, then the base was actually shifting higher. So from 22,250, we saw it going to 23,000 or shifting to 23,077 and thereafter shifting to 23,500 to 600 range. Nifty has filled that gap and has been trending higher. In fact, since past couple of months, if we see then on the upside, 24,600 where we are placed right now, that has been acting as a resistance somewhere around close to 24,600 is where the 200 DMA is as well for the Nifty, and that is what has been acting as a supply area. But then it has been forming a higher base, so that is positive, and I think this time eventually the possibility of a breakout from this range is quite high. And once that happens, when Nifty is likely to immediately test 25,000. That would be the minimum target, I would say. Otherwise, it can go and test the levels of 25,400 as well, roughly around the area from where Nifty had started that correction when, in February when the war broke out and we saw from 25,400 to 500 levels, Nifty actually, in a straight, had a straight fall until 22,000 levels approximately, right? So that is those are the levels which I'm expecting now for the August series. I'm quite optimistic, and I think that once Bank Nifty also takes off the 58,000 strike or the levels wherein it has the highest call base, I mean, post or beyond that, you don't have any major resistance or a supply area. So beyond that, you can see Bank Nifty also inching towards 60,000, which can help, in fact, Nifty to move even higher. The volatility index, that is the India VIX, has been pretty much sideways, and we have seen the FI index short positions also coming quite down below 2 lakh contracts now. So that is also something positive. So with this, I would say that one can continue to maintain the bias positive and trade on the long side for a target of 25,000 to 25,400 mini. And hence, I've got two buy recommendations. The first buy recommendation is on Siemens. Now, Siemens is trading around the levels of 3,900 as of now, and I think on the upside, Vinny is likely to test the levels of 4,200 to 4,400 going forward. On the downside, I believe that now 3,750 will act as a very, very critical support. So with that as a stop loss, one can go long on Siemens. And the second buy recommendation is on Supreme Industries. It's trading around the levels of 3,500 right now. I'm targeting 3,700 to 3,800 on an immediate basis, and one can place a stop loss below 3,400.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and giving us all of your strategies. Well, for the markets, it's in fine fettle at this point in time. We have the Nifty, which is up around 200 odd points, and the advanced decline ratio, which is extremely steady at this point. So 3,200 stocks advancing to around just about 1,300 stocks declining. So great going for the advances. We'll take a short break now, but up next, we'll get you a lot more on the markets. And Sonal will also decode the Q1 FY27 earnings of the OMCs and highlight the key takeaways from the management conference calls.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Let's talk about the oil marketing companies, because the last of them, IOC, reported numbers on Friday, and it was expected to be a weak quarter. However, if you look at the numbers, the losses are lower than what the street was working with. And we did get comments from the petroleum minister where he indicated on the marketing side they're making a loss of around 1,000 crores a day. But if you look at the overall numbers, BPCL has reported losses of around 4,000 crore rupees. IOC is at around 2,600 crore rupees. HPCL is the highest at 11,526 crore rupees. And this, of course, compares with big profits that the company made in the quarter gone by. This was led by higher crude oil prices, marketing margins, which were squeezed. But what really worked for these companies this time, which led to better earnings than what the street was working with? It was strong refining performance. This was despite the fact that there was an export duty element on diesel, petrol, and ATF exports in the quarter gone by. So BPCL reported margins of $41.4 per barrel. IOC was at 36. HPCL was the lowest at $23.5 per barrel because the company said it could not process the crude at higher efficiencies. The marketing segment did not do well for all of them, but BPCL was the highest at 16.3 rupees per litre in terms of marketing losses. This is combined for both petrol and diesel, and these are gross marketing margins that Motilal Oswal has calculated. IOC was the lowest. It has the lowest exposure to marketing segment as well. It does have a petchem segment which took care of some of the losses. HPCL was at 14.9 rupees per litre. All of them reported LPG under recovery as well. That continued to be a big issue. BPCL at 5,380 crore rupees. IOC was the highest at 10,200 crore rupees, and HPCL at around 5,600 crore rupees. These companies, if we talk on an average, the losses that they are making per cylinder, in quarter 4, it was around 80 rupees per cylinder, which inched up to levels of 510 rupees per cylinder in quarter 1. And as on July, they are making losses of around 490 rupees per cylinder on LPG sales. So that's causing the big LPG under recoveries that these companies are making as of now. The stocks have not done well. However, they have recovered from their 52-week low levels. BPCL is down around 16% year to date. You have IOC with cuts of around 14% and HPCL with cut of around 20.5%. Now, do remember, HPCL has the highest exposure to the marketing segment, which is the sale of petrol and diesel, followed by BPCL, and then we have IOCL as well. In terms of valuation, BPCL continues to trade at a premium to the other two oil marketing companies. It has been the case since the time there were conversations around BPCL divestment. The others are trading at around 6.7 to 6.9 times. Now let's talk about what companies did indicate in their conference call. The outlook on refining continued to be very positive. However, with respect to crude pricing and sourcing, IOC indicated that the situation is highly dynamic and the crude pricing premium keeps changing. There are higher spot purchases for now. HPCL said that there are no concern on crude and LPG availability. Pricing, however, continues to be the key risk for these companies, and HPCL could not refine the most optimal crude during the quarter, leading to lower than expected refining margins, or lower than peer refining margins for them now. BPCL said their refineries can process Venezuelan crude through blending, but purchases remain opportunistic rather than under long-term contracts. So the big risk or the trigger going forward could be pricing of crude and availability and supply of crude and LPG purchases as well, because these companies are still making losses there. The stocks, though, are higher today, and this is considering the fact that they have done better than what the street was working with, because refining came to rescue this time around. GRM stronger all over the place for all these three companies.
Okay, all right, Sonal, thanks very much for that. So that's what took place with the OMCs. As you can see, they're managing to hold up quite well. Remember, Brent crude prices have fallen around 5% odd. We'll take a short break, but up next, we'll speak to the top management of ABB India to discuss its Q2 CY26 performance and the road ahead. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Now let's just put the spotlight on another earnings conversation. ABB India, they reported their numbers. Mixed quarter, revenue was strong, auto inflow was strong. But what is the outlook of the company, especially in terms of margins, which missed the expectation? That'll be key to watch out for. I spoke to the management on the quarter gone by and started by talking about this margin trajectory, right? What could one expect as an exit rate for calendar year 26? Listen in to that slice of the conversation.
I think today the margins has been impacted largely by the material cost increases, especially driven by the commodities, which have seen an elevated ranges at this point of time, plus also the foreign exchange volatility as such. So now we are at 12.5 to 12-13% of EBITDA levels. I think we definitely want to move to those levels where we were earlier. The demand is pretty much strong. We have quite exciting emerging segments which are growing. So I think the next level of expansions will primarily be driven by the volumes, right? So it will be a volume-led growth. And for the margin-led growth to happen, will take some more time, is what we see. Right? And I think we are putting all efforts to make sure that we're able to cater to the customers and stay resilient at this point of time. And we were confident that if the volatility is sort of settle down, so we'll be on the right position to go ahead.
So yes, it will be more of a volume-led growth versus margin-led growth. Will take some time for the margins. Then maybe calendar 27 is when maybe we get some certainty on the geopolitical front. That's when we can start seeing the older margins coming back.
So geopolitical uncertainty is something which is beyond our control. I think we are by and large a resilient organization to meet this. So in the past, we have definitely waded through these type of topics. So we are confident that if these remain sort of settle down, so we would also look at an increasing margin trend.
Okay, point taken there, Mr. Sridhar. Mr. Sharma, the ABB parent group, we know that there is no direct correlation, but every time the parent group reports their numbers, we see the India order inflow coming in. This time it was 81%, and we saw the impact coming in for ABB India as well, and we saw the run up. Now, what is it that, there seems like there's some gap that is going on, right? And versus your 50%, which is beyond those marine and ports, are there any other verticals where the order is being booked directly by the parent company? What is the gap that we could maybe, help viewers understand this gap between both of them?
Good to talk to you, Vinny. And this is true. I think there is a gap between what is reported by the group and how we see it in our books here in India. For the simple reason that ABB is a very well diversified product portfolio company, wherein there are a portfolio which we have established within the country and wherein we have localized it and it passes through us to cater to the customers directly. But then there are certain opportunities which are indirect, wherein the group is able to kind of supply into the market from the global portfolio. This gap has been bridging down over a period of time, and I think it will continue to bridge down over a period of time, but it will not be negligible in a few years to come. But as we see the demand for these one-off projects or one-off products, as they consolidate their consistent demand in the market, what we do is we include that part of ABB India portfolio, localize it, and give it to the wider market.
So you're saying this gap that, previously we were seeing that is coming down because in the last few quarters it was almost in line. So this time there's a one-off that has happened, right, in the order inflows?
So, Vinny, let me pitch in over here. I think there's more a bit of a finance-related question as well. So I think this time the orders which we saw was definitely 80% and we grew at 50%. And this 30% gap basically came from two opportunities which were placed on the ABB group, but for strategic reasons. One was an order which was an innovative contract of a global contract placed on an Indian customer. Naturally, it's more of an order arrangement which happened. So there's already an existing contract execution. Other one is basically for marine and ports. And this is something which we are building capacity and competency in India. It's a future growth opportunity for us. So while the main systems are provided by the global company, ABB Group company, but we support them quite a lot from the servicing and installation and commissioning of that opportunity in India. So it's like any other business. The early part of getting into the market is supported by the group, and then we later on catch up with that. And this has happened in the past, and this is something which Marine & Ports also will go through. So it's a natural transition, is what I see, and these things are good for us because we are building install base going forward, which will be an opportunity for ABB.
Okay, so we are building that capacity, right, and the capability on the marine port front. Any other capacity that you all are adding as well to reduce this gap? What are the talks that you're seeing, and in the near future, how does that investment also move for ABB India? What are you all looking to invest more in terms of capex?
So I think in our inorganic options, we are already on the lookout. On the organic options, I think we do at a minimum of 300 to 350 crores every year, and that will continue. We always make sure that our capacities are at 85 to 90% so that we have a headroom of 10-15% to expand organically at any point of time. And this has actually resulted in continuous supply, ensuring continuous supply to the customers. I think you would have also heard too in the recent past when our global CEO was there. So we did announce some capex plans, and that will continue over the next 2 to 3 years to construct and make us future ready.
Let's focus and talk about a couple of segments particularly as well. Data centers, around 15 to 17%, you all have said is your, it accounts to of your order book, right? How do you see that scaling up? What is the opportunity that and influx that you all are getting in terms of inquiries or orders as well?
Market as such is quite robust, and we have been reporting it for last 7 years. When we actually started focusing on data centers, we were perhaps one among the first who captured that opportunity. And there's a very high level of resiliency in this market segment, and we see in coming years it will only increase going forward. And our portfolio and our capacities are already in place. We have invested in them, and we'll be able to cater to all the demand that is coming from the data center. We only feel that in terms of our order books, it will be quite strong from the data center market segment in the future.
And overall to the revenues, how would it be contributing? Overall, what would that share be going forward, maybe in the next 1 year for this?
So these data centers are typically very fast-moving projects. The decision-making is fast, as well as the demand for deliveries is quite good. So I think the ratio between when the order comes in and when it goes out is pretty good. So we will see the same kind of books. Like say if you have 15 to 17% coming orders which are sitting with us, I think they will convert into revenues in 5-6 months' time. I think that's what we foresee. And there are certain customers who are standardizing with us. There the conversion between orders to delivery will be even faster.
Okay, so that's management of ABB talking to Vinny. That stock is up around 3% at this point in time. They are indicating that yes, the margins were impacted by commodity prices as well as forex volatility. We'll do one thing. We'll take a short break with the news that the Nifty is holding above 24,580 at this point in time. So let's see whether we manage to inch back to 24,600 today. We'll take a short break, but we'll get you a lot more stocks on the other side. Stay tuned. Welcome back. Well, Blue Jet has come out with what is a disappointing set of numbers. So you can see that the stock itself is lower by around 6% reacting to its 5% just came out. I think there was a profit decline, a double-digit profit decline, which has come in at around 14% on a year-on-year basis. And there's been a revenue decline, which has come through this time as well. So looking like a disappointing set of numbers in terms of at least the revenue as well as the profitability for Blue Jet. Margins have come in stable at around 33%. But on that note, we need to wrap up on halftime report as well. Business Lunch will take all of the action forward. Stay tuned.
surge after US President Donald Trump says that an Iran deal is in the works, driving down oil prices. Strong forex inflows and recent FPI buying also buoy sentiment. FMCG, IT and NBFCs lead the gains, while the media sector is the big drag, courtesy Zee Entertainment.
ITC's Q1 margin takes a hit from the tax hike on tobacco, but resilient volumes and likely price recalibration suggest better days ahead. The management says multiple measures have fortified the portfolio and its market standing.
Zee Entertainment's preferential issue of warrants approved at its AGM is now in question after SEBI bars the company and promoters Subhash Chandra and Puneet Goenka from the securities market for specified periods. The stock is down over 10%.
Sales of automobiles across segments see double-digit growth in July. Maruti and Hyundai clocked their highest monthly sales, while tractor sales grow far ahead of estimates. Two-wheeler sales too stay on the growth path.
The rupee gains after RBI reports an inflow of over $40 billion under the special swap facility, with the FCNRB deposits alone seeing an inflow of over $36 billion. A drop in oil prices after Trump's top strikes in hopes of a deal also aids sentiment. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormuz. No Monday blues for the bulls today, that's for sure. And a de-escalation in the tensions in West Asia, helping the markets move higher. Nifty holding well above that 24,500 mark.
You bet. And we were that 24,500 mark was the one that was a psychological barrier. We did also manage to cross the 24,601 swing high recent in just a few minutes earlier, but we are still hovering around those levels. There is some resistance at that 24,600 mark. Flashes at the bottom of your screens for IEX, the saga that has continued for years now with regards to the market coupling regulations. The Supreme Court has allowed the CERC to frame regulations, and the CERC has also mentioned that they would be framing the regulations in the next 4 to 6 weeks is what they've said. The Supreme Court has also said that it is not appropriate as a stage to hear the case, but they have allowed the CERC to proceed with framing regulations. We'll get Ashmit on this in just a bit, but IEX, the one stock that has been badgered because of this regulation, again has slumped from the highs of the day, down 3.5%. But otherwise, the markets are in a league of their own. The Nifty is continuing to do well. A couple of results that came in just a few minutes ago. Blue Jet Healthcare was one of them. That stock slumped around about 7% after reporting a drop in its operating performance compared to last year. Of course, there are plenty of other results to track during the course of the day, be it UPL, be it DLF. So it's possibly the penultimate week of the results season for the quarter. The market's doing fairly well. At least the bulls will take that with both hands.
Absolutely. And if you take a look at the sectors, IT stocks are resuming their up move after a breather that they took on Friday, and that's the top gaining index today. Sectoral index 2% higher. Infosys and TCS up nearly 3%. LTM up over 7% in trade as we speak. PSU banks also doing well. SBI, Canara Bank and the Bank of Baroda, all of them up over 1.5% in trade. FMCG stocks also doing very well today. ITC up in trade today. We've got Tata Consumer and Godrej Consumer, all of them gaining over 1%. ITC 2% higher in trade. The only index that's in the red is the media pack, and that's primarily due to the fall that we're seeing in Zee Entertainment, which is currently over 11% lower. So that's how the markets are set up this afternoon, Hormaz.
Indeed, and the other talking point because of a lot of this data has been the rupee that opened sharply higher at 95.14 compared to the dollar. Still around about has given up some of those gains during the course of the day. But the good news is the fact that the Reserve Bank of India came out with this data that $40 billion have flowed in the past 7 weeks via the FCNR deposits. However, some dollar buying brought the rate down a little. Lata is here with more on this. Lata.
Well, 0.25% higher start to the rupee was somewhat heartening for the rupee bulls. And that was obviously because of the flow of very positive data over the weekend. On Saturday, the Reserve Bank updated the amount of FCNRB flows that the country has got in the past 7 weeks. It has got about $36.5 billion, and then a further $4 billion has come by way of overseas foreign currency borrowings by banks and by companies. So a good 40 billion in 7 weeks and 8 more weeks to come. So the market was in a joyous mood. 8 more weeks because the FCNRB scheme runs till September 30th. Brent crude was down 5% and the dollar index, the DXY, was down about 1% to less than 100, whereas we had closed the week on July 31st at closer to 101. All that was supposed to be positive, but the point is the rupee has been the lowest gainer among the EMs. It's still a gainer, but it is the lowest gainer among EM currencies, which has left the FX market kind of scratching its head. The reasons dealers are guessing is that importers and exporters are not quite convinced that the rupee will continue to strengthen from here on. They point out to the fact that if $40 billion came, you look at the FX reserves from June 30th to about the third week of July. It has risen only from $667 billion to about $682 billion, a rise of about $15 billion, whereas we are saying that $40 billion has come in. So there is a bit of a worry that whether the Reserve Bank has sold a lot of dollars, either cancelled forward dollars, forward short dollars, or it has had to intervene heavily. There is still a lot of naysayers and a feeling that importers are still hedging high forward months, and exporters are not selling up their dollars because they're not quite convinced that the rupee is strengthening from here on. The expectation is that if RBI continues to support with walk and talk the rupee, and the rupee moves from 95 towards 94, then perhaps exporters will come and sell big time. And of course, crude also remains a worry. It's one day 83 and then again goes back to 90, 95 and towards 100. So, the importer-exporter confidence in the dollar getting weaker and the rupee getting stronger is not yet there. That's the message from the market.
All right, Lata, many thanks for taking us through those details. Now, auto sales numbers for the month of July have come in strong as expected. Let's go across to Sudarshan Kumar for the highlights. Sudarshan?
It's been a strong trend that auto sector has been seeing. Even in the month of July, we have seen the biggest ever or the highest ever sales that company has seen, sector has seen in a month. Now talking about all the segments have seen double-digit growth. Maruti, if you talk about that, total sales have increased by 34%. Domestic sales have seen a growth of 42%, and SUV continues to see an uptrend. Growth here is 50%, and entry-level segment for the second straight month has seen a growth of almost 90%. For Hyundai, it was a strong set of numbers that company has posted for Q1 FY27, and for the month of July, it was highest ever monthly sales have increased by 25%, and export numbers were highest in more than 100 months, and here sales have increased by 31%. Another PV maker, Tata Motors Passenger Vehicle, has reported 59% increase in the total sales, and domestic sales here have seen a growth of 58%. EV sales have almost doubled, growth of almost 114%. For Mahindra & Mahindra, both auto and tractor segments have seen a growth of more than 20%, and auto sales here have seen a growth of 26%, and SUV continues to see a growth of more than 20%. In the tractor segment, company has reported growth of 18% versus FY27 industry growth estimate of mid-single digit. Coming to two-wheeler space, Hero Motors sales were largely in line, growth was 19%. For Eicher Motors too, sales were largely in line, and growth, it has seen growth in both up to 350cc and more than 350cc segments, and overall sales were up almost 10%. For Bajaj Auto, sales were largely in line here too, and total sales have increased by 30%, and export numbers have been more than 2.5 lakh units. Coming to commercial, first TVS Motor, highest ever monthly sales, more than 6.30 lakh units. In the commercial vehicle space, Ashok Leyland has reported a very strong set of numbers. MHCV truck sales were up 47%, LCV2 has seen a growth of more than 32%, and bus sales were down 14%.
Sudarshan, thank you for those auto sales figures. Good summarization of the numbers that have been reported so far. But a whole host of other stocks are also buzzing on the back of their first quarter results. Ananya is joining in with all of those updates. Ananya.
Well, let me first start with Muthoot Finance. The stock is under pressure, you can see, because of the 300 bips NIM compression that we saw, which led to the 17% sequential decline in PAT. If you see the business, the AUM growth was also in line. Nothing, not a big surprise here, for 3% year and 6% sequentially up. Now, coming to ITC, it is also trading higher as cigarettes volume declined only 5 to 6%, much better than feared. Even even though revenue, EBITDA and PAT missed estimates here. Now, ABB India is also gaining after reporting 21% revenue growth and a 50% rise in order inflows, although margins and PAT were below expectations here. Now, coming to Persistent Systems, they remain under pressure as the margin miss and forex-led PAT decline overshadowed better than expected constant currency growth and a record deal win of $1.15 billion here. Now, Indian Oil, they are also trading higher with its 2,660 crore loss coming in better than estimates, and core GRM improving sharply to $19 per barrel. Now, finally, Urban Company is surging, supported by 44% revenue growth, strong order volume and user additions, despite elevated loss from InstaHelp investments. So these are the stock buzzing in trade today.
All right. Thank you, Ananya, for taking us through all of those stocks that are in the news today. But moving on, Z Entertainment is in the eye of a regulatory storm. The stock has tumbled over 10%, down 11% right now after the SEBI barred the company promoter Subhash Chandra and MD Puneet Goenka from the securities market for 12 months. And the fallout doesn't stop there. The order now puts a serious question mark over Z's freshly approved 3,100 crore rupee warrant issue. Devyani Vibhute joins us now with all of those details. Devyani?
Well, shareholders of Z Entertainment have approved the 3,144 crore preferential warrant issue to promoter group entity Sunbelt Mauritius, which would raise the promoter stake from 24% to 24% from the current 4% levels. Now, the fundraiser is under a cloud after SEBI barred Z Entertainment for a period of 2 months and restrained its promoters Puneet Goenka and Subhash Chandra from accessing the securities market directly or indirectly for a period of 12 months, following findings that the promoter used company-owned land to borrow 726 crores in privately held entities without the appropriate approvals. Now, Z says that the order has no direct bearing on the warrant issue, but legal experts believe that the issue cannot proceed unless the SEBI order is stayed by the SAT. Now, this uncertainty around the fundraise and the fresh governance concerns against the promoters is weighing on the stock in trade today.
11.5% lower on Z Entertainment. Devyani, thank you for that update there. The biggest single day fall for the stock since June of 2024. Take a short break. Back with more on the other side.
Welcome back. You're still with us on Business Lunch. HDFC Bank was once the easiest stock in banking to own. Now it's down nearly 25% this year, even as the Nifty rallies. Margins are shrinking, profit growth has slowed, and ICICI Bank is pulling ahead on almost every metric. Ritu Singh breaks down what's going wrong and why analysts still aren't giving up on it. Ritu?
Well, HDFC Bank was once the easiest stock to own in banking. Now, down nearly 25% this year, even as the Nifty rallies. Margins have been shrinking, profit growth has slowed down, and ICICI Bank, of course, is pulling ahead. Let's look at what's really gone wrong here. Because, earlier you had the market that was happy to pay a premium for this stock. And now what's really happening is that it's down 25% this year. Like I said, more than 9% in the last 3 years, while the markets are performing better. Start with the profits. They're still growing, but the pace has slowed sharply, just 5% in the June quarter and 11% for FY26 versus the near 20% growth engine that HDFC Bank used to be. Bad loans are not really the problem at all here. Asset quality remains among the best in class. So let's look at what's happening to margins. Now, when HDFC Bank merged with its parent, it suddenly had far more loans on its books than deposits to fund them. So it's spent the time since bringing that CD ratio back in line, which has come down from a peak of 110% to about 96%, still high, but at least coming down. But let's look at the funding mix, that is CASA, the current and savings account, which has fallen from 44% of the book to 32%. And that means a smaller share of deposits is now coming from the bank's cheaper funding sources. And you can see the impact in the margins down to a record low of 3.26% versus more than 4% the bank would consistently deliver before the merger took place. Let's look at the return ratios, because ultimately when you're buying a stock, you're looking at how efficiently it is generating returns on its assets and on shareholders' capital, and both have come down. Now, those are important numbers because superior returns were one of the big reasons that HDFC Bank commanded that premium valuation. Then, of course, there's governance, which adds a cloud. The chairman's abrupt exit, the CEO reappointment delay, the regulatory matters around AT1, the Dubai issue, the MSRDC issue, these US law firms announcing investigations. Now, independently, none of that is existential, but together, it is one more reason that investors have found it easier to stay away. And that matters right now because investors have somewhere else to put that money. ICICI Bank is out-earning HDFC Bank almost across the board. Profit growth of nearly 16% against HDFC's 5% in the last quarter. Margins of 4.36% against 3.26%. Return on assets is higher, and that performance gap is also showing up in the valuation. So HDFC Bank, that trades at roughly 2 times the book value. ICICI Bank closer to 2.8 times, and this is a complete reversal from just 2 years ago when HDFC Bank commanded that premium. But here's the most interesting part. Of the 47 analysts that cover the stock, 46 still have a buy rating on HDFC Bank, and the average target price even today implies an almost 38% upside from the current levels. So essentially, analysts are saying the franchise is strong, it's good, but the stock has become too cheap. The market, though, is waiting for evidence that that old growth engine gets roaring again, and that's essentially the debate around HDFC Bank right now.
Ritu, thank you for that. The street not ready to give up on HDFC Bank. The stock, though, is giving up some of the gains, is still hovering around those 52-week lows of around 730. On to the latest updates from West Asia. Then, US President Donald Trump said that an agreement with Iran is imminent, with negotiations set to begin today. In a post on Truth Social, he said that he had agreed to call off a planned military strike on Iran after Tehran and other regional governments requested a pause, saying that the parameters of a deal had been agreed upon. Later, he spoke to reporters aboard the Air Force One on the matter. Listen to what he had to say.
Was asked to by Saudi Arabia, by UAE, by Qatar, and by Iran. We were all set to go just about at this time right now, and it would have been a massive attack. We're all set to go, but when the allies ask to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. There's a deal on Hormuz, and then there will be a deal on the nuclear, or you might call it the denuclearization of Iran. Well, now what we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that, save a lot of lives, save a lot of unnecessary power, to be honest with you. It'll take many, many years to ever build it back. If it could, I don't think it would be even buildable back. So we had a We had an attack that would be the biggest attack since World War II, and it would have been disastrous for them, and they didn't want us to do it. And frankly, Saudi Arabia didn't want it either. They thought that a deal is imminent. And the deal is imminent having to do with the Hormuz Strait and also ultimately the denuclearization of Iran.
And meanwhile, Iran's president urges the U.S. to remain committed to the MOU signed between the two countries in June and says the interim deal will be the center of gravity of Tehran's foreign relations in the future. Additionally, Iran's foreign minister says negotiations between Tehran and Oman on the future management of the Strait of Hormuz are in their final stages. Elsewhere, Israel says there is no change in policy towards Gaza, despite Trump's announcement of a roadmap to implement the second phase of a peace deal, including Hamas disarming and Israeli troops withdrawing.
Take a short break then. Back with more on the other side. Stay tuned. Welcome back. Moving on to national news then. The death toll in the rain-related incidents has risen to 11 in Kerala as heavy rains continue to wreak havoc across the state. The IMD has recorded over 100 millimeter of rainfall in several districts, and several district collectors have also declared a holiday for educational institutions in view of the continuing heavy rainfall. The officials have also urged people living in low-lying areas to shift to safer locations as authorities monitor vulnerable regions. Meanwhile, Chief Minister V.D. Satheesan has convened an emergency online meeting with the district collectors to review the rain situation and coordinate response measures.
It's a big moment for Indian sport at the Glasgow Commonwealth Games 2026. India produced its biggest medal haul of the Games so far, winning an outstanding 16 medals on day 10 to climb to 4th in the overall standings. Boxing stole the spotlight with 10 medals, including 7 golds, underlining India's growing dominance in the ring. There was more success in athletics, with Gulveer Singh claiming his 2nd medal of the Games, while India also secured a gold-silver finish in the men's F57 shot put. The country added medals in the triple jump and judo as well. With this stellar performance, India's overall tally has risen to 39 medals, 13 gold, 17 silver and 9 bronze.
Well, still a double hundred on the index, so the index continues to remain where it was. There is some semblance of recovery in Muthoot Finance. The stock that was down over 12% is still down around 8%, but there is some recovery from lower levels. IEX as well, continuing to maintain losses of close to around 4.5% as we speak. There was some recovery, but that recovery has been sold into very quickly. 127 now on IEX. Pine Labs has moved to the highs of the day, 10% higher on that one. Reddington has moved to the highs of the day, 8.5% on that one as well. And LTM, among the IT names, that one has seen a very sharp surge, has moved to the highs of the day, 7.5% now, almost 8% actually on LTM. A sharp surge after 11 o'clock and holding on to gains from those levels. Take your leave on this edition of Business Lunch. Plenty of earnings still coming up during the course of the day. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra, and with me, as always, Vivek Iyer. A good start to August, a good start to the week as well. The banking index, the IT pack, broader markets, all are contributing to the gains that we are seeing. Good macro setup as well. Crude lower, rupee higher. I think that's what the markets need.
That's right. Neatly encapsulated all the positives that the market is pricing in today, and that's ensured that the mid-cap and small-cap index too is continuing the momentum. But we have very important managements lined up later on the show, so let's start off quickly with the top headlines. Market continues to trade with gains, with the Nifty trading near the 24,600 level, led by gains from metals, FMCG and IT. Media emerges as the sole sectoral laggard. Broader markets trade in line with benchmarks.
Urban Company's solid growth in the core business sees the stock trade with gains over 13% in today's session. The company looks to prioritize market leadership in its Insta Help segment.
Margin pressures weigh on Muthoot Finance's June quarter as margins shrink over 250 basis points, dragging profits lower sequentially. MD George Alexander Muthoot guides for 10.5% to 11% margin. Tell CNBC TV 18 that AUM guidance may be revised post Q2. The stock sharply lower in the session.
Shares of Persistent Systems sees a sharp recovery from the lows to trade near the flat line. The IT company reports a beat on revenue while margin misses the street estimates due to increase in direct costs and sales marketing expense.
SEBI action batters Zee Entertainment. The stock tumbles over 10%, marking its steepest decline in over 2 years. The regulator bars the company, Subhash Chandra and Puneet Goenka from the securities markets for a year. The order casts a shadow over company's 3,100 crore warrant issued to ex-promoters.
All right, those are the top headlines that we are tracking for the markets. As we pointed out earlier, continues to be a good day. We are above that 24,550 mark by a huge margin, and that was an important resistance. So the levels have been crossed, and let's see which way things go now from here on. Mid caps are doing better, 0.9% higher. Small caps also contributing. So the broader market rally continues, and a lot of earnings which are coming in thick and fast. That is something which is contributing a lot to market moves.
That's right. It's all about the earnings, and that's exactly what is making all the market moves. Some time ago, we saw the results of Blue Jet Healthcare. On a year-on-year basis, there's been a bit of a dip, but on a sequential basis, there has been quite a bit of a recovery as far as Blue Jet Healthcare is concerned. But this is our special segment, Mid-Cap Movers. Upasana standing by the big wall to take us through all of the mid-caps that are moving around in the session.
Well, certainly it's a good day for the markets today. Now, Nifty Midcap Index up nearly 0.8%. Let us look at the top gainers in today's trading session. Topping the list is Blue Dart, one of the key volumes buzzers, volume up 19 times. Pine Labs up nearly about 9%. LG Electronics is also seeing a sharp move. If we look at the volumes of this counter, it's up more than 1.2 times the weekly average. Now, sugar stocks also seeing some kind of a buying. Balrampur Chini up 7%. Dalmia Bharat Sugar also up 14%. Now, let us look at the key result reactions and the stock in focus on the back of that. Urban Company up more than 12%. APL Apollo Tubes seeing a sharp surge on the back of that strong commentary from the management. Muthoot Finance is taking a hit out there. Latent View Analytics down nearly about 6%, and EPAC Prefab is down nearly about 8% on back of that weak result. Now, on the flip side, let us look at the mid-cap losers in today's trading session. Thangamaya Jewelry continues to go on the downtrend, taking a hit of 5%. Thermax is also down nearly about 4%. And lastly, Credit Access Grameen is also taking a hit of nearly about 3%. So all in all, these are the stocks on our radar in today's trading session.
Okay, take that point, Upasana. Thank you so much for joining us as always. So those are some mid-cap movers that we are tracking. But let's get some management conversation going now. Embassy REIT is the first management of the show. The company reported a good set of Q1. Revenue came in healthy. Company says deal activity levels have normalized in the last 2 months. There is around 86% of demand coming from the new entrants in the Indian office space. We are now joined by Amit Shetty, the CEO of Embassy Office Parks REIT. Amit, good afternoon. Thank you so much for joining us as always. Good quarter, but this time around, if I look at the distribution per unit, you maintain your guidance, but it has been lower than what you had guided for earlier in this particular quarter. Yeah. What led to that? How is it 9% versus 10% that you've guided for? And what is leading to the growth that we are seeing in FY27?
Sure. Firstly, thank you for having me on the show, but just on the question of why our DPU is slightly lower than our guidance is simply because the first quarter always sees the property tax, and also there was some cash tax impact that we had to pay the last year that we paid this first quarter.
Okay. And what is the outlook now? Like you maintain your 10% guidance?
We maintain a guidance of 10% on the TPO.
Okay. Let's talk about leasing activity. How was it in the quarter gone by? 1.3 million square feet of leasing. How much of it was renewables? What is fresh leasing trends like? And are the rates similar or better?
Okay. I think a very interesting market, I should say. Very strong start to the year for us as well. 1.3 million square feet leased, of which about 17% of that 17 transactions across 10 new entrants into the book. Okay. So that's been very, very encouraging. A total of 10% higher spread as well. The market's doing extremely well, Vivek. The fact is that, we've seen the first half of the year about 45.5 million square feet of transaction already concluded. And I think it's going to be a record year compared to what's been out there in the real estate market.
So how much will Embassy Office Parks REIT be a part of it? Because 1.3 million square feet in quarter one, what are you guiding for in FY27? And now, we talk about Bangalore, yes, but there is a lot of commercial activity already happening here. So from here on, which geography will contribute to the growth?
See, I think, Bangalore still continues to be the leader of the pack, right? So if you see the last quarter, about 27-30% of the total absorption came from Bangalore, and we continue to see that trend through the RFPs that are out in the market, right? 30 million square feet of RFP, about 50% of that RFP is for Bangalore. So Bangalore continues to be the stronghold. Again, the southern states seem to be, doing the bulk of the activities, Hyderabad as well as Chennai for that matter.
Okay. Now, the next question, what we want to ask you is, given your presence, especially in South India, especially in Bangalore, very IT-heavy cities, both of them, a lot of worries, especially about layoffs in the IT space. So does there continue to remain demand as far as IT companies are concerned? Has the demand shifted? How is that entire dynamic playing out?
In fact, very contrary to what you've been hearing, the fact is that the demand is actually anchored by the GCCs, and we've been speaking about this for a bit. The last quarter, we saw about 10 million square feet of absorption from the GCCs, which led to about 42% of the gross absorption itself. And an interesting trend that we're seeing or continuing to see is the domestics. Domestics are contributing to about 46% of this demand, followed by Americas at 30%, then the EMEA at about 16-18%, and Asia Pacific at about 8%. So, the flex is also, got a big contribution in that domestic demand, which is about 27%, again stimulated by the GCC.
How much is GCC a part of your portfolio?
See, today about 68% of our rent comes from GCC clients, right? And this last quarter, about 81% of our total leasing was from the GCCs.
I didn't get the leasing target for the year. What are you guiding for?
We've guided for 92%. Occupancy.
Occupancies. Yeah. And if it is 1.3 million square feet in the first quarter, do you think multiply by 4 is going to be the target for this year?
Not really, Sonali. You shouldn't see it that way because, we don't have too much of occupancy, vacant spaces rather, right? So it's about 4.5 million square feet that we have in terms of vacancy itself. But again, there's a lot of demand on the pre-leasing side. So I think it'll be safe for me to say that we'll hit the 92% occupancy guidance.
Okay, one thing the market looks for, and you've alluded to this as well. Give us a sense of how you see your AUM growing or total asset size growing. Which are the opportunities you're seeing? You spoke about South India, doing the bulk of the heavy lifting. What is the trend as far as the rest of India is concerned?
I mean, the demand is across the country. I mean, every city is growing. For example, Bombay or Pune or even for that matter, NCR as well. All the cities are growing from their baselines. But having said that, for us particularly, we are actually developing about 6.2 million square feet of portfolio. That's organic growth, right? We are spending about 3,500 crores and our stabilized NOI will be about 610 crores on that. And also we're looking at about 10-12 million square feet of acquisition, which is inorganic from our sponsor as well as from third party.
Okay.
Any targets?
Not really. I mean, these things take a little bit of time to bake, and then we're thinking this should get done in the 4 to 5 year time frame. Okay. But again, probably not all of that 10 million square feet will get culminated, but a significant portion of that will.
Last question on the hotels business. Jefferies expects a 25% NOI growth in the hotels business over the next 3 years. There was a dip last quarter, but this time you've made a comeback. Occupancies are at 61%. Your ARRs have climbed 5% on a YOY basis. First, do you agree with Jefferies' projection of 25% growth? Plus, what happens with occupancies? It's at 61%. What are the plans with your hotels business? You just launched one in the quarter as well.
Yeah, so we are happy to announce that we just launched the Hilton Garden Inn in Bangalore in Embassy Tech Village. This is, I should just share this with your viewers that, on the first month, we've actually had an occupancy of about 18% and we've already hit our ADRs of about 19,000 rupees plus. Oh. So, the hotels are doing well and we continue to see the momentum spurred both by domestic as well as international travelers.
So 25% doable?
I wouldn't want to make any forward-looking statement, but I think, the overall macros are really positioned well.
Well, thank you so much for coming to us today. Thank you so much for explaining the business. Wish you all the best for the rest of FY27.
Thank you so much.
We hope to see the DPUs inside going forward as well.
Thank you.
Well, that was the management of Embassy REIT in conversation post Q1 FY27 results. But we'll now slip into a short break. We'll get a conversation with the management of M&M on the other side. Stay tuned.
See you guys.
Welcome back to Midcap Radar. Well, now shifting focus to the auto space, Mahindra's auto segment saw a strong show in the first month of June with growth led by the SUV and commercial vehicle segment. Our colleague Sudarshan Kumar spoke to the CEO of Automotive Division and started off by asking about the factors behind the July sales. Let's listen in.
So a couple of major factors for us, obviously, one of them is post-GST reforms last year. We had fairly strong growth happening happening on the lower end of the segment and mid segment, and then continues to happen. And beyond that, we've had two major launches we did in early Jan. We had the XEV9S on the EV portfolio and then 7XO refresh on the 700 portfolio. Both of them have given very, very strong numbers. The demand continues to be very robust on both these fronts. So that's adding to the growth momentum as well. But all in all, the portfolio is in a very strong place. And we are very hopeful that to have a very strong festive season.
So XEV9 and 7XO that you had launched recently and that are adding to your already increased volumes. So going into H2 FY27, could you talk about some of the launches that you have you are going to undertake?
Yeah, primarily currently we're focused on the two major launches and ensuring that we are delivering to the customer demand at this point in time. And in next calendar year, we have two major launches lined up. It's hard to say which month it's going to come in. Probably in about 2 to 3 quarters, we should be able to see that. And one of them would be on the ICE. It's a brand new brand we are getting in. And then on the EV side, we're going to get a new vehicle brand on the InterGlobe platform as well. So again, two major launches coming in, but not necessarily in this year. Current focus in this year is to deliver on the 9S demand as well as 7XO on overall demand for festive.
And on the capacity front, sir, how are you? What all steps you are taking to meet the increased demand that entire sector has seen?
So we're doing two major steps. One, before festive, end of this quarter, we should have our ICE capacity go to 60,000, and then our EV capacity is 8,000 at this point in time. And then the next major boost for us will come by end of the year, by end of this fiscal. We'll be adding 10,000 more capacity on the ICE portfolio. And that will be coming out of the new IQ platform, a new model launch. We're doing that as well. And then on the EV side, we'll have a new brand that I talked about. And that will add on the 4,000 capacity. So net, you will be at 70,000 plus 12,000 at 82,000 as against what we have right now, which is about 68 or so. So strong plans in place. Half of it will come in by end of Q2 and then the rest of it by end of the year.
So good growth, but one concern and one topic that has been talked about the most is the commodity cost. Now, over the last 1 to 2 months, we have seen some downtrend. How are you seeing in the industry? Have you started seeing that cost have started coming down? And how are you seeing the trends over the next few months?
Yeah, firstly, it's a very, very hard one to predict. Things can change day to day. As you know, commodity prices have been very volatile. So I wouldn't go and make a prediction at this point in time how it's going to play out. We are hopeful that it is benign over the next quarter or so. But we have taken 3 price hikes already at this point in time. In Jan, we took a 1% price hike. We took a 1.3% price hike in April. And in July, it's a substantive price hike of 2.7%. The good news is the demand continues to be robust even after the third price hike. So we're hopeful with these price hikes, we are in a good place in Q2, but very hard to predict how the commodity prices will go.
So besides your passenger vehicle segment, one heartening factor, and I was talking about, is the commercial vehicle segment. It has seen a very strong growth. So 2 to 3.5 tons, 21% growth in July and 19% growth in April to July. How are you seeing this growth panning out or going into H2 FY27? Current set of growth, are we going to maintain?
Yeah, very strong numbers. Like you said, our domestic, if you look at it, 25,204, 23% growth for us year on year in July. We are right in the middle of a replacement super cycle. As you know, the CV vehicles go through replacement cycles every 3.5, 4 years. We were supposed to have had one early last year, didn't happen. But post GST reforms, I think we've been in a replacement cycle, and currently it looks very, very robust. The portfolio and the end applications, as we call it, whether it's fruits and vegetables or infrastructure, we see strong growth across the board. So I'm very optimistic, at least till the end of festive, we're very optimistic on the CV numbers at this point in time.
And last 2 months, we did talk to you about the supply side issues, and you had said that by the end of July, almost all the issues have been resolved. So there are no issues related to supply side?
Currently, most of our suppliers are supplying. Like we had some early issues with few suppliers. And in the last few weeks, most of it has been moderated. We did take a planned shutdown in the beginning of July. It was a planned event that we had for 4 days or so. So that it impacted a little bit of output in July, but that didn't impact on the billing numbers. We have had good growth. So August should be good. We are all tight on supplies. As you know, the industry is growing very fast, but from what we have seen in the last couple of weeks, we're very optimistic on the supply front.
Lastly, sir, on the back of strong set of numbers, we still have 8 months to go into FY27. How do you see the outlook for both passenger vehicle segment and commercial vehicle segment for the industry? Any change?
Again, hard to predict, but from our side, we are projecting for mid to high teens growth on the SUV front, and we'll do well on that. And we're holding on to the projection on the LCV side. So far, it's been very good. We were projecting late or high single digits, but we'll see how that plays out over the rest of the year.
Last one question. Recently, there was a consolidation announcement between SML Mahindra brands and Mahindra's commercial vehicle brands, especially truck and bus. How do you see that strategy panning out? And exactly on the market share, if you talk about that, you would be looking at the market share even in the higher commercial vehicle segment from the incumbents?
Yeah, no, as you said, it's a big announcement for us that helps us have one single entity focus completely on trucks and buses. It's a separate listed entity. I would let them have the conversation about that as well on projections. But overall, it allows us to consolidate everything, get synergies and focus in one single entity on trucks and buses.
All right, that's the word coming in from M&M. The stock, though, absolutely flat with some negative bias. We'll slip into a short break now. When we come back, we'll talk more about markets, get you some stock-specific action as well on the other side. Stay tuned for that. Welcome back. You're still tuned in a mid-cap radar. Markets continue to trend higher, but it's the earnings reaction which is keeping us and every market participant very busy. Margin pressures, they weigh on Muthoot Finance's June quarter as they shrunk 250 basis points. We have Ananya joining us now to decode the quarter one numbers. What are brokerages making of this number? Ananya, over to you.
Well, yes, Muthoot Finance delivered a soft quarter with profitability falling short of the expectation as business growth, if you see, was largely in line, nothing new year. AUM rose 43% year on year and 6% sequentially because of the elevated gold prices. The PAT rose 25% year on year, but declined 17% sequentially due to the margin pressure, like Sonal mentioned. So the main disappointment here was NIM. It compressed 300 bips quarter on quarter and 220 bips year on year basis to 10.4%. This was because as yield normalized and funding costs remain elevated here. Now, in a CNBC TV interview, management said that the margin reset is largely behind them. Expects NIM to remain around 10.5 to 11% range, with yield stabilizing at 18 to 18.5% range, and remain open to reducing lending rates to drive further growth. Now, when you look at the brokerages, they remain cautious post the results. Bernstein highlighted that the margin normalization could weigh on earnings despite healthy asset quality. CLSA noted that the AUM remained resilient despite a 4% Q-on-Q correction in gold prices, but pointed to a shift in focus from profitability to growth. While Jefferies downgraded the stock, citing competition, lower yields, and a weaker earnings growth outlook. So going forward, margins and gold prices will be the key monitorable for Muthoot.
Well, thank you so much, Ananya, for joining us, giving us all of the key reasons as to why exactly Muthoot Finance has been under considerable pressure. But with that, it's a wrap on this edition on Mid-Cap Radar from Sonal and myself. Your stocks when we return.
Hello and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan and with me as always is Vinny Motiwala. Vinny, good afternoon. You know, it's a great start to the week for the markets. The Nifty holding well above that 24,500 mark, and that was a psychological level that we wanted to see the Nifty break, right? So that's about 200 points higher and in the green. We've got the mid-cap index also rising in tandem with the blue chips. The Nifty Bank as well doing well today, 0.8% higher. The stocks leading from the front are those IT names that are doing very well. It's the top gaining index today. We've got even those PSU bank names doing well, and we've got FMCG names on top. The only sector in the red is that a media pack, and that's all because of Z Entertainment. So that's how the markets are shaping up this afternoon, Vinny.
Absolutely, you know, interesting shape up in terms of markets. And today, PSU banks, like you said, they are also supporting. So IT and PSU banks doing well is leading the up move in today's trading session as well. We have a lot of earnings that came out also over the weekend. We had a urban company that's holding on to gain very strong gains as well. Now you have Ethos that's come out with its numbers, so keep an eye out on that. It's flashing at the bottom of your screens. Well, the stock is up almost 6% in the trading session. Net profits up 47%, a sharp spike up that we're seeing coming in. More in terms of internals later on through the show as well. But as of now, whole host of movers that we're watching out for. And 52-week high for Reddington. We're seeing Paytm trading at 52 weeks high. We have Craftsman Automation, all these stocks trading at 52 weeks high as well. So yes, that's how the market setup is looking like. But let's keep it going with all your stock-related queries that you all have sent us. And to do that, we have our experts joining us. We have Chandan Taparia from Motilal Oswal Financial Services, as well as Lancer Dekuna from ValueX Wealth, connecting with us later on shortly in the show as well. So we will have all those queries and we'll get them answered. Chandan, let's start the first query with you today. We have G. Krishnamurthy, who's writing to us from Chennai. He's holding 1,000 shares of Kalyan Jewellers. Price is 597 rupees per share, making a little bit of profit on this one. Wants to know, does it merit holding the stock for the next 1 to 2 years? What are the levels, Chandan, that the viewer should keep an eye out on?
Yeah, thanks for having me. So looking at Kalyan Jewellers, in the recent past, we have seen a good momentum in the selective jewelry counter, and Kalyan also rallied well. In fact, this counter is up by around 25% in last 5 to 6 months. And in the last month, it rallied well from 352 all the way to 640, 650 marks. So major trend is positive as of now if I look at the medium-term point of view. But in last 2 days, it witnessed some profit booking decline. But trend is intact, and I believe buy on decline could continue. If he's holding the position, he can continue to hold because in the recent past, the major trend has changed and some more positive stance could be there. So buy on decline could continue for the new traders. Those who are holding, they can continue with support near 570, and we believe that this counter can head towards 650 to 680 marks on the hard side.
All right. Lancelot Dekuna has also joined us from ValueX Wealth Connect. Lancelot, hi, good afternoon. You know, the first query coming in there, and it's about Kalyan Jewellers. The viewer holds 1,000 shares of the stock at 597 rupees and wants to know if he can hold it for another 1 to 2 years. So, Lancelot, what's the fundamental view on the stock? Is it a good bet to hold on to for the next 1 or 2 years?
I think, if you look at the valuations and if you look at the business has been growing at a decent rate. So one can expect that this business will continue to grow. It trades at about 45 times its earnings and has a reasonably high return on equity. So given that you are going to see, revenues grow for the next 1 or 2 years, and you have a reasonably high return on equity as well as margins, I think one should stay invested if you're already holding it. As long as you have 2-3 year time horizon, I think you would benefit from this investment over time.
All right, so you'll benefit from this investment over time. So hold it is what you're saying for the time being. The next query coming in from Shriram Raghuraman, who writes to us from Coimbatore. He's a senior citizen and he holds 10 shares of Titan at 991 rupees. He is making a profit on the stock. And he wants to know a fundamental view on this stock from a 1-year perspective. You know, the stock has done well. Its Q1 numbers were also good. So, Lancelot, from the fundamental perspective, should he continue to hold Titan from a 1-year perspective, or should he book some profits right now?
So I think, if you've looked at Titan's results, it has given out good results. There's been good growth in the last couple of quarters. And even in the last couple of years, it's a very strong company because it has multiple brands. Apart from the jewelry business, they're very strong in the watch segment. They have the eyewear segment. They also have come out with some niche products like, saris and wedding stuff. So I think that Titan will continue to compound its earnings and grow returns. So one should stay invested even if it is for a year or so.
Stay invested even if it's a year or so. For Titan, Kalyan, both you're giving it a thumbs up right now. Chandan, what's your view coming in on Titan as well? What should the viewer do? We spoke about Kalyan before, now we have Titan. So two leaders coming in this space.
Yeah, so Titan looks quite positive. In fact, counter has been making higher top, higher bottom on the weekly, monthly, and the daily chart. And it has really rallied well in last 9-10 years from 325 to all the way to 4900 levels. The only problem is he's just having the small quantity. Otherwise, this is the counter one can continue to hold. Already his price has gone more than 4 to 5 times. I believe overall trend could remain positive. Any small decline can be bought. Those who are looking to buy new. Major support is near 4650. And I believe slow and steady, this counter has potential to head towards 5200 on short-term point of view and 5800 to 6000 on positional point of view. So those who are holding can continue to hold Titan with the view that this stock is likely to generate alpha with lower beta with margin of safety as well.
Okay, can generate alpha with a lower beta. That's interesting. So can continue to hold Titan. Let's move on to the next query for today. We have Rajesh, who's writing to us from Hyderabad. He wants to know whether he should hold or sell Sansera Engineering and Azad Engineering. Actually, it's more seems like he sent us an investment query. Azad Engineering and Sansera Engineering. It's wants to know whether it's a good time to look at this one. Time period of investment is 1 to 2 years. Sansera Engineering obviously is on the auto component manufacturer side. Azad Engineering is more towards that capex tilt that they have as well. Lancelot, what's your view coming in on both these names, Sansera as well as Azad Engineering?
I think if you look at Sansera, they are an engineering company manufacturing complex and critical, precision equipment, both for automotive and for other non-automotive sectors. And the turnover has been growing at a good pace. The margins have improved to almost 18% over the last year. But the stock trades at a very high multiple. It's at almost 70 times earnings. So for an engineering company, while the stock is trading at a high multiple, the growth is not that high to justify such a high multiple. So I would suggest that if either you're holding a large quantity, one can look at booking profits, or just continue to hold if it's a smaller quantity, and maybe at some point in time you will look at cashing out if the stock moves up at a higher level. As far as Azad Engineering is concerned, I think it is trading at almost 100 times its earnings, so it's very high for an engineering company, and given the risk reward, it's not really favorable at this point in time to accumulate this or even to hold it. One can look at booking profits in this company.
All right, so that's the view coming in there for Azad Engineering and Sansera. Chandan, the viewer wants to know if he can invest in one of these stocks. Do you think either of these stocks are a good bet? And if so, any technical levels that they can enter at?
Yeah, so both of these companies have rallied well in the recent past. In fact, the Sansera rallied by more than 100% in just last 7 months. So major trend is positive as counter has been making higher to higher bottom. But the only problem is now the risk reward ratio for entering the current level. But trend is intact. If I look at the last 16 months, this counter rallied well from 1000 to 3470. But trend is intact. Any small decline is being bought. So my suggestion for traders to continue to hold the position with support of 3200. And I believe till this level holds, it has potential to extend the rally towards 3650 to 3800 levels. But one need to keep in mind about the position sizing because already counter has rallied well. Talking about Azad Engineering, we have positive view on the same. However, from last 4 weeks, it has been consolidating, but holding well above its rising support trend line and holding above its key 50-day exponential moving average. So here one can hold the long position or can accumulate on decline with support near 2150 for an upside target towards 2500 to 2750. So more comfortable in Azad than Sansera, but trend for both the counter are positive, but need to look at the position sizing as counter have really do well. So risk reward might not favorable here.
All right, all right. The next query is coming in from Shrikant, and he is actually calling us from Bangalore. He's a regular viewer of the channel and has investments in South Indian Bank. Shrikant, can you hear us?
Yeah, I can hear you clearly.
Yeah, please go ahead with your question.
Live call. Yeah, thank you for this live call with the team. Yeah, I have a query on the South Indian Bank, and I have it at 21. Yeah, I wanted to understand, can I hold it, or should I exit, book the profit? Yeah, that's my query. Thank
All right. Lancelot, the viewer has holdings in South Indian Bank and he wants to know if he should continue to hold or book some profits at this point.
I think one should look at booking profits at this point because, the relative situation as far as banks are concerned, most of the banks have come out with good numbers this quarter. But going forward, I think the bigger banks will benefit in terms of, being able to maintain margins. And the smaller banks would find it a lot more difficult in order to raise funds at lower valuations. So one should look at maybe booking profits and look at the option of switching to some of the larger banks.
Okay, book profits and can look at larger banks as well. And Srikanth has already made a good profit in this one, right? Almost doubling from the price that they bought it at. Chandan, what is your view on the technicals as well? Is it the same, given that the stock has also seen a good run-up, right? 63% in just the last 1 year's a run-up. The viewer is making a profit. What is your suggestion on the technicals?
Yeah, so the trend is positive because counter has been making high tops, high bottom, but it got stuck in a range from last almost 8-10 weeks. So suggestion is he can book some position or can trail the support. As of now, till it holds above 44.50, trend remain positive, but it is finding some supply at higher levels. So suggestion is reduce some position or keep the trailing position so that he can continue to be with winning trade without losing much. So 44.50, 44 is major support for the counter as of now.
Okay, point taken there. And Srikanth, I hope that answers your query as well. And thank you so much as always, for watching us and calling us as well. Thanks so much.
Yeah, thanks a lot.
Thank you so much, Srikanth. But let's move on then to the next query for today. We have Nagaraju, who's writing to us from India, and he is asking about investing in Orkla India. This is for the long term. Lancelot, what's your view coming in for Orkla India? Is it something that you would be looking at?
So, Orkla India is a company that owns various brands like MTR, Eastern, and these brands have been they're old brands and are well established. But actually, at the moment, the valuations are a little on the higher side. Second is we expect to see some kind of input pressures, from these companies, because a lot of the inputs are going to rise and it may be difficult for market penetration unless you increase selling prices. So that may have an impact both on the margins as well as on the volumes. So given that background, and since the stock is trading, it's fairly valued at this point in time. I think at this point in time, if one has to buy, it may be better to wait it out and buy on a dip. But otherwise, the overall business seems pretty robust and strong.
All right. So wait it out and buy later is what you're saying. Chandan, what's your view on Orkla India? Do you think, it's a good time to buy now or any levels to watch out for?
Yeah, so this counter has been making lower top, lower bottom from last almost 14 weeks, corrected from 660 to almost 550 level. However, multiple supports are there near 530, 540. There is all-time low for the counter, but trend is negative. Let it settle. I think if it comes near 530 or 540, which is major support, some buying interest may emerge. So better to wait for some more decline and to get the stability for bargain buying in the counter.
Better to wait for a bit more of a decline, because right now the trend is a bit more on the negative side of the charts as well as what Chandan is highlighting. So wait out before you enter the stock, and Chandan mentioned some levels, so keep an eye out on that. But on that note, we're going to slip into a very short break. We'll come back with more of your stock related queries after the break. Stay tuned in. Welcome back to your stocks on CNBC TV 18. As of now, Nifty at 24,590 levels, 200-point uptick as of now is what it's holding on to. But let's keep it going with all your stock-related queries. We still have with us Lancelot as well as Chandan to answer those queries. Let's move on to the next query. This is also a caller query that we have. This query is from Manav. He's calling us right now, Manav from Chandigarh. Manav, hi, good afternoon. Thank you so much for calling us. I believe you have two queries, right? One is on Apollo Microsystems and Time Technoplast. Please take us through it.
Hi, thank you. My query is about Apollo Microsystems. I'm holding 100 shares at the rate of 400. And what is the long-term view, medium to long-term view for this? Should I continue holding this? And another is about Time Technoplast. Its results are expected on 5th of August. Should I hold it or book my whatever profit I have?
Sure, Manav, thanks for that. First one is Apollo Microsystems. They bought it at 400 rupees. And the other one is Time Technoplast. Currently, the stock is trading at the buy price. Lancelot, on the fundamentals, Apollo Microsystems, defense side, we've seen a lot of action coming in, a lot of profits that are made here as well. But does it still merit holding on to both these names? What would you suggest?
So I think as far as Apollo Microsystems is concerned, they are a leading technology provider of high performance, mission critical solutions for the defense sector. And this sector has seen good order addition and is seeing good traction. But if you look at the stock, it's trading at 130 times its earnings. Like most of the defense stocks may be expensive. And if you consider that, these stocks, even if there's a 1 quarter bad result or a poor result, it could result in some serious re-rating on the downside. So the risk-reward ratio is very much in favor of, selling at this point in time and definitely not buying because you do not know what can happen in the near term, and that could impact the valuations significantly. As far as which was the other company it mentioned?
Yes.
Time Technoplast. So I think that company is also trading. It's trading at a reasonable multiple, and it's basically manufacturing products which are in the packaging industry with a specialization on the medical pharma side. So as the pharmaceutical business grows, the demand for the new type of packaging is increasing, and that has become a big driver for them. We have seen the sales as well as return on equity is reasonably good for this company. Revenue is growing and it is trading at a reasonable valuation. So one can look at accumulating this, for if you have a 3 to 5 year outlook.
All right, so can continue to accumulate Time Technoplast is what you're saying at this point. Chandan, 100 shares of Apollo Microsystems and 100 shares of Time Technoplast. What do you make of these? Should he continue to hold or what should he do with these investments?
So first, I want to comment on Time Techno. The counter has been consolidating in a range from last almost 24 months. It has taken multiple support near 160, headed towards 200 plus. And this consolidation can give the breakout anytime soon. In fact, on the weekly chart, it completed a bullish pattern, which is similar to head and shoulder, which is known as a positive price pattern is technically concerned. So I believe one can accumulate Time Techno. You can hold the position. However, some consolidation may be there, but any decline towards 190, 195 can be bought with support of 180. And I believe this counter can head towards 230 to 250 level. Talking about Apollo Microsystem, major trend is positive, but it has been consolidating in a range. However, in the last month, it witnessed a corrective move after the sharp rally of last 2 to 3 months in the April and May. But multiple supports are visible near 375. Suggestion is, if someone is holding a position, keep the support near 370. If it manages to hold 405, 410, I believe next momentum can be kicked off, which can take it towards 450, 470 marks.
All right, so that's the view coming in there for Time Technoplast and Apollo Microsystems. The next query is coming in from Rajan, who's writing to us from Trivandrum. He wants to know whether it is a good time to buy GE Vernova for the long term. The stock is currently trading at 4,342. So, Lancelot, from the long term, is GE Vernova a good bet?
Yeah, I think it is a good bet, but at the moment the valuations are very high because this company is in the transmission and distribution business and is providing solutions for connecting power and moving it onto the grid. Now, this is it's a growing industry because there's more and more need for various sources of power, whether it is renewable, to be connected with the grid, and therefore, they are getting good orders. But if you look at the valuations, it trades at almost 80, 90 times earnings. So it is very expensive valuation, and there could be, any kind of risk in terms of execution risk or anything that comes up could result in some serious downgrading of the stock in terms of re-rating. So one should be a little cautious, and I think at this point of time, the risk-reward ratio is not in favor of adding at this point.
Risk reward is not in favor of adding at this point of time. All these, capital goods, especially in the power T&D side, are trading at such high valuations. It becomes difficult if you have to enter at such a time. But Chandan, in terms of the technicals as well, given that we've seen such a sharp run up, just YTD performance, if I look at it for the stock, also is up 40%. What would you suggest on the technical front?
Yeah, so the counter is up by 40% in last 7 months, but that 40% even after a corrective move from 56, 52, 4,000 marks, which is seen in last 2 months. So I believe let it correct more to retrace the key levels. As of now, 4,000 is major support for the counter. If it comes near 4,000, one can accumulate with the view that again next leg of rally can be seen towards 4550 to 4700. So buy on decline can be seen after the recent run up and recent corrective move.
Okay, so maybe around that 4,000 level can look at it. Right now, a bit expensive, but Lansard as well as Chandan, thank you so much for joining us as always, helping viewers get answers to all their stock-related queries. So thanks so much for that. And viewers, keep sending us your queries. You can email us your queries. You can send it at the phone number at the top of your screens for you all as well. So do send us your queries and we'll get them answered as well. And that's all the time we have on this edition of Your Stocks. Thank you so much for tuning in. Up next, you have Closing Bell to take you to the last hour of trade.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Your screens as well. The Asian markets have started off on a mixed note after the kind of frenzied moves that we saw on Friday.
When the allies ask to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal.
40 billion has come in all, and the breakup is as follows. 36.7 billion came in via the FCNRB deposit route.
Nifty resistance is 24,500 and 24,800. These are the two numbers which you need to watch on the upside. We have the first rates coming up, 24,572. It's a 0.75% pop. The Nifty Bank is up 0.5%. You've got the mid and small cap indices also starting in the green.
The earnings growth in this quarter, which was expected to be the worst quarter, is 21%. Mind you, it's halfway.
Last 3 quarters was just an aberration, or maybe some old loans and interest coming in, ARCs coming in, etc.
Margin drivers for us is going forward. One will be higher share of ODM business coming from lighting, from refrigerator, washing machine business as we expand the portfolio.
Z has got shareholder approval. It cannot issue new securities because the SEBI order is effective immediately.
Within the period of 2 months, I think after that, the company will be able to do this fundraising act.
Well, HDFC Bank was once the easiest stock to own in banking. Now, down nearly 25% this year.
We do have manufacturing facilities in the US, both technical and formulation. So we look at it appropriately at the right time.
For the markets, as we pointed out earlier, continues to be a good day.
Well, that is the day so far. You're with us here on Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi. Good afternoon. I just want to make a quick mention of what's happening right now on the index. 24,590 is where we're at. We're up 200 plus points on the index. And guess what? The top performing index is the IT index once again. It should come up 7% Friday to Friday. And there's another additional 2% coming in right on the first day of this new week. Market breadth is very positive. It's easy, 3:1 in terms of advances to decline ratio. So pretty good looking screen all told. That's what I'm talking about. And of course, the other one is what's happening with IT services stocks. A bit of a stealth move and 9% in the last 6 trading sessions. Guys, hi.
But the big tailwind for our markets today, which is providing that support through the day, has been crude prices and still subdued. So when we started trade, we were at $84 per barrel on Brent crude and still hovering around there, 84.5. European markets have started strong. The French index, that's CAC, is up nearly 2%. The DAX has got a gain of 1.5%. So you've got strength across the European markets. So that is a positive. For the Nifty, almost at the 24,600 mark, 1 hour to go. The key level to watch will be the 200-day moving average from here, 24,778. But there is participation from the other sectors. So barring the pharma index, which is subdued today, all the other sectoral indices are holding up in the green. So you've got the Nifty Bank moving in step with the frontline indices. The metal index has been powering ahead. That's got a gain of 1.5%. Autos also have been fairly strong.
Well, that's right. And the earnings reactions come in thick and fast. You know, the earnings cracker that we have seen in the last 1 hour or so is Ethos. You know, the numbers have comfortably beat a few domestic brokerages that we have. Monarch, for example, they cover this company. And the revenue number that has come in much better than expectations. The EBITDA number as well. Ethos is the one that we're talking about. I think we should get that one up for you on the screen. And the margins as well have come in flat at around 13.3% or thereabouts. So I think that's the stock up close to around 14%. So clearly the street is latching on and willing to look ahead as well on various other numbers. Like if you look at Nalco, APL, Apollo Tubes as well. Both those two stocks are buzzing in trade.
Absolutely. And I think Shriram Finance reported just a while back. There was scams which reported numbers. So coming in thick and fast at the bottom of the screen. So a lot coming up in terms of what you will see. Oils, of course, come up. That's a big macro cue and everything else in relation to that. Pharma and healthcare is in focus. A bunch of stocks, which we will discuss with Ekta in a bit. Market structure changes starting 3:15 today. So a bit of focus on that as well. Today is day one. So we'll all, I'm assuming, will be learning as we go along. Lots of individual buzzers, APL, Apollo, Blue Dart, auto sales numbers for the month of July. All of that and more in focus. Well, let's just quickly run you through the trades that Mitesh wants you to take. Mitesh is with us. Good afternoon, Mitesh. What do you recommend?
Good afternoon, Prashant. So I think, very clearly, 24,600, as I had mentioned, will be a small or a slight supply pivot. If you look at the historical charts, we got a daily closing of 24,576 and an intraday high of 24,601 on the 21st of April. We are back to those levels, but that was a singular top, and there was some consolidation before that in March as well as February, when lows were made around 24,600. So important line on the chart. Maybe, take some profits, but otherwise stay long. It's clearly a market which I'm now waiting for closing about 24,620, 630. Once that happens, momentum should extend, and I've given a revised target or secondary target level of 25,050 to about 25,100. That remains. Having said that, I have a buy on Hindalco. Keep a stop at about levels of keep a stop at about levels of 974. Look for 1,030 as the target area, and also a buy on PI Industries. Keep a stop below 2780. Look for targets in excess of 2,900.
Okay, all right. Mitesh, thanks very much for that. So those are trades, and we'll have Mitesh back on with more. But Blue Jet is one of the stocks which has actually swung quite wildly since the numbers came. It's off, I think, about 8 or 9% from the day's high. Hit almost 650 and now under at what, 593-ish kind of. Look at that sharp cut which came through. Expectations were building in. They've done a QIP recently. Ekta, take us through the numbers.
Well, yes, definitely disappointing. The revenue is down around 17% this quarter. We have the EBITDA, which is to come in just below around 100 crores, and that's around a 19% decline on a year-on-year basis as well, with margins at around 33.5%. The profit came in at around 78.26 crores. Now, for the company, it listed in November 2023. The issue price was around 346 odd rupees at that point in time, so it's still showing some movement on the upside since then. The company manufactures contrast media intermediates, high-intensity artificial sweeteners, niche pharma intermediates and APIs. In terms of the performance, it is, the street was anticipating a good growth coming in for the contrast media segment. And in fact, for FY27, they were anticipating around double-digit growth for the contrast media segment. So one needs to see what the commentary from the management would be at 5:30 p.m. This evening. Remember, they also raised 800 crores just in the month of July via QIP, and that too was at a price of around 506 odd rupees.
And Ekta, a lot of hospital stocks are also under pressure today, whether it's Narayana Health, Jupiter Life. How did the numbers look?
Well, definitely, pressure on the margins is what you'd have to say. So, for example, for Narayana, what stands out is that the company added their UK revenue to the numbers this quarter. So on a year-on-year basis, it's not comparable. The margins did see some dilution. So the revenue, which was up around 78% on a year-on-year basis because of the addition of the UK revenues, saw the margins come in at 18.8% versus 20.8% year-on-year and 23.9%. Remember, this is something that the company has been guiding on, that there will be margin pressure as there is some amount of expansion and capex that they undertake. Profit came in just about around 6% higher. So India was up around 17% despite seasonality. The company said Cayman was up around 39%. UK revenue was up around 2.1% on a sequential basis, and the net debt stood at around 1967 crores. For Jupiter Hospital, also there was a margin impact on account of capex. So the margins were impacted because of the ramp up of the Dombivli Hospital. So the initial ramp up loss of Dombivli was around 9.5 odd crores, which was because of higher marketing, debt pre-interest costs. So occupancies 59.6% versus 60% year-on-year, and ex of the Dombivli operations, it was around 61.7%. The average revenue per occupied bed, however, moved up, and the average length of stay, which is lower the better, actually moved lower. So that too was was a parameter which was positive, but margins were under pressure.
Deepan Mehta is with us, Director at Elixir Equities. Ekta, thank you very much for that. Deepan, any thoughts on first Blue Jet?
Yeah, Prashant, good afternoon. Thank you for having me on your show. It's been a very disappointing numbers from Blue Jet last 2-3 quarters or so. And this is the case with CDMO players where supplies get extremely lumpy. And these are small value but high margin products. And then if some of them get pushed to the next quarter or the quarter after that, then this is what the situation is. Management, of course, has been promising that, things will start to improve this quarter, next quarter, but we have to see. And as I said, I think, a lot of questions to answer. Typically, after the QIP, you have such a disappointing result. It does tend to mar the sentiment significantly. But look, I think long-term story is good because end of the day, CDMO is another high growth area within the pharma industry. It's just that they need to get the right kind of combination in terms of supplies and booking of volume. And that's not taken place last 2 quarters.
There's a conference call, by the way, I think later at 5:30 in the evening. I'm not sure, whether that will change the mood on this one. But I guess there was just too much pumped up expectations around this one as well about what can happen, especially after that QIP and the like. On the hospital names which Ekta mentioned, Deepan, Narayana, Jupiter.
See, I think these are all steady performers. And from time to time, there may be an odd surprise here or there. And sometimes the new hospitals also tend to depress margin. But it's a great, solid, secular growth story. Healthcare costs keep on going up year after year, quarter after quarter. And from that point of view, I think these companies are steady, provide steady growth. But look, valuations also are expensive. I mean, the likes of Apollo Hospital or Narayan Rudalaya or Fortis, all of these trade at very rich P multiples. And there's also intense competition. From an investor's perspective, there is just far too much choice. I would prefer niche players like there's a company called Nephrocare, which focuses only on dialysis. That looks interesting. Then there's another company called Guardian IVF, which is focusing only on IVF. So like that, I think if there are focused companies within the hospital industry, I think those are better to understand. They are smaller, therefore growth rates could be higher. And some niche offering, so that investors can play that specific micro trend within the healthcare industry. But look, these companies are good investments for the long term. I would remain invested if I was having any of these shares. The most important development in the industry we're looking forward to, of course, is on Apollo side, where they're splitting the company. And I think that could create a lot of value unlocking. Having said that, Apollo Hospital is a company which we have invested in, and it's been a fabulous performer. I think best of the industry kind of numbers. So I would prefer that over many of the other hospital companies.
Since you spoke a lot about Apollo, let's talk about APL Apollo. That's another name I think, Deepan, your track. Well, let's run you through a brief analysis on the numbers and the commentary. Well, the volumes were down on a year-on-year basis, but that was on expected lines. However, they bit up a ton, that was flattish. That's telling you that realizations went up, and that's what supported the profitability. So that's why you're looking at it on, on a sequential basis. Actually, the EBITDA per ton was more or less flattish, while on a year-on-year basis it was up. Other details were actually good. ROC is more than 30%. Net working capital is a surge. Then they have cash in their books as well. So that chart as well is looking good. But what has excited the street today is the commentary. Now this management is sounding extremely confident. We'll have to see whether or not they can walk the talk and meet up to this guidance. So what excited the street was they're saying that the EBITDA number for the year will be up by close to around 20%. Remember, in Q1, the absolute EBITDA number was up by close to around 11%. So they are believing that things will improve drastically from here on. In fact, they've said that Q2 will be much better than Q1. In terms of the volume guidance, they're talking about 15 to around 17% of volume growth for the year. Remember, the first quarter, they're down by close to around 6%. So there'll have to be a big makeup that they're looking at. And they're targeting volumes of around 1 million tons in the second quarter, which compares with around 750,000 tons in the first quarter itself, which means that volume growth needs to continue on a month-on-month basis. And they've given a number for July. They say July, the volumes are up by close to around 20% in comparison with June. And now the run rate that they're going at is around 300,000 tons in July. In August, they're expecting it to go to around 330,000 tons. And by September, 350,000 tons. This 350,000 tons will compare with around 250,000 tons that they did on an average per month in the past quarter. The longer-term goal as well, they say when they can get to around 8 million tons or thereabouts, Apollo's EBITDA per ton will move to around 6,000 rupees per ton, because the quantity coming out of VAP, which is value-added products, will move to around 75 to around 80%. That compares with around 65%. Remember, the stock in the past has traded at around 35 to around 40 times. Now, if you look at it on the forward earnings basis, provided they can get there to around 61, 62 rupees of EPS in FY29 that Nuvama is working with, then the stock trades relatively cheaper in comparison to what it has traded in its peak. This is a stock that's not given any returns for many, many years, but now the street is banking on this volumes, this EBITDA guidance that they've given, and hopefully they get there from a bullish perspective. Deepan, what do you make of this one? APL Apollo Tubes, the street has clearly bought into these commentary that they have given, though the numbers are very muted. Now, in the past, you've seen this go wrong. Give good guidance and then not achieve it. This time around, the street believes so. Do you believe it?
I don't know,
You've liked this company in the past, I think so, right? Or you'll have held it at much lower levels.
No, the management has successfully talked the stock up, which is good. And in markets like this, we tend to believe any positive news. But clearly the results are very disappointing, no doubt about that. And actual volumes were lower. Even the value-added products volume was lower. So if they're guiding towards higher volumes, let's wait and see. I mean, I wouldn't, just chase the stock on account of this fact. It's a good, nice long-term story. They made a great space for themselves, built a superb brand in a commoditized industry. They're way ahead of the competition. Massive capacity going from 5 million to 8 million tons in the next 2-3 years going on stream. And clearly, I think the infrastructure build out and the way the architectural trends are taking place clearly benefits APL Apollo. So I would be invested in it for the longer period of time. But let's see whether management are they able to achieve this kind of 20% type of EBITDA growth and all. If not, even if it is slower, this is a nice steady compounding story, which is what I like. But look, it's expensive at 43 times or so. So I would say that at best right now remain invested. From a fresh investment perspective, I think just wait and watch. Under the number surprise on the upside, I wouldn't want to jump to the stock.
Deepan, what about Muthoot Finance, big wealth creator, and it was the undisputed leader of the gold loan boom. But now a lot of players are in the fray and they're getting aggressive. And perhaps this is the first quarter where we've seen some margin pressure on account of that. The management has shrugged it off. They said it's just normalization of the higher margins that we had in the prior 2 quarters. Our gold yield guidance remains at 18 to 18.5%. But I can see 3 downgrades on Muthoot Finance. There's a Jefferies downgrades, Investec, and Nirmal Bang. Do you think this competitive pressure is going to show up structurally? There could be some weakness in Muthoot Finance margins going ahead?
See, Rima, I've studied this segment for many years, and this cycle keeps on happening where competitive intensity increases, new players come in, they burn their fingers, and they move out. But the likes of Muthoot and Manappuram, clearly, I think they have ridden many such cycles and many such situations. So I would remain invested in them, having said that's a company which we are invested in. But yes, you have to be cautious. I think there's going to be pressure on the margins, and gold prices have stopped moving up. So that clearly that benefit which was there, whereby they could increase the loans because the LTV had gone down because the gold value has gone up. That advantage is no longer there. And typically, if gold prices fall below this thing, then NPAs also start to inch up. So in my opinion, I think from a long-term investment, remain invested, but be prepared for slightly lower returns next few quarters or so. But long-term, I think story of Muthoot also is very good. But look at Manappuram, I think, there's something nice happening over there. Change of management has taken place. And they're again focusing back on gold loans and going away from some of the other non-gold loans, which had got them into the problem in the first place.
So between the two, you would go with Manappuram?
I think there's an opportunity. It's a special situation over there. And I would give the management a new kind of a rope to kind of grow the business beyond what the street is expecting.
What about IIFL Finance? I think you've liked that one in the past as well, right? That stock actually has been the big outperformer. There was some selling pressure which gradually got absorbed. If I remember correctly, I think the last 60 days, IIFL Finance is actually up 20%. While both these other 2 companies, they have seen some kind of selling from the top. Among the 3, would you still pick Manappuram or would you give IIFL Finance the low?
See, I think IFL Finance is all about re-rating of the P multiple. The company had got into all sorts of NP-related issues, but now those are well behind it. And clearly it's focusing on LAPs, that is loan against property, as also gold loans, and those are done very well for IFL. So I think it's the P rating story will continue for some more time. And I think that on the whole, I think the industry is getting a bit crowded. So you may have some outperformance in terms of IFL because of the P part. But apart from that, I think in the returns will start to middle from somewhere around 2-3 quarters down the line.
Okay, let's just get back to the gold loan finance story, Muthoot Finance, and hear out what the management had to tell us earlier. We quizzed him about the decline seen in margins in the current quarter. We asked him whether there is competitive pressure, will yield stabilize around 18.5%, and what happens to growth from here on. This is what the MD, George Alexander Muthoot, had to tell us.
Steady state, the yield should be in the range of 18 to 18.5. What we saw in the last 3 quarters was just an aberration, or maybe some old loans and interest coming in, ARCs coming in, etc.
Okay, let's talk about some big winners. Blue Dart, that's searching and trade after the company reported its Q1 numbers. Mangalam joins us to dissect that for us. Mangalam, take it away.
Well, it's a good performance that is coming from Blue Dart. A large part of that is obviously pricing-led growth, because remember, every year the company announces a price hike towards the end of December, and it's effective from the start of January. So obviously the current prices versus same time last year would have an element of almost 7 to 8% sort of price hike. Add to that, we've seen fuel price expansion as well. So all these factors led to a 15% revenue growth, and there is some revival in the e-commerce packages as well. So as a result of which, there's a near 15% jump that we've seen in the revenue. But on the EBITDA front, operating leverage has led to a bigger growth. So we've seen a 13% jump out there. Margins have improved all the way up from 13.5% to closer to 16%. And as a result of which, on a low base, we've seen the net profit jump 80% from about 49 crores to 88 crores. And that explains the kind of up move that we've seen on Blue Dart. So far, from all the logistics companies that have reported, it's a good set that has come by, and that's something that the street is anticipating from Delivery as well, which reports its numbers towards the end of this week. So we'll keep an eye out on not just Blue Dart and all the numbers that have come by, but also the numbers that are likely to come.
Okay, and Ethos, stock is flying. Mangalam, a lot of people are buying luxury watches. What have you made of the numbers?
Well, stock is flying just as the way, luxury watches are flying off their shelves. If you look at their performance as well, 33% revenue growth is what the company has reported, and that's reflected in a 33% jump that we've seen in their EBITDA as well. Margins at around 13.3%. The net profit on a low base, obviously here too, has increased by about 51% to about 28 crores. The internals out here are a lot stronger. Same store sales growth of about 13.2%. They've added 9 boutiques, 2 exclusive and 7 multi-brand. But more importantly, the average selling price per watch has jumped all the way up to 2.26 lakh. Remember, it was just about a year and a half, 2 years ago, 3 years ago, where these numbers used to be in about 1.2, 1.3, 1.4 lakh range, and the management would come and say that they are targeting higher levels. I remember them saying at 1.8 lakh as an average selling price as well. Now it's jumped all the way up to 2.26 lakh, and the penetration of luxury watches in the market has gone all the way up to 71%. And mind you, average selling price is obviously the average, right? So there are a way more number of stocks, more number of watches which are selling upwards of 2.26 lakh for them to come to the average of this price. And the rate at which they're flying is explaining why, the stock is also doing extremely well after seeing a bit of a correction lately.
You're dipping in?
Not a single one, Nigel. I haven't bought a single watch in the last, I think, 8 years or so.
How many fitness trackers you've bought?
None. You'll be surprised, because you have the, not endorsing the product here, but the Apple smartwatch is all you need.
Mangalam, we should come up with a punchline. The truly fit have no need to track fitness, huh? Or
people track it for you.
I think it's not Mangalam's collection is not watches, it's shoes. Right? Yeah. So I think maybe that is another conversation. Thanks very much, Mangalam, for that. A big move on Ethos coming through. Deepan is with us. Deepan, just before we wrap up, look, I just put up Pine Labs, if you will. It's up 10%. Paytm is up 5.5%. The chatter is around this MDR, larger ticket value transactions. Perhaps something will happen, but this is just chatter. We've heard back and forth on this for a while. But any thoughts, actually, on both Pine Labs and Paytm?
Prashant, I think if something happens over there, these are the pioneers in payment, and automatically any changes over there will go straight to their bottom line. They've created the infrastructure. I suspect the returns that they have got on the actual payment business is not high as would expected. A lot of revenues coming from ancillary businesses, especially trying to lend or facilitate lending, and that also has worked out well for them. And these are great platform businesses, so you hold them for a long period of time and operating leverages will benefit you. But look, valuations also are quite rich at this point of time. And unless there is something specific like this MDR which changes the business model, I would say that they are pretty much well priced and they will give steady returns going ahead also. I just thought that Pine Lab numbers are not as good as at least we thought they would be. I thought the company can deliver much higher than this as well. But I think it's a matter of time. So I would say that, rather than focusing on the banks and the NBFCs, these are the new generation players within the financial services space, where I think over a 4, 5, 10, 15-year period, they'll give far superior returns than an average bank or an NBFC.
Okay, Dipan, we'll leave the conversation here. Thank you very much for joining in as always. Get into a break. On the other side will be our Alpha Manager for the day, Mithun Aswath of Kiba Advisors. Stay tuned for that chat.
Welcome back. Mithun Aswath is with us, Managing Partner, Kiva Advisors. Mithun, good to have you with us here. Thanks for joining in. Still lots and lots of numbers coming through thick and fast. Before we were talking to Deepan Mehta earlier, and we were talking about this Pine Labs, there's of course Paytm, and we were talking about MDR. Do you own any of these names, Mithun?
No, Prashant. We've not advised on any of these so far. No.
Okay. So no advice. What are you liking right now, Mithun? Say in the month of July, we've seen markets consolidate, but a lot of individual stories. Software, for instance, has made a comeback. What have been the themes that you all have picked up in the month of July?
So, Rima, good afternoon.
Afternoon.
Yeah, I think we've looked at some bottom-up ideas. I think last we spoke also about, say, Tata Motors passenger vehicles had corrected significantly. They are seeing good traction, say, in the EV vehicles domestically, and JLR should rebound. So that is something that we've been nibbling on or advising our clients to add at lower levels. Apart from that, a recent company that we looked at has also corrected from the highs was on the capital market side is KFinTech, which is basically the registrar services that it provides for mutual funds. But interestingly, this company has a very large franchise globally as well, with an acquisition that they made late last year of Ascent Fund Services. So this is a play both on the domestic fund services side as well as the international. And the international is growing very rapidly, and they expect that to grow by about 70% in FY27. The main issue is that the international business is still very low margin. And over the next 3 to 5 years, the company is looking at making the international business margins equivalent to the domestic business margins, which are more than 40%. So here you're going to get a business which is growing maybe 15-20% plus with the potential of margin upside.
You all have owned HDFC Bank and Kotak Mahindra Bank, and both of them have been plagued with individual issues and they've underperformed the market. Is your conviction still as strong on both these two private sector banks, Mithun?
Honestly, Rima, these have been disappointing for us. Obviously, I think it's across anyone who's held onto both these names. But at least out of the two, I think Kotak's performance this quarter has been reasonably good. Also, their recent acquisition of the Deutsche business will also provide a little bit of a tailwind in a few quarters ahead. And also, Kotak has a little bit more of a diversified business, which is not only banking, but capital markets through its mutual fund broking businesses. So it's and it owns pretty much all of it. So maybe the market is not giving its due credit for a business which is a lot more diversified compared to, say, other listed banks.
All right. Hi, Mithun. Good to see you, Win. Let's talk about some of the casualties of the day. Gold financiers. Suddenly the story went wrong. Very well-run franchises, but unfortunately, sometimes there's too much of competition. The yields could have been at elevated levels. Well, do you like anything? I think in the past you've chatted about a couple of these names: Muthoot, Manappuram, IIFL Finance, maybe a CSB Bank.
Honestly, Nigel, we've not participated in the gold finance space. We've looked at it, but I think right now it's becoming a more crowded space because there's quite a lot of competition from banks. PSU banks are doing gold finance. Most of the NBFC's growth is coming from the gold finance portfolio. And obviously, the mainstay or the leaders like Muthoot or Manappuram, who will definitely face competition from the others. And pricing is where, I think today Muthoot slightly disappointed and you saw what happened. So I think it's becoming a crowded space. The differentiation is narrowing. There are several NBFCs also, I think like Fed Bank Financial is also focused on this. IIFL Finance obviously is another one. So maybe, the premium valuation or, there's maybe money moving out of one to the other. But I think it's a little bit of a crowded space right now.
All right, let's talk about EMS. I think in the past we've chatted about this. It's the one that, had everyone's fancy, say, 2 years or so ago. And it's been rather rough for the last couple of years. Now, there's some uncertainty with regard to margins. We had Dixon speaking to us earlier today. And they couldn't really quantify the impact of that extension that is there in the PLI. Because part of the benefit, well, that's not going to come back. But the hope is that, the new PLI that's been announced, that could offset some part of that. And obviously, they have their various ways of reinventing business that can help them pull back some kind of margin. Your view on the space, all these stocks have corrected anything between 20, 30, 40, 50% as well from the top.
I think, Nigel, I think this is still a huge runway for growth in this space. Obviously, companies like Dixon, who are more weighted towards the mobile device space, are impacted higher because of the memory prices going up. So optically, the margin will go down. But on an absolute profit basis, I don't think they've done badly. I think the biggest trigger for them was the Vivo deal being signed. I think that is now behind them, and that could provide quite a bit of a kicker for their revenue growth in the second half. And FY28 will be a good year because you'll have the Vivo JV completely showing operations for the full of FY28. Plus, you have their entities which makes the cameras and displays also operating at robust levels in FY28. So I think the story in some of these spaces is durable. I don't think it is a 1 or 2 quarter story. Obviously, a year and a half back, the valuations were very high. But I think now, after this correction, some of them look quite attractive.
Okay. All right. And you like the big boy, which is Dixon, right?
That's right. That's right.
Got it. All right, Mithun, always good to have you on the show. Thanks a lot for joining in. We look forward to chatting up with you rather soon.
Thank you, Nat.
All right, keep an eye out on a couple of these stocks. JM Financial, I think I saw those numbers that flashed on the screen. The stock initially saw a sharp downtick. I think JM Financial, let's get the chart up. And it's seen some kind of recovery, from the low. So it fell initially very sharply. It's still down close to 1.5%. Seen minor recovery from the lows of the day. That said, let's get in the F&O market then. Today it's been a very, very good trading session. And the start to the August series as well has been good. But there are a couple of factors that tell us that in the near term, some kind of consolidation may not be so bad. I say that because the Nifty is up and normally you have an inverse relation with the VIX. But the VIX as well is mildly higher. Yes, the VIX is coming up out of bombed out levels, but you'll want to keep an eye on that factor. The other factor is that the PCR, when it moves around 0.65, we say, well, that's the time to get in because technically you get a bit of a bounce. Now it's moving to the upper end of the range, which is at around 1.6. So probably we could see some kind of consolidation, some kind of profit taking as it gradually moves higher. Because put writing has got very aggressive. 24,600 put. Pull that up for you. The premium out there is down by close to around 70%. It's come down to around 69 bucks. At the start of the trading session, it was 232 rupees. The 24,500 put as well. The premium out there is down by close to around 80%. It's come in sub that 30 rupee odd mark. Remember, the start of the trading session, it was 155 rupees. So that's aggressive writing that we've seen, and you can see a fair bit of open interest build up. While on the flip side, some of those out of the money call buyers, they're dancing away to the bank. The 24,600 call. At the end of the trading session on Friday, it was at around 15 rupees, a little less than that. Now, in today's trade, it's moved to 50 rupees. They're going to be parting on a Monday, those that bought that particular strike. So some signs of out-of-the-money call buying that's creeping back in. Individual stocks, some of those names that did get absolute bashing up, they are bouncing back as the market comes into its own. IRDA, the stock had seen a sharp correction. It's half of its peak. That's coming for a bit of a short covering bounce. As is the case with Tata Elxsi, not done anything much for the last many years. In fact, it's come off drastically. The shorts as well are getting squeezed out of that one. And on APL Apollo Tubes, there is that hope out there that they've set out a guidance. It's ambitious, but they could probably get there. So you're seeing them delivery-based buying. You're also seeing some long build-up as well in the F&O market. So we'll keep an eye out on that particular name as well. Well, time for our special segment, though. D-Street Chatter. Nimesh is joining in to tell us what is he picking up in Dealing Room Chatter. Hey, Nimesh, good afternoon.
Hi, Nigel. A strong day for the markets, and I guess it's backed by institutional buying as well. So I'll look out for the institutional data closely. Might be a positive number, both on the FI and the DI side, so something to watch out for that. In fact, there is going to be a small MSCI buy basket as well, so maybe that will add to the momentum in some of the large cap names in the last 30 minutes of trade. The large part of the basket seems to be towards the financial names. So all the NBFCs and banks are something which are part of that basket. So watch out for some bit of reactions on those financial stocks. A bit of confusing signal from a trading point of view. A close about 24,500 could trigger further a short covering rally, but at the same time, as you also rightly pointed out, the PCR has intraday hit a high of almost 1.54. And generally around 1.6, we see a bit of profit booking as well. So maybe at a stock level, you might see some profit booking. But at the index level, if this level is sustained, you might see a bit of a further short covering rally in the Nifty as well as in the bank Nifty. So that's to watch out for. But as I said, there is a buying in the last 30 minutes of trade. And in general, today's rally is backed by institutional buying as well.
Nimish, in terms of individual stocks, what's on the list?
So the first stock is Bajaj Finance. We saw a big rally on Friday on the back of very strong earnings. And that's followed by another strong day of good buying interest from larger institutions. So expect high delivery volumes on the buy side in Bajaj Finance. Looks like some large, FI investors seems to be quite actively accumulating even at current levels in Bajaj Finance. So that's the first name. Second, couple of stocks where there is selling today. Suzlon and Muthoot Finance. Both stands out for aggressive selling. So watch out for high delivery volumes on the sell side on both those names. The last name is Rico Logistics, a small cap company, but it's been buzzing off late, and the street is anticipating a fundraising very soon. Some influential investors are likely to participate in the pref issue. So watch out for any sort of fundraising in Rico Logistics in the very near term.
Okay, all right. Nimish, thanks very much for that. So that's what is on D Street chatter list. Look at Z, by the way. I think it's down 14% now. And it's basically taken another leg lower. Has been at 100 odd rupees since the morning, but I think it's down a little bit more. So 98 now on Z, 14.5% lower, pretty much at the day's lowest level. We'll take a quick break, some trading ideas on the other side, and our next set of guests. It's 3:08, and there is some changes to market timings, how the closing values on both the Nifty and the Sensex are going to be calculated. All of that changes. It's day one of a new regime in terms of trading. So we'll focus on that as well on the other side.
Welcome back. Well, the markets have come off a little bit from the top. At one point of time, we were at around the 24,620 or thereabouts. By the way, we have Ather Energy's numbers that are flashing for you on the screen. It's still reporting a net loss and an EBITDA loss, but those losses have come down drastically, which explains why the stock has popped up in trade. So revenue up close to 90%. EBITDA loss has come down drastically. And if I saw that number correct, the net loss is at around 30 crores or 33 crores, which is 100 crores lower. On the EBITDA performance itself. So EBITDA loss down to 30 crores from 130 crores. Net loss down to around 51 crores. It's a third of what it was, say, a year or so ago. So the street will like that. We'll get a further analysis on that. For the time being, let's go to the man of the hour, though. Auto sales data has been trickling in for the month of July. So Darshan joins us to do a quick number crunching of all that's come in. Sir?
It's been just 7 months in 2026 and total vehicle registrations are already at 70% of what the entire 2025 had seen. Now for the month of July 2026 has been the best ever July that auto sector has seen, and all the segments have seen a double-digit growth. So we'll start with the biggest automaker, that's Maruti Suzuki. Highest ever sales that company has seen in a month. Total sales have increased by 34%. Domestic sales have increased by 42%, and SUV continues to see an uptrend. Here it's up almost 50%, and the biggest heartening factor was the entry-level segment. For the second straight month, growth was almost 90%. For Hyundai, it was highest ever monthly sales. Total sales increased by 25%, but the export sales, it's the highest ever export numbers that company has seen in more than 100 months, and it's up 31%. For Tata Motors passenger vehicle, it has reported growth of 59% on a low base, and passenger vehicle domestic sales have increased by 58%, and if you talk about electric vehicle, sales have increased by more than 100%. For Mahindra and Mahindra, both auto and tractor segments have seen a growth of more than 20%. Just talking about auto segment, total sales have increased by 26%, and SUV continues to see a growth of more than 20%. For the tractor segment, April to July growth was 18% versus FY27 industry estimate of mid-single digit growth. Coming to two-wheelers, for Hero Moto, sales were largely in line. Sales were up 19%. For Eicher Motors too, continues to report a strong set of numbers. Sales were largely in line. Both segments up to 350cc and more than 350cc have reported a healthy growth. For Bajaj Auto 2, like Hero and Eicher, sales were largely in line. Total sales have increased by 30%, but biggest positive part for Bajaj Auto was the export numbers have reported more than 2.5 lakh units. For TVS Motor, highest ever monthly sales of more than 6.30 lakh units. Total sales here increased by 38%, and exports were up 29%. Commercial vehicle segment, very strong month. And I was talking to Mahindra and Mahindra, they have said they are in the super cycle. They are just in the middle of super replacement cycle as far as the commercial vehicle segment is concerned, and it's reflecting in the Ashok Leyland numbers. Total sales have increased by 47%, and LCV increased by 32%, while M&HCV bus sales were down by 14%. So it's been a continued strong momentum that auto sector has been seeing. Very good FY27 so far.
Well, indeed, and month after month, it continues to remain strong. Everyone thinks base effect will kick in, things will slow down. It's been a good run, but the auto sales continue to surprise.
You know, it's 3:15, Rima. I just want to make a quick mention, and we should put our first alert out. So what is happening now is that, cash trading in F&O stocks is basically stopped at this point in time. So we should have that first 3:15 super on. So you look at... there are 219 F&O stocks. There are 219 stocks with F&O contracts on them, and as we speak, and maybe we should put out a flash as well, a news flash as well, that cash trading in F&O stocks has stopped. So 3:15 to 3:20, it's stopped. So look at, you can, and by the way, obviously, I mean consequently the index value will not be changing because none of the stocks are moving. So the Nifty 189.75 is the change, and 320 onwards, 320 to 328 is the auction session that we were talking about, where these 219 stocks essentially will be trading in a special window. There will be price discovery, and we will have the index, adjust accordingly at between 330 and 335, as we understand it. So. No, the closing auction session has not begun. We should change that. the closing auction session only starts at 3:20. So 3:15, the trading stops, and 3:20 is when the closing auction session begins. Mitesh is with us. Maybe just might as well run through some of the trades. Mitesh, good afternoon. So this is a new one. I suspect many will essentially say that, at least for the time being, close shop at 3:15. We'll figure out as things settle down. But yeah, go on, Mitesh.
Yeah, Prashant, I think trying to figure out how things are working, I think, very clearly, once we go through it, maybe we'll have a better idea of that. But just on the stock price side, I think Siemens has closed near the base high. Good breakout above the earlier swing highs of 38.60, 70. So that's the BTSC with a stop below 38.88 and a target of 39.40 is what I suggest can be looked at. And the other one is SBI Life, similar setup again at today's high. BTSC here with a stop at 1903 for targets of 1930.35.
Okay, all right. Fair enough. Thanks very much, Mitesh, for that. By the way, the F&O trading will continue. I mean, index futures, index options, stock futures, stock options, all of that will continue all the way uninterrupted till 3:40 today. So not just today, but I mean, today is day one, but basically F&O screen will be active till 3:40. I don't know if we have our guests also with us with regards to some of the changes. I'm not sure who do we have. I think we have Rajesh Bahetia. Rajesh is with us. By the way, UPL numbers are also flashing at the bottom of the screen. But as you can see, the stock is absolutely unchanged. 621.4 is where UPL is trading at. But if you can just quickly put up UPL in the on the F&O side, maybe look at what's happening on the August contract. We should just quickly look at the front month contract and see if that is still trading. Rajesh, welcome in, and thanks for joining us. We're just kind of sort of getting our heads around all of this. So it's 3:19, Rajesh, and 3:20 is when this auction session begins, right?
Yeah.
And UPL numbers are flashing as we speak right now, Rajesh. So of course UPL is an F&O stock, so it's not moving, it's unchanged. But the futures are trading, stock futures?
Yes, they are.
Okay. Can I request our producer to put up the UPL F&O, if he can, Smita? The UPL August contract. Yeah, you can see it. So as I was saying, the futures are trading. And as I said, the futures will trade uninterrupted all the way till 3:40. So the thing to focus on, and maybe the ticker team can tag the UPL, and these adjustments we'll have to kind of sort of learn and live with and adjust. So if when numbers are coming through in earnings season, especially with regards to, okay, I think the auction session has now started, so that's why you see UPL starting to reflect some of the changes. It's 3:20 right now. So, but between 3:15 and 3:20 is a bit of a dead period. So, yeah, I mean, but right now, of course, the auction session has begun for the F&O stocks, for the 219 F&O stocks. Rajesh, so just run us through, I mean, how you see it, in terms of how does this compare to global practices, any complications, anything comes to mind?
So you see, there was a request from most of the passive funds that when it's time for them to rebalance, whenever the index gets changed and they need to rebalance, they are facing tracking error problems. And you've seen on the days of whenever you see a Morgan Stanley rebalancing, that some of the stocks behave very strangely in the last half an hour. In order to reduce the tracking error, SEBI has introduced a closing auction session, and this is not the first instance globally. It is a prevalent practice. It helps all the passive funds to minimize the tracking errors. We know how passive funds have gained a bigger and bigger market share in the mutual fund industry. So from that point of view, it's helping them. How our markets react to it, I think time will tell. But yeah, certainly, we've just had the first so-called risk that you just put out, that UPL put its numbers out. Maybe SEBI might then bring out a regulation saying that companies will not be allowed to give out price-sensitive information between the time of 3:15 and 3:30 or whatever that might be. So I think that might be a good move. We'll learn as we go along. I don't think it's a big market changing event. But having said that, there will be some unintended consequences.
So between 315 and 320, I mean, just to use your live example, F&O was trading, but cash was not trading, right? On UPL.
Yeah. But even otherwise, the closing option section, you don't really get to see at what price you will be able to do that trade. It'll get done at the point where the maximum number of trades would have gotten matched.
Yeah.
So to that extent, it's a little blind. So maybe corporate results or companies, when they announce big news, SEBI might do well to say that, you can't do it, let's say, between 3 or after 3 p.m. till 4 p.m. or something like that.
Yeah. Got that. So, So now it's 3:23, Rajesh. So now till 3:28, the session goes on for these 219 stocks, and there's price discovery for the index.
Yeah, and we'll come to know at what price all this is settled and what price the index will officially close at around 3:30 or 3:35 p.m. I'm not entirely sure. And after that, you'll get another 5 minutes window to trade your F&O positions.
Okay. Got that. Prateek is with us. Prateek Oswal. Prateek, good to have you with us here. Thank you very much. We're learning as we go. But as Rajesh, you heard Rajesh say, this is of course all done from an index fund's perspective to reduce tracking error, etc. I mean, markets, of course, and the trading community will have to learn to adjust how they trade around this period in that sense. Just your first thoughts, Prateek?
Yeah, hi. Thanks for having me here. So the issue with managing index funds and ETFs is to be able to match the end of day price. What happens is, what is tracking error? Tracking error is basically the difference between the price at which you buy your stocks versus what is the end of day value. And what this mechanism does is sort of bring those two together. So there's not a lot of difference between the price that the customer or the investor is getting versus what the AMC is buying at. So I think it's a good mechanism where the AMCs don't have to do this thing where they have to match. There's something called VWAP, or we have to buy stocks every half a minute or every minute in the last 15 to 20 minutes of trade. And this is to ensure that we are very close to the end of day price. And what this does is actually makes this entire process go away. So it's actually a much better way of managing index funds from a fund management point of view. And investors can actually expect lower tracking errors because of this being set. So overall, I think it's a very good regulation.
Right. So Prateek, the idea is to crowd in all the demand and supply in this window so that it kind of, that's the idea? So, I mean, if an index fund has to rebalance, it does this in this window.
Yeah, so anything where you're deploying money, or when you're rebalancing, it tends to happen at one specific price. Normally, what we had to do as guys who are managing index funds is deploy equal parts of money every minute or every 2 or 3 minutes to be able to match the end of day price. In this case, you can just I think it's much easier for us to rebalance and also deploy cash towards investing into stocks. So yeah, it's a much more efficient way of deployment as opposed to what we used to do before.
Yeah. But my only point is that index funds will be active in this window, basically, right? Because they'll be.
Yes. Yeah. So I think there's not regulation in which where they decide when we can be active. I think best practice is to be active in the last half an hour trade. But there is a leeway given to AMCs to be able to deploy money at different points in time during the day. But yes, I think most of it happens in the last 30 minutes of trade.
Yeah.
But it happens in a very systematic way, a slightly more complicated way. So in this case, this is actually a lot easier.
Yeah.
Because you're able to match the end of day price where your tracking error goes down dramatically over time.
I see. Mr. Venkatachalam was with us in the morning. Mr. Venkatachalam, you want to come in, sir? It's almost as if I'm giving cricket commentary. 3:26. So it's I think the session goes on till, I mean, we'll have price discovery at 328, right, Mr. Venkatachalam?
Yeah, 328, and then the stop would be random. We don't know when the system will stop accepting the orders. Actually, that's where the other part of the system will start calculating the equilibrium price. Actually, so we should get the equilibrium price between 330 and 335. Actually. So just to to respond to the question that you had, so as Pratik had said, it's actually you have to do it if you want to minimize the tracking error. That you do it during this period in time when the closing auction is there, because there are two orders which would be going in. You would be trading at the market price and you would be putting the limit orders actually. So trading at the market price means whatever the market is closing at, which is where the index would be coming up actually. And so, you would be buying those stocks at the closing price, which goes into calculation of the closing index levels, actually. So that would be an efficient way to reduce the tracking error, actually. And the other one is on the calculation of the equilibrium price, actually. So I believe the exchanges would be disclosing the indicative equilibrium price and the indicative balanced volumes and imbalanced volumes, actually, at every period of interval. So I'm not sure how much is the period of interval at which they will be showing. Maybe it may not be at the nanosecond level, but it will be at a particular period in time. And they would also at the same time put in the indicative index numbers, actually, because so that it becomes easier for the mutual funds and the passive funds to actually manage the exposures.
Got that. So I just want to repeat once again, it's 329, which means that the special auction window has ended, and I'm assuming there is price discovery which is happening, and the index will settle. It's I think at about 24,774. The F&O market continues uninterrupted all the way till 340, basically. So that is what we're seeing. I think my colleague Yash is with us at the Motilal Oswal offices. He's with Chandan Taparia, who handles their derivatives and technicals. Yash, take it away. What's happening?
Well, Prashant, as the closing bell gets stretched a little longer, what we're witnessing here, and all the traders here on the dealing room floor of Motilal Oswal are witnessing, is something very, very interesting. Everyone is sort of stuck to the screen, looking at how the special auction session is panning out, and the prices are changing. But you spoke about how there has been a commentary from your end on every minute. We have Chandan Taparia with us, who's living this commentary through his trading screen today. Chandan, tell us, the new settlement cycle extension of trading hours for F&O. What are the important time slots which now traders will have to keep it in their mind? What are those smaller things, bigger things which they'll have to keep it in mind while figuring out how the cash and non-cash, F&O stocks will see a movement?
So now earlier the regular market was 330. Now for derivatives, it will be the regular market till 340. But the case stock which are part of F&O, their extension will be there, and there is the 3 to 315 regular market will end at 315, but volume weighted average will be taken care of.
Yash.
For reference,
Yash.
315 to 320 is the transition.
Yash, can I?
One second. Yes, Prashant.
Yeah, sorry, Yash, 1 minute. Are you guys seeing the Nifty rate? It's at 24,774. We're up 400 points. I don't know.
Correct.
I just come to you, Yash. I'll just come to you. But so this is the pre-open session. I mean, in the morning from 9 o'clock to 9:08, we have the pre-open session, and with the initial rates that we get are wild, right? I mean, sometimes the Nifty shows 500 points up, 600 points down, and then they finally settle. I suspect that is essentially what is going to happen here as well. So, Rajesh, you want to come in? I mean, because right now, we have like a 400-point bump, 390-point bump.
So I think, so that's what I said. It's yet to be seen what are the unintended consequences if there is some kind of one-sided demand and supply that gets created in this closing session, then you might have a gap open for the next 10 minutes, whether that gap gets filled or it's some index management. Today's not an expiry day, so I think it's a lighter day, but it'll be very, very interesting tomorrow, which is an expiry day, how the index changes during the closing option session.
Rajesh, but why?
Currently, there is order matching that's taking place. So we'll have to...
Nigel, order matching is done. 328 order matching is finished, right? Rajesh?
No. Because I'm looking at the... it's 330 to 335 is the order matching and trade confirmation period. So I think we still have a few minutes of that. That should take place.
Let's ask Mr.
Yeah, because I'm looking at the exchange notification itself that's sent by the NSE. Order entry period is 320 to 325 approximately, then 325 to 330. And order matching and trade confirmation period is 330 to 335.
Correct.
That's the notice that I have. And we're at 332 right now.
Correct. So
the matching is still taking place.
So should we expect these rates to change, Rajesh?
Yeah, certainly. I would be very, very surprised if you get 24,774.
Mr. Venkatachalam, just your thoughts. It's 333 now, right? So
yeah, I think the closing prices would have been determined and settlement would have been going on. I don't think it should be changing from here on, actually, because that's the closing price for the day. There's no price discovery that happens after this particular timing.
So the from my conversation with the exchanges, 320 to 28 is the session, right? After that, at any point is the final value is arrived at, right?
Yeah, between 28 and 30, there is a random stop. You don't know when it will stop, actually. And it'll actually, they'll start calculating the equilibrium prices and then start settling down between 330 and 335, actually.
Correct.
And there is a session which goes on between 335 and 350 and 50 to 4 o'clock. That's basically for the market orders. It's not for the price discovery. Limit orders may not be.
So, Mr. Venkatachalam, why are we going home with 400-point gain on the Nifty?
I'm not sure. Something would have changed fundamentally. But anyway, if you look at the overall regulations, actually, it only says that it can go up or go down by 3%, actually. So even if the market can go up at the extreme of the situation, all the 50 stocks.
I mean, just look at that. Just look at that. The Nifty is up 1.6. The Sensex is up only 0.75%. All right. So this is obviously highly unusual. And let's just, if we can, maybe we just put up the Nifty again and Nifty futures as well, right? I think that will, Mr. Venkatachalam, that should give us a better sense, right?
Yeah, that should.
Can we have the Nifty and the Nifty futures on one screen? It'll be interesting to see because the Nifty futures are still being traded, and so are the Sensex futures for that matter. And I think that should be giving us a sense of what is really happening, because this is obviously, something which is unanticipated. Can we have futures as well, please? Yeah, there you go. So, and that tells you the story. So the August futures are reflective of the correct picture, 24,662. It's only up 0.86%, but the cash price has been is looking ramped up by about 400 points or so. So, Mr. Venkatachalam, you want to comment there? Comment on this? Let's just stick with this, please. This graphic.
Yeah, so the futures is about when it is going to expire. That's the last Thursday or somewhere where it is going to expire, actually. So that's the August month expiry. There is still time to expire, actually. So that's a price discovery which can go on. But this is today's Nifty price, actually. So there would be some fundamentals of these 50 stocks which would have moved.
I don't think so, Mr. Venkatachalam. I don't think so. Pratik, you want to come in?
No, I don't have any comments on the market movement.
Rajesh, you want to come in? Mr. Venkatachalam is obviously saying there has to be something which has changed for the 50 stocks for the Nifty to show us. Yeah, go on.
Nothing. If this indeed is the official close, then I think we have a big problem. The funds may have been absent today, so somebody has had a field day in the post-closing session, or the closing session rather. And this is going to distort the data because a lot of technical averages and all will get calculated on a completely bizarre and wrong number. So I think if this indeed is the close, then we do have a problem.
No, that is the close. I mean, we are up 390 and we've been there. We've been there since 330.
Then certainly the first day has not gone down well.
Yeah.
Something needs to be fixed, for sure.
Yeah. No, you said somebody must has had a field day, but with what end in mind, Rajesh? To do what?
So it is, as you say, as you can see, it is inching the futures up. It is creating a little bit of a distortion in the last 10 minutes of trade, and nobody knows where we are going to open tomorrow. And the fact that most of the technical analysis is done on the index close and not on the futures. And you have moving averages, you have various other things people look at. And that's going to drastically change if the index closing goes up this way.
Can we have the bank Nifty? Rajesh, we should see something similar, not the distorted values, but bank Nifty would have, in terms of the index value, would have derived, right, by 330, whereas futures are still trading.
From what I can see is that TCS, Reliance have been pushed up by over almost 1%.
Yeah.
In the closing session, and some other stocks also, and that's clearly not the way it should have been. So something's got to be done about thin liquidity and prices moving by these kind of numbers.
We should put up the list actually. Bajaj Auto. Let's pull some of these intraday charts up. Bajaj Auto, Grasim, Titan. These are all the stocks that and Reliance, obviously, that's the bigger boy in there. Yeah, all these charts come up for you on the screen to see that distortion, the reason why suddenly we're seeing a bit of a bump up. I'll tell you what, who will not be complaining? The bulls. Because the market is net short, suddenly you have this sort of a bump up. You're wondering when you're going to hit the 200 DMA, and because of CAS, you're there.
No, I think, Nigel, this is all going to reverse in the morning. In the morning pre-open.
Something has to be done about it, but otherwise the bulls will be quite happy about this in a net short market, particularly.
Yeah, no, absolutely. So, what's the Rajesh? What's the advice for people who are watching and who are active traders?
Get out of the market at 315 and wait for them to find its more natural and more correct footing. And I'm sure SEBI is observing what has happened today. And I think we'll have to give it a little more time. But this kind of closing is certainly not one that will please anybody at the regulator.
Yeah, but I'm sure they'll. I mean, this is just day one, right? So they will.
Yeah, as I said, you're hoping that it'll settle. Maybe other funds were completely absent today. People were not there today, and a few trades put in at market values might have skewed this number. But then you're likely to see a gap down open tomorrow, and these things matter if you're doing a lot of technical trading.
Yeah.
And this is a complete distortion, which is not desirable.
Yeah, and absolutely. By the way, we should put out a flash saying that F&O's trading has also ended. It's 340 now, which means that we should, F&O trading, which was continuous without interruption all the way, which is index futures, index options, and stock futures, stock options. All of it has now come to a close. And we should have that flash come up as well, so we will have that in just a bit from now. I'm not sure we have Prateek still with us. Prateek, you want to just sort of? Okay, I think Prateek is not there with us anymore. Mr. Venkatachalam, last thoughts, sir, on what we've seen and what needs to happen to fix this.
I think it must be a teething problem, and hopefully, this enablement has been done for the passive investors, actually. So there has to be a little bit of a nudging of the passive investors to actually come into the closing session. And so thereby there should be some bit of a stability that comes into the system. But anyway, in my view, this is a teething problem. This should be solved as we go along. And then there will be this disruption for the quant players, definitely.
Yeah. Rajesh, you want to come in?
I'm just saying, just leaving you with a thought, what if today was the expiry day?
Oh dear. Oh dear. As someone is pointing out, we should have had a gentleman, there should have been a mock session, right? Rajesh?
There was a mock, but mock doesn't tell you what's going to happen. Mock people are privileged with their orders. You're not going to lose money. You're not going to make money. So the system is a tried and tested one. I mean, how option works, opening option or closing option. It's just that when there is no liquidity or thin liquidity, you can move the prices and move the index by 200 points. We clearly have a problem. Today must have been just served as a warning to everybody because not an expiry day. But as I said, if this was an expiry day, you're looking at some serious profits and losses happening at brokerages.
All right. Should we just bring in Chandan as well to just understand what's happening on the Motilal floor and what's the feedback to that 400-point bump on the Nifty? I don't know. Yash, why don't you ask Chandan?
Of course, Chandan has been giving me his insights here. Chandan, but if you just look at Nifty, I mean, if you look at the spot price and the future price, we see a bump up on the other side. How do you explain this now between 40 to 45? What happens? Does an arbitrage always remain for the following day? Does it close the gap? If you could explain to us, to our viewers, how does it happen from here?
So one thing we need to keep in mind that if there is any event stock specific, the counter will move in future while in spot it may no move, right? And this CS, the auction session is more applicable for FNO counter in the cash segment because derivatives trading will continue. So if you notice here, as per the recent price, the underlying is up by around 390 points.
Correct.
But future is not, there is a difference of almost 100 rupees from spot to future.
Correct.
Right? Because in spot price, 320 to 340, 320 to 335, there is they will match the best buyer and the seller. So accordingly, price will be considered, but future trading will continue.
Correct.
So because of that, some arbitrage may be there, but now we need to understand how the pre-opening session will consider. But we need to keep in mind, but stock which are comparatively having some news in last 5-10 minutes, they may get volatile and people get opportunity there. So let's say, for example, if you take the UPL, the result came, stock headed by 10-15 rupees higher than the spot price.
Correct.
But then again, it fell in.
Correct.
So people can take some opportunity in the options or the future. Let's say I have in delivery, but future is down because of this adjustment. I can do some arbitrage out of that if I have to take consider from the future segment. So this is what we need to understand. One more thing, we need to keep in mind that there is the limit of 3% order entry. So the ultimate
that is in the cash segment.
That in the cash segment.
Correct.
So you cannot put, so let's say Reliance is now quoting near 1300 rupees. So you cannot put 3% plus minus entry for cash adjust auction session.
So the arbitrage can't be higher than that.
Right.
Okay. Now, 340 is when we've had the FNO trading till. What happens between 340 to 345 now in the next 2 to 3 minutes? And what would we see at 345? Largely, would we see the closing of gap between spot and future? Or would the arbitrage continue for tomorrow for the FNO traders?
So some gap might be filled, but as of today is the first time it's happening.
Correct.
And we have noticed that hardly there is the volume in last 5 minutes. So some gap will be there, but somehow the other here we have seen a spike in the spot price, but future remain almost traded and consolidated.
Correct.
So I believe future will head towards the spot because spot
is stopped.
That is stopped and price will be considered based on the maximum, the order.
Correct.
So I think the spot might give slight dip in line with the future. This may happen as per my understanding.
Okay, so I think what Chandan seems to be suggesting is that spot might give a little dip coming closer to the future, and that's how the arbitrage will become slower and smaller. But of course, a lot of people today are just trying to understand how things pan out. Where does it close at 345 and how does it follow tomorrow then in that case?
Okay. Thank you very much for that, Yash. And thank you, Chandan, for explaining that. So day one, a lot of teething issues, technical issues, but it's been an eventful one for sure. Get into a break. We'll come back with more. Welcome back. Let's prep you up for tomorrow's trading session and the numbers that we're expecting. Marico, first up, Mangalam joins in to tell us the CNBC TV 18 poll.
Marico, it's a good set. The reason why I'm saying that with so much authority is the fact that we know their first quarter numbers already from the update. It's a low 20s revenue growth with domestic growth, volume growth in double digits, which is the highest that we've seen in the last many quarters. So put all of that into perspective, the analysts are expecting a 20.5% revenue growth, closer to 4,000 crores on the top line, 18.5% jump in the EBITDA, which means the margins come in around that 20% mark, and the net profit grows nearly 15% as well. Domestic volume growth seen between 13 to 15%. Value-added hair oils, remember, grew in 20s. Their digital business is growing extremely well. So management commentary on the way forward will be extremely crucial, given some of their key raw material prices have seen a big decline year on year. So as a result of which, can we see further expansion in their revenues and margins or not is something that we'll be tracking. As far as Pidilite is concerned, now this has been a consistent mover, double-digit volume growth for the last many quarters, and this time around as well, it's not going to be any different on the top line. If anything, it'll only be further aided by price hikes. A cumulative price hike of almost 12% is what the company had taken. Amount that to some realization growth, you're expecting an 18.5% jump in their overall revenue, closer to 4,500 crores on the top line. Margins come in at around that 24% mark. EBITDA growth 15%. We are expecting a 14% jump in the profitability out here as well. Domestic overall volume growth seen between 11 to 12%. Revenue growth will be further supported by price hikes. The consumer and bazaar business is likely to report 13% volume growth, with B2B volumes growing steadily at around 10%. The most crucial part for Pidilite this time around would be the commentary that the company has on margins. Remember, they typically guide for 20 to 24% in terms of a margin band. This time around, we're expecting it to be at the higher end of that band. Can we see any downside in this itself or not would be the big question.
Okay, all right, Mangalam, thanks very much for that. ONGC is the next one, which is going to report numbers tomorrow as well. Sonal is here with that expectation. Sonal, take it away.
It is expected to be a strong quarter for ONGC, led by higher crude oil prices, and that is something which will show in earnings as well. Overall, revenues are expected to increase by 29% on a sequential basis, leading to an EBITDA growth of 117% at the 27,482 crore mark. Margins will see a sharp jump to come in at 59%, and accordingly, profits are expected to see a growth of around 107%. As I said earlier, it's the Brent crude realizations, that sharp jump in crude oil prices, which will aid earnings. This is expected to improve by around 31% on a sequential basis, 55% on a YOY basis. In general, analysts are expecting net crude realizations in the range of around $92 to $95 per barrel, which compares with around $75 to $78 per barrel, which the company saw in the quarter gone by. Realizations will also benefit from higher mix of new well gas. This gas is priced at a premium to the generic gas or the older gas, and that's one of the reasons why earnings will be higher as well. Average gas price realizations are expected anywhere between $7.7 to $8.3 per MMBTU. Additionally, in terms of sales, it's expected to improve. Motilal Oswal expects oil volumes to increase, or sales volumes to increase by 4%, and gas sales volumes to increase by 3% on a YOY basis. So both the segments are expected to perform well for ONGC this time.
Thank you very much for that. We will get into break. We'll come back with more. Welcome back. What a debut we had of SEBI's closing auction system, or CAS. Today was day one, and just prior to 3:15, the Nifty was hovering around 24,590, and then it suddenly had a spurt of close to about 200 odd points. The Sensex is not showing that kind of a game. So the Nifty ended with a gain of 1.6%, but through the trading session, the continuous trading session, we had a gain of about 0.8 to 0.9%. So interesting day one, perhaps some technical issues, low volatility, low volumes. Sensex ended with a gain of close to about 0.75%. The Nifty Bank had a similar spurt compared to the Nifty. But that's day one today. Tomorrow opening will be very important. Will we have a gap down, which sort of reverses that last minute push that we had? Now, earlier today, we had a chat with Pankaj Tibrewal of Ikigai Asset Manager, who said that strong FCNR deposits have helped stabilize the rupee, and he highlighted tiles, plywood, home improvement as a key theme. Listen in.
We have seen about $36 billion of FCNR deposits flowing into the system. What it has done two things. It has stabilized rupee, and it has stabilized the FPI outflows which were happening. Private sector banks have not participated yet. We believe that the next run up in the market, especially in the Nifty or the front indices, would happen from the private sector bank financials. Dark horses, home improvement space. I think tiles, plywood, pipes all have shown very, very strong numbers. And we see an indication where unorganized to organized movement is happening in all these sectors which are happening right now. So whether it be tiles, whether it be plywood, PVC, everywhere we are seeing market share improvement. And that's one sector, I think, which has been forgotten by the street, which looks good. Home building improvement perspective, I think what is happening, for example, let's take an example of tiles. I think in Morbi, there was a lot of under-invoicing going on, and there was a wide gap between the organized and the unorganized. With the gas price increase, which is a major cost for all the tile manufacturers, I think that under-invoicing is behind us.
Okay, well, that's a wrap on this edition of Closing Bell extended session till 4 o'clock. Business 360 takes the action forward in just a bit.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Iran pushes back on US President Trump's claim of negotiations. Today, Tehran maintains no direct talks are scheduled, says progress has been made with Oman to secure a temporary passage through the Strait of Hormuz. Crude oil prices ease as President Trump pivots back to diplomacy. Top oil-producing nations also agree to raise output by nearly 2 lakh barrels per day from September. The inaugural closing auction session at the NSE begins on a confusing note. Nifty gains 1.6%, but Sensex is up only 0.7%. There's a similar divergence in the stock prices on BSE and NSE. A roller coaster ride for the Indian rupee as early gains are short-lived. Reserve Bank's three-day monetary policy meeting kicks off. CNBC TV 18 Citizens Monetary Policy Committee unanimously expects a status quo. In a rare move, US and Japan coordinate yen purchases to stem the fall in the currency. This is the first such intervention since 1998 after the yen weakened to a 40-year low. Passenger cars hit top gear in what has been the best ever July for the Indian automobile industry. Every major vehicle segment posts double-digit growth. Vehicle registrations in the first 7 months this year have already crossed 70% of the total registrations in the whole of 2025. Willie Walsh takes over as the new CEO of India's largest airline, Indigo. The Irish national has 4 decades of experience in the aviation industry and was previously the head of British Airways and the International Air Transport Association. Shares of Zee Entertainment plunge after SEBI bars promoters Subhash Chandra and Puneet Goenka from the capital markets for a year. The father-son duo also face a 1.5 crore rupee penalty over an unauthorized pledge of the company's land to secure loans. Supreme Court says state governments are free to close or withdraw criminal cases against student protesters who do not have any criminal record. Also clarifies that criminal records should be restricted to grave and heinous offences. Government admits to using facial recognition and social media data to identify suspected miscreants. Parliament's monsoon session enters a third week amid disruptions. Lok Sabha witnesses repeated disruptions as opposition MPs demand presence of Home Minister Amit Shah and a discussion on the Ram Temple donation theft. The lower house passed a bill that increases the sanctioned strength of the Supreme Court judges from 34 to 38. Former Wrestling Federation chief and BJP strongman Brij Bhushan Singh showered with rose petals by his supporters after a Delhi court acquits him in a sexual harassment case. Vinesh Fogart and other female wrestlers say they will appeal against the decision. All right, the top story this evening. Iran has pushed back on Trump's claim that negotiations were scheduled for today as the US president pivots back to diplomacy. Here are the latest developments. Now, Iran says it's not currently holding talks with the US. Addressing a press conference, Iranian Foreign Ministry spokesperson clarified that Iran was not planning to send or host delegations. He added that progress has been made with Oman to secure a temporary passage through the Strait of Hormuz. Earlier, US President Trump said he called off an imminent US attack against Iran after Tehran, along with other Gulf nations, asked him to hold off. Speaking to reporters on Air Force One, Trump also claimed that negotiations would begin on Monday afternoon, but did not give any timeline. Meanwhile, Iranian president urged the enforcement of the MOU signed in June. In a post on X, the Iranian president said that the interim agreement will be the center of gravity for Iran's foreign relations in the future. He also added that security of the West Asian region will be enhanced by the deal. In the oil market, Brent crude prices eased to the $85 mark per barrel as traders exuded optimism that US and Iran will return to the negotiation table. However, ship traffic in the Strait of Hormuz remains constrained. Iran has also said that situation in the strait will not change as long as US military aggression continues.
Well, now what we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that, save a lot of lives, save a lot of unnecessary power, to be honest with you. It'll take many, many years to ever build it back. If it could, I don't think it would be even buildable back. So we had an attack that would be the biggest attack since World War II, and it would have been disastrous for them, and they didn't want us to do it. And frankly, Saudi Arabia didn't want it either. They thought that a deal is imminent. And the deal is imminent having to do with the Hormuz Strait and also ultimately the denuclearization of Iran.
ما الان مذاکره‌ای با آمریکا نداریم.
We currently do not have negotiations with America. The negotiations are with Oman and are focused on reaching an understanding over a path to ensure the security of shipping passage through the Strait of Hormuz. Our effort is to, at the first opportunity, with consultation and cooperation with Oman, determine a route that will naturally be temporary. Based on that, we can provide the security of shipping in the Strait of Hormuz.
Right, the new closing auction rules got off to a confusing start with a sharp divergence seen between spot and future prices in the final minutes of trade. The Nifty jumped nearly 200 points in a single tick, with the bank Nifty seeing a similar spike. The Nifty ended the day up 1.6%, while the Sensex gained just 0.7%. Hormaz Fatakia is here with what transpired in the last few minutes of trade. Hormaz.
Well, it was the first day of the special closing auction session, and it turned out to be a very confusing one at that, because of the fact that the last few minutes saw a very sharp spike on the Nifty. In just one tick, the index moved from 24,573 to as high as 24,774, which eventually turned out to be the closing price as well. Now, of course, the special closing auction session was only for those stocks that have futures and options contracts, and orders could be placed only in specified time windows between 3:20 and 3:30 p.m. and for within a price band of plus 3% or minus 3% of the reference price that was determined by the index. And then there was a very sharp one-way move seen on the NSE names and the BSE names. There was a sharp price divergence seen as well in stocks like Asian Paints, Larsen & Toubro, Bajaj Finserv. The rates on the NSE were completely different and the rates on the BSE were completely different. There was a big price mismatch that was seen, and even on the futures and the spot prices on the Nifty spot price ended at 24,774. The futures are at 24,660, around about those levels. So it's a bit of a 115 point gap that you have seen between the spot and the futures prices. There's a lot of confusion still. Similar price action seen on the Nifty Bank as well. It remains to be seen what happens at market open tomorrow as we go into the weekly expiry session of the Nifty. It'll be interesting to see whether the futures price catches up with the spot price, or whether the spot price comes down towards the futures price to meet at a middle ground and therefore restore the price equilibrium is what it said. So it'll be an interesting market open tomorrow, but at least the first day of the special closing auction session has turned out to be a very confusing one.
All right, thank you, Hormaz, for that. Moving on to the Indian rupee, that opened sharply stronger at 95.14 against the US dollar after RBI data showed inflows of over $40 billion via RBI's special forex swap schemes. However, the early gains were short-lived as dollar buying emerged through the session, weakening the rupee. The currency eventually closed at 95.34 against the greenback. The three-day meeting of the Reserve Bank's Monetary Policy Committee kicked off today. The central bank will announce its rate decision on Wednesday. CNBC TV 18 Citizens Monetary Policy Committee is unanimously expecting a status quo. But what about the full year? Here is Lata Venkatesh asking the members of the Citizens MPC.
What will the MPC do to the repo rate on August 5th? First, Samiran, your call.
No change.
Okay. Sonal, your call?
Hold.
Saumya?
Hold.
Ajit? Dr. Sen, the committee is already overwhelmingly hold.
Hold.
Hold. All right. So that's a unanimous vote, exactly as our poll also suggested. The other question is, okay, if there is no rate hike or cut in August, how many rate cuts or hikes are you all expecting in calendar 2026? So, Sonal?
None.
None. Okay, no changes in rates. Samiran?
No rate hikes in 26, more likely 27.
Okay. Saumya?
No rate hike.
Okay. Sajid? You have to repeat it. I think you're on mute.
No rate hike, though the risks are increasing.
Okay. So that's hawkish. Dr. Sen?
One rate cut
possible.
Ooh, okay. That makes it a divided house.
All right, let's talk about the Japanese yen that rose after a third straight session after US Treasury and the Bank of Japan's rare joint intervention to support the currency. Now, this comes after the yen plunged to its weakest level against the dollar since 1986. The coordinated action saw the Federal Reserve sell euros to buy yen, while Japan spent a record $53 billion in a single day purchasing its own currency. Now, India's manufacturing activity expanded at its slowest pace in nearly 5 years. In July, according to HSBC India Manufacturing PMI, the July reading came in at 53.5 from 54.2 in June. Despite new orders increased during the month, the pace of growth in the new businesses saw a slowdown on the back of challenging market conditions and lower client interest. However, new export orders rose across markets led by Canada, Egypt and Indonesia. Meanwhile, shares of Zee Entertainment slipped over 12% in trade. This after SEBI barred the company from the securities market for 2 months. Chairman Emeritus Subhash Chandra and CEO Puneet Goenka have also been barred for 1 year over unauthorized pledge of the company's land in Hyderabad to secure loans availed by promoter-linked SL Group entities. Additionally, the regulator imposed a total penalty of 1.48 crore rupees on them. Indian auto industry experienced its best ever July as every major segment posted double-digit growth. Passenger vehicles led the charge. It's not just the month. Vehicle registrations in the
It's been just 7 months in 2026 and total vehicle registrations are already at 70% of what the entire 2025 had seen. Now for the month of July 2026 has been the best ever July that auto sector has seen, and all the segments have seen a double-digit growth. So we'll start with the biggest automaker, that's Maruti Suzuki. Highest ever sales that company has seen in a month. Total sales have increased by 34%. Domestic sales have increased by 42%, and SUV continues to see an uptrend. Here it's up almost 50%, and the biggest heartening factor was the entry-level segment. For the second straight month, growth was almost 90%. For Hyundai, it was highest ever monthly sales. Total sales increased by 25%, but the export sales, it's the highest ever export numbers that company has seen in more than 100 months, and it's up 31%. For Tata Motors passenger vehicle, it has reported growth of 59% on a low base, and passenger vehicle domestic sales have increased by 58%, and if you talk about electric vehicle, sales have increased by more than 100%. For Mahindra and Mahindra, both auto and tractor segments have seen a growth of more than 20%. Just talking about auto segment, total sales have increased by 26%, and SUV continues to see a growth of more than 20%. For the tractor segment, April to July growth was 18% versus FY27 industry estimate of mid-single digit growth. Coming to two-wheelers, for Hero Moto, sales were largely in line. Sales were up 19%. For Eicher Motors 2, continues to report a strong set of numbers. Sales were largely in line. Both segments up to 350cc and more than 350cc have reported a healthy growth. For Bajaj Auto 2, like Hero and Eicher, sales were largely in line. Total sales have increased by 30%, but biggest positive part for Bajaj Auto was the export numbers have reported more than 2.5 lakh units. For TVS Motor, highest ever monthly sales of more than 6.30 lakh units. Total sales here increased by 38%, and exports were up 29%. Commercial vehicle segment, very strong month. And I was talking to Mahindra and Mahindra, they have said they are in the super cycle. They are just in the middle of super replacement cycle as far as the commercial vehicle segment is concerned.
All right, thank you, Sudarshan, for that. Moving on, shares of One MobiKwik Systems gained in trade after the fintech company reported its third consecutive profitable quarter. This growth was driven by a turnaround in profitability, strong payments growth and improved lending performance. The company reported a net profit of over 7 crore rupees compared with a loss of 41 crore rupees a year ago. Revenue from operations rose 4% year-on-year, while the payments business posted a 50% annual surge in gross merchandise value. Ather Energy's net loss narrowed as revenue surged 89%. Strong EV demand lifts top line, while operating losses also contracted. The company said that this reflected improved operating leverage amid higher volumes. Shares of IEX fell over 4% after the Supreme Court declined to intervene in the ongoing market coupling norms dispute. The top court stated that this case not the appropriate stage to hear the matter. The court has also allowed the Central Electricity Regulatory Commission to go ahead with framing market coupling regulations. The Supreme Court has also clarified that it has not expressed any opinion on the merits of the case. And time now for a short break. Coming up, Willie Walsh takes over as the new CEO of India's largest airline, IndiGo. More on that when we return. Welcome back. India's largest airline, IndiGo, has officially appointed aviation veteran Willie Walsh as its new CEO. He will assume charge today, nearly 5 months after the airline first announced his appointment in March this year. The leadership transition has come at a time when IndiGo is aggressively expanding its international footprint. Madiha Mujawar brings us a profile on IndiGo's new chief.
Willie Walsh's aviation career began nearly 5 decades ago, and unlike many airline CEOs, he didn't start in the boardroom, he started in the cockpit. He joined Ireland's Aer Lingus as a cadet pilot in 1979 and spent almost 2 decades flying Boeing 737s. Then from flying aircraft, he went on to run the airline. Walsh was appointed CEO of Aer Lingus at a time when the carrier was under financial pressure. He oversaw a major restructuring, cut costs and improved efficiency before moving to British Airways. In 2005, he took over as the CEO of British Airways. His tenure coincided with some of the most challenging years for the aviation industry: the global financial crisis, high fuel prices, and repeated cabin crew strikes. He also played a key role in the merger of British Airways and Iberia to create International Airlines Group, or the IAG. Then as CEO of IAG from 2011, he oversaw a portfolio of airlines including British Airways, Iberia, Aer Lingus and Vueling. In 2020, Walsh took over as the Director General of the International Air Transport Association, or IATA. During his 6-year stint there, he became one of the industry's most outspoken voices on aircraft delivery delays, airport charges, taxation and supply chain disruptions. And now he takes charge of IndiGo, India's largest airline. Unlike his earlier assignments, he isn't walking into an airline that needs a turnaround. Instead, he takes over India's largest airline as it prepares for its next phase of growth, expanding deeper into international markets. IndiGo already commands a 66% market share in the domestic market. The next challenge is to build a global network. The airline has ordered Airbus A350s, is preparing to launch its own long-haul operations and wants to compete more aggressively with foreign carriers like Emirates, Qatar Airways and Turkish Airlines, which today carry a significant share of India's international traffic. So if there are 3 words that describe Willie Walsh, they would be pilot, turnaround specialist and global strategist. His appointment marks the beginning of a new chapter for IndiGo, whether that can help the airline build a strong global presence and whether passengers and employees will see a different IndiGo under his leadership is something the industry will be watching closely.
Willie's done everything he's done. You know, he's been now the DG at IATA. I mean, he's the sort of guy who's seen it all, done it all kind of chap. And I think for him, his acceptance to come and be part of the Indigo journey, I think while it has something to say about Indigo, for a man of that caliber to come and play their magic in the country, but I think to a greater extent, I think it's a reflection of how he sees India and the opportunity it represents.
All right, in national news, the flood situation in Assam is improving, but the death toll has increased to 85. Over 1 lakh people continue to be impacted across 5 districts. The state government has released the first tranche of interim flood relief. Eligible families will receive around 75,000 rupees per household. 8 people have died in floods and landslides triggered by torrential rains in Kerala. Heavy overnight rains in central Travancore have led to a significant rise in water levels across major rivers. A flash flood warning has been issued for Panthanamtha. The IMD has warned of more heavy rainfall in the coming days. Parliament's monsoon session has entered its 3rd week amid continued disruptions in both houses. The Lok Sabha was adjourned multiple times as opposition raised slogans demanding a statement from Home Minister Amit Shah on the crackdown on student protests in Delhi. Opposition also pressed for a discussion on the theft of donations at Ayodhya's Ram Temple. Amid the disruptions, the Lok Sabha passed the Supreme Court Amendment Bill 2026 without a debate. The legislation raises the sanctioned strength of the Apex Court from 34 to 38 judges, including the Chief Justice of India. Earlier, Finance Minister Nirmala Sitharaman introduced the Bankers' Books Evidence Bill. Opposition MPs, including Congress leader Priyanka Gandhi Vadra, staged a protest outside Parliament over allegations of donation theft at the Ram Temple in Ayodhya and alleged police action against student protesters. All right, so this is about the Parliament session. Let's talk about another big story. Former Wrestling Federation chief and BJP strongman Brij Bhushan Singh showered with rose petals by his supporters after a Delhi court acquitted him in a sexual harassment case. The allegations levelled against him by women wrestlers sparked nationwide protests in 2023. Brij Bhushan then was also a sitting MP from Kesarganj and was subsequently replaced by his son in the 2024 Lok Sabha elections. His acquittal comes just months after Olympian Vinesh Fogart publicly revealed that she was one of the complainants and alleged that the system was protecting the BJP leader.
18 जनवरी 2023 को आप लोग यहाँ पर मौजूद थे और तब मैंने कहा था कि ये एक साजिश है, षड्यंत्र है और अगर मेरे ऊपर कोई आरोप सही पाया जाएगा तो मैं स्वतः फांसी पर लटक जाऊंगा। और आज तक मैं उसी बात पर कायम रहा और आज लगभग 3 साल के बाद कोर्ट ने मुझे और विनोद जी को बाइज्जत बरी किया है।
एक तरफ कहते हैं कि यंग जनरेशन के साथ हैं, एक तरफ महिला सशक्तिकरण की बात है, महिला रिजर्वेशंस की बात है और दूसरी तरफ ये।
All right, before we wrap, tech giant Adobe has said that India is now central to its global growth story. The company's Japan and Asia Pacific president told CNBC TV 18's Rachna Dhanrajani that agentic AI has been the key unlock for scale. He added that the market is only now beginning to understand it.
We are empowering everyone to create, whether it's individuals looking to create for their own purposes or launch their own businesses, or the largest, most iconic brands in the globe like Coca-Cola, or in India like Maruti Suzuki, to really transform their businesses. That is where our focus has been. And agentic has been a key enabler. If we think about what it's unlocked for organisations, it's delivered unprecedented scale. The ability to take campaigns that could have taken months previously and bring it down to minutes. The ability to create content at scale to service new markets, new brands, new demographics. That is what we're working with organisations to unlock.
All right, from where you sit again, JPAC is a region that's seen as a strategic growth bet for Adobe, and globally also now the focus is on that region. Where does India rank in all this priority list for the company?
So India is an amazing market for lots of reasons. Number one, we have some phenomenal talent in India. We have some phenomenal companies in India, local brands, global brands. India is a market that redefines the word scale for the globe. And I think as Adobe, we have the opportunity to learn from some of India's most iconic brands on how to build for scale, whether it's the largest banks, automotive companies, SIs, and India is a great foundation for revenue growth for Adobe, for customer innovation. One of the great things about India is the simultaneous experimentation and usage of AI in production systems, probably ahead of most other markets, primarily because you've got such a large audience to service. Indian organisations really need to leverage AI as quickly as possible in a safe and governed way to make sure they're stepping up to the demand. So India is a huge market for Adobe in terms of criticality and relevance, and both educating the organisation on our roadmap and where we need to go.
All right, with that, it's a wrap on this edition of Business 360. Thank you for watching. News and updates continue right here on CNBC TV.
Artificial intelligence that's rapidly becoming the operating system of the modern enterprise, moving beyond foundation models. And in fact, foundation models that generate content to AI agents that can reason, plan, and automate complex workflows. So this shift could transform sectors from banking and retail manufacturing, cybersecurity, and customer experience. To explore this, we have with me Shriram Finance. I would like to welcome her on stage. Thank you very much. And joining her are our distinguished leaders who are shaping the future of enterprise AI, digital transformation, cybersecurity, and technology innovation. Let me introduce Ramesh Lakshminarayanan, Group Head of IT and CIO, HDFC Bank. Sandhya Ramachandran Arun, Global CTO, Wipro. Swapna Bapat, Managing Director and Vice President, India and SA, Palo Alto Networks. Nikhil Mittal, Chief Technology Officer, Zepto.
The move from foundation models now to the agentic era and to the agentic economy, where are we in that transition? How far have we moved ahead as far as India is concerned? And what are the checks and balances that we need to keep in mind as we make that transition? We've got a very diverse set of panelists here. We just had headlines being grabbed by OpenAI and Hugging Face. Of course, that was a test environment, but we did see the impact and the implications of an agent going rogue. So how do we ensure that we're not heading in that direction? All of those are very important but equally complex issues. So Ramesh, without further ado, let me get started with you. Rent intelligence, own intelligence. I know you are a big believer in owning intelligence. You've done that at HDFC Bank. Run me through why you believe it is imperative in the AI era to own your intelligence.
I've been very big proponent, not because, that you can't just rent it out, but the fact is that intelligence inherently has to be manufactured. I mean, if you think about it, right? And in an industry that we are in, we're not going to compete unless we are a tech-driven company. I mean, it's very, very obvious that 5 years down the line, I don't think you will have common bankers. You will have front end and you'll have only technology. And from that perspective, it's very important that you own. But also there are reasons around sovereignty that you spoke about. I'm sure we will delve upon it. But there is another thing that's happening. I think industrialization of AI, Shriram, is not easy. It's not like you just go and pull out your cloud and you start kind of prompting and things will come out, okay?
But that's the assumption almost, because it's been made to seem like that.
That's the assumption, but when you get into the real production scenario in enterprises, it's infinitely more difficult. And that's where a lot of focus, and this whole debate about India missing the AI and all of that stuff, if you look at it, there's so much of work to be done. Simply, in terms of building intelligence, building smaller models, doing better fine-tuning of models, making it so domain-driven that and in our industry, it's a 1-0. You expect 100% accuracy. You're extracting a, let's say, check image. A 0 gets missed out, you are done, So to get to those levels of insane accuracy, a lot of intelligence has to be done, and reasoning and intelligence are very inherent to human mind. That's why I'm a very big proponent of making it in-house.
Making in-house, owning intelligence, that's what you've done with Neve, which is the platform that you created at HDFC Bank. How hard was it for you to be able to put that together?
See, my entire, Shriram, the whole idea came from a visit to the US a couple of years back. And, I had a bunch, all ideas come sometimes it's very interesting to back your people. We were just going around looking at all the big techs. Everybody is showing us a lot of the platforms, which were pretty good, not that they were not good. And there was this two blokes who came and said, Ramesh, what we should probably try and build it. I said, are you crazy? I mean, this is not something that, So he said, okay, give us, we don't want too much of money. Give us 3 months. We'll put together something.
Okay.
And that's how the idea was born, Shriram. And the second thought process that I believe very truly for banks especially, you will have a situation of risk and governance catching up. Yeah. They are in a catching up mode. I'm being very honest about it because the regulator is still trying to figure out what this AI is all about. Yeah. How do you guardrail it? And one of the things I'm very clear is that the platform approach helps you to keep things very tight. Okay, it's not like anybody comes and puts a model, you don't know how the model has behaved. Yeah. So I think these were the two foundational aspects, and Neve was born, and then we kept building on it. In fact, like I said, I have only 40 people building Neve today, but each one of them is very, very deep techie. I mean, they're not typical bankers, the conversations are not around finance, around, margins.
Honest answer, how much money did you give them to get started?
Yeah. About, I would say about 2 crores was.
That's it?
That was
literally?
That was the money.
So in this world where everybody is talking about spending billions and billions of dollars, you're saying you've been able to do this in a couple of crores?
Yeah, because the billions are required only for the large LLM tokens, Shriram. And that is the biggest myth, that you need LLMs and running at insane frequency and burning insane tokens. And that's why I said building smaller models sharper models is where the institutions will have to focus and be smart about it.
Okay, well, that's a good point. So, Sandhya, let me come to you now and talk about what you're doing with this at Wipro.
So the first thing we did was set up a Wipro Intelligence Council. Everything that we do in AI is branded under Wipro Intelligence. Our leaders across the various business units and support functions are a part of the council. We have appointed a leader for responsible AI, a very eminent, known personality in the industry. And we stay ahead of the curve in terms of making sure that every one of our 230,000 employees understand what it means to be responsible in terms of AI innovation, AI experimentation, which we do want to encourage.
Yeah.
Right? And speaking about the large language models, I think initially it was essential for us to learn, to master, to understand the possibilities of what we can do for our clients, and our clients are experimenting as well, right? And coming back to what Ramesh said about having smart engineers, good engineers, deep engineers, who don't really cost a bomb in India, relatively speaking, but it's important for them to build models that are more contextual, with narrower context.
So the small language model.
The micro small, right? So the smaller it gets, the more accurate it becomes, and the latency is a lot less. The speed of response.
Will that be the key for larger enterprise adoption, you
think? Absolutely. So if you take any large language model, it knows general knowledge, right? It knows everything in the internet. But what you really need to know is, how does loan work? What is the language around loans? What are decisions being made? And all of that is a very specialized domain. And therefore, small and specialized domain models are very, very important. And that's what we focus on significantly.
Swapna, let's look at the big picture now, and let's talk about adoption at the enterprise level. What is the data telling you in India today? Also, how safe is this as we move forward to this agentic economy? Are the guardrails in place at an enterprise level? What's the data telling you?
The data is based on all the conversations me and my team have with customers across verticals in India. And the adoption seems to be in some pockets when they're having chat conversations with their customers for B2Cs. And for B2B, generally, if they have a developer environment, they're using a lot of model development use for their application development by engineers, right? Now, the security concerns are definitely there, and that's a good thing. To be concerned about security is good because the difference between a normal traditional application that we used to have in yesteryears, which has been, first started on-prem, then it started getting developed in the cloud. Unlike those applications which, even with microsegmentation, would allow to be engineered in such a way that you could upgrade certain components.
Yeah.
AI applications are constantly alive. They're constantly morphing. And then when you start building agents, they are ephemeral. So they will come, they will go. Having control over what these agents do and how much freedom they have in the enterprise is, I guess, the biggest concern of customers. And that's a good thing. Because we have seen when agents are allowed to do more than they should, and they're allowed to be free, they actually try to do more because they think it's a good thing. So I'm using the word think a little carefully, but the intent of the agent is to do more.
Yeah.
They're built for that. Now, what does more mean? Is more good that I'm allowed to go and change database entry in the CRM, but hey, I'm smart enough to go and change 10 at a time. Should the agent be allowed to do that? So basic principles in security continue to be extremely important. Things like zero trust. If you can't trust, I won't say you can't trust, but you always verify a human interaction with an IT system. You must doubly verify agents when they interact with an IT system. And it should be constant because they will die and they will come up. And in that time, each time, they should be verified.
Absolutely. But you brought up a very interesting aspect, Swapna, and that's what I want to address. This question about autonomy, because we are talking about agents being at the execution end. Now, how much autonomy should be given, and should it vary from sector to sector? For instance, for Ramesh in banking, I mean, the RBI is going to be breathing down his neck. Should he give any autonomy at all? And for Nikhil at Zepto, I mean, can he or should he give his agents much more of a free hand? How do we look at the issue of autonomy based on whether you're a regulated entity or not?
See, regulated entities, and I would say rightly so, have come under a lot of learnings right now. Our regulatory bodies in India are asking to understand what models are being used. How are these models constantly being fed? What type of data are they being fed? So there is that understanding phase that is happening now, which will ultimately translate to how these agents are going to be used. Are the agents coming? Absolutely, they're coming. Now, we spoke briefly earlier. One of the things that is still not very clear are regulations around who is responsible if the agent misbehaves. Is it the enterprise that is hosting the agent, or is it because the person who was interacting with the agent gave a wrong prompt? Where does the fault lie? So unless that is very clear, having agents exposed to a non-employee and not having all those guardrails around from when you use an agent to build an agent to at the end that agent accessing any item in the enterprise, that's a problem. So
I would imagine that is a big problem that you're speaking of, and one that we don't have the answers for at this point in time. But Swapna, before I get Nikhil into the conversation, I know one of the things that you've been sort of highlighting and talking about as a key risk is the CEO doppelganger. For everybody here in the room, explain to me why that is a specific risk and whether you've sort of seen instances of that going up significantly in the last few months.
So that phenomenon is really around, again, I would say it's the role, right, that the CEO plays in the organization. Having identity as a core foundation of when AI is being used will allow such incidents to really minimize and be controlled. So identity dictates what a person or what an agent is allowed to do. So those principles, if continue to be used and enhanced at a much higher speed, because the speed at which one agent, 1,000 agents are going to be working is going to be much broader than one human. So,
absolutely. Nikhil, are you delivering agents in 10 minutes as well at Zepto?
So for us, the biggest focus has been, how to be one of the biggest beneficiaries of this whole AI agentic wave, and be it across both, across consumer experience, how do we deliver them better consumer experience, across their shopping, let's say through search, through browse, or like showing them relevant ads, or like making their delivery perfect. And similarly, on the enterprise side, all of the internal processes across operations, like FinOps, procurement, planning.
But is it more internal today than external for you?
It's both. So there is like very significant presence across both the surfaces, both internal and external.
Okay, like Ramesh, I believe that your move into the AI world and specifically into the agentic world was also on the back of an interesting meeting that that the internet says you had with Demis Hassabis. Is that true?
I mean, we obviously started adopting AI way before that, but obviously those meetings definitely help you set perspective for what's about to come. And you definitely end up, sort of forming your views and strategies on basis of that. But obviously, like, we have been one of the very early adopters of AI even before the Gen AI and the agentic AI became like the top of the town.
And the talking point. But, you've got, what, 600 engineers at this point in time, and you were telling me along with the product team, it's about 800 people. Is this a Gen AI-ready, equipped employee base, engineering employee base?
Yeah, so in fact, when we talk about, modernizing our workforce with the Gen AI or agentic AI capabilities, we don't limit it to just tech and product. We rather think about the overall org as such, because there are ample opportunities across all departments that exist in a company where they can leverage these capabilities in their workflows and like be able to automate a lot of their work or augment a lot of their work and be able to do a lot more. So that's where not just tech and product, obviously there the investment has been a lot more, but even beyond that, there's a lot of investment that we have done across finance, operations, and planning. And we have been able to get very meaningful outcomes out of that.
Give me a sense of the meaningful outcomes that you've been able to achieve.
Sure. So some of the examples like finance operations, we get like hundreds and thousands of invoices from the vendors that we procure from, right? So how do we sort of process those invoices with very minimal human intervention? Similarly, we have like thousands of dark stores across cities, and you have to plan what to procure, where to procure, how much, get it shipped across those dark stores. So all of that planning, coordinating with brands, getting those items first delivered to our larger facilities, and then getting those delivered to the smaller facilities, etc. So
is this being done by agents?
So today, majority of it is like fully automated in terms of what needs to be procured, how much, where, and then some bit of coordination is being done by agents today. The idea is there to almost make it exception-based, where humans should only get in when something breaks or when some intervention needs to be done, but the business as usual flow should be managed by agents fully.
Business as usual should be managed by agents. What about for you, Ramesh? I mean, we're talking about humans in the loop, humans on the loop, whether humans should be involved in a particular transaction at all. I would imagine at the bank, it's very different from what we just heard there from Nikhil, but give us an example of some of the key use cases as well and what you're being able to do on the agent front.
I think you're right, absolutely, Shriram. We have to be more careful, right? But the way we've approached it slightly different is not by build use cases by use cases. Like I said, we have a capability layer in Neve. What we do, for example, image extraction is a capability.
Okay.
So whether reading a trade, LC document or let's say CRL letter, or whether you're reading an Aadhaar card, it has to come from the same engine.
Right.
The logic is not different in that sense. So what we have done, we've deployed, for example, trade has been one of our biggest success cases where a lot of our trade processing today, where the customer CRL comes in, some of the other documents come in, import document, export documents, we're reading that, converting that into an accurate kind of a model. Of course, there's a human in the loop, but an A-type becomes a 2i kind of a disruptor. Similarly, when you go to the branches today, search is a capability for us. So when you search for a particular product, a credit card search, or let's say a current account, a CASA search, and a particular matter on that is the same. And what happens, we put agents behind a search today. So, for example, very interesting example is credit card, service charges.
Okay.
Everybody hates this saying, how can I be charged on a minimum amount due? That's something like this. So if you call up, we've not put this agent directly right now, but if you call up our center, they will send you within a minute. The agent actually calculates this whole calculation within seconds. It also explains that if it's a 100 rupee calculation, how the daily balance would look like. And in a very neat way, the human agent is able to use the agent to kind of communicate that back to the customer. So that's a very interesting use case.
What should we realistically factor in from a jobs point of view?
Look, I think from Wipro's perspective, we look at 4 quadrants. Job roles where AI can easily replace the human, right? Which are probably lower end jobs, automation. I would also say low risk kind of jobs that it's okay to let AI take over. And then there are spaces where AI is going to augment the human, make the human more powerful, more empowered, get them to, humans can work with a bunch of agents, and instead of being a lowest rung worker, can actually start getting a higher quality of life, higher quality of work, that sort of a thing, get work-life balance, be augmented by AI. And then there is another quadrant where those jobs are not going to exist anymore, right? Which is true. It is true of every era that we have seen in terms of evolution. And then there are jobs where only AI can do better than humans, right? So those are the 4 quadrants we are looking at. And obviously, we are looking at reskilling, upskilling, transforming our workforce. In the middle, there was a little bit of a thing about bottom of the pyramid jobs are going away, but we are hiring actively from campuses because the new generation is born AI today. I don't think they fear AI. And all
they
of
don't seem to fear anything, by the way.
Which is true. Which is true. Speaking of the recent events that we have seen in the industry, in the world as well. But I think, so we are hiring. So I don't think the young people need to fear, am I going to have jobs? They're going to have a different need of what a job looks like. There are going to be different roles that they can occupy. The middle levels are struggling, as always. So there's a lot of training, transformation, KPIs, goals that are changing for them. So that is happening. And AI only, my team specifically focuses on future. So as the CTO, my job is to try and make Wipro future ready. So we're doing a lot of interesting experiments, particularly with the doppelganger type of scenarios. And not that we're going to unleash it on the world, but we want to know what happens when.
I can't wait for you to give us a glimpse of what that could potentially mean. But Swapna, let me come to you now and address for everybody who's watching here and who's watching us online on TV as well. What should companies brace themselves for? We've had several incidents grabbing headlines. You know, we just saw one from Apple's data being put out in public. We've, of course, seen what happened with Tata Motors. You know, which are the sectors that find themselves most vulnerable today? And what is it that you believe companies need to do to be ready for this AI future?
See, there were times where companies bought different security products for different areas in the enterprise to protect one element versus the other. The problem at that time was you had different data sets to look at when an incident actually occurred. To actually perpetrate an incident and exfiltrate data or ransom that environment, it used to take a lot of days, 4 days. It started with 10 days, went to 4 days, hours. Now, to exfiltrate data is under 25 minutes.
Wow.
So how can you expect a human to look at 10 data sets and figure out what's happening in the environment? And when a bad actor actually exfiltrates data, they do a lot of activity. There are 5 stages that the attack life cycle goes through. The goal is to catch it well in advance, not wait till exfiltration has happened and then find out what happened. So what enterprises really need to do is bring all their data into one place so that they can use AI to to understand what's happening in the environment and prevent bad things from happening.
Absolutely. Nikhil, I'm going to give you the final say. What should we now expect as far as your AI future is concerned?
From an AI future perspective, the idea obviously is, and that's what our philosophy has been in last, I would say, 2 years or so, especially with the whole Gen AI and agentic AI, is how can we build for the frontier capabilities that would be available 6 months down the line?
Yeah.
Because it is always, if you just build for the capabilities that are there today, by the time you build it, ship it, like the model would have already moved ahead of where it was. So that's our attempt has been that how can we sort of extract far more value, be it in customer experience or internal productivity across engineering, coding. How can we sort of, we have been running initiatives around, can we have, let's say, product managers themselves building the first prototype and, sort of getting their hands dirty in terms of, how does it look like, and sort of running some small scale experiments on top of that, etc. So the idea there is how do you sort of like enable the organization to be able to do, exploit agents to do more and more autonomously without, let's say, getting into troubles. So that is where
stay out of trouble. That is the key. The key message that each of our panelists is throwing up. Ramesh, Sandhya, Swapna, and Nikhil, many thanks for joining us here. We wish you the very best of luck with each of your efforts, and thank you very much for your time today. Thank you very much.
Thank you so much.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the Supreme Court has said that state governments are free to close or withdraw criminal cases against student protesters who do not have any serious criminal record. The court clarified that coercive action should be restricted to protesters with grave and heinous criminal records. This comes after petitioners had flagged that the court's earlier order had led to confusion and that the students with even minor criminal history, like driving offences, continued to face action. The Chief Justice observed that officers involved in excessive force against protesters should not be unduly protected, but a hardened criminal should also not be shielded. The court also said that it was considering setting up a high-level panel led by a retired judge to probe incidents of violence during the protests at Jantar Mantar instead of a special investigation team or an SIT. Now, meanwhile, the government admitted to using facial recognition and social media data to identify suspected miscreants, something petitioners termed as patently illegal. The centre told the court that it was committed to withdrawing FIRs, but that the law does not offer an option for withdrawal, and hence it added that it was open to even considering the route of filing closure reports. The petitioners have also sought an explanation from the Commissioner of Police and Rapid Action Force on how the use of pellet guns, electrical weapons and lathis with nails had been authorized. They noted that there was no order authorizing pellet gun use against protesters. The court posted the matter for further hearing on August 18th. Separately, a retired Air Force officer filed a plea opposing filing of FIRs against protesters found using abusive language. The plea argues that action should be restricted to community service at West. It also said that organizers of protest march should be held accountable since many of them are still making reckless statements. The court agreed to hear this plea on August 5th. Well, joining us now to take this discussion ahead is with us Ms. Anjali Bharadwaj. She's a social activist. Also joining us shortly will be Yashovardhan Azad, the former IPS officer who's also a petitioner before the Supreme Court. Ms. Bharadwaj, thank you so much for joining us. First up, how important is today's clarification from the Supreme Court? Number one, the state governments are at liberty to withdraw the FIRs. And number two, no coercive action against protesters unless they have grave criminal history. So whether that's rape and murder, only those protesters can be proceeded against.
The matter is extremely serious. We have seen the kind of brutality. I think there are any number of videos, and that was also brought on record today, that videos have been shared where there has been excessive use of force by the Delhi police, by the RAF, and we saw very, very concerning pictures which are also at the moment being shown on your screen, where there was use of force, there were lathis with nails that were being used, there were pellet guns that were being trained at the faces of students and which were being used, some of which have resulted in people getting permanently injured. You know, they're losing their eyesight in one eye. There's, women, the way they were dragged, the way they were inappropriately handled, there was violence against them. There are very, very serious questions. I think, the other issue, which was very important, which again was brought up today in court, was a policeman, or at least people who were very easily identifiable, who were not in uniform. So, a police force officials who were not in uniform, who were using lathis, who were using force against protesting students and youth. So I think these are very, very serious issues which were discussed today. The court, of course, sort of heard the issues. The fact that in the previous order, the court had said that those with serious charges, and today the court was asked to clarify. And the court said that only those with heinous charges against them, the cases will not be withdrawn. So it's not a case where somebody has a driving, challan against them, or they were protesting somewhere in a political rally.
Ms. Bharadwaj, I'll just come in there. That's an important clarification that the court gave, that only protesters with heinous criminal past are to be targeted. One confusion that the petitioners flagged in the course of these proceedings, and we also saw over the weekend, is that there is police action being undertaken against the protesters, some of them even minor, some of them 15 years old. How important is today's clarification? Will it clear the air to state-level police that at least as far as protesters, as far as minors are concerned, no action to be taken against them?
No, this is very important, because what we are seeing is, the kind of videos that are emerging. In fact, it's both state and non-state actors, where we are seeing that action is being taken against young people. There is a 15-year-old who is on, her videos have been going viral, where she's been saying that the police is hounding her. She had made some remarks, probably use of some derogatory language, abusive language. And, she's saying that the police is following me and I'm being sort of sought out and FIRs are being filed against me. Now, these are, these are 15-year-olds, minor people. And I hope that the state police also takes what the court has said seriously and stops this kind of witch hunt, this kind of targeting of young people. Also, in many of the cases, what seems to be being said is that they said some things which were objectionable against the prime minister or somebody else. Now, these are there is freedom of speech expression. People have a right to say things. Of course, one can say that certain kind of language can't be condoned, but to kind of file FIRs, to take this kind of action, to in many cases non-state actors, where goons are reaching women's houses and forcing them to record statements. How are they getting their addresses? How are they identifying them if it is not with the help of the police? So these are very serious questions. It's important that the court steps in. The court has said that they are willing to set up a panel under a retired judge. Of course, the demand is for an SIT, under the leadership of a retired judge of the Supreme Court, because what is being questioned here, what is under question here, is the conduct of the police itself, the police force itself. And so we can't leave the investigation.
Right. Well,
Yes, we can't leave the investigation to the police. Yes.
That there is a need for accountability as far as the police action on July 20th is concerned. Speaking of police action, also with us is Mr. Yashovardhan Azad, former IPS officer, also a petitioner in the Supreme Court. Mr. Azad, you filed a petition. You've raised the question on the use of pellet guns. Let me ask you, in context of what Vrinda Grover, your very counsel, had raised, the point that she made, there is no standing order with the Delhi government, with the Delhi police, I beg your pardon, for use of pellet guns, or even an order that mentions the use of pellet guns. How did we come to a point that the police thought they had the authority to do so, to use pellet guns on protesters?
See, these are two different issues. Let me clarify that. I am against the use of pellet guns per se, right? And I'm against the use of pellet guns per se because of a technical issue that whenever you fire a pump action gun, a pellet gun, it's a cloud, it throws a cloud spray of metallic shrapnel. So it cannot be directed pinpoint, but it affects people in the area. So if you're targeting a violent man, instead it may hit somebody else in the eye, or it may affect some of the sensitive organs. So that is why I'm against it. It was used in 2010 and 2016. And after that, there is no such use in mainland. And it does not, it's not even the SOP of Delhi police in 2022. Now, the second issue is the use of pellet gun in Delhi. It's not banned. So the pellet gun will be used as a non-lethal weapon under a graded response, which is first you do that water cannon, and then finally, when nothing happens, and then you fire it. So that will be a point of inquiry by the judicial inquiry, and as to how it was used. Important point is it was never used in the mainland. So what are the conditions under which it was used? The RAF is the specialist force for crowd control, and they used it under the orders of the DCP. So DCP has to justify that the grounds were so that I had to fire the gun. So there are two different issues. You get my point, I hope.
Well, that's an interesting point that you point out. And then, as per your counsel, Ms. Vrinda Grover, arguing before the Apex Court, she had put out that it's only been used twice, once in 2011 in Kashmir, once in 2016 in Kashmir, and as you pointed out, not least of all in the national capital. But Mr. Azad, let me also ask you another question. We've all seen visuals that came out of July 20th. These didn't appear to be disjointed incidents of police action. There appeared to be some kind of strategy, some kind of concerted effort being taken by the police officials, by the RAF. What I want to ask is that the issue that has been raised by multiple petitioners is that it didn't seem like it was a disjointed effort undertaken by individual officers and constables, that there was a very clear direction given from the top. It flowed through down the chain of command and then eventually led to the action. How important is it to ensure accountability here? Because we've heard the Supreme Court previously say any investigation without accountability would be meaningless.
No, absolutely. The police should be accountable. And there are a few unprofessional acts done by the police. For example, not using name badges. You have a collection of plainclothesmen with lathis. That's wrong. If there were nails, more wrong. If women were sort of misbehaved or attacked accidentally, or as bystanders, that is wrong. That's fine. But on the other hand, we must also keep in mind that 118 policemen were injured, and some of the most violent acts also took place against the police. One of the head constable has died. She was a lady constable, and the policemen were dragged, beaten up, they were stoned. So this is also a part of the judicial inquiry. And I was hearing when my counsel was arguing, there were other petitioners also, the Supreme Court. And so that will be a point of inquiry which should look into the brutality both sides.
Well, the court said that it will be constituting a high-level committee. We're almost out of time. Ms. Bharadwaj, quick closing comment to you. We've seen high-powered committees before. We've seen SITs before. Any reason to believe that this time will be different? This time with a new leadership, with perhaps a new retired CJI at the helm of such proceedings?
It's absolutely essential in cases like this to fix accountability. And one would hope that the SIT or the panel that is set up by the Supreme Court takes up its task in all earnestness, and accountability is fixed. I think people have a right to know what exactly was happening in terms of plainclothes policemen attacking people, nails on sticks, rods that were being used, pellet guns. SOP is still not in the public domain. We are seeing the kind of violence that was unleashed that day. There was, of course, there was no transparency from the police force either. There was this truck laden with stones that was found outside Jantar Mantar, which eventually turned out that the police had seized that vehicle, and it just mysteriously turned up the morning of the protest. And when the police was asked, initially they had totally denied it till some reporters accessed documents. So I think there is a lot of accountability that that ought to be fixed, and without that there will be loss of trust, public trust in the force.
But a lot of questions being raised. One of them that was in fact raised by way of a fresh petition is that, is Jantar Mantar even a fit site for protests? That's a question that the Supreme Court said it wants to take up on an urgent basis. That hearing will come in, of course, today or tomorrow. I'd like to thank both of our panelists, Ms. Bharadwaj, Mr. Azad, for joining us with their perspective. On that note, let's slip into a very short commercial break. But coming up next, Parliamentary panel has summoned the social media platforms to evaluate the broader framework for online safety. We will discuss the implications on the other side. Welcome back to News Centre. Now, the Parliamentary Standing Committee on Communications and IT, chaired by BJP MP Nishikant Dubey, has summoned officials from Meta, X, Snapchat and Google today. The meeting is expected to focus on online safety of women and children, data privacy of farmers, rural residents and labourers, and platform compliance with law and order rules. Now, this comes days after Prime Minister Modi's Facebook video on exam paper leaks was briefly removed, with Meta citing a technical error. The committee hasn't linked the meeting to that incident directly, but it has fueled the wider debate on platform accountability. Earlier this year, a private member's bill sought to bar children under 16 years from holding social media accounts. Karnataka and Andhra Pradesh have proposed their own age bans. The Delhi High Court will hear a plea on August 5th, seeking guidelines to enact a law to ban social media access for children and court-mandated age verification. Now, this comes as the government has already tightened the rules, cutting takedown timelines for child sexual abuse material and nudity from 24 hours to just 2, and mandating labels for deepfake content. Well, that's, of course, the whole gamut of regulations that we're looking at. Joining us now to help us unpack all of that is with us Rohit Kumar, founding partner of the Quantum Hub, and Apar Gupta, lawyer and founder director of the Internet Freedom Foundation. To both the gentlemen, thank you so much for joining us. Mr. Kumar, coming to you first. Let me get your thoughts. The last time we had this conversation was about a week back. We were talking about how perhaps there may be gaps in the current regulatory framework. So I want to begin by asking, are there gaps in the IT rules, the IT Act, the AI guidelines that we have? Are there gaps that need to be filled that this parliamentary panel will need to look at?
Absolutely. And thank you so much for asking that question. I mean, we've been saying for a very long period of time that the IT Act needs comprehensive revamp. Because currently the IT Act the only powers that the government has are, essentially content takedown and some kind of due diligence requirements that they force on government, but force on platforms. But everything under the IT Act ultimately boils down to safe harbor and the threat of removal of safe harbor, with the government having no other tools at its disposal, to get platforms to do better or design their platforms better. So I think all the things that we are seeing, that is increasing amount of disinformation, misinformation on platforms, or lack of online safety, or some of the other things that have sort of come about, point to the fact that there is a need to relook. And in fact, when Rajiv Chandrasekhar was the minister, he had started taking, picked this up as a project, but it was deprioritized along the way. But what we really need to do under the IT Act is to move away from this, content takedown regime to a duty of care kind of regime, where incentives and penalties are used to get platforms to design their systems better and to sort of make sure that they are safer.
Sure. Mr. Gupta, let me get your thoughts on that. Mr. Kumar says his perspective is that there are many gaps that we need to fill. We had a word with a few industry members off the record. What they tell us is that, look, we are already heavily regulated. We're almost censored to a point is what they tell us off the record. So tell us, is there need for giving more teeth to the regulation as far as the government is concerned?
So I think the government already has a lot of teeth and it's already biting these platforms, and it's biting them very aggressively. But what it is biting on is primarily sensorial control of content. Let's be very candid here. What is this Parliamentary Standing Committee about? What it's hearing is not the triggers with respect to child safety or the effects on vulnerable communities. It's also emerging in the background of the Sansad Chalo March on 20th of July. It's coming in the background of a political challenge which is being posed towards the government from content-based movements rather than just a child safety perspective. The second thing I'd like to point out is that the regulation which is needed on these platforms, and these platforms are possibly the companies with the highest amount of market capitalization in the world, which equals the GDPs of many, many countries. They need regulation. They are not heavily regulated. They're heavily censored. So what we do need are platform-based regulations that focus on design, which undertake long-term longitudinal studies as to what is the impact on children, and then enforce that design in a way in which it does not harm the children once those harms are identified. And here we need to create not only a legislation, but also the regulatory capacity to conduct the scientific research and prescribe evidence-based policy making. rather than having more powers with the government, which it can directly enforce for censorship.
That's an interesting thought that perhaps more regulation may be needed, if not censorship. Mr. Kumar, let me get your thoughts. You mentioned Mr. R. Chandrasekhar, former MOS matey. One of the issues that he had been pushing for was algorithmic accountability, and that was, of course, in context of children. There's a debate being had the world over. Should there be some kind of restriction, if not a ban entirely, as far as social media access is concerned? Is that the question we now need to have at the regulatory level as well? Some form of regulatory mechanism that imposes restriction on minors from accessing social media?
See, I think there has been a discussion on what is the best way to protect minors. Let's be very clear about the end goal. The end goal is to keep minors safe on platforms. Restricting their access is being proposed as one way to sort of keep them safe. But the question that I want to ask is that the only way to keep them safe? And more importantly, if you were to sort of prevent them from accessing social media, how effective are you likely to be? And what is likely to be the spillover effect or the collateral damage that happens when you impose something like this? For instance, and I think Apar has been talking about it quite often, if you were to put hard age restrictions across platforms and you build in age verification mechanisms, and initially it was proposed that Aadhaar is going to be used to do that, then eventually it will mean that you will have to verify everyone on the internet, and that is not proportionate in any way. It will break anonymity. But if the question is that we need to keep kids safe online, then I have to figure out, are there other means to do it? There are several design changes that can be done on platforms. For instance, default settings. What is available? So if an age assurance mechanism predicts that a person who is using the social media is a child, does it default to a certain kind of feed? Does it impose age limits? Does it prevent it from, seeing certain kinds of content? Is advertising allowed to be targeted at them? Those are the kinds of changes that we need to make. And under the current law, unfortunately, while the government can use other strong arm tactics to get platforms to comply, legally it doesn't have the powers to force design changes. And this is something I think, Ashmit, you and I also discussed in the context of the WhatsApp username debate, that government, while it is pushing Meta to roll back that feature, technically under the law, it does not have that power to stop a company from launching a feature. Whereas in some of the new age legislation that is coming up in other countries, there are risk assessments that are required where platforms have to assess that what is the overall impact on the regulatory objectives. For instance, if keeping children safe is the regulatory objective and you're launching a new feature, what is going to be the impact? And if it looks like that this feature is going to cause more harm, then you need to go back to the drawing table and redesign it. And if you fail these responsibilities, then safe harbor is not the only tool in my arsenal to come after you. I can impose a penalty.
Right. You brought up a very pertinent point, which is the WhatsApp username notice that has been issued, a reply has been sought. Apar, coming to you, I mean, these are issues that we have been talking about, we have been reporting on Meta, WhatsApp being on the receiving end. That has also been a core concern that the government has had, that, look, there should not be a divorce between the identity of the person and the social media presence. There should always be a correlation. The law enforcement agencies should always be able to establish who the person behind the social media account is. How important is that? How significant is that to also perhaps be given a regulatory layer to move forward?
So the first thing is that the Supreme Court recognized and reaffirmed the fundamental right to privacy about 8 years ago in the Justice case Puttaswamy judgment. And it stated that there first needs to be a law which needs to be proportional to the objective which is sought to be achieved. And then an individual's privacy can be restricted through that law. So what is the objective which is being sought to be met through that law when it is being stated that every person's Aadhaar will be potentially linked with their social media presence? And when we think about the police, let us not think about the amorphous presence of good faith. Let us think about the police which exists today. And as per a common cause report, Lokniti CSDS, 7 out of 10 people are already not airing their social political views because they fear a legal case. We should think about the police as the Kanpur police, perhaps, not the Kanpur police being bad, but just in case of it being a police official which may be tagged onto one of your tweets, one of your social media posts, and then ask people whether this makes them feel more safe or more threatened. given that today social media is one of those platforms which is also used for political advocacy or even just tweeting or making your views heard about a wider contentious social issue, at least for 3 out of 10 Indians. Now, the second thing which happens is that when you link your Aadhaar details with a social media platform, your real world identity gets fixated with your social media presence. The model of surveillance capitalism, which is employed by an online platform, is to gather more and more information about you. And when you have a centralized government identity, which is also linked to it, but also linked to 10 other services, 100 other services, 200 other services, that profile becomes even richer. And this becomes a very big problem given that our data protection law is inadequate. It is not even right now in enforcement, will not have a regulatory body even when it comes into enforcement. So both harms result and they expound exponentially. They exponentially increase. That is why linking real-world IDs such as Aadhaar with social media is destructive to individual privacy for every Indian.
It's clearly a number of issues that perhaps may be taken up as a part of that parliamentary panel meeting. Again, summons having been issued to X, Meta, Google. We're, of course, yet to see the results of that engagement, that meeting. I'd like to thank both of our panelists, Mr. Kumar, Mr. Gupta, for joining us with their insight. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
In 2005, India's aviation industry saw the emergence of a new player, a startup that would rewrite the rules of the airline business and defy the odds of survival in a sector that seen the demise of several private airlines. 20 years on, Indigo Airlines is India's largest airline with an overwhelming 66% market share, fleet size of more than 400 aircraft, annual revenue in FY26 of 10 billion, delivering profits in a sector that's been marred by airlines losing money, with the aspiration of being India's most formidable international airline. But what was considered its competitive advantage, its scale, is being seen as a vulnerability for the sector in light of the collapse of its operations in December of 2025, which forced the regulator to step in with penalties and restrictions. While operations have normalized, winning back customer trust and regulatory confidence is among the key challenges for the airline as it starts its third decade of connecting Indians. Joining me now to talk about Indigo's flight path is its co-founder, its interim CEO, and its managing director, Rahul Bhatia. Rahul, it's great to have you back on CNBC TV 18. Many thanks. We don't really get a chance to speak to you very often, so it's good to have you speak to us today. Congratulations are in order as you complete 20 years. And as I said, Indigo's had many important milestones, not just for the airline, but for the Indian aviation sector as well. It's sad, though, that it coincides with what happened in December of 2025, forcing you to come back to manage the airline. Is that a regret?
So, you talked about 66% market share and the footprint. Can we talk about that a little bit?
Yes.
Because I think this is something the company has failed in sort of educating the world. So 34% of, actually 1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in, we only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure, we are able to experiment. And the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing for the sake of the country.
I'll pick up on your words. You're saying you're being badgered for your size and scale today. That was not the case up until December 2025. People were not going after Indigo. Of course, the times when you saw the prices spike and so on and so forth, that was the case, but that was the case in the natural course of things. This badgering, the fear of a monopoly, the fear of this emerging as a national vulnerability has only started post what happened in December, which was a debacle. There's no other way to sort of put it. That's where I wanted to push you a little bit. You talked about cost optimization and why that gives you the ability to fly to routes that other people can fly to but choose not to fly to. Are there limits to this lean, mean machine that you've operated for 20 years? And were those limits really tested in December?
No, I mean, I've gone on record to say that December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. But I think there was a confluence of several different things that came together, and then the cookie crumbled. There was implementation of FDTL. We went through a massive upgrade on our entire fleet. A couple of days before that, there was, I think, volcanic ash. There were several things that came together, and that sort of, broke the back of the camel. But talking about disruptions, the disruption in Indigo was not unique. It was not something that's happened for the first time anywhere in the world. You've had some carriers larger than Indigo that have been through issues like that. Southwest, Ryanair, JetBlue. I mean, there's a long list of these things. Is this something that we wanted? No, of course not. But it happened, and we took corrective action, and we were back up and running in, I think, 2 or 3 days.
Yes, operations have normalized, but let's talk a little bit about what you've been able to change. There have, of course, been leadership changes. As I pointed out, you have come back as interim CEO. Billy Walsh will take over as the new CEO. You've had other changes. You've got a new CHRO, you've got a new CFO, you've got a new Chief Strategy and Transformation Officer. How much of what we saw happen in December was a result of poor management decisions, a leadership issue, and hence you believe that the leadership changes that you've been able to bring in will help address some of those challenges?
I think the changes that we have seen over the last 3 or 4 months, some of them have to do in preparing this company for the future. Some of them have to do with holding some people accountable for what happened in December. It's a mix. It's not about one thing or the other. It's really taking stock of what happened that should not have happened, and also building resilience in the organization for the future.
Regulatory confidence, and that is going to be key now as you start your third decade of operation. And at this point in time, it's pretty evident that the government is concerned about the so-called monopoly that you enjoy, the 66% market share that we just spoke of. The Civil Aviation Minister in Lok Sabha has gone on record to say that India needs more airlines. He believes that we need 5 more airlines, and he believes that India cannot be, quote unquote, I'm paraphrasing what he says, cannot be held hostage by one large airline. How do you win back regulatory confidence? You've also got the Competition Commission looking at issues of violation of dominance. You have, of course, proposed a competition settlement. How do you win back regulatory trust?
So in terms of sort of our operational resilience, I'd say this fairly confidently, that if you went under the covers of this airline, it's probably one of the finest airlines operationally globally. Like I said to you, what happened in December was actually coming together. It was a perfect kahuna. A lot of things came together that did what happened. But the regulator watches us on a daily basis, watches the entire industry on a daily basis, and I think we demonstrate on a regular basis that we do a fine job. Something you may not know, technical dispatch reliability, which essentially talks about how many missions you can't complete in a day because of technical reasons. Indigo, since inception up till today, has had one of the finest TDRs globally amongst all A320 operators. So if you go under the covers of this company, it's a well-run machine. December happened, and it's clear to us that it's something that we cannot afford. I mean, it is we clearly recognize that we have a responsibility towards the nation because of who we are and what we do, and we do on a daily basis everything we can to make sure that we can live up to that promise.
You talked about going under the hood of the airline, and the DGCA set up its own committee. You set up, the board set up its own internal review, external review as well. Now, the DGCA, in its findings of what happened in December, talked about operational deficiencies. It talked about optimization, which perhaps had been pushed beyond its limits. It talked about the lack of FDTL preparedness. Now, if I were to ask you on each of those fronts, which has of course been publicly spoken about by the regulator, what is the corrective action that's been taken? If you can give us examples of, for instance, in terms of roster buffers, where do we find ourselves today? In terms of active pilot ratios, where do we find ourselves today? So that there is a sense that this is unlikely to repeat.
I mean, we have now been flying for 6 months since December, and our punctuality has never been better. And this is something where you earn your wings every single day. We fly over 2,000 trips a day, and I think the machine runs fairly smoothly. Our only appeal to the government is that put regulations in place. Okay, let me go back. I know of no airline operator in the world, whether they fly 1 aircraft or 1,000 aircraft, that they want to fly an unsafe operation. Mm-hmm. Right? I hope you and I agree
Absolutely.
to that. And our only appeal to the government has been that when you look at FDTL regulations, look at it from 2 lenses. One, that we must do what is best in class on a global basis, right? Look at regulations around the world and figure out what's the right thing to do. But if we put in regulations in place which actually, in the garb of being safe, make the industry as a whole uncompetitive because you're actually taking down productivity of the cockpit, I think is something that we need to look at, because you cannot have on the one side an aspiration for the nation as a whole to get on to the stage of global aviation and yet have its airlines compete with the rest of the world with an uncompetitive cost structure.
So you're saying the current FDTL regulations make Indian aviation uncompetitive?
In terms of cockpit productivity, absolutely.
In light of the FDTL regulations, will you need to staff differently from what you've been accustomed to doing over the last 20 years?
Well, like I said, if productivity is going to take a beating because of the FDTL regulations, we are staffing differently. We already are.
Which means that you will need to hire more, or will you change the way that you fly?
It's a mix of both.
You know, you talked about, for Willie, this being not just a bet on Indigo, but a bet really to understand how the Indian market is going to grow from here. There's potential and significant headroom. What do you see as the addressable market as we talk about Indian aviation? I mean, every day you get reports talking about the numbers, but from an insider's point of view, given all the constraints, given all the uncertainty and the challenges, what do you really see as the headroom for growth from where you are?
Yeah. So let me go back to 2006. So when I think in the calendar year of 2006. We started in August, and by December, I think we had 6 planes in the fleet. We begged and borrowed 2 slots in Delhi, parking bays, 2 slots at what used to be the Bangalore airport at that time. And then we started to park planes in Jaipur because there was no slots to be had. And we were parking those things late at night, bring them back up to Delhi early in the morning so they could do their daily run. So in 2006, had you asked me, Rahul, would you have been able to foresee at that time where Indigo is today? I would be honest to tell you, no, I wouldn't have. I keep telling internally, we all understand that the India opportunity is large, but what we don't understand is how large is the opportunity. We just don't know. All we have to do is make sure that we have cost leadership by which we can, put out affordable fares to consumers, bring up demand, fill up planes, and just keep going, keep that flywheel going. I think Willie has said this already. All I know is that when you look at international markets, it's actually preposterous that we have only 50 long-haul planes in India for a country of our size. So I think there's great opportunity into the future. I wanted to actually, if it's okay with you, I know you're interviewing me, but I've thought that maybe we can talk about a couple of issues, if it's okay with you.
Absolutely.
And I want to go back to this market share sort of narrative.
Sure.
This is our view, and I say this with utmost humility. What is Emirates' market share in Dubai? What is Qatar's market share in Qatar, in Doha? What is Lufthansa's market share in Frankfurt? What is BA's market share at Heathrow? And the list goes on. And the reason I bring this up is that if India, this is not Indigo, if India truly wants to compete with carriers in their home markets who are of the size of some of the ones I've named, or Singapore Airlines in Singapore, India needs a few big carriers. Otherwise, you'll never, ever be able to compete. So, we have to take into context that this, of course, we can have 10 airlines in India, 20 airlines in India. But to be able to, this is not about competing in India. I think this journey is about India competing with the world. And if you really want to take them on, you will need to have 1 or 2 or 3 winners who will actually just do what they have to do. And you have to allow them to grow. And because if you truly want to be, we talk about India being sort of the 3rd largest aviation market by a certain year. If you truly want to go out and yank that economic wealth that has been over the years taken by others, you'll need to back some winners.
Well, speaking
That's
of
the one part. And the other thing I wanted to talk a little bit about,
No, go ahead.
Sorry for, stealing your time. I'd like to talk a little bit about airfares. So we constantly, the industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India, and when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines. has gone up, and this is the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1 and 3%. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete. And in that mix also is ATF and the tax on ATF. We need to ask ourselves the question, if we really want to get there, then I think we collectively have a responsibility to make sure that we have a cost structure that makes the industry, from a profitability standpoint, sustain. It has sustained profitability. Because if you don't, you'll have people who come and go, right? People will come, they'll put in money, they'll fly an airline, they may not make it, and then they go away. But if you want this to be a profitable industry, then I think we collectively have a responsibility to make sure we go there. And once you have that, you will have investment come in. You will have airlines come in. People will invest in airlines. But all of that needs to change.
You're right in pointing out that what we've seen in terms of taxation, whether it's ATF and, of course, the examples that you gave on UDF and other charges, have been a problem. You talked about your cost leadership and how that has allowed you to be able to connect to locations that others don't wish to connect to. Is that cost leadership today under more pressure than it has been over the last 20 years? Will you be able to deliver and connect to the locations that you would otherwise like to connect to, which may no longer be viable for you to do so? How much pressure is there on your cost leadership today?
Well, we talked about this earlier. This FDTL regulation puts pressure. I mean, we have an ATR fleet that is under tremendous pressure because of this new FDTL regulation. Suddenly, many markets from being profitable have become unprofitable. And I think there needs to be a discourse amongst all the stakeholders to see we need to fundamentally change a few things for the industry to prosper. And the responsibility does not lie only on airlines. And the reason I brought up airfares is because every time the fare goes up, guess who gets the beating? It's the airlines. Nobody ever talks about all the other elements of that airfare. So and we try. I mean, we have been working with the government and they've been very supportive. But we need to keep working on this thing to make sure that the ecosystem in India in totality competes with the best in the world. And then, of course, the opportunity is there.
So given where things currently are, as far as taxation and other charges are concerned, your own profitability has been under strain, 2 consecutive quarters of losses. Of course, the operational performance still continues to be robust. But if this were to continue, and we've got plenty of examples of Indian aviation, which unfortunately has been a graveyard of airlines, are we looking more vulnerable today from an industry standpoint? And there's barely a handful left.
Like I said, the industry, Shireen, will remain under pressure till we make some fundamental changes. And I think all the stakeholders need to have a deep look into this and see what can be done. You can't have a situation where aviation in India is increasingly considered infrastructure and a public utility. And yet when it comes to taxes, it's seen as an elitist mode of transport, right? We carry more first-time flyers than ever before on a daily basis. And I think we just, like I said, we need to review this.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Iran pushes back on US President Trump's claim of negotiations. Today, Tehran maintains no direct talks are scheduled, says progress has been made with Oman to secure a temporary passage through the Strait of Hormuz. Crude oil prices ease as President Trump pivots back to diplomacy. Top oil-producing nations also agree to raise output by nearly 2 lakh barrels per day from September. The inaugural closing auction session at the NSE begins on a confusing note. Nifty gains 1.6%, but Sensex is up only 0.7%. There's a similar divergence in the stock prices on BSE and NSE. A roller coaster ride for the Indian rupee as early gains are short-lived. Reserve Bank's three-day monetary policy meeting kicks off. CNBC TV 18 Citizens Monetary Policy Committee unanimously expects a status quo. In a rare move, US and Japan coordinate yen purchases to stem the fall in the currency. This is the first such intervention since 1998 after the yen weakened to a 40-year low. Passenger cars hit top gear in what has been the best ever July for the Indian automobile industry. Every major vehicle segment posts double-digit growth. Vehicle registrations in the first 7 months this year have already crossed 70% of the total registrations in the whole of 2025. Willie Walsh takes over as the new CEO of India's largest airline, IndiGo. The Irish national has 4 decades of experience in the aviation industry and was previously the head of British Airways and the International Air Transport Association. Shares of Zee Entertainment plunge after SEBI bars promoters Subhash Chandra and Puneet Goenka from the capital markets for a year. The father-son duo also face a 1.5 crore rupee penalty over an unauthorized pledge of the company's land to secure loans. Supreme Court says state governments are free to close or withdraw criminal cases against student protesters who do not have any criminal record. Also clarifies that criminal records should be restricted to grave and heinous offences. Government admits to using facial recognition and social media data to identify suspected miscreants. Parliament's monsoon session enters a third week amid disruptions. Lok Sabha witnesses repeated disruptions as opposition MPs demand presence of Home Minister Amit Shah and a discussion on the Ram Temple donation theft. The lower house passed a bill that increases the sanctioned strength of the Supreme Court judges from 34 to 38. Former Wrestling Federation chief and BJP strongman Brij Bhushan Singh showered with rose petals by his supporters after a Delhi court acquits him in a sexual harassment case. Vinesh Fogart and other female wrestlers say they will appeal against the decision. All right, the top story this evening. Iran has pushed back on Trump's claim that negotiations were scheduled for today as the US president pivots back to diplomacy. Here are the latest developments. Now, Iran says it's not currently holding talks with the US. Addressing a press conference, Iranian Foreign Ministry spokesperson clarified that Iran was not planning to send or host delegations. He added that progress has been made with Oman to secure a temporary passage through the Strait of Hormuz. Earlier, US President Trump said he called off an imminent US attack against Iran after Tehran, along with other Gulf nations, asked him to hold off. Speaking to reporters on Air Force One, Trump also claimed that negotiations would begin on Monday afternoon, but did not give any timeline. Meanwhile, Iranian president urged the enforcement of the MOU signed in June. In a post on X, the Iranian president said that the interim agreement will be the center of gravity for Iran's foreign relations in the future. He also added that security of the West Asian region will be enhanced by the deal. In the oil market, Brent crude prices eased to the $85 mark per barrel as traders exuded optimism that US and Iran will return to the negotiation table. However, ship traffic in the Strait of Hormuz remains constrained. Iran has also said that situation in the strait will not change as long as US military aggression continues.
Well, now what we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that, save a lot of lives, save a lot of unnecessary power, to be honest with you. It'll take many, many years to ever build it back. If it could, I don't think it would be even buildable back. So we had an attack that would be the biggest attack since World War II, and it would have been disastrous for them, and they didn't want us to do it. And frankly, Saudi Arabia didn't want it either. They thought that a deal is imminent. And the deal is imminent having to do with the Hormuz Strait and also ultimately the denuclearization of Iran.
ما الان مذاکره‌ای با آمریکا نداریم.
We currently do not have negotiations with America. The negotiations are with Oman and are focused on reaching an understanding over a path to ensure the security of shipping passage through the Strait of Hormuz. Our effort is to, at the first opportunity, with consultation and cooperation with Oman, determine a route that will naturally be temporary. Based on that, we can provide the security of shipping in the Strait of Hormuz.
Right, the new closing auction rules got off to a confusing start with a sharp divergence seen between spot and future prices in the final minutes of trade. The Nifty jumped nearly 200 points in a single tick, with the bank Nifty seeing a similar spike. The Nifty ended the day up 1.6%, while the Sensex gained just 0.7%. Hormaz Fatakia is here with what transpired in the last few minutes of trade. Hormaz.
Well, it was the first day of the special closing auction session, and it turned out to be a very confusing one at that, because of the fact that the last few minutes saw a very, very sharp spike on the Nifty. In just one tick, the index moved from 24,573 to as high as 24,774, which eventually turned out to be the closing price as well. Now, of course, the special closing auction session was only for those stocks that have futures and options contracts, and orders could be placed only in specified time windows between 3:20 and 3:30 p.m. and for within a price band of plus 3% or minus 3% of the reference price that was determined by the index. And then there was a very sharp one-way move seen on the NSE names and the BSE names. There was a sharp price divergence seen as well in stocks like Asian Paints, Larsen & Toubro, Bajaj Finserv. The rates on the NSE were completely different and the rates on the BSE were completely different. There was a big price mismatch that was seen, and even on the futures and the spot prices on the Nifty spot price ended at 24,774. The futures are at 24,660, around about those levels. So it's a bit of a 115 point gap that you have seen between the spot and the futures prices. A lot of confusion still. Similar price action seen on the Nifty Bank as well. It remains to be seen what happens at market open tomorrow as we go into the weekly expiry session of the Nifty. It will be interesting to see whether the futures price catches up with the spot price, or whether the spot price comes down towards the futures price to meet at a middle ground and therefore restore the price equilibrium is what it said. So it'll be an interesting market open tomorrow, but at least the first day of the special closing auction session has turned out to be a very confusing one.
All right, thank you, Hormaz, for that. Moving on to the Indian rupee, that opened sharply stronger at 95.14 against the US dollar after RBI data showed inflows of over $40 billion via RBI's special forex swap schemes. However, the early gains were short-lived as dollar buying emerged through the session, weakening the rupee. The currency eventually closed at 95.34 against the greenback. The three-day meeting of the Reserve Bank's Monetary Policy Committee kicked off today. The central bank will announce its rate decision on Wednesday. CNBC TV 18 Citizens Monetary Policy Committee is unanimously expecting a status quo. But what about the full year? Here is Lata Venkatesh asking the members of the Citizens MPC.
What will the MPC do to the repo rate on August 5th? First, Samiran, your call.
No change.
Okay. Sonal, your call?
Hold.
Saumya?
Hold.
Ajit? Dr. Sen, the committee is already overwhelmingly hold.
Hold.
Hold. All right. So that's a unanimous vote, exactly as our poll also suggested. The other question is, okay, if there is no rate hike or cut in August, how many rate cuts or hikes are you all expecting in calendar 2026? So, Sonal?
None.
None. Okay, no changes in rates. Samiran?
No rate hikes in 26, more likely 27.
Okay. Saumya?
No rate hike.
Okay. Sajid? You have to repeat it. I think you're on mute.
No rate hike, though the risks are increasing.
Okay. So that's hawkish. Dr. Sen?
One rate cut possible.
Ooh, okay. That makes it a divided house.
All right, let's talk about the Japanese yen that rose after a third straight session after US Treasury and the Bank of Japan's rare joint intervention to support the currency. Now, this comes after the yen plunged to its weakest level against the dollar since 1986. The coordinated action saw the Federal Reserve sell euros to buy yen, while Japan spent a record $53 billion in a single day purchasing its own currency. Now, India's manufacturing activity expanded at its slowest pace in nearly 5 years. In July, according to HSBC India Manufacturing PMI, the July reading came in at 53.5 from 54.2 in June. Despite new orders increased during the month, the pace of growth in the new businesses saw a slowdown on the back of challenging market conditions and lower client interest. However, new export orders rose across markets led by Canada, Egypt and Indonesia. Meanwhile, shares of Zee Entertainment slipped over 12% in trade. This after SEBI barred the company from the securities market for 2 months. Chairman Emeritus Subhash Chandra and CEO Puneet Goenka have also been barred for 1 year over unauthorized pledge of the company's land in Hyderabad to secure loans availed by promoter-linked SL Group entities. Additionally, the regulator imposed a total penalty of 1.48 crore rupees on them. Indian auto industry experienced its best ever July as every major segment posted double-digit growth. Passenger vehicles led the charge. It's not just the month. Vehicle registrations in the first 7 months are also encouraging. Sudarshan Kumar joins us with all the key trends. Sudarshan, please take us through the numbers.
It's been just 7 months in 2026 and total vehicle registrations are already at 70% of what the entire 2025 had seen. Now for the month of July 2026 has been the best ever July that auto sector has seen, and all the segments have seen a double-digit growth. So we'll start with the biggest automaker, that's Maruti Suzuki. Highest ever sales that company has seen in a month. Total sales have increased by 34%. Domestic sales have increased by 42%, and SUV continues to see an uptrend. Here it's up almost 50%, and the biggest heartening factor was the entry-level segment. For the second straight month, growth was almost 90%. For Hyundai, it was highest ever monthly sales. Total sales increased by 25%, but the export sales, it's the highest ever export numbers that company has seen in more than 100 months, and it's up 31%. For Tata Motors passenger vehicle, it has reported growth of 59% on a low base, and passenger vehicle domestic sales have increased by 58%, and if you talk about electric vehicle, sales have increased by more than 100%. For Mahindra and Mahindra, both auto and tractor segments have seen a growth of more than 20%. Just talking about auto segment, total sales have increased by 26%, and SUV continues to see a growth of more than 20%. For the tractor segment, April to July growth was 18% versus FY27 industry estimate of mid-single digit growth. Coming to two-wheelers, for Hero Moto, sales were largely in line. Sales were up 19%. For Eicher Motors 2, continues to report a strong set of numbers. Sales were largely in line. Both segments up to 350cc and more than 350cc have reported a healthy growth. For Bajaj Auto 2, like Hero and Eicher, sales were largely in line. Total sales have increased by 30%, but biggest positive part for Bajaj Auto was the export numbers have reported more than 2.5 lakh units. For TVS Motor, highest ever monthly sales of more than 6.30 lakh units. Total sales here increased by 38%, and exports were up 29%. Commercial vehicle segment, very strong month. And I was talking to Mahindra and Mahindra, they have said they are in the super cycle. They are just in the middle of super replacement cycle as far as the commercial vehicle segment is concerned.
All right, thank you, Sudarshan, for that. Moving on, shares of One MobiKwik Systems gained in trade after the fintech company reported its third consecutive profitable quarter. This growth was driven by a turnaround in profitability, strong payments growth and improved lending performance. The company reported a net profit of over 7 crore rupees compared with a loss of 41 crore rupees a year ago. Revenue from operations rose 4% year-on-year, while the payments business posted a 50% annual surge in gross merchandise value. Ather Energy's net loss narrowed as revenue surged 89%. Strong EV demand lifts top line, while operating losses also contracted. The company said that this reflected improved operating leverage amid higher volumes. And time now for a short break. Coming up, Willie Walsh takes over as the new CEO of India's largest airline, IndiGo. More on that when we return. Welcome back. India's largest airline, IndiGo, has officially appointed aviation veteran Willie Walsh as its new CEO. He will assume charge today, nearly 5 months after the airline first announced his appointment in March this year. The leadership transition has come at a time when IndiGo is aggressively expanding its international footprint. Madiha Mujawar brings us a profile on IndiGo's new chief.
Willie Walsh's aviation career began nearly 5 decades ago, and unlike many airline CEOs, he didn't start in the boardroom. He started in the cockpit. He joined Ireland's Aer Lingus as a cadet pilot in 1979 and spent almost 2 decades flying Boeing 737s. Then from flying aircraft, he went on to run the airline. Walsh was appointed CEO of Aer Lingus at a time when the carrier was under financial pressure. He oversaw a major restructuring, cut costs and improved efficiency before moving to British Airways. In 2005, he took over as the CEO of British Airways. His tenure coincided with some of the most challenging years for the aviation industry: the global financial crisis, high fuel prices, and repeated cabin crew strikes. He also played a key role in the merger of British Airways and Iberia to create International Airlines Group, or the IAG. Then as CEO of IAG from 2011, he oversaw a portfolio of airlines including British Airways, Iberia, Aer Lingus and Vueling. In 2020, Walsh took over as the Director General of the International Air Transport Association, or IATA. During his 6-year stint there, he became one of the industry's most outspoken voices on aircraft delivery delays, airport charges, taxation and supply chain disruptions. And now he takes charge of IndiGo, India's largest airline. Unlike his earlier assignments, he isn't walking into an airline that needs a turnaround. Instead, he takes over India's largest airline as it prepares for its next phase of growth, expanding deeper into international markets. IndiGo already commands a 66% market share in the domestic market. The next challenge is to build a global network. The airline has ordered Airbus A350s, is preparing to launch its own long-haul operations, and wants to compete more aggressively with foreign carriers like Emirates, Qatar Airways and Turkish Airlines, which today carry a significant share of India's international traffic. So if there are 3 words that describe Willie Walsh, they would be pilot, turnaround specialist and global strategist. His appointment marks the beginning of a new chapter for IndiGo, whether that can help the airline build a strong global presence and whether passengers and employees will see a different IndiGo under his leadership is something the industry will be watching closely.
Willie's done everything he's done. You know, he's been now the DG at IATA. I mean, he's the sort of guy who's seen it all, done it all kind of chap. And I think for him, his acceptance to come and be part of the IndiGo journey, I think while it has something to say about IndiGo, for a man of that caliber to come and play their magic in the country, but I think to a greater extent, I think it's a reflection of how he sees India and the opportunity it represents.
All right, in national news, the flood situation in Assam is improving, but the death toll has increased to 85. Over 1 lakh people continue to be impacted across 5 districts. The state government has released the first tranche of interim flood relief. Eligible families will receive around 75,000 rupees per household. 8 people have died in floods and landslides triggered by torrential rains in Kerala. Heavy overnight rains in central Travancore have led to a significant rise in water levels across major rivers. A flash flood warning has been issued for Panthanamtha. The IMD has warned of more heavy rainfall in the coming days. Parliament's monsoon session has entered its 3rd week amid continued disruptions in both houses. The Lok Sabha was adjourned multiple times as opposition raised slogans demanding a statement from Home Minister Amit Shah on the crackdown on student protests in Delhi. Opposition also pressed for a discussion on the theft of donations at Ayodhya's Ram Temple. Amid the disruptions, the Lok Sabha passed the Supreme Court Amendment Bill 2026 without a debate. The legislation raises the sanctioned strength of the Apex Court from 34 to 38 judges, including the Chief Justice of India. Earlier, Finance Minister Nirmala Sitharaman introduced the Bankers' Books Evidence Bill. Opposition MPs, including Congress leader Priyanka Gandhi Vadra staged a protest outside Parliament over allegations of donation theft at the Ram Temple in Ayodhya and alleged police action against student protesters. All right, so this is about the Parliament session. Let's talk about another big story. Former Wrestling Federation chief and BJP strongman Brij Bhushan Singh showered with rose petals by his supporters after a Delhi court acquitted him in a sexual harassment case. The allegations levelled against him by women wrestlers sparked nationwide protests in 2023. Brij Bhushan then was also a sitting MP from Kaisarganj and was subsequently replaced by his son in the 2024 Lok Sabha elections. His acquittal comes just months after Olympian Vinesh Fogart publicly revealed that she was one of the complainants and alleged that the system was protecting the BJP leader.
18 जनवरी 2023 को आप लोग यहाँ पर मौजूद थे और तब मैंने कहा था कि ये एक साजिश है, षड्यंत्र है और अगर मेरे ऊपर कोई आरोप सही पाया जाएगा तो मैं स्वतः फांसी पर लटक जाऊंगा। और आज तक मैं उसी बात पर कायम रहा और आज लगभग 3 साल के बाद कोर्ट ने मुझे और विनोद जी को बाइज्जत बरी किया है।
एक तरफ कहते हैं कि यंग जनरेशन के साथ हैं, एक तरफ महिला सशक्तिकरण की बात है, महिला रिजर्वेशंस की बात है और दूसरी तरफ ये।
All right, before we wrap, tech giant Adobe has said that India is now central to its global growth story. The company's Japan and Asia Pacific president told CNBC TV 18's Rachna Dhanrajani that agentic AI has been the key unlock for scale. He added that the market is only now beginning to understand it.
We are empowering everyone to create, whether it's individuals looking to create for their own purposes or launch their own businesses, or the largest, most iconic brands in the globe like Coca-Cola, or in India like Maruti Suzuki, to really transform their businesses. That is where our focus has been. And agentic has been a key enabler. If we think about what it's unlocked for organisations, it's delivered unprecedented scale. The ability to take campaigns that could have taken months previously and bring it down to minutes. The ability to create content at scale to service new markets, new brands, new demographics. That is what we're working with organisations to unlock.
All right, from where you sit again, JPAC is a region that's seen as a strategic growth bet for Adobe, and globally also now the focus is on that region. Where does India rank in all this priority list for the company?
So India is an amazing market for lots of reasons. Number one, we have some phenomenal talent in India. We have some phenomenal companies in India, local brands, global brands. India is a market that redefines the word scale for the globe. And I think as Adobe, we have the opportunity to learn from some of India's most iconic brands on how to build for scale, whether it's the largest banks, automotive companies, SIs. And India is a great foundation for revenue growth for Adobe, for customer innovation. One of the great things about India is the simultaneous experimentation and usage of AI in production systems, probably ahead of most other markets, primarily because you've got such a large audience to service. Indian organisations really need to leverage AI as quickly as possible in a safe and governed way to make sure they're stepping up to the demand. So India is a huge market for Adobe in terms of criticality and relevance, and both educating the organisation on our roadmap and where we need to go.
All right, with that, it's a wrap on this edition of Business 360. Thank you for watching. News and updates continue right here on CNBC TV.
and welcome to Startup Street. I'm Arundhati Ramnin, and with me as always is Ritu Singh. These are the top headlines from the startup world. Shares of One MobiKwik Systems gained in trade after the fintech company reported its third consecutive profitable quarter. The company reported a net profit of over 7 crore rupees compared with a loss of 41 crore rupees a year ago. Revenue from operations rose 4% year on year, while the payments business posted a 50% annual surge in gross merchandise value. Ather Energy's net loss narrowed as revenue surged 89%. Strong EV demand lifts top line, while operating losses also contracted. The company said that this reflected improved operating leverage amid higher volumes. Google has announced the 2026 cohort of its Google Play Accelerator India, selecting 20 AI-powered startups for its 3-month equity-free program. The startups, spanning sectors from healthcare and agri-tech to gaming and fintech, will receive hands-on support across AI integration, app quality, security, growth, and monetization. Mechatronics startup Mattel Motion and Energy Solutions has raised 130 crore rupees in a Series B round led by UC Empower, with Catamaran joining as a new investor. The company will use the funds to expand manufacturing, strengthen R&D, scale hiring, and accelerate the development of energy-efficient motors and powertrain solutions for EVs and industrial applications. Coffee equipment company Copy Machines has raised 50 crore rupees in an equity infusion from Sedna Horeca, which will also become a strategic partner. The company targets over 150 crore rupees in revenue this financial year. Those were the headlines that we're tracking for you this evening. But on what's brewing today, quick commerce has already changed the way we buy groceries, medicines, and electronics. Now, a new startup wants to bring that same speed to India's construction industry. Fixly has raised $5.5 million in seed funding from Accel, Fireside Ventures, and Lightspeed India partners to build an AI-driven quick commerce platform for building materials. From plant and plywood to plumbing fittings and electrical supplies, the company promises delivery to work sites in as little as 30 minutes. Joining us now is Shehzan Bojani, the co-founder and CEO of Fixly, to talk about the opportunity, the business model, and what it takes to disrupt a highly fragmented industry. Thank you so much for joining us on the show today. You know, construction is a really massive market. But why has no one cracked this last mile supply chain for building materials? And what's the gap that you're trying to solve for the traditional dealers and even quick commerce players haven't?
First of all, thanks for having me. It's a good question, actually. It's a very large market. Honestly, I don't know why nobody solved it. It's there in the open. I mean, I've been around construction and home for almost 20 years now. And anybody who's been around construction can tell you that every single site, every day in India, falls short of some material. Har jagah par hi hota hai. Today, right now, as we speak, there are probably thousands of sites, or rather lakhs of sites today that are stock short, kaam ruk gaya hai, because material nahi hai. And it's so obvious in my mind that these guys material quickly. So what we try to simply solve is that, under no circumstance should work stop. Why should you, waste time going to find the store, figure out if there's stock, if there's no stock, when it can come to you in less than 30 minutes. And this works for everybody, you're a small contractor, large contractor, homeowner, everybody. But if you need anything, you should definitely go after this. I think as for the question is why others have not solved it, I think it's a different supply chain, different logistics architecture, different dark store architecture, because, plywood, paint, etc., different materials you kind of stock. It won't fit a regular dark store that Zepto or other players may do. So I think it needs a special understanding of the space, of the consumer, the end consumer, which is what we're calling a prosumer. They're a small contractor. There are millions of them, and they need millions and millions of material every day, and we're hoping to solve that problem.
Absolutely. And you are yet to launch commercially, right? And that's going to happen on the 1st of September. Are you sort of doing trials right now? And are you set to launch on the date that you've promised? And how have these trial runs look like?
So the good thing is we've been in this industry for a while. So we've done a few trials. We've got amazing response. We are definitely ready to launch on September 1st. I'm actually hoping to launch a few days early, but let's see. Just like our brand promise, we'll be there earlier than expected. So my sense is we'll open a few days earlier.
So your sense is you'll start commercial operations a few days earlier than that. And, the big promise is here, delivery of everything, from paint to plywood in 30 minutes. Operationally, how do you sort of make that work without inventory costs sort of spiraling out of control?
Well, I think the good thing is that, there are certain items that we know through data that construction, sites need every day. We are AI powered, we are AI driven. So I think we'll have enough data to tell us what to stock, what not to stock. We probably won't get it right on day one, but eventually data will tell you what you need to stock, which wire, which paint, etc., etc. And, by sheer density of dark stores in every city, we can definitely be there in 30 minutes, if not less.
Absolutely. And you call yourself an AI-powered supply network rather than just another quick commerce platform. Where exactly does AI come into play? Inventory, demand forecasting, routing, or all three of it?
Actually, all three, including nudging what to buy. I think today, if you're building a company and you're not AI first, I don't think you're building a company.
Absolutely, that's true. Most companies today have to be AI first to sort of, stay ahead of competition. Quick commerce has often been criticized for burning cash. How do the unit economics of building materials compare with grocery delivery? And when do you sort of expect, to start seeing the money coming in and hit profitability? Any of these targets that you've set out for yourself as you approach your commercial launch?
So I think the one big advantage that we have versus a traditional quick commerce is the average order value. We expect that to be in excess of 2,000 rupees. Whereas I think where, general quick commerce players struggle is that, 500, 600, 700 rupees, your cost of delivery, cost of dark stores, it's very hard. For us, AOV will probably start around 2,000 and go up. So there are many ways for us to kind of make money. I think when we make money, obviously we have a certain plan, but, it's a little too early for us to kind of be talking about that. I think we are fundamentally disrupting a very large market, trying to build habit. And I think in any building material business in the world, everybody's made money. So I think fundamentally this is going to be a business that hopefully throw out tons of cash, but we'll see.
Absolutely. And how many dark stores are you starting off with?
I can't tell you everything. Quite a few. I think enough to cover Bangalore when we launch, and I think we'll be adding lots of them very quickly.
All right, and as you pointed out, your target consumers are going to be the contractors, electricians, plumbers, and carpenters rather than your everyday consumer, right? So does that make sort of your customer, because you know who to target, so does that make a customer acquisition easier since they will obviously be repeat high-frequency users?
Yeah, exactly. I mean, hit the nail on the head. I think we know who we are building for. I think we believe that the electricians, plumbers, painters, actually, in a way, they're not building homes. When they build a home, they're actually building India, they're building the nation. And whenever their work stops, India stops. And we are building for them. We love them. We want to give them a lot of respect they deserve. And I think we exist to make their life easy.
Sure, absolutely. And as you pointed out, you're launching in September, on September 1st, or maybe, as you said, a little bit earlier in Bangalore. What metrics will sort of determine when you're ready to expand into other cities? And which cities are you looking at expanding into post-Bangalore?
So I think, for us, we're just trying to understand in the first month or 2 months demand. And we have a few sizes that we were experimenting in terms of dark stores to figure out which is the right size. And then we'll be ready to expand. So it could be, I think in the next few months, we should be in a few more cities. I don't think from an execution point of view, we have a solid team. Sachit, my co-founder, obviously is from Zepto. We have, other great team members. I think if you ask me, I'm probably the most useless guy on the team. So we have better folks on the team and who build a great business.
Absolutely. But, before I let you go, you and your co-founder are not first-time builders, right? You've built Design Cafe before, and he's helped scale supply chains at Zepto and Flipkart. How much of this venture is built on the lessons that you've learned from your previous experiences?
Oh, a lot. A lot. I definitely will not make all the mistakes we made earlier. I'll make brand new ones, I promise. But the old ones I definitely won't make. And learnings have been immense for sure.
That's great. All right, Shehzaan, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on this new venture.
Thank you so much. Thank you for having me. Have a good evening.
Well, in a big strategic pivot for the company, fashion startup Snitch has now acquired women's fashion brand Berry Lush, marking its foray into the much larger women's apparel market. Rather than building a new brand from scratch, Snitch is betting on an established label with existing customers and plans to scale it using its tech, supply chain, and existing omni-channel playbook. The larger ambition is to evolve from a menswear brand into a multi-brand fashion house. So let's get in Siddharth Dugarwal, the founder and CEO of Snitch, for more on this one. Siddharth, welcome to Startup Street. You built Snitch from the ground up. Why decide to acquire Berry Lush? And how did that make more sense than launching your own women's brand? And why now? What was the strategic calculation?
First of all, Ritu, thanks for having me here. I think from our perspective, one question that kept coming up was, when are we launching women's wear? And we just didn't want to build a brand just for the sake of it, but unless we find great value for consumers. When the opportunity of Berry Lush came in, I thought, the brand had great recognition already. It had some, loyal consumer base. Plus, the founder has been working with, product supply chain for a while. With that, I thought the magic of Snitch, which is, our core expertise on supply chain, on, technology front, and even to use our, internal resources to not only pivot the brand, but also scale it super fast.
Well, what's the size of the deal and how fast do you expect the business to grow in terms of revenue contribution?
I think on the commercial discussion, there's nothing much to be disclosed. But what we are super excited is to build, Berry Lush from wherever it is to 1,000 crore sort of a journey in probably lesser time than Snitch. And we're super confident because, the TAM is humongous. And I think the timing is absolutely right for us to enter the women's wear space.
But any financials that you can share for Berry Lush? How do you expect it to grow from here on? What is it currently doing in terms of revenue, scales, profit?
So currently the business is at about roughly 5 to 6 crore per month. Our ambition is to grow at least 3x this year and then take it beyond that.
Siddharth, fashion acquisitions often struggle because each brand has its own identity. How are you going to improve Berry Lush's operations without diluting the brand equity and the kind of customer base it has already built?
So I think Berry Lush was largely a marketplace-driven brand. Snitch has the core expertise of scaling, on its own platform and retail. And hence, we've sort of now started pivoting the brand from the marketplace business and, relaunching it entirely over the next 100 days. You'll see a fully new ramped up website, new product line, new, pricing strategy, etc. And then, we would go in the D2C direction, come up with an app, and of course, at the right time, even go offline.
Got that. So, Snitch has grown using this fast design to shelf model and a very agile supply chain you've spoken about before. But is that model directly replicable in women's fashion as well, or will you go about this a bit differently?
No, of course. Like I said, we're using the brand Berry Lush, but the backend will remain the same. We'll be using our same supply chain, the same sort of technology that we've built. A lot of learnings has gone through, to build this whole technology around what sells faster, what should be the lead times, and how do you replenish products. And of course, Anusha and the Berry Lush team comes with great experience when it comes to product. But yeah, the backend would remain the same of Snitch.
Well, since you now describe Snitch as a multi-brand fashion business, should we expect more acquisitions?
Look, we are here to build brands that can go global. And, that's been super clear even with Snitch. And if you've looked at the Snitch journey, we started off probably like a shirtwear brand and then ramped up into different categories. Today, we do luggage, we do footwear, we do fragrance, and a complete lifestyle brand for men. With Berry Lush, again, the ambition is the same that, we start with, the bigger categories and then expand the horizon across all categories and make it another lifestyle brands. For now, I think, Berry Lush is a 1,000 crore opportunity to us. The focus is on executing this.
Would it be fair to assume there'd be a lot more investment you'd be making in Berry Lush, in technology, marketing, offline expansion that you spoke of? And how are you going to balance this kind of aggressive growth you're planning while maintaining healthy unit economics?
So I think if you know the journey of Snitch, we've always been EBITDA positive, and hence we know how to build a business from from whatever stage it is efficiently. And honestly speaking, from a fundraise perspective, we've raised about 35 million about a year back, and we have enough capital, and we're sure that this brand doesn't require capital as much as it requires execution, which we are really good with.
All right, Siddharth, we'll leave it at that. Thank you so much for joining us here on Startup Street.
Thank you.
On that note, it is time for us to head into a short break. But coming up next, can AI help India Inc. build a healthier workforce? A new report suggests preventive care may be the next big productivity lever. Stay tuned for that. Welcome back. You're still with us on Startup Street. Corporate wellness has long been seen as an employee benefit, but a new report suggests it may now be a business necessity. A study by MediBuddy and CII has found that employees who skip annual health checkups are nearly 3 times more likely to be hospitalized, while just a quarter of the workforce accounts for almost half of all insurance claims. The report also argues that artificial intelligence could play a crucial role in shifting corporate healthcare from reactive treatment to preventive care. Joining us now to discuss the findings and what they mean for India Inc. is Enbasekar D, the co-founder and CTO of MediBuddy. Enbasekar, thank you so much for taking time out and being here with us on Startup Street. You know, your report shows that employees who skip annual health checkups are nearly 3 times more likely to be hospitalized. Why are so many employees still avoiding preventive care despite easy access to workplace health benefits?
Yeah, first of all, thank you for having me here, from MediBuddy. And with MediBuddy, we work with over 450 plus corporates in the survey, and that has showed us this startling report. What this shows is that there is a huge awareness gap. While we all know prevention is better than cure as a statement, but in practice, it rarely gets adopted. That's where, different organizations try different mechanisms to make sure the workforce is healthy, are aware, and we catch, potential issues earlier than usual. thereby finally reducing, hospitalizations and treatments which are far more serious in nature.
Absolutely. And, you estimate poor employee health costs Indian companies over 1 lakh crore rupees every year. That's a big sum. Is corporate India still treating wellness as a perk rather than a business imperative?
Definitely. I think traditionally companies have started with only IPD insurance, where we support employees when they get admitted to a hospital, has been the traditional approach to insurance. But over the last 5 years, we see a rising trend of this changing. There is increasing focus on preventive health by doing even in fact health checkups before a company somebody joins, called pre-employment health checks or annual health checkups, and also OPD and more comprehensive wellness programs. It could be a diabetic program, maternity programs, but this is an evolving trend. So historically, some industries have adopted some of these advanced ways of treating wellness as part of the core workforce and core ROI of a company, and therefore are starting to invest in some of this early, while there's many companies which are still early in their journey of adopting wellness.
Absolutely. And the report is titled India's Health AI Frontier. How exactly can AI bridge the gap between diagnosis and treatment, especially when over half of the employees don't act even after a health checkup?
That's right. Very much, like some of these initiatives are focused on the measurement side of things. The more important work or the fruitful work comes what happens after a measurement. I get a lab report in my hand as a customer or a patient or a user. What do I do with it, and how I engage through the rest of the year also becomes far more important than the first step. While the report always helps in the awareness creation, platforms like Medibuddy are AI enabled to see how a continuous care, continuous nudge, and engagement can happen with the workforce throughout the year, and not just only episodic at the time of a report or a lab test. So we all have this, it's health is not always top of mind, but how can we solve this together definitely helps through the right AI interventions at the right time for every patient or every user at a personalized level.
Absolutely. And, your report says that 4 generations in the workforce face completely different health challenges. From Gen Z's mental health concerns to Gen X's caregiving burden, can one workplace wellness program really cater to everyone's needs, considering it's different across generations?
You're very right in pointing out a workforce has a 20-year-old who's just entered the workforce in their first job to somebody who's a 60 plus, maybe a CXO or a leader in the organization. So the job is very hard for a HR team or a wellness team to actually design. What Medibuddy and platforms help is to plan for different age segments. What a younger workforce needs might be more fitness related, whereas someone who's in the 20s, 30s and 40s may need more parental care, maternity care sort of support, whereas somebody who's in 40 plus might need a chronic support or a preventive health checkups far more frequently and so on. So hence, again, with AI, we can build flexible programs today, which we are able to deliver at a much more granular level than a broad brush programs, which were the norm before. So it's an exciting phase. Again, technology is also enabling this to happen today, which was hitherto not easily possible before.
Absolutely. Technology is helping making all of these things a lot easier, especially when it comes to providing care for different needs. Now, if investing in preventive healthcare reduces hospitalization and insurance payouts, are you seeing more companies measure employee health as a return on investment metric rather than just an HR initiative?
Definitely. I think there is increasing awareness about how we can correlate the data on preventive efforts rather than it just being words. How can we quantify some of this is where an active effort, Medibuddy and CIA with this report has published. We have published, in fact, a toolkit on how a CFO or a CEO can look at corporate wellness and how an ROI for this can be, addressed, and therefore the right investments can be made into this domain. Earlier, it was always in the domain of a CHRO, but we see this increasingly changing in more mature corporates and employers, and we see this trend continuing in the future as well with more and more corporates.
And your workplace health maturity curve shows that nearly 3/4 of Indian companies are still at the earliest stages of workplace health management. It's something you pointed out at the beginning of this conversation as well. What is sort of stopping organizations from moving beyond annual health camps and insurance coverage? What worries these companies to go beyond that?
It's a journey, I would say. The way to look at it is companies who are further up the maturity curve, can they look forward to more advanced solutions like can I enable AI-enabled personalized healthcare delivery, multiple programs, put together into one by a platform like Medibuddy. But somebody who's early in the maturity curve should not get overwhelmed and think about stage 5, but rather move to the immediate next stage, which means if I don't have a program, launch a preventive wellness and an OPD program. If I already have a running program, can we progress forward to say how to move this beyond measure to a act sort of a mode? And that's the journey. And somebody who's already measuring and acting, can they start creating avenues to actively track how an IPD and a wellness is correlating in terms of their outcome? So hence, not to overwhelm, different organizations at different stage of their journey maturity. But fast forward 5 years, we would expect more of them to start moving towards the right side, to more stage 3, stage 4, and stage 5. That's the opportunity that is there in front of the employers today.
All right. So in 5 years, you expect all of them to be at a higher stage of covering health within the organization. All right, Mr. Enbasekaran, thank you so much for taking time out and being here with us on Startup Street.
Pleasure. Thank you for having me.
And with that, it is a wrap on another edition of Startup Street. Goodbye and many thanks for watching.
In 2005, India's aviation industry saw the emergence of a new player, a startup that would rewrite the rules of the airline business and defy the odds of survival in a sector that seen the demise of several private airlines. 20 years on, Indigo Airlines is India's largest airline with an overwhelming 66% market share, fleet size of more than 400 aircraft, annual revenue in FY26 of 10 billion, delivering profits in a sector that's been marred by airlines losing money, with the aspiration of being India's most formidable international airline. But what was considered its competitive advantage, its scale, is being seen as a vulnerability for the sector in light of the collapse of its operations in December of 2025, which forced the regulator to step in with penalties and restrictions. While operations have normalized, winning back customer trust and regulatory confidence is among the key challenges for the airline as it starts its third decade of connecting Indians. Joining me now to talk about Indigo's flight path is its co-founder, its interim CEO, and its managing director, Rahul Bhatia. Rahul, it's great to have you back on CNBC TV 18. Many thanks. We don't really get a chance to speak to you very often, so it's good to have you speak to us today. Congratulations are in order as you complete 20 years. And as I said, Indigo's had many important milestones, not just for the airline, but for the Indian aviation sector as well. It's sad, though, that it coincides with what happened in December of 2025, forcing you to come back to manage the airline. Is that a regret?
So, you talked about 66% market share and the footprint. Can we talk about that a little bit?
Yes. Because
I think this is something the company has failed in sort of educating the world. So 34% of, actually 1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in, we only have, I think, about 44%. So this thing about Indigo being what it is, what is often lost in translation is the fact that that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure, we are able to experiment, and the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing for the sake of the country.
You know, I'll pick up on your words. You're saying you're being badgered for your size and scale today. That was not the case up until December 2025. People were not going after Indigo. Of course, the times when you saw the prices spike and so on and so forth, that was the case, but that was the case in the natural course of things. This badgering, the fear of a monopoly, the fear of this emerging as a national vulnerability has only started post what happened in December, which was a debacle. There's no other way to sort of put it. That's where I wanted to push you a little bit. You know, you talked about cost optimization and why that gives you the ability to fly to routes that other people can fly to but choose not to fly to. Are there limits to this lean, mean machine that you've operated for 20 years? And were those limits really tested in December?
No, I mean, I've gone on record to say that December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. But I think there was a confluence of several different things that came together, and then the cookie crumbled. There was implementation of FDTL. We went through a massive upgrade on our entire fleet a couple of days before that. There was, I think, volcanic ash. There were several things that came together, and that sort of, broke the back of the camel. But talking about disruptions, the disruption at Indigo was not unique. It was not something that's happened for the first time anywhere in the world. You've had some carriers larger than Indigo that have been through issues like that. Southwest, Ryanair, JetBlue. I mean, there's a long list of these things. Is it something that we wanted? No, of course not. But it happened, and we took corrective action, and we were back up and running in, I think, 2 or 3 days.
Yes, operations have normalized, but let's talk a little bit about what you've been able to change. There have, of course, been leadership changes. As I pointed out, you have come back as interim CEO. Billy Walsh will take over as the new CEO. You've had other changes. You've got a new CHRO, you've got a new CFO, you've got a new Chief Strategy and Transformation Officer. How much of what we saw happen in December was a result of poor management decisions, a leadership issue, and hence you believe that the leadership changes that you've been able to bring in will help address some of those challenges?
I think the changes that we have seen over the last 3 or 4 months, some of them have to do in preparing this company for the future. Some of them have to do with holding some people accountable for what happened in December. It's a mix. It's not about one thing or the other. It's really taking stock of what happened that should not have happened, and also building resilience in the organization for the future.
Regulatory confidence, and that is going to be key now as you start your third decade of operation. And at this point in time, it's pretty evident that the government is concerned about the so-called monopoly that you enjoy, the 66% market share that we just spoke of. The Civil Aviation Minister in Lok Sabha has gone on record to say that India needs more airlines. He believes that we need 5 more airlines, and he believes that India cannot be, quote unquote, I'm paraphrasing what he says, cannot be held hostage by one large airline. How do you win back regulatory confidence? You've also got the Competition Commission looking at issues of violation of dominance. You have, of course, proposed a competition settlement. How do you win back regulatory trust?
So in terms of sort of our operational resilience, I'd say this fairly confidently, that if you went under the covers of this airline, it's probably one of the finest airlines operationally globally. Like I said to you, what happened in December was actually coming together. It was a perfect kahuna. A lot of things came together that did what happened. But I mean, the regulator watches us on a daily basis, watches the entire industry on a daily basis, and I think we demonstrate on a regular basis that we do a fine job. Something you may not know: technical dispatch reliability, which essentially talks about how many missions you can't complete in a day because of technical reasons. Indigo, since inception up till today, has had one of the finest TDRs globally amongst all A320 operators. So if you go under the covers of this company, it's a well-run machine. December happened, and it's clear to us that it's something that we cannot afford. I mean, it is we clearly recognize that we have a responsibility towards the nation because of who we are and what we do, and we do on a daily basis everything we can to make sure that we can live up to that promise.
You talked about going under the hood of the airline, and the DGCA set up its own committee. You set up, the board set up its own internal review, external review as well. Now, the DGCA, in its findings of what happened in December, talked about operational deficiencies. It talked about optimization, which perhaps had been pushed beyond its limits. It talked about the lack of FDTL preparedness. Now, if I were to ask you on each of those fronts, which has of course been publicly spoken about by the regulator, what is the corrective action that's been taken? If you can give us examples of, for instance, in terms of roster buffers, where do we find ourselves today? In terms of active pilot ratios, where do we find ourselves today? So that there is a sense that this is unlikely to repeat.
I mean, we have now been flying for 6 months since December, and our punctuality has never been better. And this is something where you earn your wings every single day. We fly over 2,000 trips a day, and I think the machine runs fairly smoothly. Our only appeal to the government is that put regulations in place. Okay, let me go back. I know of no airline operator in the world, whether they fly 1 aircraft or 1,000 aircraft, that they want to fly an unsafe operation.
Mm-hmm.
Right? I hope you and I agree
Absolutely.
to that. And our only appeal to the government has been that when you look at FDTL regulations, look at it from 2 lenses. One, that we must do what is best in class on a global basis, right? Look at regulations around the world and figure out what's the right thing to do. But if we put in regulations in place which actually, in the garb of being safe, make the industry as a whole uncompetitive because you're actually taking down productivity of the cockpit, I think is something that we need to look at, because you cannot have on the one side an aspiration for the nation as a whole to get on to the stage of global aviation and yet have its airlines compete with the rest of the world with an uncompetitive cost structure.
So you're saying the current FDTL regulations make Indian aviation uncompetitive?
In terms of cockpit productivity, absolutely.
In light of the FDTL regulations, will you need to staff differently from what you've been accustomed to doing over the last 20 years?
Well, like I said, if productivity is going to take a beating because of the FDTL regulations, we are staffing differently. We already are.
Which means that you will need to hire more, or will you change the way that you fly?
It's a mix of both.
You talked about, for Willie, this being not just a bet on Indigo, but a bet really to understand how the Indian market is going to grow from here. There's potential and significant headroom. What do you see as the addressable market as we talk about Indian aviation? I mean, every day you get reports talking about the numbers, but from an insider's point of view, given all the constraints, given all the uncertainty and the challenges, what do you really see as the headroom for growth from where you are?
Yeah. So let me go back to 2006. So when I think in the calendar year of 2006, we started in August, and by December, I think we had 6 planes in the fleet. We begged and borrowed 2 slots in Delhi, parking bays, 2 slots at what used to be the Bangalore airport at that time. And then we started to park planes in Jaipur because there was no slots to be had. And we were parking those things late at night, bring them back up to Delhi early in the morning so they could do their daily run. So in 2006, had you asked me, Rahul, would you have been able to foresee at that time where Indigo is today? I would be honest to tell you, no, I wouldn't have. I keep telling internally, we all understand that the India opportunity is large. But what we don't understand is how large is the opportunity. We just don't know. All we have to do is make sure that we have cost leadership by which we can, put out affordable fares to consumers, bring up demand, fill up planes, and just keep going, keep that flywheel going. I think Willie has said this already. All I know is that when you look at international markets, it's actually preposterous that we have only 50 long-haul planes in India for a country of our size. So I think there's great opportunity into the future. I wanted to actually, if it's okay with you, I know you're interviewing me, but I've thought maybe we can talk about a couple of issues, if it's okay with you.
Absolutely.
And I want to go back to this market share sort of narrative.
Sure.
This is our view, and I say this with utmost humility. What is Emirates' market share in Dubai? What is Qatar's market share in Qatar, in Doha? What is Lufthansa's market share in Frankfurt? What is BA's market share at Heathrow? And the list goes on. And the reason I bring this up is that if India, this is not Indigo, if India truly wants to compete with carriers in their home markets who are of the size of some of the ones I've named, or Singapore Airlines in Singapore, India needs a few big carriers. Otherwise, you'll never, ever be able to compete. So, we have to take into context that this, of course, we can have 10 airlines in India, 20 airlines in India. But to be able to, this is not about competing in India. I think this journey is about India competing with the world. And if you really want to take them on, you will need to have 1 or 2 or 3 winners who will actually just do what they have to do. And you have to allow them to grow. And because if you truly want to be, we talk about India being sort of the 3rd largest aviation market by a certain year. If you truly want to go out and yank that economic wealth that has been over the years taken by others, you'll need to back some winners.
Well, speaking
That's
of
the one part. And the other thing I wanted to talk a little bit about,
No, go ahead.
Sorry for, stealing your time. I'd like to talk a little bit about airfares. So we constantly, the industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India, and when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines, has gone up. And this is, the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1% and 3%. UDF charges at airports have gone up to 95%. landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete. And in that mix also is ATF and the tax on ATF. We need to ask ourselves the question, if we really want to get there, then I think we collectively have a responsibility to make sure that we have a cost structure that makes the industry, from a profitability standpoint, sustain. It has sustained profitability. Because if you don't, you'll have people who come and go, right? People will come, they'll put in money, they'll fly an airline, they may not make it, and then they go away. But if you want this to be a profitable industry, then I think we collectively have a responsibility to make sure we go there. And once you have that, you will have investment come in. You will have airlines come in. People will invest in airlines. But all of that needs to change.
You're right in pointing out that what we've seen in terms of taxation, whether it's ATF and, of course, the examples that you gave on UDF and other charges, have been a problem. You talked about your cost leadership and how that has allowed you to be able to connect to locations that others don't wish to connect to. Is that cost leadership today under more pressure than it has been over the last 20 years? Will you be able to deliver and connect to the locations that you would otherwise like to connect to, which may no longer be viable for you to do so? How much pressure is there on your cost leadership today?
Well, we talked about this earlier. This FDTL regulation puts pressure. I mean, we have an ATR fleet that is under tremendous pressure because of this new FDTL regulation. Suddenly, many markets from being profitable have become unprofitable. And I think there needs to be a discourse amongst all the stakeholders to see we need to fundamentally change a few things for the industry to prosper. And the responsibility does not lie only on airlines. And the reason I brought up airfares is because every time the fare goes up, guess who gets the beating? It's the airlines. Nobody ever talks about all the other elements of that airfare. So we try. I mean, we have been working with the government and they've been very supportive. But we need to keep working on this thing to make sure that the ecosystem in India in totality competes with the best in the world. And then, of course, we will, the opportunities there.
So given where things currently are, as far as taxation and other charges are concerned, your own profitability has been under strain, 2 consecutive quarters of losses. Of course, the operational performance still continues to be robust. But if this were to continue, and we've got plenty of examples of Indian aviation, which unfortunately has been a graveyard of airlines, are we looking more vulnerable today from an industry standpoint? And there's barely a handful left.
Like I said, the industry, Shireen, will remain under pressure till we make some fundamental changes. And I think all the stakeholders need to have a deep look into this and see what can be done. You can't have a situation where aviation in India is increasingly considered infrastructure and a public utility. And yet when it comes to taxes, it's seen as an elitist mode of transport. Right? We carry more first-time flyers than ever before on a daily basis. And I think we just, like I said, we need to review this.
In 2005, India's aviation industry saw the emergence of a new player, a startup that would rewrite the rules of the airline business and defy the odds of survival in a sector that seen the demise of several private airlines. 20 years on, Indigo Airlines is India's largest airline with an overwhelming 66% market share, fleet size of more than 400 aircraft, annual revenue in FY26 of 10 billion, delivering profits in a sector that's been marred by airlines losing money, with the aspiration of being India's most formidable international airline. But what was considered its competitive advantage, its scale, is being seen as a vulnerability for the sector in light of the collapse of its operations in December of 2025, which forced the regulator to step in with penalties and restrictions. While operations have normalized, winning back customer trust and regulatory confidence is among the key challenges for the airline as it starts its third decade of connecting Indians. Joining me now to talk about Indigo's flight path is its co-founder, its interim CEO, and its managing director, Rahul Bhatia. Rahul, it's great to have you back on CNBC TV 18. Many thanks. We don't really get a chance to speak to you very often, so it's good to have you speak to us today. Congratulations are in order as you complete 20 years. And as I said, Indigo's had many important milestones, not just for the airline, but for the Indian aviation sector as well. It's sad, though, that it coincides with what happened in December of 2025, forcing you to come back to manage the airline. Is that a regret?
So, you talked about 66% market share and the footprint. Can we talk about that a little bit?
Yes.
Because I think this is something the company has failed in sort of educating the world. So 34% of, actually 1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in, we only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure, we are able to experiment and the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing for the sake of the country.
I'll pick up on your words. You're saying you're being badgered for your size and scale today. That was not the case up until December 2025. People were not going after Indigo. Of course, the times when you saw the prices spike and so on and so forth, that was the case, but that was the case in the natural course of things. This badgering, the fear of a monopoly, the fear of this emerging as a national vulnerability has only started post what happened in December, which was a debacle. There's no other way to sort of put it. That's where I wanted to push you a little bit. You talked about cost optimization and why that gives you the ability to fly to routes that other people can fly to but choose not to fly to. Are there limits to this lean, mean machine that you've operated for 20 years? And were those limits really tested in December?
No, I mean, I've gone on record to say that December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. But I think there was a confluence of several different things that came together, and then the cookie crumbled. There was implementation of FDTL. We went through a massive upgrade on our entire fleet. A couple of days before that, there was, I think, volcanic ash. There were several things that came together, and that sort of, broke the back of the camel. But talking about disruptions, the disruption in Indigo was not unique. It was not something that's happened for the first time anywhere in the world. You've had some of the some carriers larger than Indigo that have been through issues like that, Southwest, Ryanair, JetBlue. I mean, there's a long list of these things. Is this something that we wanted? No, of course not. But it happened, and we took corrective action, and we were back up and running in, I think, 2 or 3 days.
Yes, operations have normalized, but let's talk a little bit about what you've been able to change. There have, of course, been leadership changes. As I pointed out, you have come back as interim CEO. Billy Walsh will take over as the new CEO. You've had other changes. You've got a new CHRO, you've got a new CFO, you've got a new Chief Strategy and Transformation Officer. How much of what we saw happen in December was a result of poor management decisions, a leadership issue, and hence you believe that the leadership changes that you've been able to bring in will help address some of those challenges?
I think the changes that we have seen over the last 3 or 4 months, some of them have to do in preparing this company for the future. Some of them have to do with holding some people accountable for what happened in December. It's a mix. It's not about one thing or the other. It's really taking stock of what happened that should not have happened, and also building resilience in the organization for the future.
Regulatory confidence, and that is going to be key now as you start your third decade of operation. And at this point in time, it's pretty evident that the government is concerned about the so-called monopoly that you enjoy, the 66% market share that we just spoke of. The Civil Aviation Minister in Lok Sabha has gone on record to say that India needs more airlines. He believes that we need 5 more airlines, and he believes that India cannot be, quote unquote, I'm paraphrasing what he says, cannot be held hostage by one large airline. How do you win back regulatory confidence? You've also got the Competition Commission looking at issues of violation of dominance. You have, of course, proposed a competition settlement. How do you win back regulatory trust?
So in terms of sort of our operational resilience, I'd say this fairly confidently, that if you went under the covers of this airline,